Hello everyone, this is Teddy Keckstead from Forex Trading Unlocked, and we are here with a weekly analysis for the week ahead of November 29th through December 3rd. Before we get into this weekly analysis, we want to have our disclaimer here for you, just to remind you that this webinar is for illustrative and educational purposes only. And if you wouldn't mind, also check out the book, High Probable Japanese Candlestick Patterns, written by myself, Theodore Keckstead. And make sure that if you haven't done so already, subscribe to our YouTube channel, Forex Trading Unlocked, or our Twitch channel, Forex Trading Unlocked, and make sure you like and share our videos as well, if you wouldn't mind, to help us grow the FTU Army. All right, let's go to our live action screen here. We'll take off the broadcaster, and where is our chart? We had our chart up here. All right, that's not it. There we go. All right, now we got the right chart. Okay, so Doge USD. Well, we're going to get back to the Doge USD, but first we're going to go to Dixie. Dollar index, as you can see, took a beating on Friday. What happened? Well, I'll tell you what happened. The dollar really got hit hard in the euro, and also by the pound and by the Swiss and by the yen. All the major currencies around the globe really hit the dollar took one on the chin pretty hard from each one of them. So as you can see, this is the largest downside move that we've had in months. Now we are coming off of a multi-month high from 2 days prior, so now be very cautious getting caught up in the selling frenzy. There's a lot of global news that is indicating a lot of COVID resurgence, obviously, with these variants. We know there's all kinds of lockdown measures that are popping into place. I would use caution no matter what. First of all, look at this as a dollar correction at first. And let's see how things line up as we get into our other Forex markets. So if you take the recent swing low up to this recent swing high that just happened just a few trading days ago, we'll take our 50% level right here and our 0.618 to see how far the dollar index could fall down. Now this is important because especially for like the euro and the pound, if they have relevant buy signals and target areas that kind of line up with this dollar index support target, that would help to give us a gauge as far as the new trend, as far as how much momentum is there possible in this current bearish slide. The overall trend, remember, for the dollar is a bull. 1 day does not a bear market make, okay? So be very cautious. Now, there's been definitely, if you were on the right side of these trades from last Friday, you are a happy camper going into Sunday evening's trade. I would not expect very much. Remember, the U.S. is coming off a holiday. Now, let's see what's going on. All right. Okay, so as you can see, the dollar index, the biggest element of that cross rate is the euro US dollar. Okay, as you can see, technicals obviously have it in the sell zone. Performance, except for on a 1 week basis, has been negative year to date, over the past year, 3 months, 6 months, blah blah blah. So the trend is obviously bearish. Indicators are oversold. What do we have here though? We have a high probable Japanese candlestick pattern that was confirmed on Friday's trade. Now, if you'll notice the little arrow there, that is Friday. It's a 3-day pattern that started from the low that was set on Wednesday. Thursday, you had a harami buy. It's a short-term buy pattern. It's usually meant more of a pause for a cause than a trend change. Now, this 3 inside up buy signal, however, that does signal a very likely change in trend. So what does that mean here? Well, that means that the buy signal level is the close from Friday, and we need to move. Let's move this over a little bit. Okay. And here's our stop. 111.83 right here. This here is our stop level area. So if you look at your risk, now obviously if we fell below 111.83, that would mean a new swing low. Obviously, right now, we are coming off of a newer swing low, looking to make a higher move high, if this buy signal is valid. So, if that buy signal is valid, definitely you're probably going to see a lot of stops resting around this 113.74 for all your weak shorts. Any any rise above 113.74, most likely momentum will build very strongly over at least 1 to 2 to maybe even 5 trading sessions, driving up this currency cross up towards 115.29. Now this is where you found a lot of support before we failed and had this big slide right here. Remember, support usually becomes resistance. Resistance usually becomes support, typically when you have valid swing target areas. Right now, we have an upside target level here, buy signal looking for a rally up towards this area to begin with. So 115.29 puts us right up against this, what had been support. Expect this to be a very strong resistance area. Now, does it mean that we're not going to pierce it? Absolutely not. But most likely, you're going to see a lot of chopping going on around this level should we manifest this rally over the next few trading sessions. So right now, 3 inside out buy signal. If you want to learn how to trade this buy signal pattern, once again, go check out the book, High Probable Japanese Candlestick Patterns, which is available on Amazon.com. And you can get it in Kindle and paperback versions, soon to have a hardcover version of it coming out. So, and if you want to find out where to get that book, I'll give you a link right now that you can send to your friends and stuff. All right, give me 1 second here. We're pulling up our streaming, and that doesn't pull in. Okay, we got 2 viewers on Twitch, so we're going to send this link out to you guys just in case you want to learn how to trade these patterns. Here's a link to the Amazon for the book. All right. Okay, and by the way, for those of you that are on Twitch right now watching us, if you wouldn't mind liking and sharing our video right now, we would really appreciate it as well. All right, so let me send out this link on to you on YouTube. Okay, so you guys got the link. All right, so once again, if you want to learn how to trade a 3 inside out buy signal, you can read about it in the book, or you can watch this trade manifest over the next few sessions and see if it works. Now, interestingly enough, today we have a couple other buy and sell signal patterns emerging. We also have a continuation pattern. These are all patterns that will follow through with this short-term turn in the US dollar. So are we calling for a top from the past couple sessions ago? Short-term, yes. Are we bearish? Short-term, yes. We are definitely looking for a little more follow-through because the euro right now has got a buy signal. So that would be negative for the dollar index because the euro is the #1 component in the dollar index. Now, let's go to British pound, US dollar. Let's see what's going on here. So let's say the dollar index really is making a turn. It's very likely that with these other currencies that have reversed in a big way, that the pound may at least stay neutral. So if it's coming off of a lower move low, it's the currency that definitely, while the other ones were turning already a couple days ahead of time, the pound had not done so. But it did set a lower move low, settled positive on the day. So we're looking for possibly, if we have a correction from a Fibonacci basis, we have your 50% to 0.618 right here in this area. This would be a nice little corrective area for the pound to gravitate to. That would also fall in line with the dollar index. Remember, with the dollar index is the biggest components is the euro and the pound. So the euro already has a buy signal, kind of looking for a corrective area that would line up with the dollar index falling into that area that we had indicated from the beginning of this webinar. The British pound US dollar, should this correct to the upside and roll with the momentum of the other global currencies against the dollar, then we would say that most likely you can see a pop up to this 135.55 to 136.21 area. This is where you can see we had found support once again also in this market, and you see where a lot of consolidation happened, right, especially at the upper part of this range. Once again, this would be a perfect scenario for this market to correct up to this area here. Doesn't mean we're going to set a big bull rally going on for the long term, but definitely in the short run, we have a good potential to rally up to this area, probably set a range trade at that point going into 2022. Reason being is we have some, I mean, obviously COVID's on the resurgence. The question is, how much are the lockdowns globally going to influence things? Is trade going to slow down even more again? Is international travel restrictions going to start to come back after just having been opened up? I mean, people from the U.S. are finally allowed to go to Europe. Now all of a sudden they're locking down again. So what impact will this have on the economy and other currencies? This would also pan out where if we do get this correction right now against the dollar right now, meaning dollar bears and bullish to major currencies going into the end of the fourth quarter, the end of 2021, by 2022 we manifest, if we are, excuse me, not manifest, if we mainly are trading in this area right here for the pound and like the euro and the dollar index consolidating on those pivot points, that would give us the area to either base, where the dollar will gain a lot of strength and all of a sudden have the big momentum going off to kick off the new year, or it's the pause before the dollar really starts to take a tumble in the beginning of 2022. We do have a lot of things to look forward to in a negative capacity, which is, I guess, no matter what, we know it's on the horizon. Chinese tensions globally are growing. The odds of them invading Taiwan and making an attack on them at the very least are very likely. This is not a conspiracy thing. We know that their military drills, if you will, tests have been pushing the gauntlet. And now with North Korea also, I would be very leery of strength as far as with the yen. Even the Australian dollar is going to be very tenuous at best. So we're going to see a lot of swinging going on, and we'll have dollar strength in certain currencies. The question is, will it be a dollar bull all across the board, or will the dollar be under siege? And it's going to be very interesting. It's going to, as a currency trader, I can't even begin to tell you. If you think that we saw some swings over the last year and a half, from my experience with what's going on, I would say that 2022 aims to please on as far as volatility for currency traders. I'm not saying it's going to be an easy ride, but I definitely don't think we are going to have a range trade market, which we have had for sure in the past. Like, that's something we have not had for a couple years now, where the trends in the currencies will remain, I think, where we are definitely going to have sweeping trends, which is nice, especially when you trade something like the British pound US dollar. Speaking of the pound US dollar, let's go a little precursor to some other currencies. British pound AUD. This is something that exploded to the upside. Now, isn't it interesting? The pound set a low, short-term low versus the dollar, and settled positive, but is at the bottom of a trending lower move. To try and say that its bottom is really hard. But look at this. British pound has had strength against the Australian dollar for a while, and the Australian dollar is falling very hard against the dollar. So that's where you're seeing this very interesting show of strength. So the pound has strength versus global currencies. That's why I think that yes, on Friday's positive close there and very tight range, that we may see a big move to the upside sometime between Sunday night tonight and into Monday afternoon tomorrow. So right now you're seeing strength here in the pound, weakness in the Australia. Wait till we get to the Australian dollar currency cross. You'll see why. All right, now let's go to the US dollar CHF. This one, talk about, I mean, it was trending higher, just bobbling here with this double topping, and now shabam, boom, did this get whacked on Friday. We're coming off of this higher move high from this recent uptrend. Talk about how I always say markets go out like they come in. Wow, the steepness of this slope. In one day, we came all the way down to 92.14. I would key off of these levels. The Swiss could be range bound. If you look at how it's been swinging, this just hit the upper parameter of where resistance seems to be very strong, and all of a sudden in one day it came down to where support seems to be there. Like, this has been an area where, as you can see, resistance, then boom, it comes up, becomes support, holds support, and then boom, fails. This is the explosive level above we're right in the middle of this pivot point range. So I would key off of the low from Friday. If we take out this 93.73, then that means the US dollar is a bull, probably versus all the other markets as well. Until that situation arises, it could be a big choppy range trade here for the US dollar Swiss. We don't have a signal here. We have a very, very bearish slide that happened on Friday, but we're coming off of a higher move high. The trend is, no matter what, a bull. We do not have a reason, even though we had this violent sell-off, to be on the bandwagon. And the Swiss may be overdone. Think about this. I've been talking about this for weeks, even on some of the excerpts I do on tfnn.com on Wednesday mornings at 8:40 Central Standard Time. I'm their Forex consigliere, if you will. We talk about also the different futures markets and equity markets. And one thing I've been stressing that's been a dynamic that most of the pundits don't talk about is the volatility in the as far as range for the Swiss has been so much more than the euro on any given day over the past 4 to 5 months now. Now, relative to the pound, in that relationship, it's definitely larger, but no matter what, the Swiss is hard to outpace the pound and is in a range on any given day because the pound just has it's one of the widest range currencies out there to begin with, even when it has a tight day. But that being said, Friday is a day where you have to wonder. It's like uses that famous Greenspan term. Is it irrational exuberance as far as what happened with the selling off on that market that day? Overall, the Swiss is a flight to quality currency. Now, this is where you have to look at this, where if the dollar truly is setting a short-term top, meaning it's going to trend lower for the next few sessions to maybe even the next few weeks into the end of the year, that means it would lose a lot of ground versus the Swiss. Remember, the Swiss, the flight to quality currencies out there, number one is the US dollar. Then it goes by your trade zones, where the Swiss is for the European trade zone, especially now that the UK, remember, the pound has still always existed during when it was part of the EU. They had a sovereign currency, but it was part of the EU. Now, because of Brexit, the UK is now solely on its own. And the EU no longer has the backing of the UK as far as on a monetary support level. So that's different. And there's a difference and indifference that now exists once again in the European trade zone. That being said, the Swiss is a flight to quality currency. It's the one neutral currency there, and it's definitely the flight to quality. It's a currency of economic strength. So be very cautious being bearish on the US dollar Swiss. This market right now is in an overall bullish trend. Just because it is having a short-term violent sell-off of one trading day does not just mean that we are now bearish this market, especially even if the dollar is a bear versus all the other currencies. Be cautious, because when the dollar turns back to even just a bullish correction based on no matter how far it falls, whether it really tanks and drops significantly over the next few sessions, the next few weeks, or if this is truly just a short-term bearish correction, whenever this dollar does turn again bullish, this US dollar Swiss most likely will violently turn to the upside. Don't discount the fact that you could have a bullish run like we've had back in this little area here. So real quick, I just want to see on Twitch, do we have any questions? All right, we have a couple viewers, but we don't have any questions out there, but that's all right. So we just want to make sure that for those of you that are doing it, that are watching this, that you are giving us a little shout out and a little tweet, if you don't mind. We would appreciate it. All right, so US dollar Swiss range trade, and as you can see on the technicals, neutral. Overall performance very strong, once again confirming that the US dollar Swiss is in an overall bullish market. Right now, it's in a negative way just because of the violent sell-off. Like we're talking, it absorbed a lot of trading range in just one session. But remember, that's because of the news that's hitting the market. I think that algos, and it was a holiday market. One thing, if you look at my my interview on tfnn.com on last Wednesday prior to the holiday, I warned all their viewers, and I always stress this from all the years in the business. When it comes to holiday markets, take the day off. It's a holiday. It doesn't matter that the machines are on. Stay away. Now, if you have a position, you have to monitor and adjust it. You do what you would normally do. You discount the fact that it's a holiday. But you do whatever happens, happens. Do not enter a trade in a holiday market unless you absolutely are following a systematic system that you need to do that. Otherwise, stay away because violent moves happen erratically because of very thin volumes. So, but anyhow, remember, if you treat trading like gambling, like trading holidays is gambling, then you're going to have a gambler's results. If you treat trading like a business, which you should because it is, you won't trade on holidays. You will only maintain positions because you are aware of the fact that, oh, look, here was Friday's trade. Everyone in America is on vacation. Look at what happened. Let's look on the hourly basis when this all happened, too. Here's American hours here, right here. This is the late, this is the afternoon. Here's the morning. This is when everyone's sleeping in America, and then they wake up, and then there's that the market's closed. Yeah, this is this erosion overnight from Thanksgiving on into the Friday's trade right there. Everyone in America is closed. Asia was open. Europe opens. They slam the hell out of this currency. Big sell off. Machines start kicking in. You can see on any given hours lots of erratic spike. Look at this. Down, 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 almost replaced the whole thing. I mean, this is all algo trading. You should not be involved. So, all right, irony of it all, we have our next high probable Japanese candlestick pattern. This is now considered a 3 inside down. This is the opposite of the euro US dollar signal, which was a 3 inside up buy signal. Remember, so this is where you rally into a high. The following day is actually a pause for the cause short-term sell signal. But usually it's more of a neutral where you get choppy, where you hit support. You don't really sell off, like definitely not like this typically. But when you do have this, that's when it becomes a 3 inside down sell signal. Now usually when you have a 3 inside down, it would settle somewhere around this area here, maybe even down to even 114. But to have such an extreme break like this and settle near its low, that is a wowzer. So if you happen to be the short-term pessimist, which taking the low-risk sell against the high from Wednesday with this Harami sell signal on Thursday afternoon, boy, did you get a lot of bang for your buck. You know, like this is where you look at the close of the next day as you roll into the weekend being like, wow, that just really made up for a couple of losers in the past because you already blew through all your price. You already hit your initial short-term downside target level. Now, and that would be just from the Harami sell signal. Now you have this one. This sell signal level here is all the way at 113.21 starting off our week, especially if the market opens a little higher above here. You have a really good chance to catch one more wave lower down towards this 112.34 to 111.57 area. This would be the initial downside target range. Remember, the US dollar yen is in a very big bull market. So if this is just a short-term dollar correction, it's going to be really tough to get the US dollar yen below 111.57. The only way that you're going to possibly see this is if you have a really big rally in the interest rate market in the United States in the 30-year and the 10-year, and a huge sell-off in oil. Now, why are we going to talk about the interest rates in oil markets? Well, because they actually have an impact on the U.S. dollar yen trade. Oil has a big influence on the Japanese yen. And then the fact about interest rates is another thing also. Now, interest rates are a function of currency pricing. So for all of you people out there that are like, why is he always talking about interest rates? Well, I'm going to keep on hammering it in your head that because interest rates are a factor and a variable of currency pricing. So for US dollar, it would be the US 30-year Treasury bond and the US 10-year notes. Now, the pundits will have you look at the 10-year the most. However, the 30-year bonds are really the market you need to watch the most when it comes to interest rates. As you can see, the bonds had a huge rally on Friday. Okay, now they're coming off of a low set on Thursday. So this started here on Thursday, trading at around 159 handle right here. They settled at 162.28. That's just below 163. For those of you that are not futures traders or treasury bond traders, that is a big, significant move in the bond market to have over the course of 2 days, also in a holiday market, okay? This happened going into the close, all right, of the week. Now, if you have a radical move like that, meaning interest rate market goes up in price, that means interest rates go down. Okay, there's an inverse relationship between which direction interest rates go and interest rate derivatives or cash markets trade. Okay, so it's an inverse relationship. So when bond prices or 10-year note prices go up, the rates go down, and conversely, when those markets go down, interest rates go up. So right now, that means that when interest rates are going down, that puts a lot of pressure on the U.S. dollar. The U.S. dollar becomes bearish. Get that? All right, so we have confirmation from the 30-year note. The 10-year would also be very similar. We'll go to this one. And once again, from our navigation bar, you can get this information. Now, futures markets are always delayed every day. You can't have them live like we have in real time. All our Forex data is in real time. And we have other equity in certain markets that are in real time or close to real time because we can by law. But with futures markets, you have to pay for the data. Otherwise, it has to be in delay. Just to remind you of why that is what it is. So we went to futures to get to the 30-year and the 10-year note, in which we can look at it once again. So we looked at the 30-year, now we're going to look at the 10-year just so you can see, once again, confirmation of interest rate movement set on the weekly. We'll go to the daily. This one as well. Now this one set, look at this. This here is also a high probable Japanese candlestick bottom. Now this one, as you can see, is coming off of a lower move low. This is divergence in the interest rate market. Okay, this is huge. I need you to understand what's going on here. This is a big buy signal. So this is bearish for the dollar in the short run. Okay, this interest rate rally here is huge. Remember how I said that it went from 159 to 163 almost? That's a $4 move. Here's 129.15. So that's basically right in the middle of that price handle of 129. Went all the way up to a high of 131.10. That's almost a full that would be a whole $2 move in the 10-year. Now the 10-year is a shorter term rate than the 30-year move, so it doesn't move as much in dynamics, so it won't have as big of a move. So in other words, you'll have a price move that's bigger in the 30-year than you will in the 10-year. Now, once again, both of these put a short-term bottom in. That is just like the dollar index. Remember the dollar index? It had topped out. Look at this. Just like how those interest rates, they did it's an upside down chart almost. This market turned radically, as you can see, this big sell-off that coincides with the interest rate. So the pricing is there. You have the confirmation of all these trends that we've been talking about, okay? So that is huge, all right? That brings us back to the U.S. dollar JPY. So we have the dollar index, which is supporting the sell-off in the U.S. dollar yen, meaning that it's very likely that we can get down below this 112.34 and pressure this 111.57 area, okay? Then we have oil, which we're going to bring up now. Let's see what's happening with this one. This is the one where it's also dictating a lot of what's going on with the trade going on with the U.S. dollar yen. So we go back to the markets tab here. We're going to go to our commodities page here. Now here we have a listing of all kinds of grains, meats, energies. Right here you go to crude oil, and this will pull up the chart necessary to take a look. Look at this. Look at this sell-off. This is huge. We have not hit. Look at the price of oil in one trading session. Look at what happened. Look at that. We went from that's a $10 move. This is a huge sell-off. I've been calling for $100 a barrel oil for a while. This is now this is where you got to use caution. Watch out. If the oil market snaps back, which I think it will, this is because of the whole Biden pushing out the U.S. reserves. What you don't understand, and which the media always downplays, is that when we touch the reserves, it doesn't mean a thing as far as gas pricing. It is so nominal when you look at the consumption for on a national level that it is just a speed bump. You're talking about a penny for a day, literally. And I mean, that's a little extreme, but it's a little more than a penny for a day. But it's what it means. This is all news reactionary, guaranteeing right now you have all these bears. This was a perfect profit-taking time for people that have been long, okay? So believe me, this isn't heavy shorting. This is people taking profits, and you have a lot of, I'm sure, buying pressure that people are willing to take some heat on this trade because the oil is in a bull market. This is just a short-term sell-off, and this will be where I think you're going to see a consolidation of oil first. You're going to see the interest rates continue to rally, meaning interest rate pricing going down. This will put pressure on the U.S. dollar, which once again, this bodes well for the yen. Now, if oil stabilizes, this is about where you're going to see the U.S. dollar yen sell off to. It's most likely not going to continue lower unless you see an extreme rally in the bonds, which in the 10-year, which I don't think you're going to see. I think you're going to see a continuation to the upside, a little follow through, but not much over the next couple of sessions to even couple weeks. Only if you have a radical trend follow through in those markets would you see the U.S. dollar yen most likely get down to this 109.32 area down around here. So it's a very good market to trade. Expect a lot of swings. If you are short, or if you're short selling into this market today, sometime tonight or tomorrow, somewhere around the 113.21 or higher, will be a great area to catch another slip down towards this area over here. All right, now let's look at the AUD/US dollar. All right, well, with the crashing price of oil, that doesn't help Australian dollar. With the rallying interest rates, however, it should, but it's not. So in this case, why is Australian dollar, US dollar falling to through the floor right now? I mean, we're looking at hitting multi-month lows no matter what, and we almost hit them on Friday. So, overzealous sell-off because of the American markets being closed, possibly. The sell-off in oil definitely is adding fuel to the fire for this one. Once again, the interest rates should be causing us to slow down and not be like this, but it's not. So since we don't have that neutralizing of impact, it has to be the lockdowns and what's going on there. So Australian dollar, US dollar, forget about it. We had this big rally up here that ended at the end of October. This slide that we've had through the whole month of November, this is not that steep of a slope. Granted, Friday was a very harsh sell-off, but I think that what you are seeing here is just the beginning of something that's going to continue longer. The overall trend here is lower. If we take out this multi-month low here, we're treading right above key support right here at the 70-cent level. Anything below 70 cents has us trending down towards 65, and I wouldn't doubt that if these lockdowns persist, that this low here in 2020 and during the height of COVID here, where we got down to this 55-cent area, we could see this level here again, and we could see this level probably by springtime. So right now you're looking at a very good chance that it's a sell rally forecast. If you can get a chance to sell it higher than it's settled at on Friday, it's a low risk sell. And as far as how far can you ride this trade, if you are already short and you work it, I would say you have the potential to ride this trend lower for the next not just 3 to 5 trading sessions, but at least the next 3 to 5 trading weeks, if not maybe even the next 3 to 5 trading months. That would put you out to, let's go March 14th. Let's go out to March 28th. So 3 months from now, we could literally be down here, somewhere in this range. This is our target right here for Australian dollar, US dollar. Especially as tensions with China seem to grow globally, and if they really do start to kick up their heels militarily, which we think they will, you're going to see that continue. Now, in the same trade zone, New Zealand dollar, US dollar, as you can see, this one is not in the same necessary trend that Australian dollar has been in. Short term, yes, it is bearish. Short term, it is definitely very negative. The momentum is very strong. It is not as bearish as Australian dollar, US dollar. We do believe that you're going to see newer move lows over the next 3 to 5 trading.
Welcome to our webinar, and thank you for taking the time out of your busy day to join us. We're in the Chicago area, and I see that we have attendees from all over the country joining us today. Welcome. and we're happy to partner again with one of our most popular speakers and a professional trader with over 30 years of experience to bring you this option trading webinar today on Kick Off Your Fall with Backspread Option Strategies. My name is Gina Bocayas, and I'm on the management team of Regal Securities, which is the parent company of eOption and its sister company InvestTrade. The session today will last approximately 1 hour. Our speaker will talk for around 45 minutes, and the remaining 15 minutes will be used to answer all of your questions. We ask that you look now to locate the Q&A box on your screen. If you have any questions during the webinar presentation, please feel free to type them into the Q&A box, and our speaker will answer those at the end of his presentation. We ask that you use the Q&A box and not the chat box, as our speaker will only see what's in the Q&A box. And you can access the recording of the webinar tomorrow on our YouTube channel, so make sure you subscribe so you can have access to it as soon as it's live. And you can go to youtube.com/eoption and hit subscribe, and you'll get all of our content as soon as it becomes available. And we recently revamped our entire YouTube channel, and you'll find trading education on there and playlists for whatever you're interested in, no matter if you're a beginner or more advanced option trader. We also encourage you to visit our website at www.eoption.com, where you'll find all kinds of educational material, as well as all of our past webinars and videos. So I'd like to turn our attention to our speaker, Teddy Keckstadt. Teddy has over 30 years of trading experience, and you'll see shortly how he's very passionate about trading and educating others. He's currently the president of Forex Trading Unlocked and the author of the book High Probable Japanese Candlestick Patterns. Some of you may recognize his name from past webinars he's done with us, and we're happy to welcome him back today. So without further ado, I'll turn it over to Teddy Keckstadt. Thank you.
Thank you, Gina, for that introduction, and thank you everyone from eOption for sponsoring this today and all the attendees. All right, so let's get our webinar started here. Kick off your fall with backspread option strategies. All right, I already had the introduction from Gina, so we'll skip over that one. And all you bulls and bears out there, let's get ready. But first, let's take care of our disclaimer. Just want to remind you once again that this webinar is for illustrative and educational purposes only. And since I'm doing the webinar, I always put up my company disclaimer as well, pretty similar. Okay, the parts, let's get into it right now. So the stocks, underlying asset, we'll be using those, some names that you're very familiar with. Call options, the right to buy an asset at a fixed price. We'll be talking about call options today. Put options, the right to sell an asset at a fixed price. We'll be talking about those as well. The length of time before option expiration will be a topic also for our study of backspreads today. Expected length of a backspread option trade. We will talk about how you incorporate that into your different trading strategies or goals for your investments and trades that you're placing in the equity markets. How to integrate backspread option strategies into your trading plan will be focused mostly towards the end after we get the moving parts all explained. What is the proper way to manage the spreads as they expire is also something we will talk about. Everybody has expiration anxiety. There's no reason to have that. Especially when we're talking about very fundamental basic strategies such as what we are talking about today. So take advantage of spreads and directional option trades at the same time. That's another useful thing that you can use with the back spreads, whether they are the call or the put back spreads. Okay, how do you make and lose money? Everybody wants to know that right off the bat. So just for those of you that are super beginners to those of you that are not, we just want to make sure everybody's on the same page here. Okay, when you buy a stock or underlying asset, ETF, what have you, and the market goes up, you profit. Everyone pretty much has that one down. When you buy a call and the market goes up, you profit from the price of the call option going up in value. Now, at the same time, you will have time decay, but as the market goes up, typically it overrides the time decay, so that will put you at a profit. When you buy a put and the market goes down, you profit. It's the same thing as a call, but in reverse. When the market's going down and you own a put, you profit as the market goes down because the value of that put goes up in price as well. Although remember, there is a time decay also that is working against you whenever you own an option. Now, when you buy a stock or underlying asset and the market goes down, you lose. Everyone pretty much is pretty familiar and understands that. Well, the same thing is if you buy a call and the market goes down, your risk of loss is defined, though. Remember, when you buy a call, the only amount of money you can lose when you purchase an option is the money that you paid for the option. There is no other risk. There is zero margin. There is nothing technical about it. It's pretty simple. You put the money up, you own it until expiration or until you decide to sell it before expiration. And your risk of loss is always defined. Remember that. When you buy a put and the market goes up, your risk of loss is also defined in a similar way. You only are at risking what you paid for the price of the put, or if you get out of it before expiration, what you paid for it minus what you sold it out for. But your risk of loss is always defined. Now, a call back spread is a bullish position. That will be one of our examples we'll be talking about today. And then we will also be talking about a put back spread also, which is a bearish position. So we're going to talk about how you can play both sides of the market depending on whether you are a bull or a bear. This webinar is not about trading signals. It's about implementing either a bullish or a bearish strategy at any given point with the back spread. Okay, so both back spreads are a combination of an outright option purchase of a call or a put plus a credit spread, which offsets the cost of the position typically to some degree, where you will end up putting this position on for either a slight credit or usually it's at a very small debit. Okay, so we'll get into those intricacies as we break down these trades. But once again, a back spread is a simple combination of an outright buying of a call and then a credit spread, or an outright purchasing of a put and a credit spread, And remember, the pricing is offset by the fact that between these two transactions, you will have either a slight debit or a slight credit. And we will get into what the risk is for each of these trades as we move forward. Okay. So back spread volatility strategies. So we're going to go over this before we get to the charts, and everything will start to get really clear. So for the first thing you got to remember is that back spreads are a volatility strategy. Okay, so what does that mean? It means that volatility, an increase in volatility typically will help your position. Okay, now for the call back spread, it starts by you selling one call and buying another call at a higher strike price, plus matching that higher call with, the higher strike price with another call. So that would give you a credit spread plus an outright call position, which when you put those together, they are called a back spread. And we'll get into all the intricacies of how you place these trades after we get through these parts. So why do you put on a call back spread? Your outlook is bullish, typically, especially if you are very bullish. Now, when would you be very bullish and why would you want to do something like this? So let's say you consider that there's a news event coming up and you think it's going to be very bullish for it. Whatever the news is going to come out, that it's going to be very bullish. So for instance, like an FDA approval of a miracle drug, which we know we have many of those out there right now, or some other patent pending or something like that. That would be a fantastic time to put on a call spread if you think the market's going up. You don't want to put risk into buying the stock, okay? And remember, your risk with this is definitely limited, okay? So why is your risk limited? Because remember, we have a credit spread and we have an outright option. So the outright call that you purchase is limited to only the cost of that option. Okay, so you already know right there, the most you could lose on that one half of the back spread is the cost of that call option. Then you have the credit spread, which you already take in a credit to begin with to initiate the transaction. So your risk is only the difference of the two strike prices of those two options minus the credit you already had taken in because you already have that money. So that difference is the only risk that you would be dealing with. And we'll get into that as we break down the trades with the different pricings. So once again, an increase in volatility helps this position. Why? Because you want volatility, you want market movement. If you have market movement and if it goes in the direction of your call back spread, then that aids the position as far as your pricing. So you will be making more money more quickly if volatility goes up and market movement goes your way. The only thing that does hurt you though is time erosion. Reason being is that you have a total of 2 net long calls that you own and 1 net short call that you are short. Now for the short position, the time decay is in your favor because you sold the option. So you want the option to go down in value whenever you have to purchase it back, if you should have to do so. However, for the 2 calls that you purchased, the time value will hurt them over time, especially as you start to get closer to expiration, because that's just what time does. It erodes it's a part of the pricing of the option. So that will be working against you, even if the market is working for you. So that's the one part of the calls that you have going against you that you have to be mindful of. So the put back spread is the same thing, but it is a bearish spread. This is where you use puts. And in this case, you will sell 1 put and then you will buy 2 puts at a lower price. Okay, so what you do to enter the trade you would first sell 1 put, sell 1 put and buy 1 put at a lower price. And then you would add 1 more lower price put at the same time, which would be your outright position. Okay, so you have your outlook, which is bearish. Your risk is limited. And why is the risk? Why is the risk limited? Sorry about that. Okay. The reason your risk is limited is because you already know that for your outright put, what you paid for that option, just like when in the first example, that's all the money you can lose. And then also on the credit spread, you would have already taken in a credit for the difference between selling the 1 put and buying 1 other put further out. So that credit minus the difference between the 2 strike prices would be the only thing that you would have as far as your risk that would be involved. Okay. Now, similarly to the back spread, an increase in volatility helps this position for the same reasons. And time erosion hurts the position for the same reasons as well. Okay. So now let's get into how to place the trades. Okay, for a call back spread, order number 1, you sell 1 call and purchase a call at a higher strike price. Okay, this is a credit spread. Then order number 2, you buy a second call at the same strike as the call purchased in order number 1. Okay, so remember, you're selling 1 call and then you're purchasing a call at a higher strike price. And we'll get into what's the difference in strikes that you're going to use for depending on the market or the underlying asset or stock that you're trading. That will be coming up in a few minutes. Okay, so once again, for a call back spread, your order number 1, and we'll go over this with the platform as well, is you will be selling 1 call and purchasing another call at a higher strike price, which is that is a credit spread. Now, these are in the same expiration month also, okay? So you're going to buy a second call at the same strike as the call purchased in order number 1. That's an outright call. So you will have a net position of owning 2 calls at a lower strike price and having sold 1 call at a you sold 2 calls at a higher strike price, and you will have bought 1 call or sold 1 call, sold 1 net call, bought 1 call at a higher strike price, which gives you your credit, plus the buying the second one, which gives you either a net credit or a net debit. So that gets back to when we first talked about the intricacies of this position will either cost you a slight debit or it will be a slight credit. So that if you're wrong about this position, which we'll get into also, or if you happen to do this at a credit and you're wrong on this position, it actually works in your favor, which is one nice bonus to if you do, or if you're wrong with this position. Okay, so for the put back spread, it is the same thing. You're going to order number 1 will be selling a put and then purchasing a put at a lower strike price. And this is your credit spread. That's the first half of your position. Your order number 2 will be buying a second put at the same strike as the put that you purchased in order number 1, which that's the lower strike price put. Okay. And once again, this will be done for either a net credit or a debit. Now you ask, well, what situation will bring this on? Well, this has to do with volatility for one. That's usually one of the biggest things. And also in relationship to how far you are initiating these put or call back spreads to the underlying asset price, because the call back spreads will be above the market price and the put back spreads will be below the market price. Okay, so now Why two orders for a call put back spreads? Okay, well, buying an outright call or a put is a beginner strategy. Placing a credit spread call or put is a beginner strategy. Back spreads on certain platforms are considered ratio spreads. Although there is a 2-to-1 ratio in a back spread, it is not a ratio spread. Okay. Now, this term gets totally confused because of depending on where you go and look at it. It's a converse ratio spread, really. Okay. So it's a reverse ratio spread. And the reason it's called a back spread is because of the combination of two trades, the purchase of one option and adding a credit spread simultaneously. 2-to-1 is a mathematical ratio, but it is not a ratio spread. It is a converse spread. Once again, any combination of more than 2-to-1 options is a real true ratio spread. 3-to-1, 4-to-1, 5-to-1, 5-to-2, etc. You get the idea. Real ratio spreads are for advanced traders only. They're totally different topics. Some of them have their own exotic names, but it gets very complicated, and it's something that you would have to have a very good understanding of a lot of variables when it comes to options to even get into them. Be very clear. Back spreads are a combination strategy and not a ratio spread. Confusion comes from non-industry explanations of this strategy. If back spreads were ratio spreads, then they would be no term back spreads. Back spreads let you know that there is only a 2-to-1 combination. And the difference is because there's no margin risk, and there's also there's defined risk with a back spread. You already know that you have the one outright call or put. You can only lose if you're wrong on that position, what you paid for that option. And then for the credit spread, then you can only lose the difference of the credit minus whatever the difference in strike prices is. So we're going to get into that as we get into our next slide. So absorb that. It's actually very simple. Remember that, yes, 2-to-1 is a ratio, but because it's a back spread, it's only a 2-to-1. So that's how you know. It comes from the trading floor. So you would know that if someone was selling or buying back spreads, they were only doing a 2-to-1 combination. Otherwise, it would be something called something else. Okay, now let's get into our next slide. Uber Technologies. Everyone's familiar with Uber. It's becoming a verb. So you know a company is, even if they're not successful, but they've done something if a name of a company becomes a verb. So once again, what kind of a strategy will we do here? So at the time of writing up this webinar, I looked at the November 19th expiration options. So in this situation with Uber Technologies, transportations were going down. The S&P 500 index was going down. So the broad outlook for just stocks and equities in general was a little bit bearish. So you have a choice. You can either be a bull saying, I like Uber, or you had some idea about some of the new announcements that were coming out, which definitely have changed the market, because right now Uber's trading at $45. At the time of this webinar, putting this slide together, was at $39. So very good for this example that we're talking about. So at the time, the outlook for a bullish trade for this back spread would be selling the 42.50 call at $1.81. So the 42.50 is this first strike price above where the market's trading, and then buying two calls at the 45 level. Now, when you enter it into the platform, you would be selling one 42.50 call, buying one 45 even call for a credit spread, and then you would be adding another 45 even call that you would be purchasing. At the time of this slide, a 49-cent debit would have been pretty much the transaction that you would have had for this one. Now, if you were bearish, thinking that this trend is your friend and it's going to continue to go lower, then you would be doing the puts back spread, which would have you selling the 37.50 put for $1.75. Remember, all options pricings are times 100. So $1.75 would be $175 credit you would get for that selling of that put. And then you would buy one call at the 135 even put rather, which would have cost around $1.06. So that would be $106. Okay. And then that would be your credit spread, where you would have that amount that would then offset the cost of buying one more 35 put at $1.06 or $106. which would then come out for a debit of 37 cents. Now you would put the put back spread on if you were bearish. You would put the call back spread on if you were bullish. Now here's another thing you could do too is if you own the stock, using the put back spread is a great way to hedge your investment. It's a way that you can absorb some of your depreciation of stock value over time during market swings, while giving yourself a very good bang for your buck in the event of a big market sell-off. And also, if you don't own the stock, it's a great way for you to take advantage of different swings in the market, whether they are bearish or bullish. So in this case situation, we're looking at the November 19th expiration, okay? So if the market rallies up into this area here, especially above $45, then that's above the second strike price. Well, in that case, those two calls that you bought here at the 42.50, or excuse me, the 45 even level, those calls would be in the money. So would the 42.50 one that you sold. So now everyone's, I'm sure, thinking, oh my gosh, I'm going to get exercised on. Well, typically you don't just get exercised on by a couple dollar move. You usually have to have a very extreme move. The one thing though is that you're offset by your 45. So no matter what, you have one that offsets the other. And typically in this situation, once you get to this point, you would just buy your credit spread back, in which case then you would be offsetting your loss on the option that you sold because you have another one that is in the money. Because right now, currently it's trading at, what is it, 45.50 or something like that. So in that case, you would have at the point, which is a great time to talk about this trade, is that we are crossing this threshold above $45. So when this option scenario was put together, as of now, we're trading above 45. So the 42.50 strike price, this option here that you sold has gone up in value too, because now it is over $2.50 in the money, whereas the new one's only 50 cents in the money. Okay. But remember, it's a credit spread. So when it comes to those two options, the only liability you have is the difference of the credit for the initial selling of one call and buying of one call here, which would have been, remember, that's your credit spread. So that's all that you can possibly lose. So, and then your other call is now worth more than you paid for it. So in this case scenario, having a bullish call back spread on, you would be in the money and you would be looking at having taken advantage of a market swing over the last couple of weeks without actually owning the underlying asset. Now, how about the bearish position? Well, obviously these puts here, and no matter what, this one you sold and the ones you bought, now they still have some value because they have time value going on. Remember, these are November 19th expirations. They still have 3 weeks before expiration, or excuse me, a month and 3 weeks before expiration, which that gets back to another thing, is that the time decay value that we talked about, because they're not expiring in October or in a couple weeks or in 3 weeks or so, the time value is not eroding that fast. So the value of these options and these spreads hasn't changed much because of the time value. The volatility, however, has definitely hit this particular stock, because now it's gone from, once again, trading at just below $40 to above $45. So, which then I think everyone can figure out the math on that, how much of an appreciation that is in just a period of, well, this is only a period of 9 days, 10 days. So right now we're going to go and take a look at the math so you got it all clear in your heads, and then we'll show you how it works on a trading platform. Okay, Uber back spreads, the bearish back spread. You are bearish the underlying asset. So in this case, you would sell one 37.50 put at 175, and you'd buy one 35 even strike price put at $1.06. Remember, these are the November 19th expiration options. This would yield you a credit of 69 cents or $69. And then you would then buy one 35 even put. Remember, that was a strike price that you bought for your credit spread, for around $1.06 as well. And that would leave you with a net debit of 37 cents or $37 to put on this whole position. So for $37 per spread, technically, which would be the combination of your credit spread and your additional put, it would come at a cost of $37 altogether. And the only risk that you would have on this spread altogether now would be, remember, once again, the 30s with the money that you had put up for your put, and then also the net difference on the from the credit of the initial of the credit spread between the initial selling of the put and buying of the lower put for that half of the position. Now, for the bullish back spread here, you are bullish the underlying asset. So in this case, you're like, oh, I know the market S&Ps are going down, Uber's trending lower, and all the transportation stocks are looking very, very bearish right now. But you're like, you know what, Tom, forget it. I like it, but I don't want to buy the stock. So you're like, let's do the bullish back spread and see what happens over the next month and a half to 2 months. So you sell one 42.50 call for $1.81, and then you buy 145 even call for $1.15 for a net credit of 66 cents. Then you buy 145 even call for $1.15 for a net debit of 49 cents or $49. Okay, so in this case, you are bullish and you want the market to go up, in which case it did for Uber, which was nice because it got above $45. So in this case right now, your bullish back spread would be profitable. And at this point, you could lay off the credit spread and just stay long the $145 call strike price option, which that's what I would suggest that you do. Main reason being is that at this point, you have a month, just not quite a month and a half, around a month and a half for of time value left in this option to ride this trend. So, and this would be a case where you can offset the credit spread. There's no difference in whether you offset it or not. It's just that you don't have to worry about the expiry, the exercise risk in case the market explodes. And where the only time you really have to worry about an option getting exercise, which it wouldn't matter because you have another one to offset it, in that difference of 250. So the only liable risk you ever have on that spread between that credit spread is the distance between 250 and $5 on 100 shares. But you remember, you also had the credit that came in already. And should this situation occur, remember, you're making a lot of money on the outright call that you are long. Okay, so now let's get into how do you enter it in the option platform. All right, so your ticket number one is your Uber credit spread trade. Okay, so you have your symbol Uber right here. Then you have your option sell to open one quantity. Then you have your option number two, buy to open one quantity. You have your expiration here, November 2021. And then you have your strike prices. Remember that you are selling the 37.50 put. You are buying the 35 even strike price lower put. Okay, both of these are marked as puts. Okay, now as far as the pricing and that you would get it off at, since you are selling the one option here, you'd be selling it at the bid, and here to buy to open, you would be buying it at the ask, and this would be the net debit here of 25 cents, or excuse me, a net credit of 25 cents or $25. And that is on this transaction for this half of the back spread. So by just doing this, it's only a credit spread. It becomes a back spread once you have your individual buy to open one quantity, same expiration, November month, 35 even strike price put. Remember to make sure your put is marked, and this is where you would be paying the 31 as well. You can see the price right here. So you would have this, and these are two simple trades that when combined, you have what is called a back spread. So remember, it is a combination of a credit spread and also an outright long option spread. Now you might say, well, why don't you just buy the two upper strike price calls and forget about selling the put? Well, yeah, you could do that, but here's the problem is if the market goes nowhere or it tanks, well, then you're out all the money that you would have paid for this call to open here and this buy to open call right here if you only did an outright buying two strike prices or two calls and forgetting about having initiated a credit spread first and then adding a second call. Okay, so to be clear, once again, for the e-option trading platform, it's a very simple platform to use. I've been using trading platforms for a very, very long time. Excuse me. And I've used everything from equity, options, stocks, futures, you name it. So this is a very simple order entry system. Once again, it shows you your pricing and what you will be paying and for when your entry is, and also very distinct and simple and clear to show you what you are doing. Remember, like here, and always whenever you're entering orders, make sure you look at what you're doing. So once again, like this is red, sell to open, your quantity is 1, just like here, option buy to open, quantity 1. You'd be surprised how people will nick a button or whatever. You never know. And just always be clear and look at these numbers before you hit enter. And once again, your expiration is a huge thing as well, for sure, that you have to make sure that you're on the same page for this transaction, or any transaction to begin with, but especially when you're dealing with multiple, with a credit spread and also an individual outright option. So I think we got enough of that. I think we're pretty clear on that. So let's go to the Uber example here once again. So remember, the market is now trading above 45. So the options that, remember your bullish outlook, that would have been a great position for those of you that if you had not owned the stock and you wanted to trade Uber and be long and be like, you know what, think about it. In the past 10 days, Uber went from 39 to above $45. Okay, so that is a more than 10% rally in less than 2 weeks. A 10% return on your money in 2 weeks is a lot of bang for your bucks, folks. I don't know what your base for comparison is, but, you know, I mean, it's definitely a very good ride in the marketplace, you know. So is it going to go higher than $45, 45 and keep going? Who knows? That's not the issue to really wonder about. But for this trade, you know that it was a very good way of playing this market, where had the market gone nowhere, or a collapse, for sure, you would only be out that small little debit on that trade versus being down the loss from owning the stock, which is for sure. Now, obviously, if you were bearish and you put on the, the put bear spread, back spread, you would still have some value because there's still a lot of time left. However, the what would be left in it would not be very much. So most likely you would just be leaving it on, or you could still lick your wounds and get out of it. But I'm sure you'd have to be careful with the pricing, because a lot of times when you're going that far out to liquidate a position for what it's going to cost you to get out of it, to get it back your little bit of money, you might as well, it's like a cheap lottery ticket, like, because just in case right now, if you have a big market sell-off, remember you have this November 19th expiration. Like right now, the market's gone up to $45, but this could be just a bullish correction before all of a sudden it joins the rest of the S&Ps and the rest of the stock market, which is trending lower. So we'll be mindful of these positions also. Like, once you hit them, pigs get fat and hogs get slaughtered. Once you have a chance to take a profit and just manage them properly, and be mindful of your time. Once again, November 19th seems like it's a far time away, but it isn't when it comes to options. Remember that right now, time decay is slow because we're still very far out. However, in a couple of weeks, it'll start to accelerate at a rapid rate until it gets closer to the last couple of weeks before expiration, where then there's not much time premium left. Then it's all about volatility. And once again, volatility is our friend for the callback spread. It typically helps the position. Same thing with the put position as well, if it goes in favor with that one. So now let's move on to Amazon. This is a big flyer. We use this for a lot of our examples in the webinars, because it's pretty much guaranteed that if on any given day that you look at Amazon, if you're going to be looking at it a couple of weeks later, the price will be at least a couple $100 away, you know, so people at least can see a valuation number there. Plus they can see how much these options cost. So be mindful of that when it comes to what you're trading. Okay. So once again, we're using November 19th expiration for the Amazon.com example. For our bullish outlook for a back spread, we would be doing simultaneously selling of the 33.80 strike price call for around $153.10, and buying 2 of the 33.90 calls for around $1.4805. So that's at $148.05 times 2. So that would be the net what you would be doing. However, remember, you would be placing them as selling 1 call, buying 1 call as a credit spread,
and buying another call simultaneously. It has a net effect of being long 2 calls and short 1. In this case, you would have a net debit of 143. Now, 143 always looks kind of like, oh, it's not that big of a number, but remember with options, it's times 100. So it's a big spread to put on as a debit spread. So if you don't have the money to trade the stock, you do have to have a lot of money still to trade these kinds of spreads for the options. Okay, the converse trade is the put-back spread. So in this case, we would be utilizing the 33.60 put and also the 33.50 put. In this case, you would be selling one of the 33.60 puts for 147.45, and you'd be buying two of the 33.50 puts for 144.85. Okay, now that would give you a net debit of 142.25. Remember, that's times 100. This is our bearish trade outlook. Now, where is Amazon today? Well, today, this is a nice thing. Uber went to the upside. Amazon went to the downside. Amazon is now trading at 3,307. So it's not down a lot, but it's down kind of like near the low of this last trading bar that we use for this example. So it is below our put strike prices. So in this case, our call back spread, if you were bullish Amazon at the time when this was put together, you'd be taking some heat. Now, you would still have value. And the nice thing is because Amazon options are so expensive that, yeah, if you were all of a sudden changing your mind on it, it probably would be good to not just leave it as a free trade, because there is a lot of money on the table because they're very expensive and priced very, very high. So you would have a lot of money left to get out of your bullish back spread, or you could leave it on thinking that, you know what, right now, Amazon's just in a short-term correction and it's going to go because, you know what, you got to buy that AWS web service and everything else. Amazon is a little engine that could, right? It just keeps on trucking along. So whatever your rationale, if you're bullish, that would be your decision. Now, as far as the puts, you're in a very good situation right now. You have the market is already putting you in the money, and the market is riding its short-term lows right now and is under pressure. So you have either a good leg up on the beginning of a nice slide in the marketplace, or you could take advantage of where it's at right now and exit these trades a winner. That's up to you. Remember, depending on why you are being bullish or why you are being bearish, I would always make sure that you are, besides knowing your risk, which we were teaching you how to know your risk for these positions, know why you're risking what you're risking. What is your profit objective? You should always have some sort of target in mind where if the market gets there, you will be satisfied with the return, or that's the return you're looking for that particular trade that you're putting on. So if the market yields it, time to react and take the money off the table. It's when people don't have a target objective that you typically hear them say, oh, I should have gotten out by this point. I should have gotten out at this point, like, oh, I knew it was going here and it did, and I didn't get out. Well, if you knew it was going, or if nobody knows where it's really going, but if you hit your target where that was what you were looking for it to go, you should at least take some profits or be mindful of what you do then and reevaluate your position. If anything, roll into a different position and adjust what you're originally doing. Okay, so let's go and break this down and see how we get this clear in your head. Amazon back spreads, the bearish back spread, you are bearish the underlying asset, which is Amazon.com. In this case, you would be selling 133.60 put for 147.45 and buying simultaneously 133.50 put for 144.85. So just like in our last example, or in our slide where we showed you the trading platform for e-option, this is the first one. You would be entering to sell one put here, remember, of November 19th expiration, and buying simultaneously one put here for a net credit of around 260. That would be the first entry that you would put in on the e-option platform. Your second order ticket would be to buy 133.50 put at around the same area where you had purchased the one from the credit spread, which would then give your total position a net debit of around $1.4225. Now, if you were bullish Amazon, and for this example, okay, you would have sold 133.80 call for around 153.10 and simultaneously bought 133.90 call for around 148.05 for a net credit of 505. Remember, this would be your first order ticket. This would be your credit spread. And then here would be your second order ticket, which once executed turns this credit spread into a back spread. So that would be buying 133.90 call for around $1.4805. This gives you a net debit for the whole transaction of around 143, which would be obviously once again 1,430. So this is how you put together back spreads. Remember, once again, that the key thing here for you is you don't want to pick an expiration date that's too short, something that's only 1 to 3 weeks. You want to be at least 30 to 45 days. You can go out even further to more like 60 days out, even a little bit further. Reason being is that if you are very bullish or very bearish, especially if it's a short-term outlook, like once again remember, if you were, say, for instance, for the callback spreads, if you were trading a number like an FDA announcement, okay, that would be a reason for you to put on your bullish back spread, which would be your buying or selling your one call strike price above the market and then picking another higher strike price above it to buy back, initiating your credit spread, followed up by purchasing one more call. And that's where you'll be looking for a big rally off of, say, an FDA number or a patent coming out, something such as that. And then remember, for instance, like here in Amazon.com, we had this position here where, for instance, let's say you're not bullish Amazon.com, but you own Amazon.com and you're like, you know what? I've been riding the Amazon train for 10 years and I am not letting go. But you know what? The NASDAQ's under pressure. The S&Ps are under pressure. Economy looks like it might be slowing down. Costs are going up, blah, whatever. You're like, I think I need to figure out how to hedge my Amazon position. Well, that's what you would be doing. And we're going to get to questions after this final comment. You would be putting on this bearish put spread, back spread rather, where in this case scenario where the market had just sold off a little bit, you could either exit your hedge or you could leave it on for a little bit longer. You have until November 19th. Now, should the market rally and accelerate above where it was originally, then you're making your money on the rally in Amazon.com and you were covered in case there was a big sell-off. But right now, between coronaviruses, containers, shipments, backlogging in harbors all across the world, and you can go, the list goes on for reasons to be like, there should be some time that the stock is taking a little bit of a back off, So, and even if the market just has a correction, whatever the reason being right now, particularly because the market obviously is lower, you're seeing that this as a hedge would be a viable options transaction strategy to put on. And it's very simple. Once again, it's two simple order tickets where once again, you would have been selling the one put, which is just below the market where it was at the time of the slides at the 33.60, buying the 33.50 put. That would be your credit spread. And then you'd be buying the 35.50 put outright afterwards in your second order ticket, which in this case would be a viable hedge for the current bearish slide that's going on at Amazon.com. Now, am I bearish Amazon.com and saying you should go and put something like this on? Absolutely not. But if you do for your portfolio, whatever your goals are and what have you, when you get to a certain point, if you're looking to protect any type of stock, this would be something you would do. Now, Amazon's a very expensive stock. So remember, it's still a very expensive hedge. For other markets, not so much. So remember that you are paying up because of the volatility is so high in Amazon. So that's a big deal. Just remember that. All right. Once again, for the Amazon to be clear, remember if you would put on the bullish outlook, the callback spread right now, you would be taking some heat. And if you had put on the put back spread, like if you were just bearish and you did not own Amazon.com, you would be up money in this position. And you could figure out, well, do I want to take the profit and run, or do I want to give it a little more time since I have a month and a half still, over a month and a half still? Or you look at it in the sense that if you did own Amazon.com and had you put on this hedge, you could empty the hedge right now and say, hey, I just absorbed some of my loss. I don't want to be hanging on. I don't think Amazon's going to take too much of a dip. Or you say, hey, you know what? There's a lot of uncertainty coming into the marketplace over the next week or so. I want to see how this quarter ends. give it a couple of weeks. And if it's lower, you know, who knows, maybe it's a lot lower, then you really get to absorb part of the slide from your equity position on Amazon. So once again, there's multiple ways, multiple reasons why you'd put these on. And from both our examples, you can see how actively in the marketplace within just 10 days, either position would have actively helped either someone who had owned the stock or would like to participate in stock movement for whatever the reason may be. Okay. So real quick, we got some questions about the webinar, the option strategies, and the applications. So let me pull up the questions and answer. I'm getting to it. Okay. So the difference between spread and the back spread. Okay, back spread once again is defined by having you are putting on a credit spread and adding an extra option, depending on whether you're being a call or a put direction, which is your direction. If you're bullish, you would be simultaneously selling one call, which is close to the market price, above the market. And then you would be buying two calls above that at a higher strike price, depending on how wide and how much risk you would like to take and how much market movement you're looking for. Now, a spread is all kinds of things. First of all, the spread could be just the difference between the bid and the ask. It's a difference in price. It's a differentiation in using multiple contracts. It's different contracts with multiple months. So a spread is a very wide open term as far as what's the difference between a spread and the back spread. But good question, Junmin. Michael, all contracts in a trade at the same expiration. Correct. In this example, everything was the November 19th expiration. No matter now, you could put on different, like let's say you wanted to put on, for whatever reason, you could have on a bullish spread, you know, and which month you use, whether you go out to the November 19th or the next one further out or one shorter. When I did the example, that could be once again due to your goals. Remember, if you're, let's say you're only trading a earnings announcement that's coming out 2 weeks from now, okay, you could go out to, let's say, month that I did, for instance, in this example, but you wouldn't need to go out to January of 2022, you know. So, but the main thing is, yes, for whether you're putting on the call or the put back spread, same month expiration. Okay, how to select the proper strike price for either back spreads. Okay, so for the back spreads, the one strike that if you're a call, a bullish back spread, you will be always selling a call strike price that is above the current market price of your either your equity or underlying asset. The ones you will be selling will be typically, depending on, it depends on the ranges that you have. Like for instance, with Amazon.com, going $10, $20 in difference in strike price is not really odd or unusual, because the volatility of that stock is sometimes $50, $100, $200 a day. If you were trading something, say like Uber, which went from $39 to $45 in the period of this time from putting this webinar together and today, you would use option strike prices that are tighter, because I mean, even though it had a great move in 2 weeks, or less than 2 weeks, of 12% or almost, those aren't normal. You don't have that typically in a very short amount of time. I mean, a lot of times you won't see a 12% move over the course of a year in some stocks, you know. So in that case, you would have them much tighter, which also means your risk is less. I mean, your ability for market movement to get above those higher strike prices is much easier too. You don't want to go too far out and too wide with your gap in between your strike prices, because otherwise you need more market movement. Okay, let's see. Next one. I hope it is not too low. Can the financial system exercise only part of the strategy? That would be a headache. Well, okay. So for instance, here's the reason why you don't really typically have to worry about it. If somebody was only going to exercise something at a price that's very close to the market or right there, you just buy the stock. You wouldn't put on an option. You just put an order in to buy the stock once it hits that price. Okay, typically when you have options, you're looking for movement. So if it just, for instance, let's say that for in this example, let's see, the one was like a 45 even call, 42.50 call, and 45, I think 45 even call, right? And a 47.50 call. If the market is in between those at 46.50, someone is most likely going to just sell the option versus exercising, because you're pretty much buying the stock at the price you could buy it anyhow. And if they exercise, they still have to have the money. Remember, they have to still put up the money. Just because they buy a call, it doesn't mean the stock is free. It just means they have the right to purchase it. So, and usually you're not going to find somebody exercising an option. And the thing is too, is once you get above your second strike price, as long as your strikes aren't too far apart, if you don't have the stock, you can always exercise it. And your only risk is that difference between your strike price and whatever credit you took in. And in this case, because you have the second call option or put option, if that one's in the money making money, that's offsetting any loss that you would have from that difference of your initial credit spread. Because remember, when the market does get above those two calls in the strike for the back from the callback spread, or below the two lower strike price puts in the put back spread, both of those options, all the options are in the money, and the two that you own are in the money, and you own two of them, so, and that second one offsets any loss typically. Now, if you're in the middle, that's a different story, but you can always just get out, sell the credit spread if you're worried about being exercised once the market gets in between the two. And then keep the one call, and you're long pretty much just below the market. And then if it does rally, you got it. And if it falls apart, your only risk was what you paid for that call to begin with. Okay. Next question. Hello, Snapper. Do you recommend trading options first over equities? Well, it's okay. That's the chicken or the egg question. I think that when it comes to stocks, first of all, you're only going to be buying them as a beginner. I first of all think, unless you are a super good professional and have really deep pockets, you should never short stock. You would use the options, just buy puts, so. As far as starting with stocks or options, I would say that depending on how much money you have, options gives beginners and advanced traders more opportunities to capitalize and give a bigger bang for your buck with options than you do with stocks. Like for instance, you looked at the reason I use Amazon a lot as an example and other stocks is to compare the difference in pricing, so people are aware of the fact that you might be like, I love Amazon, but you got to have deep pockets to know what you're doing. Because if you're wrong, you're going to be, everything is all relative. But when it's 1,000 times more relative than what you could be doing in most average stocks and around in the marketplace, it's a big deal. So for beginners, I would say be mindful of options as a way of utilizing your capital. Probably and maximizing it in a better way than you could with equities. I'm not saying you shouldn't start with equities. If you do start with equities, I would also make sure that you stick with ones that have like dividends, so that somehow along the way, you're probably picking up some free money that from ownership, at least, where you don't get from certain stocks. So it's a very big open-ended question. But for beginners, like I said, it's for bang for buck and to give you more opportunities to take advantage of market swings. Options is definitely the right way to go. It takes a lot more to make money in the stock market, and you definitely have to also be just as mindful and as study and be as mindful of the market factors as well. All right, next question. Why doesn't EF have an option? Okay, that's a market broker question about a market analyzer. Can this be used in IRAs? Yeah, I know. As far as I know, you can have option accounts that are in your IRAs. I know I have equity account that is. So yeah, you can use options in your IRAs. So that is now there are certain restrictions when it comes to platforms and IRAs and a bunch of things with options. So make sure you consult your accountant and also your broker before you start doing things like that when it comes to your IRAs. Why not just type 2 strikes instead of opening up another buy trade for a put? Okay, so good question. Why do you put the credit? I think what you mean is, why do you put the credit spread on, and then why do you put on the individual other option, call or put, whether depending on which one you're doing? That has to do with how you enter trades in the e-option platform. Depending on the scale of investor that you are, some people, depending on how much equity they have in their account, what their margins are, they have the ability to do things that are marked as advanced traders. So for instance, your platform does not allow you to do ratio spreads. That's why we were very clear in explaining the back spread definition, and we're winding things up. But I want to be very clear with this once again, that the reason you only enter 2 transactions versus 1 is because ratio trades are not allowed on that platform. Other platforms under other designations, depending on your account balances and stuff, may allow that. that's a different story. But for the platform and for the webinar we're doing today, for you able to execute this transaction, you would have to do it as a credit spread, and then also an outright call or a credit spread and an outright put, depending on whether you're doing the call back spread or the put back spread. So that's for that answer to that question right there. And can you put on both back spreads simultaneously? What is the recommended? Okay. Absolutely, you can put on both back spreads simultaneously. And that's a case where, let's say you think the market's totally range bound. You could throw a call back spread on and a put back spread on. And then if the market goes absolutely nowhere, well, you know your cost. But the thing is, here's the problem. It's a volatility spread. So you know what you'll lose, and you could do that, but you're going to lose on both transactions. Because if the market goes nowhere, now if it goes one way, which it can only go one way. So if it goes up and explodes, then you'll make money on the callback spread, but you'll lose money on the putback spread. And conversely to the other way. So unlike, there are things where you would put on both, you could play both sides of the market. That would be when you put on a iron condor. There are option strategies for playing both sides of the market. But with back spreads, you want to be either bullish or bearish, or you own the underlying asset and you put on a put back spread as a hedge in case of a downturn in the market to protect your stock for short over and absorb short-term losses. So that's the question. So yes, you could put them on simultaneously. However, you would be losing money if the market goes nowhere, and no matter what, you would lose on one leg. So you could only recoup some of your money. But yes, you could do that. But I suggest you don't do it because you would be losing money for sure. Okay. At expiration, what is the difference in profit loss for back spreads? Okay, we'll finish up with this question. At expiration, if the market is in your favor at expiration, well, then obviously it's in the money. So you could, now I always suggest, and there are those that will argue that you can let things expire, and you can. When there's very little time left, there's no reason not to just clear your assets out and get out of them. So I suggest before expiration, either like the day of or the day before, especially if you have realized your targets and your profits, time decay is gone. Market movement and volatility is the only thing that can hurt you. A lot can happen in a very short amount of time. We just celebrated the anniversary of September 11th. I remember that day visually from being on the trading floor and walking on the trading floor in between when the two planes hit. So, and what it did to markets that day. And so, not to use that as an extreme example, but anything can. So I suggest that, as always, clean up your positions before they expire. Now if you're out of the money on something that, for instance, if the market is extremely higher and you own puts that are worthless, you don't have to get out of that position. That would be stupid. But yeah, when you have something like a credit spread on and have this position on where you are in the money, then do it, because the odds are greater that you will potentially lose part of the value of your position before expiration happens, and on expiration, then increase your profits on your investments and your trades. So that's where I would say absolutely, definitely make sure that before expiration, and it doesn't have to be that close to expiration either. But once you hit that's why you want to have targets. Once you hit them, take your money, you reevaluate another opportunity in the market. So, but that's a webinar for another day. Today we were just explaining how to implement call back spreads and put back spreads. So with that being said, I'm going to give one last little plug here and just remind you that I'm Teddy Keckstedt, and I wrote a book called High Probable Japanese Candlestick Patterns. It's available on Amazon.com in paperback and Kindle versions, and soon to be hardcover. Amazon's finally going to allow hardcover versions. So in the next couple of weeks, hopefully that will be released. I get the first edit of it next week. And also don't forget to like my YouTube channel, Forex Trading Unlocked on YouTube, and also eOptions YouTube channel, which you can see all the webinars they have, and also go to eoption.com. And now I'm going to turn things over to Gina. Thank you guys for your attention today, and you have a great day.
Great. Thank you so much, Teddy. That was very interesting and informative. And we hope everyone learned a new trading strategy today. We'd also like to thank all of our attendees for taking the time out of your busy day to join us and for all your terrific questions. I think we reached a new record for questions today. And there were a few questions specific to our trading platform in the Q&A. If your question wasn't answered or you have additional questions, feel free to reach out to us. We do have a live expert support desk, and we're happy to answer all of your questions. You can email us at support@eoption.com. You can give us a call or go to eoption.com, and we have a live chat option on our website where a broker will answer your questions. And someone asked if you're a beginner, should you trade options? And I just wanted to make clear that options can be riskier than equities, so you really need to understand what you're doing and educate yourself. It's extremely important. And so I do urge you to go to our YouTube channel and subscribe. And we have different playlists. And one of those is for beginner option traders. And so we'll go over strategies like covered calls or ways to generate more income, just more conservative strategies. So you definitely want to educate yourself, and eOption can help with that. We also have on our website, we have materials. So I encourage you to check it out. And even if you're intermediate or advanced, we also have strategies for you as well in playlists on our YouTube channel. And just briefly, I want to touch base. If you're a current customer, we're glad you can join us for this webinar. But if you're not a customer, we hope you'll take a closer look at eOption. And just to quickly tell you some of the benefits, we charge zero for unlimited stock and ETF trading, so that's zero commission. And options are just 10 cents per contract plus $1.99 per trade. That's one of the lowest rates around in the country. So if you traded 10 contracts with eOption, that would just be $2.99, and 20 contracts would be $3.99. And that really does blow away a lot of the competition. If you went with some of the other big firms, they charge 65 cents a contract, so 20 contracts would be $13. So that's more than 3 times than eOption charges. We also offer free tools just to help you generate trading ideas. We offer something called Options Play that's normally $500 annually, but we offer it free to all of our customers. And we also offer unlimited research reports. We have a free screener that you can customize and search by over 60 criteria. We offer a wonderful service called Auto Trading, where you can get your newsletter alerts automatically traded for you, low margin rates, and so much more. And our parent company, Regal Securities, has been around for over 45 years. So, we're not a brand new company. We've been around, and we really take pride in servicing our customers. And we do more webinars in the future, so stay tuned. We will send you an email when the next one is available. So again, we hope you reach out with any more questions, and we're so glad that you can join us. And thank you again for your time. We hope you have a wonderful day and stay safe. Bye now.
High probable Japanese candlestick pattern. So don't forget to do that. So you get a copy of that today, just like the presentation of this tomorrow. And it'll be on the YouTube channel for eoption.com. Don't forget to subscribe and like and share that one if you haven't done so already, just like my YouTube channel also. Let's see from Mark. Let's see with the call, if the stock is over 140 as you approach 813, isn't there a risk the call you sold could be assigned to you? Once again, if it comes to assigning, when it comes to these spreads, one cancels out the other. So you don't have to worry about the assigning of the call on expiration. Could it possibly happen? Well, yeah, but then you don't have to worry about it because the other one rolls it out and that covers it. But like I said, you can always get out of the option instead of letting it expire worthless. And then you don't even have to worry about any of that. And then usually that just gets cleared through the exchange and what have you. There's ways that gets washed out. And especially when you have a neutral position, you don't have to worry about that. It's only if you were naked the call, then that's a totally different situation where then you're getting assigned. Well, then it's all on you. Let's see. As the stock swings around 140, the implied volatility will slide down over this time. This will erode the price of October options. Yes, but it will also erode the other ones as well. How can you estimate this effect? In this case, that volatility variable, it affects both options, so that it's neutral. The only thing that really you're trading here is the time. That's the biggest part of the spread. So as far as when it comes to the volatility, when you first put on the spread for value, that could be in that situation. It's a double-edged sword. So where the option you sell gets gains from the high volatility, the option you buy gets hurt by the higher volatility, and the same thing happens, or it's worse the other way if the volatility is low. Now that's a situation where you can gain. Where let's say you sold into low volatility, or bought the spread on low volatility, where you obviously you're buying the back month, you're selling the front month. Because there's such an erosion of the options, if all of a sudden, like in this case, you're a couple of days of Friday expiration, your front month August option is about to expire, and volatility kicks up, the value of the option that you bought in the back month is supported in price by the volatility boost. So in that case, if you get out of the option spread entirely, you may see a little bit of a kick because of volatility. It just happens to be, or if you roll it, then you're getting burned because in one sense, well, actually in that way it would help you because you already own the back month. Rolling into a September option with a higher volatility, would offset your price a little bit more. Sorry, I've been talking straight without any water. Okay. Let's see. So that should explain that little thing. All right. One last question before we turn it over to one last plug-in, Gina. Okay. But the difficulty is on the bearish or bullish. When is defined any move in the field of investing is no probably leverage protection. Okay. I'm not quite sure what that means about that. Leverage protection was 16. Yeah. Okay. The leverage of protecting the existing stock. Okay. That's where, for instance, if you are bearish, the put calendar spread is what you would initiate. And you can think of it this way, is where you don't want to get rid of the stock. You're looking to insure it a little bit. And should there be either no market movement or a little correction, you have the chance to capitalize off of that. Also, if you are bullish, you can look at it as where if you were long calls, you would put on the calendar spread or turn it into a calendar spread, because you're not sure if the market's going to maintain its true bullish posture or whether it is going to start to go sideways, in which case, if it's only slightly bullish to neutral, you can still benefit from that market condition. So I think we've gotten to all those questions. Well, those are really good questions today, guys. I just got to tell you, pretty interesting topic. Remember to check out this video again, pass it on to your friends. And don't forget, you can get my book, High Probable Japanese Candlestick Patterns, available on Amazon in paperback and Kindle versions. The Kindle version is free. And also don't forget to subscribe to my YouTube channel, Forex Trading Unlocked on YouTube. All right. And with that, I'm going to pass it on to Gina.
Okay, great. Well, thank you so much, Teddy. That was very interesting and informative, and those calendar spread tips were really helpful. And thank you to all of our attendees for taking the time out of your busy day to join us. And just a few reminders before we go today. As mentioned a few times, a recording of this webinar will be available on our YouTube channel tomorrow. So make sure you subscribe so you don't miss any of our videos, and you'll get updates as soon as they're available if you subscribe on YouTube. We'll also be sending you an email in the next week with a copy of the recording as well. But if you'd like it right away, we encourage you to subscribe to our YouTube channel. And also, please visit eoption.com. We have so many wonderful resources on there. I can't stress. We have so much on option education. There's videos, there's clickable option strategy links. So you can, if you have a strategy in mind, you can just click on it and it'll show you charts, motivation. Some of them have videos. So I really encourage you to check that out, especially if you're trying to learn more about options. And another great tool, which is kind of the hidden gem of the firm, is we have a service called Options Play, and it's a free tool. It's normally $500 annually, but it's free to all eOption customers. And basically, it scans thousands of stocks each and every day, and it highlights potential option trade opportunities for you. So with the market going higher and higher, and if you're looking for new ideas or ways to generate ideas, this is a wonderful tool. So I encourage you to check it out. And if you go to eoption.com, we do have a page on Options Play. And so, you know, we also have lots of wonderful videos on our YouTube channel, as it says on the screen. And then last, I just wanted to bring up our next webinar. So that will be on Wednesday, September 1st at 1 p.m. And it is called Key Points to Know About Selling Options. And we're going to have Ed Modla at the Option Industry Council speak about that. He's been also a popular speaker with us. So if you'd like to sign up, you can just go to eoption.com under resources, and you'll see a webinar and video tab, and you can just sign up there. So thank you again for your time, and we hope to see you on September 1st for our next webinar. Stay safe, and bye now.
Welcome to eOptions webinar, and we're excited to have you here, and thank you for taking the time out of your day to join us. We greatly appreciate it. We're happy to partner with our popular speaker, a professional trader with over 30 years of experience, to bring you this webinar on how to enter and exit basic option trades. My name is Gina Bocayas, and I'm with Regal Securities, which is the parent company of eOption and its sister company, InvestTrade. And to provide some basic logistical information, the session today will last approximately 1 hour. If you have any questions during the webinar presentation, please feel free to type them into the Q&A box on your screen, and our speaker will be happy to answer those at the end of his presentation. We ask that you use the Q&A box and not the chat box, as our speaker may not see if you enter a question in the chat box. And our speaker will be talking for about 40 to 45 minutes, and the remaining time will be to answer your questions. You can access the recording of the webinar in the next week on our website at www.eoption.com, and we'll also be emailing you a copy of the recording in the next week as a courtesy, and you can watch it at your own leisure. You'll also find it on eOption's YouTube channel. We recently revamped the entire channel, and we have all kinds of playlists, no matter what level that you're at. So we encourage you to go to eOption's YouTube channel and subscribe so you can get access to all of our videos. And for those of you just joining, we'd like to welcome you to our webinar on how to enter and exit basic option trades. As eOption's name implies, we are a firm that specializes in option stock trading. Our founder was a founding member of the Chicago Board Options Exchange in the 70s and has been trading stocks and options for nearly 50 years. We charge some of the lowest option rates in the industry, and all stock and ETF trades are commission-free. And options are just 10 cents per contract plus $1.99 per trade. We also offer a powerful trading platform, a mobile app, free trading tools, and live expert support on our trade desk that are happy to answer any question that you have. And something we're very proud of is our excellent customer support, where our professionals are licensed brokers with years of experience, and you can reach out to them with any questions. You're not limited to a trading app where you can't reach a live person to answer your questions. And we also offer a useful options trading tool called Options Play, which scans thousands of stocks each day to highlight potential option trade opportunities for you. Normally that's $500 annually, but it's free for all our customers. And we just did an Options Play webinar a few weeks ago on how to use Options Play and how to get the most out of earnings season. So if you go on our website or on YouTube, you'll be able to see a recording of that and view at your leisure. We also support option education, and we're glad you can join our webinar today to learn more about using options in your overall investment strategy. And now I'd like to turn our attention to our speaker, Teddy Keckstad. Teddy has over 30 years of experience in the financial industry and trading. Some of you may recognize his name from past webinars he's done for eOption, and we're excited to welcome him back today. And just to tell you a little bit about him, he has over 30 years of trading and industry experience. He traded on the Chicago Board Options Exchange, the Chicago Mercantile Exchange, and the Chicago Board of Trade for 21 years. And he's been an institutional market analyst for over 25 years. He currently serves as president of Forex Trading Unlocked, and he is the author of the book, High Probable Japanese Candlestick Patterns. He has a degree in finance from DePaul University in Chicago. So without further ado, we'll turn it over to Teddy Keckstad. Thank you.
Thank you very much, Gina, for that introduction. And I want to thank you all for attending as well today. Real quickly, just want to say hi and hope you're looking forward to this webinar. We just want to show you our disclaimer from eOption real quick to remind you
that this webinar is for illustrative and educational purposes only. And since I'm doing the presentation, I always put up my company disclaimer as well, which is basically the same as theirs. Okay, so what you will learn today: how to trade stock and other market movements without large capital allocations, how to expand your portfolio diversification, how to maximize your potential returns with options, basic bullish entry and exit techniques, and basic bearish entry and exit techniques as well. So why stock options? Well, options can help you to diversify your portfolio because you can trade a much broader range of stocks with your allocated capital, especially with some of the pricing at certain stocks that everyone's very aware of. The ability to trade those for most people is, unless you have very deep pockets, is out of the range for most people. But with options, you can actually trade these market movements and have a higher return on your investments. So options allows the smaller to larger investors the ability to capitalize on trending markets that are highly liquid. We are going to discuss 3 of them today that you are most likely very familiar with. And we're also going to explain to you how trading in these products is similar to trading in normal equities, but with a higher potential return on your investment. So trading options allows bulls and bears to reduce their risk, which that's one of the wonderful things that we're going to highlight, is how you can guarantee one thing for sure, and is what your risk will be. Okay, so today's focus: what to look for. Simplicity is best. What we're going to talk about today is very simple, and how to look for opportunities in the market. We're going to find actionable strike prices. We're going to show you how you can analyze both any equity or underlying asset, and then find very good strike levels to use, whether you are bullish or bearish at the time of when you're looking at this said market. We're going to use some trend-based trades to enhance your odds, and we're going to protect yourself from reversals in the markets as well, with how we highlight how to enter these and find these strike prices. So stocks versus options, we're going to discuss what is the difference between whether you would use the techniques we highlight today or whether you would just go long the stock. So with that, okay, so the parts of what we are going to discuss today. So number 1, we're going to highlight 3 stocks or otherwise underlying assets. You could use ETFs, but we're going to keep it very simple and just use stocks today. The other pieces we're going to discuss today are call options. For those of you that are new or just need a reminder, a call option gives the purchaser the right to buy an asset at a fixed price. In this situation, the asset in question will always be the stock for each model that we discuss. For the put options, it is the right to sell an asset at a fixed price. So it's a way of synthetically going short the market. If the market breaks, you can exercise your option, or you can just sell your option for the increased premium and capitalize on that, which we will discuss as we get into the examples. So the length of time before option expiration, we are going to discuss the expected length of an option trade. We will discuss how you can factor in different possibilities for entering and exiting your trade once especially a target has been reached, and then how to integrate options into your trading plans. Okay, so how do you make and lose money? First of all, that's something everybody wants to know, right? So when you buy a stock or underlying asset and the market goes up, then you profit. It goes up and it appreciates in value, you're up money. When you buy a call, which remember is the right to buy an underlying asset at a particular strike price, meaning point in the market, and the market goes up, then you profit. In this case, the price of the option will go up in value from what you purchased it. And then you'll have the opportunity to either sell out of that option for a profit, or you can hold it on towards expiration to exercise the option to actually purchase said stock or underlying asset. If you buy a put and the market goes down, then you will also profit as well. Remember, when you buy a put, you're synthetically going short. So that's when you're a bear. So when you buy a call, you want the market to go up. When you obviously buy an asset, you want it to go up. But when you buy a put, remember, it's the opposite. You want the underlying asset or market to go down. That's the only way you profit.
Now, conversely, when you buy a stock or underlying asset and the market goes down, then you lose value, which means you lose money. The same is also for when you buy a call and the market goes down. So before there is an expiration, there will be some value in the option, but it will definitely go down. The thing with the option is that your risk is totally defined. You can never lose more than what you paid for the option. Doesn't matter when it does expire, whether what happens to the market. Remember that you can only lose what you paid for the price of the option. This also goes for the put. When you buy a put and the market goes up, then you lose money. That's but your risk is also defined once again. So if the market is still moving around and there's time till expiration, it may decrease in value significantly, but it will have some value up until expiration date. So those are the core basics of what we're going to talk about. So let's get into our first example here. So most of you are familiar with the company Walgreens. There's one on many corners in most suburbs and towns in America. The stock symbol, is WBA. So let's take a look at why we have this as a model. So I looked at the stock knowing that most people would know about it. So what is the interest and why would you buy the stock and what are the key stats? Well, one thing is Walgreens has always paid a very strong dividend and has been known to maintain its dividends through up and down economic cycles. Currently, they're paying a 3.53% dividend. That's more money than you can obviously get in a savings account, that's for sure. Their yearly revenue continues to grow. However, it does have some interesting variables that are not so positive. The net income is flat. The profit margins are declining. The stock performance over the past one week was down 2 to 2.5%. Now, this is when I first put these slide deck together, which was at the end of April. But these numbers actually still are valid for today for the stock performance. For the month, it was only slightly higher. For 3 months, it was up 9.69%. The market as a whole has been up very strong. 6 months, it was up almost 40%, but year to date, it was up 31%. Now, remember, a year ago, the market was on full tilt, so it wasn't on its highs at that point. But from where we were at the beginning of the onset of the pandemic, it is up 31%. So if you're bullish, buying a call 30 to 45 days out or around that range, maybe even a little bit longer than 45 days, that is your play. If you are bearish, then you would buy a put. So remember this, if you are interested in this stock, but you don't want to buy it and you want to have your biggest return on investment and have your risk defined, then you would be buying a call. If you think that, for instance, since Walgreens income is flat, profit margins are declining, there's other issues, and you think maybe Walgreens is going to fare as well as other stocks are, maybe perhaps in the future 6 to 8 months, 12 months, then you would buy a put to take advantage of that potential sell-off. So let's go and look at how we find our strike prices. So we take a look at the monthly chart and you can see where it says H and you can see where it says L on these different swing points. These H's are your swing highs, these L's are your swing lows. So as you make lower lows and lower highs, it's a bearish trend. So that means no matter what, Walgreens since 2015 has been trending lower into the end of 2020, and now we have 2021 where it has pretty much bounced and stabilized. We're kind of at the average price of the last 2 years. So at the time of this slide deck, the market was trading at 52.60. So to identify if you're bullish and bearish, the best strikes to use in this instance, when you're going for a 30 to say 45, 50 days out, something like that, you would find the upper two strike prices from the current market price, and then the lower two strike prices below the current market price. So to make this a little clearer for you, the strike prices here are the $50 strike price, the $52.50, the $55, and the $57.50 strike prices. They all have a June 18th, 2021 option expiration. Once again, the monthly trend is bearish. So our stock was trading in between the 52.50 and 55 even. So let's go to the next slide to make it a little easier on a daily chart here. So now if you look at this, and let's say that you are looking to buy the stock, it would be cost you $52.50 a share. And now for this instance, because we are looking as a short-term investment and comparing options to stocks, we have to make sure that we have risk protected also in our stock. So we're going to use that as our bottom of our range for our strike prices. So the market is trading once again above the 52.50 and the 50 even strike prices, and it's trading below the 55 even and the 57.5. Now, ironically, the last higher move high is just below this 57.5. So should this short-term bull trend continue, you would expect that after having made higher move lows, a higher move high sometime in the near future will arise. If you are bearish and you think that this market is running out of gas and you want to take a counter trend trade, well, that's when you would look to short the market, but we don't want to do that with equities. That's too advanced for most people and most capitalized people, or people that are have the capital to trade in equities. But using the puts, that is the synthetic way to go short. So we're going to look at that after we just get this valuation here. So your upside target, we're going to use this as 57.50. That's our upper strike price target right there. And then we're going to use 50 even as our protection for our stock. So that means that it would cost you $5,200, just a little over $5,200 to purchase this stock and go long. Okay. Now, if you have an upside target of 57.50, that would give you just under $5 of what your potential reward is that you're looking for when you would exit the trade. And your risk would be $255 because that's the $50. So in case the market falls below that, then you take a hit, and that's the amount of money you would lose, which would be $255 there. So now we know our risk defined and our target objective for the stock. Now let's apply an option strategy for that. So instead of putting out the $5,200 to buy the stock, you could trade the options here and buy these call prices of either $52.50, which is pretty much right at the market price, and that would cost $1.90. Now remember, with options, you have to multiply times 100. So it's 100, excuse me, times 10. So for this price, you're looking at a very, very cheap price for purchasing your options. So, and now the $50 call, because you have more of a value here, because when you think about options, the strike prices are where you would either have the right to purchase or sell this potential stock. So if you bought the equity, it would cost you $52.55. If you bought the call, you could buy the $52.50 strike price, which would give you the right to either buy that should you exercise it. But in this case, you just want to have it as a cheaper way of getting into the market and having a higher potential return, and also defining your risk. So in this case, we know that should you buy the call at $52.50, looking for a target of $57.50 or a $5 move, that it would cost you $1.90. And we'll get into the pricing of this and what the impact of total cost is on the next slide. If you were to purchase the $50 strike price because you're bullish, it would cost you a little more. It's $3.76. Okay. Now for the put, if you're a bear, the 55, the nearest strike price above where the market is $3.81, and the put is $57.50. So these are the areas, if you're bearish, you would look to buy this put here, the 55 once again, or the 57.50, and you're looking for the market to get down to $50 a share. If you are bullish and you think that this the short-term trend, which is bullish, remember the long-term trend is bearish. If you think that the short-term will continue, then you would be looking to purchase the $52.50 or the $50 calls. One of the reasons you wouldn't want to go below these lower levels of 50 would be because you would have a change in trend. Remember, we looked at the monthly chart and it was trending with lower move highs and lower move lows. That means it's a bear market. Short term on this chart, you can see that it's making higher move highs and higher move lows, and that is a short term bull market. So for the bullish play, we know our target to the upside and our risk to the downside. And then if you're bearish, well, then you're hoping that it does get below $50. So now let's see what this actually means. So if you were to buy the Walgreens stock at $52.50 and use a stop loss at $50, you would know where your upside target is $57.50 and your risk is $255. Now I have an asterisk here. Unlike with options, if you hold the equity, you still have risk over the weekend when the markets are closed. So you never know what happens in world events. You could have the market actually, hypothetically, and it does happen from time to time, open below where your stop loss is, which would mean you would actually, your risk, even though it's defined as long as the market is open, because of that discrepancy, you could potentially lose more on your stock investment than you originally had allotted to. This cannot happen with options, because no matter what, when you purchase options, remember, once again, the only thing you can lose is what you purchased and paid for that. So now let's see what this works out to. So your risk reward, if you were to buy the stock, basically was $2.55 for a potential of $4.55 plus a potential dividend. Now, in this example, I don't believe Walgreens was in the process of paying a dividend, but if you're holding a stock during such a trade, or as an investment, if they pay a dividend, even when the stock is going down, you will be getting that as either a cash payment or a dividend reinvestment as shares of stock. So that would be something that could potentially add to your potential reward, and also reduces your potential risk, but only by a slight margin. It's a very small percentage. Remember, their dividend rate was 3-point-something% annually. So now if you were to buy the call at the 52.50 call for $1.90, your upside target is $57.50. Okay, so your risk reward on this would be $1.90 or $190 versus a potential reward of $5 or $500. Plus, there's a time premium left until expiration. So if, for instance, the market rallies up to $57.50 today, while the market is still trading, actually right now it's currently trading at $53.40. So Walgreens is only slightly higher than it was when I first put this slide deck together. So in that case, right now, let's say that the market did rally above $57.50. You would have that premium that's all there because of the difference in strike prices. You're now above $57.50, and there would also be a little bit of time premium left because there's still time before expiration. Remember, we're looking at the July 18th, which still gives us a little over a month towards expiration. So there's time premium involved here. And just to give you an idea, the 52.50 call, which if you would have purchased it back then for $1.90, it's valued at $2.33. So it's up slightly, but not very much. You're only looking at 43 cents, or in other words, $43 per option. Which now remember, that's because the stock price when we did the slide deck was $52.55, and now it's almost $1 higher. So those calls are worth a little bit more, but the puts, even though they've fallen down in value because there's still a month left, they haven't fallen by so much. And we'll get to that in a second. So if you were to buy the $50 call for $3.76, that's your risk, and your upside target would be $57.50. Now in this one, because you have the lower strike price, your risk reward is different. You have a risk of $3.76, which is your initial price of the option, or $376, but you have the potential to make $7.50 or $750. So in this case, where you could only make $5 before at that same target, you're looking to make $750. It's an extra $250 per option, because that's the difference between those strike prices. Okay, plus there's also a time premium that would also still be of value should the market be above those levels. And this market here, because it's slightly higher, this was 376 at the time of the slide being created, and now as the market's trading at 395. So the calls, once again, would be up a little bit of a profit, just like the stock would be had you bought the equity. Now, as far as the puts, the $55 put, which was at 381 with a downside target of $50. The risk reward, once again, was the $3.81 that you would have paid for the option. And then the reward you would be looking for would be the $5 move from where it was at, plus the time premium left until expiration. So remember, that's where you want the market to go down, and that would be below that $50 level once again. Now, if you were to buy the $57.50 put, which is the next strike price higher, you would have a risk of $5.75, and your downside target would be 50 cents. So in this case, you would be risking $5.75 or 575 to make $7.50 plus whatever time premium is left, or $750. Remember that there is a value for every option because there is time. As each day goes by, that time value decays no matter what. So whenever you buy an option, remember, time works against you. It does not work for you. It always is eroding from the very second that you buy it. Okay. So now let's go on to our next example. We have Caterpillar Inc. So for those of you that aren't familiar with Caterpillar, those are some of the tractors you see along the highway doing all kinds of construction and what have you, and work along the interstate and stuff. So let's see the stats for buying the stocks that are key. The dividend yield is less than the last one. It's only 1.79%, but still beating that of a savings account or most CDs. The yearly revenue is dropping year over year. This is not good news and not good for the stock should you want to purchase it or be thinking about buying it. The net income is also decreasing recently over the past few years. That is also a negative thing for the stock. So right now we have some bearish winds blowing as far as Caterpillar Inc. is concerned. The profit margins are declining as well. That's another negative thing. It's one thing when you have revenue and income decreasing, but if your margins are also declining, that's a triple whammy. So as far as buying this stock, doesn't look so hot, does it? It does pay a dividend, but it doesn't look very strong. Stock performance here was very mediocre over the past week. The past month when the slide was created was actually 2.71%. These things are actually not bad, but that's probably because the overall market is strong. The 3-month gave 22%, but look at this. The year to date is only 26%. And that's when the market was at a very, very low point when the beginning of the pandemic was starting to impact the equity markets. So for this stock to be only up 26% over the year, which is barely matching the 3-month, or just superseding the 3-month, that's not very, very good at all. Especially when you see the 6-month is at 35.7%. So it's very interesting to see how this has been swinging. Doesn't seem to be very positive as far as being an equity investment, unless you were just looking for a long-term dividend payer. However, to increase your ROI, trading with calls and definitely puts, if you are bearish this market, is the opportunity. So once again, we're going to look at calls and puts that are 30 to 45 days out. Okay, Caterpillar monthly, look at that. It's exploding like a balloon underwater. Looks really bullish. It's amazing with all those fundamentals that look so bad. The overall trend, here's a low back here in 2016, 15-ish. We had this high up here. We made a higher move low, and we have definitely taken out the highs to make higher move highs over the past couple months, with it starting to run out of gas. So the short-term trend is explosive. The long-term trend is positive, even though the fundamentals are negative. So all kinds of reasons to be a bull and a bear. Once again, we're looking at the June 18th, 2021 expiration. The strike prices we're going to look at, since this is currently trading at 230.39, for our example, we're going to use the strike prices of 220, 230, and 240. And let's see how this pans out. So once again, we have kind of a breakout area above the recent highs here at 237.90. So that's our 240 strike price barrier. And then 220 here is just above this last higher move low, which is at 215. So 215 is really where we're looking for if you're bearish, for the market to get down to, but that would be below our 220 puts strike price here, which would be good for if we have puts on. So what we're going to look at here is if you were to buy the stock. Now this is where options comes into play for most individuals and even high net worth traders. If you were to buy the stock, it's at $230.75. So that's over $23,000 to buy 100 shares. In this case, if you were to buy the options, they're expensive as well. But 1480, it means, for instance, if you were to buy, or excuse me, the call here, let's say you were going to buy 230 is the stock equity price. Okay, so that'd be $23,000 to purchase that. This 230 call here, which is 988, would just be $988 to purchase. So for under $1,000, you would control that stock until the option expiration of June 18th. So if you were bullish, and you, especially in this situation where you know the fundamentals are very bearish, you might be more inclined to use calls and buy the stock. And if you're bearish, where you think this market is overdone because the technicals don't match the fundamentals, then these puts might be attractive to you. So even though they're expensive, trading these options is nothing remotely as expensive as purchasing the stock. And here's the other thing too, is think about this. For these parameters that we're using for these strike prices, like we're using this 215 as our downside target if you're a bear, and we're looking at this 237 target here if you are, excuse me, 240 target if you are a bull. Your risk for the stock is $14.76 per share. So basically, that would be what is it, $1,400 just on the stock alone, which, remember, you have weekend risk, which you do not have that kind of exposure with options. So for instance, let's say you were long the stock and it settled on a Friday at $220. It could open the following Monday at $200, and you would go through your stop loss. You wouldn't be getting out at 215, right here, which is where you would have your protection while the market is actively open. But like I said, if it closes and then there is that kind of movement, then that can go through that stock price. Normally it couldn't go through it. If it did, and while the markets are open, then that means it just trades through it a little bit because of liquidity and the amount of volume at that price level. So you wouldn't gap through that. And that's the kind of thing, that kind of exposure is something that you have to take into account if you're purchasing the outright equity stock. Okay. With the options, remember, once again, these prices here times 100, that is your risk. So your 240 put would be 1,480, your 230 put would be 855, your 230 call would be 988, and your 220 call would be 1,689. And those would be giving you the right to either buy 220 or 230 or sell 230 or 240. So let's go through this in a little bit more of a easier way to read it. So if you were to buy the Caterpillar stock, once again at 230.75 with a stop loss of 215.99 with an upside target of 240, your risk would be $14.76. And that would be to basically make less than, actually you would be risking more than your potential target is. Now, of course, you could hold on to the stock if it rallied through your initial target, and then lift your stops and put it to a break even or somewhat profitable stop on your stock, if you will. But these are all things that you have to, hopefully it does occur. With the options, you don't have to worry about these things because your risk is defined, and also so is your time frame as well. So your risk reward here on this one was 1476 to 925 plus any potential dividend. Not a very good thing to take right here. This alone right here, if this is what you were looking to do, you would say, no, I will not buy this equity, because why would you risk more than you could could potentially make. So, right, but that doesn't mean you can't trade Caterpillar. That's what options are for. So if you, oops, sorry about that. So if you buy the 230 call for 988, you know that's your risk. Your upside target is 240. Your risk reward here is almost 1-to-1. It's 988 to 10 plus the time premium. So here you would have some potential reward on this option right here. If you buy the 220 call for 1689, same upside target, then you have a little bit more risk reward to your risk, where you'd be at 1689 for your risk and $20 plus time premium for your reward. There's a little more incentive if you're bullish to purchase those calls right there, just because there's more reward to your risk, and that's what you always want to try and do. If you were to buy the 230 put because you're bearish because of the fundamentals and you think the technicals are overdone, then you could purchase the 230 put, which is pretty much at the market. And by the way, Caterpillar is actually higher right now, so you would be losing money on this one. The downside target of 220, or a little bit beyond that, whatever, because we had 215, I believe, was the target. So your risk reward here would be risking $8.55 or $8.55 to make $10 or 10,000, or excuse me, 1,000. Plus your time premium as far as the value of your option. And remember, once you get to a point where you hit your targets, that's when you exit your options. Or you can hold them if you think that if the targets are going to continue, the trend will continue in your favor. But remember, the time always ticks against you. So once you already hit your profit objective and your profit target, that is one of the best times to exit your trade, because at that point, you know that one, you've hit your mark. If the market doesn't move at all, you can only reduce your potential reward because time ticks down against you. So in this one, we have the 240 put, which would have given you a little bit more risk for the same target, where you would have 1480 with the potential of 20 plus your time premium for expiration. So this one would give you a little more value. And once again, this currently, the market is trading at 239, so it's up $10. So even though the fundamentals are bad, this is definitely a play that, obviously the trend is your friend, the bulls are there. So the calls right now, for instance, the 230 call, which was at 988, is now 1473. That would be profitable. The 220 call, which was at 1689, is at 22. So they're basically up $500 to $600 or $6 in this case per option, with the puts being basically down about the same as well. But remember, in this case, because of the option expiration in June 18th, you still have a little over a month, and anything can happen with the market. So these pricing and whether the calls or puts are profitable is yet to be determined, depending on how long you would stay in the trade. So now let's look at Coca-Cola, something that everyone is familiar with. The buying the stock key stats. Now, this one has a decent dividend yield of 3.08%. Coke has always been a steady revenue payer for our dividend payer for decades. But interestingly enough, with the pandemic going on and what have you, maybe that's one of the reasons their yearly revenue is down as of late over the past couple of years. Their net income is also down over the past couple of years. Their profit margins are declining. This is sounding a lot like the first thing we had with Walgreens. So another tried and true dividend paying stock isn't looking so good. The stock performance at the time of the slide deck was just down about 0.39%. with a 1-month performance of just over 3%, which was good, especially in lieu of the bull market that we've been in. The 3-month is up 10%, but this is where it gets really shaky. If you look at the 6-month performance of Coca-Cola, it's only up 6.14%, with a year-to-date of being down 1.91%. So that means that we're lower now than when the pandemic first hit. So in this situation, the fundamentals are looking very bearish. Now, if you're looking for the dividend rate, and you like the stock, obviously investing in the equity is what you would do. But if you are bullish, thinking that, as we come out of the pandemic and there's all these opening up of the states and businesses, and also the big thing is you have the big venues, the athletic venues and entertainment venues where you have all this vending, where you'll have Coca-Cola being sold in, abundance once again through the use, because they haven't sold any syrup. They've been selling nothing but bottles and cans and 2 liters, and instead of selling syrup to all the venues. So that's probably when, if you're bullish, you would be saying, hey, you know what? I don't care what the fundamentals and the technicals are doing. I like Coca-Cola. I think they're a bull. Let's see what happens. So actually right now, as we're speaking, Coca-Cola is slightly higher than the $53.78 it was at when we did this slide. Now, interestingly enough, if you look at the trend here, it had been making higher move highs and higher move lows, higher move high, higher move low, all the way up until the beginning of end of 2019. Pandemic happened, obviously it slammed and made a big low. So between the higher move high and lower move low, that shocked the stock into neutrality, if you will. Short run, this market's been making higher swing highs, higher swing lows. It is bullish in the short run as far as technically. Remember, all the fundamentals were bearish. So this is a monthly chart. We're looking at this, the June 18 expiration once again. And since the market is at 53.78, we're looking at the $50 call, the $52.50 call, the $55 call, or strike prices, excuse me, and the $57.50 strike prices. Ironically, these are the same strike prices as Walgreens. They're different equities, just the same dollar pricing strikes. Just happens to be that these markets are trading at the same level right now. Okay, Coca-Cola daily. Let's see what's going on here. Now, this is where the bulls come into action here. As the trend is always your friend, you have higher swing high, higher swing low, higher swing high, etc., trending higher. So we're looking, as the way things go after this higher swing high, from the market to hold and maybe make a higher swing low or continue to make a higher move high. So if you're bullish, now it's a little harder to see on this one than the other one because it's stretched under the highs here, but we have the 57.50 as our strike price, 55 strike. Also, these would be our puts because they're above the current market price of 53.78, or at the time of the slide, excuse me. The 52.50 and the $50 also call. These are the strike prices to the downside. So now if you were to buy the stock at the time of the slide deck, 53.78 would have been the price per share, or 53, basically a little over $5,378. The stop that we would be using here, because of the fact that this market's this has been trending higher, we would keep the stop and the risk at this one right below the strike price here, which would be 52.27. So our 52.50 call would be basically our base of bullishness, and which, remember, we were taking the first strikes above and below where the market's trading, and this just happens to be just above the swing low. So we know that if it gets below this one here, it's probably going to stay in neutral or be a short-term bear, which means that, do we have enough time to be long with the call? Maybe not. Maybe the puts are the way to go. Or you can look at it, the 52.50, because it's cheaper. If the market really is a bull, it should not get below here. And then it should make a stay either flat or go higher, meaning your risk would be very defined and you have a high risk or high reward to potential risk, what you have going on. Or you could do the $50 call, but remember, because this market's been trending higher, you may not really want to use that $50 call, because that means the market's correcting and you're going to have to wait for it to come down and then swing all the way up to get that to your upside target. So if you're bullish, probably the 52.50 is the right call here. And if you're bearish, then the 55 or the 57 are good. I would say the 55 is the correct one because this was a recent swing high. So sometime between when the slide was made and now, or what have you, a new swing low will have occurred, which actually it has. Coca-Cola actually is slightly higher at $54.30. So it's still right in the middle of this range. So let's see what that equates to for you. So with this, if you were to buy the Coca-Cola once again at 53.78 with a stop loss of 52.27, your upside target was 57.5 with the risk of 151. Remember, there's always your weekend risk, which could mean that your the stop could be traded through in case if the market moves adversely against you between Friday afternoon and Monday morning. The risk reward is $1.51 for a potential of 372. So a 372 reward to risk ratio plus dividend. That for a potential dividend, that's not such a bad trade. So if you're buying the stock and the equity, Coca-Cola is a solid company. Even though it has some deteriorating fundamentals, I don't think Coca-Cola is going out of business anytime soon, and it does still pay a strong dividend. So now if you buy the 5250 call, remember that's the one I like because it's above that recent higher swing low. Your call would cost $2. Okay, or $200 with an upside target of $57.50. So there you have a reward of $5 to $2. So that's more than 2.5 to 1, plus your potential time premium left on your option. That's pretty good. That's a very nice risk reward. So if you're bullish to 5250, which currently at the time of this writing, let's see, the 5250 costs, what was it, $2? Now it costs $2.39. Well, the market's only 50 cents higher. So that option would still be worth more than what you would have paid for it. The $50 even, the $50 strike price call cost $4.05 at the time. That one right now costs $4.50. So that one would also be up a little bit more. But in this case, you would be risking, or the reward was $7.50 versus the $4.05. Obviously, there's the time premium that's plus that. So this one is not on a reward to risk basis, besides the fact that it goes against our trend potential outcome that we discussed as far as it being bearish and not being able to come to fruition as being a profitable option. Your reward is less also on this one based off of your risk. So once again, that 5250 call, that's definitely the one to look at in that kind of a situation. And if you were bearish, obviously, because the stock is slightly higher, the options are worth a little bit less. But let's review what the risk reward was on this one. So for the put, and remember, there's still time on this trade, your downside target was 50 even, which is just above that one or below that one swing low. Your risk reward on this one would be $5 to $2.33. So your $55 put basically gives you the same reward to risk ratio, just a little bit less than your call would be at the 5250 level, remember, plus your time premium, obviously. And also the same, now the higher output at 57.50, that would be 365 of risk, same downside target. This one gives you more of a 2 to 1, or a little less than 2 to 1. As far as reward to risk, and plus your time premium obviously as well. So not quite as much bang for your buck, however, since this isn't a bullish market, remember like how I said that one swing low was the reason you want to use the 5250 call as far as being long if you're going to buy the option. The 55 even put is really good as far as being short, because if the market gets above 55 even, then it's basically saying that after having made a higher swing high and a higher swing low, it's going to make a higher swing high. Remember, this would be a counter trend trade, being short into this rally right now, or being synthetically short through the options. Okay, so with that, I just want to remind you once again how you can maximize your option trading potential through the use of e-option and options for your stock ETF and ETF option trading. Remember, they have their free option strategy tools like Options Play. They have the free option strategy guidebook also at eoption.com. They have a free paper trading account to test your strategies. So you could test buying calls and puts in examples like this, where you identify a trend, you identify some support risk areas and target areas, and then you put those trades on in the simulator and see how they would perform. And remember, once again, that ETF and stock trades are all commission free, and option contract commissions are only 10 cents per contract. So real quick, let's go over some questions here. Let's see, we have Rosita. Why would you buy a $50 call? It's more expensive. Yes, well, that one, the $50 call, yes, it is more expensive. However, the $50 call gives you more room as far as, remember the other price was $52.50. So let's say that the before expiration or right before expiration, that the market really hasn't gone very far and it's fallen below $52.50. Had you had the $52.50 call, it would be worthless going into expiration. Whereas the $50 call would still have some premium because of the difference between the $50 strike and the market price. Like, let's say the market was at $52, you would still have $2 of premium because of the option before expiration. So you could get out and still have some of your money back on the $50 call. Whereas with the the $52.50 strike price call, you would not have anything left of value. So you would just let them expire worthless. So in that case, so I don't know, I think that should answer that question. I don't know if we have any more. Oh yeah, here we have, let's see, there might be some questions about the strike prices once again. So remember, when you're looking at these equities or underlying asset, you find your current market price. And then what you want to do is find your nearest strike prices above the current market price, two of them, one, obviously the closest, and then the next furthest away. And then you want to find the ones below it that are closest to it, and then the next closest below that one. Those set your parameters for calls and puts as far as if you are bullish and bearish as which strike prices to use. Now, then you also overlay your trend analysis. So for instance, if you know the monthly trend is bullish and the daily trend is bullish, if the market has been correcting, and then you're assuming that, or you're assuming that the trend is going to remain. And if it does, because there's no reason to think a trend won't remain doing what it does, then you would be looking for a swing low to occur. So you'd be looking for calls to buy. The conversely would be if you were in a bearish trend and you had the market had been rallying, you'd be looking for a reason to put on some puts. And the good thing is, for your swing lows and your swing highs, you can use that as your risk levels. So for instance, when your stock is going up, your last swing low or one of your recent swing lows would be potentially your risk for if you were just getting into the market and getting long, or you would use that for your strike prices above that for your calls. And you know that if, for instance, like the market's at 55 and you have a 52.50 call on and the last swing low was $49, if you had the $50 or the 52.50 call, you know that those would be your numbers, because if the market falls below that 49, that you're looking for a lower swing low, which means you're on the wrong side of the market if you're buying the stock, for sure. And if you're buying the calls, you want to have the highest risk reward. So you don't want to pay up for options that are just decaying when you could pay a very reduced price if the trend is your friend and it's maintained. Otherwise, you would buy the put if you're really looking for the break, and then you would risk the recent high, which would be, in that case, like the 55 even strike price. So let's see, can someone exercise the right to buy a call before the expiration date? Well, you wouldn't need to, because you have the value in the option. So, but yeah, you can exercise your options at expiration. But beforehand, the pricing of the option, like, you wouldn't do it because of the cost. There's really no reason, because you're making your money unless you really want to hold the stock, in which case you could do that. Let's see, would you be able to break down exiting an option strategy like a bull debit spread? A bull debit spread would be something I'd have to explain for everybody to, I mean, yes, I could break that down for you, but without visually having a couple numbers and something to draw on, I don't think most people would catch on to that really quickly. So, but once again, for exiting in the trades that we discussed, what it would be if the equity or underlying asset hits its target in the instance of whether it's bullish or bearish, that would be when you would want to sell out the options that you had. Okay, because remember, when you're using options, you're getting the synthetic value. So instead of owning the stock, like for instance, you could exercise the stock. And the reason I'm hesitant on saying, would you do it before expiration? The whole thing is that if you would do it before expiration, you're buying, you got to remember, you still have to pay for it, so and for me to say, would you do it? It depends on how much capital you have in your account and whether it's the right thing to do from that kind of a thing. I don't want to say that you would exercise a stock just because the market is above a call price. So just like, especially like, I would never say somebody, if they bought a put, to exercise a put and be short a stock, because then you're dealing with margin, which totally changes the initial vehicle that you're using. Remember that when you're buying options, it's the right to do something. It doesn't mean that you necessarily do it. You get the value and the pricing of the option itself, and it's cheaper to just take the profit through the selling of the option, get exiting it that way, especially if once you've hit your profit target, or if it's blown through, exceeded your profit target in any given day, and you still have time left. Like right now, for instance, there's a month left on the options examples we were talking about. If you were to exit them now, there's a time premium that's there too. So if the market had rallied, like in the case of Caterpillar, where your calls are up money, you're up $500-600. If you think, especially now that the market's making a little sell-off and maybe that things are going to turn down into the springtime, you're up a little money. Yeah, I would definitely sell the calls and get out of it. And especially if you had the stock, I would do the same too, especially with the underlying fundamentals. Let's see, we have another question. Would you be able to break down exiting? Okay, that's another one for another type of spread. Okay, well, with that, I want to move on since we got most of the questions answered. And oh, you're welcome also for you who are just put that thank you in. So just to remind you, if you want to learn about when to actually put on some calls and puts and have a reason to do it in your equity markets, read the book High Probable Japanese Candlestick Patterns, available on Amazon.com, available in paperback and Kindle versions. It's written by yours truly, Teddy Keckstedt. And also like and subscribe to our YouTube channel at Forex Trading Unlocked, where you can catch other videos and lessons that we have on there. And then also, for more eOption resources for you, remember to go to www.eoption.com for more option trading resources like the ones we discussed and that Gina discussed at the beginning of the video. And also to watch more videos in options trading, subscribe to the eoption.com YouTube channel, eOption. Check it out and become a subscriber. And with that, I'm going to turn it over to Gina.
Great. Thank you, Teddy. That was very interesting and informative. And thanks so much. And thank you to all of our attendees for taking the time out of your busy day. We greatly appreciate it. And if you want to trade some of these option strategies that Teddy talked about, don't forget to take advantage of eOptions low rates. All stock and ETF trades are just zero commission, and options are just 10 cents per contract plus $1.99 per trade. And if you're not ready to open an account at eOption, we encourage you to try a paper trading account. You get 100,000 in virtual currency, and you can try some of your option trading strategies there, and that would be risk-free, and try our trading platform. So we encourage you to check that out. And at eOption, you can trade on your desktop, your laptop, or we have an app on your phone. There are many ways to trade with us. And we also offer you free tools like Options Play, as I mentioned at the beginning of the presentation. So that's normally $500 annually, but we give it to you free if you're a customer. And that basically scans thousands of stocks each day to highlight potential option trade opportunities. And as I mentioned, we will have a video recording of this available later in the week. You can go to eoption.com and get it, or you can also see it at our YouTube channel, and we will be emailing it to each person who has attended this webinar as a courtesy. And I know in the questions, a few people had questions about spreads, like a bull debit spread. We encourage you to go to eoption.com. We do have clickable links, strategy links, so you can type in whatever spread you'd like, and it'll go through the strategy, the motivation, and have videos for you. And so we encourage you to go to our strategy links on our website to learn more if Teddy wasn't able to address it in his Q&A session. And also, we encourage you to give our trade desk a call. We're always happy to answer your questions. And again, that's one of the factors that differentiates eOption, is that we have a live expert support desk. The average person has over 10 years of experience, and they can answer any questions about a strategy, about the trading platform, about Options Play. So we encourage you to give them a call, or we also, you can email or reach out on our website, and we're happy to work with you and answer any questions. Again, as Teddy mentioned, our YouTube channel has lots of videos as well, so we encourage you to subscribe. And we have all kinds of playlists. We have it on spreads, Options 101, Options Play, our free trading tool, earnings season. So whatever you're interested in options, we probably have a playlist on it for you. And last, if you could just take a look at the screen, we do have our next webinar on June 10th in a couple of weeks. That will be given by the Option Industry Council. And those are very popular. And this one is on income generating option strategies. So we hope you'll be able to join us. That's on June 10th at 1 p.m. Central Time. And you can register at www.eoption.com/webinars. So thank you again for your time. We really appreciate it. And we know your time is valuable. So thank you and be safe. And we hope to see you at the next webinar on June 10th. Bye now. Hello, and let's get started. Welcome to eOptions webinar, and we're excited to have you here. And thank you for taking the time out of your day to join us. Happy St. Patrick's Day today. We're excited to partner with our speaker, a professional trader with over 30 years of experience, to bring you this webinar on soar through market volatility with iron condor option spreads. My name is Gina Bocayas, and I'm with Regal Securities, which is the parent company of eOption and its sister company InvestTrade. And to provide some basic logistical information of the webinar, the session will last approximately 1 hour. Our speaker will talk for about 45 minutes, and the last 10 or 15 minutes will be for question and answer. So if you have any questions at all during the webinar presentation, please feel free to type them into the question box on your screen, and our speaker will answer those at the end of his presentation. We ask that you please use the Q&A box and not the chat box, as our speaker may not see what's entered in the chat box. We also see that some people are raising their hand, and we ask that you put any questions into the Q&A box. You can access the recording of the webinar in the next week on our website at eoption.com, and we'll also be emailing you a copy of the recording in the next week so you can view it at your leisure. You'll also find it on eOption's YouTube channel, and we recently revamped, and we have all kinds of playlists no matter what level you're at. So we have one on option spreads or beginning option trading or using our tools. So we encourage you to check it out. And for those of you just joining, we'd like to welcome you to our webinar on soar through market volatility with iron condor option spreads. And as eOption's name implies, we're a firm that specializes in option and stock trading. Our founder was a founding member of the Chicago Board Options Exchange in the 1970s and has been trading stocks and options for nearly 50 years. And we charge some of the lowest option rates in the industry. First, all of our stock and ETF trades are commission free, and options are just 10 cents per contract plus $1.99 per trade. So if you want to trade 10 contracts, it's just $2.99 per trade, which is a lot lower than many of the large competitors out there. We also offer a powerful trading platform, a mobile app, free trading tools, and live expert support on our trade desk. And that's something we're really proud of, is our excellent customer support, where our professionals are licensed brokers, most of them with over 10 years of experience, and you can reach out to them with any questions. So you're not just limited to an app where you can't speak to someone when you have a question. We also offer a useful options trading tool called Options Play. This scans thousands of stocks each day to highlight potential option trade opportunities for you. And normally that's $500 annually, but it's free for all of our customers. We also support option education, and we're glad you can join our webinar today to learn more about using options in your overall trading strategy. And I'd like to turn our attention to our speaker now, Teddy Keckstadt. Teddy has over 30 years of experience in the financial industry and trading. Some of you may recognize his name from past webinars he's done for eOption, and we're excited to welcome him back today. And just to tell you a little bit about him, he has over 30 years of trading and industry experience. He traded on the Chicago Board Options Exchange, the Chicago Mercantile Exchange, and the Chicago Board of Trade for 21 years, and has been an institutional market analyst for over 25 years. He serves as president of Forex Trading Unlocked, and he is the author of the book, High Probable Japanese Candlestick Patterns. He also has a degree in finance from DePaul University in Chicago. And without further ado, I'll turn it over to Teddy Keckstadt. Thank you.
Thank you, Gina, for that introduction, and thank you everyone for showing up today for our webinar on iron condor spreads, and happy St. Patrick's Day. All right, so we're going to put up our disclaimer real quick from eOption. This is just to remind you that this webinar is for educational and illustrative purposes. Everything is in behind time. There's a lag here as far as the information, so none of this is currently going on in the marketplace as we're speaking. All right. Also, I put up my disclaimer as well. For every webinar I do from Forex Trading Unlocked, I can bypass that. So what you will learn today, you're going to learn how to trade stock and other market movements without large capital allocations. That's a beautiful thing. You're going to learn how to expand your portfolio diversification through the use of these option strategy you're going to learn today. You're also going to learn how to maximize your potential returns with options. This strategy is a neutral range-bound strategy typically, for the most part. However, I'm going to show you how it can be used for directional traders as well. And we're going to show you how E-option can help improve your bottom line because of how low the costs are for trading options like Gina just spoke of. All right, so why stock option strategies? First of all, it helps to lower your cost basis, which we just mentioned. Options help you to diversify your portfolio because you can trade a much broader range of stocks with your allocated capital. The stocks we're going to talk about today for these strategies is Microsoft, Amazon, and Tesla. Some of those are, especially two of them, are very expensive stocks, and to trade those just on an individual equity basis takes a large amount of capital. However, through the use of options and strategies such as iron condors, like we're going to talk about today, you can take advantage of market moves in these very watched and heavily traded stocks. Options allow smaller to larger investors the ability to capitalize on these trending markets that are highly liquid. This is a very important cost control. Remember, the trading is a business. The whole point that you are investing or trading is to make money. It's not a game. It is not gambling. It is a business. As long as you treat it as such, you will have typically the results of running a business if you run it properly. Trading in these products is similar to trading in normal equities, but with higher potential ROI and controlled risk. So your return on investment is much higher by using strategies such as the iron condor that we're going to talk about now. Okay, today's focus, the iron condor option spread. So first, you're going to learn the moving parts of this option strategy, okay? You're going to learn what to look for. And you're going to learn this is a new approach also on how to use an iron condor. What everyone else knows is not worth knowing. That's typically what most traders will tell you. The more you're involved in the markets, investing or trading, you'll learn how to analyze markets, and you'll know a lot of things and see things that most people will see. How you profit in the markets is not knowing what everyone else knows. It's knowing something that everyone is not looking at or utilizing properly. And that's those little discrepancies is where you can jump on and capitalize on. Simplicity is the best. This technique we're going to learn today, even though it involves the use of 4 options, is actually a very simple strategy to use, and simplicity is always the best thing. The less moving parts, the harder it is to the less likely it is to get screwed up. The more moving parts, obviously the more things that can go wrong. One nice thing about this strategy is you can actually, we're going to show you how you can ignore the Greeks. You're not going to have any math anxiety. With a lot of different option strategies and ways that you can apply options, you need to pay attention to certain different variables in the Greek, such as the theta, the delta, and what have you. With this one, your market bias or no bias, anyone can apply this strategy. For the most part, though, you are fairly neutral on the equity underlying asset that you're looking to put this spread on. And the best thing about this strategy, best of all, is you get paid first with defined risk. That's right. This is a credit spread. So when you put this strategy on and implement it, you will be taking money into your account. So what is an iron condor option spread? This is what an option condor spread is, the parts. An iron condor involves 4 separate contracts, okay? So you're going to use calls and puts in a combination together simultaneously. So it involves selling of 1 call spread above the market and the selling of 1 put spread below the market. So when you combine both selling the call and put spreads together, that is when you call it, it becomes an iron condor. So if you were to just use 1/2 of this iron condor, then you would be selling a call spread or you would be selling a put spread. And these are when you would be either bullish or bearish the market, and you can trade directionally when you use those kinds of spreads on their own. When you put them together, it's a different story. And we'll show you once we get to the charts, it'll all become very clear for you. The key thing to the iron condor spread is that the same expiration month for all contracts is a must. They are all from the same month, no matter what. At the time of when I started to make this video, I used the April 1st, 2021 expiration date because that was between 30 and 45 days. Between 30 and 45 days is typically the ideal scenario for this type of option spread. You can do it with a shorter time frame. However, ideally, and you'll see why once we get into it, and especially as we wrap it up, why you can do it once, like I said, with only a week or two out. But when you initiate it within the more closer to 45 or within 30 days, you'll get more bang for your buck. Okay, so all 4 contracts are out of the money, otherwise known as OTM. It is not a mandatory requirement. Sometimes the underlying equity may have one of the strike prices pretty much right on that level. Like for instance, if the stock price was $25 or $25.25, you could theoretically you could use a $25 strike price put. We'll get close into that as we get to the charts. But it is not a mandatory requirement that the equity be exactly in between the 2 spreads. The call and put spreads are of equal width. So what that means is that the distance between the 2 call options that you put on has to be the same distance in strike relationship to the puts spread that you put on. So for instance, when we get to the chart, this will become very clear as far as equidistance for those 2 spreads. Usually the underlying asset is a broad-based market index like the Russell, the SPX, the NASDAQ, the NDX, et cetera, the S&P 500. That's why a lot of people, when you talk about iron condors, they assume that whoever's trading that there's someone who is an index trader. Like I was in the S&P 500 pit, people who were trading, there was a lot of iron condors that were sold in that options pit. It's just like the OEX when I was over at the CBOE, the iron condors were very big in the OEX pit as well. So the thing is, you don't need to trade just indexes, especially when you talk about stocks like Amazon, Tesla, and Microsoft, very liquid stocks like we're going to look at. You can use these strategies as well. So this is a neutral trade that lacks any bullish or bearish bias. So you are neutral. You can have a bias, but basically you're not looking for any severe bullish or bearish move. So you may be slightly bullish or slightly bearish, but you're not looking for an overall trend to develop during the time that you have the spread on. Okay, now selling the call and put spreads creates a credit that equals the maximum profit that you can make. We're almost at the charts, folks. This is all going to become clear. We're going to have all kinds of colors and lines and we'll be jumping out at you. Remember, selling the call and put spreads creates a credit. That means you're going to bring in money that's going to be deposited into your account. That amount of money minus your commissions is the maximum profit that you can possibly make on this spread. You cannot make more, no matter whether the market doesn't move for the next 2 months, 3 months, whatever, through your spread and it expires, or whether it rallies or breaks to zero, whatever, the company goes out of business, whatever, the maximum profit you can have is that credit minus your commissions, okay? Also, this is also considered buying the iron condor, but you do not need to think about it as that if it gets confusing. So we are going to be selling option spreads, which means you get a credit. And normally when you say selling, you are short. However, because of the nature of this spread, because you're combining 2 negative spreads, options traders typically say when they're trading iron condors that they're long in the condor. So with that, let's get into one last quick little roundup and how do you make and lose money in the iron condor, because that's what you guys are really here for. You don't want to listen to me babble about all the little intricacies. You want to know how to do it, what to put it on, and how much money can you make. So here's what we're going to get into right now. Your expectations are that the underlying assets stay in a range. You will learn how to overcome this at sometimes. When expiration arrives, you keep the whole credit, commissions if all options are out of the money, okay? Or minus the commissions if all the options are out of the money. Do not expect that to occur every time. Just because you put on an iron condor trade, it's like any trade. You're not going to make money all the time. Doesn't mean you're going to lose money. You'll have the opportunity to sometimes get out of a credit spread or a spread like this with a scratch. or just a small profit or small loss. It doesn't mean you're going to lose what your defined risk is. But remember, that's the thing, is that when you take in that money, just like you have a defined profit potential, you also have a defined risk also. All right. It is usually preferable to give up some of the credit and exit the iron condor early. Good money management is to not get greedy. It's like the old adage, pigs get fat, hogs get slaughtered. Don't be a hog. I'm telling you, every hog I've seen in the trading business isn't there anymore. Money management is key to all traders' success, period. Nothing more needs to be said on that. Sometimes the market explodes. That's why these things can go against you. But remember, you have defined risk. And when you see the spreads that we put on today, and if you get them priced out right, we can even limit that even more. So that is not good for the iron condor when markets explode, but you will already have the defined risk once again. So there is no stress about losing more than expected. So that's the nice thing about a trade like the iron condor. You know what you're going to make, most likely, if you are right, and you definitely know the most that you can lose. And it's always locked in. There is no changing that. You don't have to worry about that. Nothing else changed. It's not like when you put on certain other spreads or if you have outright positions. So here's another thing to remember. If the market doesn't move, if the market actually does move, let's say you have an extreme rally to the upside or an extreme break to the downside, and you go beyond your option spreads, you are only going to lose on one leg of the spread. Leg meaning one is the put spread to the downside, and then there's the call spread to the upside. Those are your two legs of your spreads. The market can't go in two directions at once. You know, it can only go in one place. If anyone knows how the market can go in two places at once, please let me watch your webinar. So, but anyhow, because of that fact, you can only lose on one leg, which that means any credit you take in from the leg that you won on, that you profited on, that goes to cover your losses. That's how you define your risk. So no matter what, one spread will be profitable no matter what. Okay, depending on the underlying asset, the probability of the loss can be lowered, but the profit potential will fall as well. So to do this, you would choose out of the money options that are further away from the current market. The same is true for the opposite. Options that are closer to the current market will increase the risk, but also raise your profit potential. So it's a simple thing, risk reward. The more risk you take, the more potential rewards you have. And the more risk you take, the more potential, risk you obviously have as well. So the best is to find options that fit your style and level of experience. Typically, people trade the index markets, like I said, for the iron condors, SPX, NDX, and Russell, what have you. Do this only if you understand index trading as well. So that's where, when it comes to these equities, I like to suggest this to more traders and investors as a strategy for equities and not the indexes, because stock indexes, I have a whole meaning of their own as far as how they wiggle and jiggle and the pricing and stuff. So if you're not familiar with that, it gets really hard to become to put option spreads on that. So until you're experienced with it, please stay away from it and take your time before you try and do it. I lived in the S&P 500 pit. Trust me on this one. So anyhow, stay in your comfort zone. Stocks you already follow is where you should start. So for instance, like Amazon, Tesla, and Microsoft, which I chose for today, I would think that almost every one of you that are watching this webinar are somewhat familiar with those companies. So, and if you're not, then you just use the same type of strategy on ones that you are. So by the end of this webinar, you will also learn how to establish a no loss scenario. That's right. How about that one? Every once in a while it happens, but guess what? I'm going to show you when it did and how it's happening right now. So patience and discipline are key to profiting from iron condors, just like everything else. So here we go. Here's the pictures. What do we have here? We have the Microsoft Corp here. So when I started this webinar back a month ago and laid out the different options for this and where the market was, Microsoft was trading at $228.99. Irony of it all today is that Microsoft is trading at $234.32. So you know what that means? That means it puts the stock pretty much right around where it was a month ago. that is something that's good for this type of strategy. So that means as we're getting closer to expiration, remember all these examples I'm going to show you have an April 1st expiration. So in this case, the market, like I said, was 228.99. So you would be selling the 240 call, you'd be buying the 250 call, and you would get a credit for that. You would also sell the 220 put, excuse me, and you would buy the 210 put back. That would give you a credit. The combined two credits minus your position is your maximum potential profit. Your maximum risk is the difference between, depending on which way the market goes. So if the market rallies, you would subtract the credit that you had from both spreads, and whatever that difference is from your first one, that would be your loss. So and you'll see when we get to the math on this one. So what it means is that you can only have a risk like here, there's $10 wide, it's 240 to 250 and 220 to 210. Your maximum loss is $1,000 or 10 points. Okay, so $10, which would be $1,000. Remember, you took credits for both legs. So if you take, say, 3.5 on one and 4.5 on another, that gives you 8. The most you could lose is 2. So depending on which direction it would be, that would be the one credit would be you would absorb your loss, and the other one would pay to pad part of your loss. So let's look at the pricing here. So for the Microsoft Iron Condor, with an April 1st, 2021 expiration at the time of this webinar writing, once again, Microsoft was at 288.83. You could sell the 240 call for $4.74, buy the 250 call for $220, which gives you a credit of $2.54, which is equal to $254. Okay. You could sell the 220 put for $5.59 and buy the 210 put for $3.70. That gives you a net credit of $1.89. So that's $189. So the total Iron Condor credit at the time of this webinar, when I first was making these charts up, was $443 maximum potential profit and a $557 max potential loss. So this is a situation where if you are very neutral Microsoft at the time when this trading opportunity, if you wanted to take a snapshot back then and do this trade, you know that you had a potential to lose more than you could make on the trade. So unless you had a real big reason to think that volatility and momentum of whatever the trend or non-trend was at the moment would keep the stock or underlying asset within the boundaries of your call spread and your put spread, then I could see where you might want to put on this trade. But I personally, I like to have a profit ratio of 2 to 1 or more. In this case, you're not even 1 to 1. So I would say, unless you really, really know your Greeks, and then that gets into other numbers that starts to get into a more speculative way, I would not take this trade. You don't take every trade just because, I mean, this one is actually not a bad one. It is a decent credit for the Iron Condor. However, I like to always have at least a 1 to 1 or more profit potential. Otherwise, I just don't like the trade, because over time you have to just be right more often. That's just one of the realities of it all. So, but this means that still there was a trade here. Now, if you did do this trade, just to give you an idea, we said that the credit, the total net credit was $443, okay, for this trade. If you were to put this trade on right now, this exact same, because the market is actually near the same price, you could put on the same credit spread now for, it would be a net $2.50. So had you done this spread back then, you could buy it back for $2.50, and you would basically make $200 or base $2, around $2, just under $2, had you done the Iron Condor then. If you had put on the spread back then, and you were still in it today, being that the market is 2 weeks before expiration and you've already made half of what you possibly could make, this would be a trade where I would say then you would execute your positions and get out of them. Because this way, instead of giving up having the risk potential over the next 2 weeks where the market moves, there's not much left to make on this to begin with, but your loss potential is huge, especially even though you have only a 557 loss potential, because the spread's at 250 right now, the current potential loss is 750. So take the money and run if you would have the spread on, is what I'm saying. Once again, I wouldn't take it unless it's more than 1-to-1. So now let's get into one that is. So for Amazon, we have, this one is a high flyer. What is a neutral range for this? $1,000 wide? Pretty funny, right? So at the time of this spread, when I did this setup, it was trading at $3,057.16. Amazon, ironically, today is trading at $3,057.16. So it's just a little bit lower than where it was at that time, or excuse me, a little bit higher than where it was at that time. It is within the parameters of our call spread to the upside, which, remember, you would be selling the 3,115 call and buying the 3,125 call. And then also it is it is above the 290, or excuse me, the 2,990 put and 2,980 put that you would be buying back. Let's look at the numbers on this one. This is where, looking at for spreads like this, is where you might start to say, oh, I now I see what he's saying about not taking the first trade, but looking at this one. So Amazon was trading at $3,057.16. At that time, you could have sold the $3,115 call for $116.67, and buy the $3,125 call for $108.55. Remember, these numbers are times 100. That's how expensive these options are. They're times 100. Okay, so your credit is $8.12, which is actually $812. Now think about this. We just looked at an example. You're going to be selling 2 credit spreads. You know your maximum risk is $1,000 minus whatever credit you take in. Just from one leg of this spread, you can take in $812. That only leaves $188 of potential risk left, and you know you're taking another credit. Let's move on forward, shall we? Sell the 2,990 put for $100.55 and buy the $2,980 put for $90.24. That gives you a credit of $10.31, or $1,031. That's right. At the time, the volatility was so high with Amazon, even though it was fairly in a neutral range, because of the way the stock indexes were actually moving, that some of these options, because of rotation of other spreads and calls and puts, the disparity was so huge that you could get a credit off of just the one leg right there of $1,031. So if you just sold the put spread, you knew no matter what, you'd make $31 no matter what, minus commissions. You could not, no matter what happens to the market, whether it goes market tanks or rallies or stays the same. And now you have a credit of $812 on the call spread. Total iron condor credit is $1,843. That's your maximum potential profit. That's if Amazon goes nowhere and you hold it all the way to expiration. Your maximum loss potential on this trade, because it's more, your credit is over $1,000, your maximum loss is absolutely zero. That's right. It's an absolute zero. It means that had you been paying attention and trading that day and watching, looking for a spread like this, when volatility is spiking, because you want volatility to drop when you put on a spread like this. If you're in a situation where you have a high liquid stock that's trading near its highs, in a situation like this, where it's the indexes also have a lot of influence on the stock, and the stock has an influence on those indexes. That means you have all kinds of funky different spreads going on for other options plays. Besides the iron condor, there's a lot of different types of spreads out there. Straddle, strangles, all these things people have heard of that are very common. There's all kinds of butterfly vertical spreads, and we could talk all day long on different names if we wanted to, you know. And because of that, and because of the rotation of these things, there's opportunities every once in a while with high volatility. Normally, you wouldn't see it more than probably around $600 to $700 for a credit. But whenever you see a credit on a spread like this, where you can get, like, for instance, like I said, the calls, like the call spread where you have $112. If you initially just wanted to put on a call spread, at that point, you would look to do an iron condor, because you know that if you can get, if it's close enough and has even a small credit, all you had to do is have more than $100.88 for a credit, and you would be at, no matter what, you could not lose money. So is it possible to get trades off like this? Absolutely. I took them off. Now let me tell you where this is at right now, because you're probably like, oh, genius, where is this trading now? So just like we said, the total credit for the spread is $1,843. Right now, the Amazon spread, if you could put this exact same spread on for $5.89, which equals $589, that's still a reasonable number. That's right around the 1-to-1 ratio. Okay, so with 2 weeks left to go, if you think Amazon's not going to break out, you could still put on this spread right now as an iron condor, sell that call spread and that put spread, and then be technically long the iron condor, remember, and you would have that potential. However, if you had done it a month ago and you had this situation, you could do nothing no matter what, because you know you can't lose money. The worst thing that could happen is the market explodes to the upside above your call spread, or explodes to the downside below your put spread, in which case you would then only lose $1,000, you would still make $843 profit. That's if the market exploded. So in this situation, you wouldn't do anything unless you wanted to rotate your capital, in which case, since you got a credit of $1,843, you could sell it back, buy it back for $586. You'd be basically making, that's another $1,200, $1,300, depending on your commission basis, that you would have made in 1 month with having zero risk whatsoever. So, but this is something, remember, these opportunities, they don't happen all the time, but when you're looking for more than a 2-to-1 profit ratio or more, like I said, when you see a credit spread where you have a call or a put spread that is higher than $700, let alone $800, then don't focus on just that. Look for the other side, make it into an iron condor instead of a call spread or a put spread, and give yourself a situation where you cannot lose. It's impossible. You cannot lose at all. If you are a gambler, this sometimes happens when you're betting football and stuff like that. And I'm not going to get into that kind of thing, but it's where you basically have one bet riding, and then you have it's odds where you can also hedge it with another one, and whether you win or lose on either one, you end up making money. So anyhow, that's a whole nother topic, but that's kind of how this method works. So Tesla, this is going to be a similar one as well. At the time when I did this, figured out these spreads, this is another one, $682.22 is where the market was trading. So in this case, we would sell the 705 call, buy the 715 call. So that call spread, you would sell that for that credit. And then you would sell the 660 put and buy the 650 put for a credit. And that would establish your iron condor. Remember, the iron condor is the combination of a call spread and a put spread. All right, let's see what would have happened. Tesla Iron Condor, April 1st, 2021 expiration. We have Tesla trading at $682.60. You sold the 705 call for $56. Buy the 715 call for $51.08. That gives a net credit of $4.92 or $492. That's a pretty good credit. When you remember, you're looking to get around, if you can get around 700, especially, or 800, you're really golden. And this is one where you're like, okay, well, this is already at almost a 1-to-1 ratio just for one leg. The next leg, this is another interesting one. You sell the 660 put for $59.70 and you buy the 650 put for $50. That gives you a net credit of $9.70, which equals $970. Now, remember that these option prices that we've been talking about, especially with Tesla and Amazon, even though these options cost, for instance, $5,000, $6,000 per option, remember, because you're doing them at the same time and it's a credit, it doesn't matter. Your only difference is the difference of your strike price where your credit is. You don't have to worry about the true pricing of the options because they net out. So once again, this would yield a credit of $970. That means that this put spread alone, you only had a risk of $30 if you were wrong, just on a put spread. If you have obviously an iron condor, that means that this one leg eats up $970 of your potential $10, $1,000 risk, which means there's only $30 of risk, or 3 cents actually, 30 cents. Because of the two spreads, the total iron condor credit, which I did this one also, was $1,462. Now that was your max potential profit. Remember, your max potential loss is 0. You can't lose, because your maximum loss, if the market was to explode above the call spread or fall below the put spread, remember, you can only lose on one leg of the spreads. You can't lose on both. The market can't be in two places at once. This one, no matter what, yielded a credit that if the market did explode or it did go to the upside or downside, you cannot lose. And the most that you would, then the least that you would make would be $462 profit. That's right. That's the worst thing that could happen to you. Now, you're probably wondering, well, where is this spread at today? Well, remember here, you could have gotten it off for its 1,462. So that's 146, 46.20. Right now, you could sell that spread for $8.85. So just right now, you could do for 2 weeks, you still have, this would be the one of the three with 2 weeks left at expiration. This is a trade that if this one wasn't on already, I would put this one on, because you only have a risk of $1.15 for this trade. So, and with this one here, because of where you can buy it back, I mean, why would I not leave it when no matter what, the maximum I can lose, the worst thing that can happen is I make $462. So if I was to get out of it right now, I only make around $700 or $600 and some dollars on the spread. So for me, to risk to a couple more weeks to make anywhere from $200, to another 1,000 on the spread and keep that locked in, I think I'll take the risk on that one. So as far as now you can see how when we started off with the first example, how it was a 1-to-1 ratio, and it gave you an idea that, well, for a little while, put it on and it was profitable. You could definitely get out of it. That Microsoft spread right now, remember, was at 250. You could have made money off of it. All of these spreads you could exit right now had you put them on a month ago. But the nice thing is that when you, like I said, if you wait for moments of super high volatility and then you look for, even just when you're shopping around for call and put spreads, when you start to see them creep above $500, $600, $700, and they're fairly close to your underlying market price, asset price, look to the other side for the other leg, be it the put spread or the call spread, to see what kind of a credit you can get. And then when you do that, you're locking in the closest thing to a surefire winner, or, even in these situations, you would be able to start out where literally you have a credit in your account and all you have to do is wait till expiration. And remember, you can let these expire worthless, or you can get out of them yourselves. I typically get out of them myself a little bit beforehand, just because anything can happen in the marketplace. And when you only have a couple days left, those couple dollars, once again, I said in the beginning, don't be a hog, be a pig. Pigs get fat, hogs get slaughtered. So don't be afraid to take a profit, and don't try and get every single penny out of every strategy. Trying to do that is just as bad as trying to hang on to a loser and adding to a loser, which is a whole nother story we don't want to talk about. So now you can soar through market volatility with iron condor option spreads. And we're going to get to some of these questions because they're building here, and I wanted to make sure that I have plenty of time to answer them. So once again, today's focus, before I answer these questions, the iron condor option spread recap. You learn the moving parts of this option strategy. It's combining a put spread and a call spread. You learn what to look for as far as pricing and what kind of equity to look at. Remember, start with these high-flying, heavily traded equities before you do the indexes. Once again, I tell you, do not forget this. If you learn anything about this iron condor strategy, please do not apply them to any index until you are experienced with indexes as well. This is a new approach. What everyone else knows is not worth knowing. Not many people tell you how to find the credits and build them up to where you can put more than a 2-to-1 to upwards of 3-to-1 profit potential in your favor, not to mention finding how you're going to lose when your credit is above the total risk you could possibly have. So remember, you want to look for high volatility moments for that kind of thing. And then because once you're really pushing the max on volatility, like a high VIX, that's when you have these opportunities. Remember, 30 to 45 days out. You can ignore the Greeks and not have any math anxiety. It's another thing you learn what to do today. How this is a neutral strategy is also something you learn. And directionally, here's the other thing too, is let's say you're bullish, okay? Then what you would do is keep your put strike prices, instead of being like I had these spaced out where the market was right in between the credit spreads, the call and the put spreads. What you can do is if you're bullish, you have the put spreads closer to your strike price and your call spreads further out to the upside. Okay, that's if you're bullish, because you'll get more of a credit for the options that are closer to you. So you probably would gain more, get a bigger credit on the put spread, and looking for a bullish move. So if you were neutral to bullish, you would have the put spreads higher. If you were on the same as the opposite for being bearish, you would have your call spreads closer to your market price, looking for the market to go lower, and you would get more of a credit on that side. So remember, there is no market bias, or no bias by yourself when it comes to putting on an iron condor. Anyone can apply this strategy, and best of all, you get paid first with defined risk. So remember to maximize your option trading potential with e-option for stocks, ETF, and options tradings. Free option strategy toolkits like Option Play can help you, and option strategy guidebook also at e-option. There's a free paper trading account you can use to test these strategies and then answer these questions and try them out for yourself. And then ETF and stock trades are also commission free. Remember that at e-option. So all right, questions. Let me get to this. All right, so first for Denise, would this strategy be considered day trading? Absolutely not. This is not a day trading strategy. Remember, this is 30 to 45 days out. Looks like 4 trades of the same stock in one day. No, it's not 4 trades. It is 4 trades because you're using 4 options, but remember, they have the same expiration month. 2 of them are calls, 2 of them are puts, and then 2 of them you're selling and 2 of them you're buying. So they are 4 separate trades, but they're done simultaneously. Can you do them on different days? No, you have to when you put on an iron condor, you are putting them on at the same time. Now, for instance, if you already had a call or put strategy on, if you wanted to, you could leg into an iron condor, but would have to be certain reasons why you do that, and that's a whole webinar in itself, so we're not going to get into that. That's a big intricacy. All right, for David, let's see. This example says that Microsoft was 288 and that would have put the call spread was in the money at the time of entry. No, the call spread was out of the money, because at the time Microsoft was at 228, not 288.83. So that's why it was not, and it was in between the 2 different prices. The 228 is below the 250 and 240 calls, and it's above the 220 and 210 puts. So that I don't know where you're getting 288 for that price of that day. So I could go back to the chart on this, but I don't want to lose the slide. Let's see. So both the call spread and the put spread were out of the money. David, is that normal? I'm not sure. I think that's because you're referring to the other question. Let's see, Paul, could you please do a session on simple SPY QQQ call and put options maximized today? Okay, let me see. Today I made a 112, 3 Qs calls and made 330. Okay. That's a lot of markets to cover in the next couple of minutes. But yeah, could I do a session on simple SPY, QQQ, and DJI call and put option maximizing profit? Yeah, we could. That would be a great topic. I will talk to Gina and Scott from eOption, and that might be a topic of doing the indexes. I was in the S&P 500 for 20 plus years, and I still trade and watch the indexes. So yeah, we could do an index option webinar. That would probably be a good idea. Thanks for coming up with that, Paul. Let's see, for Robert out there, thank you. So you guys are, bro, that goes to those guys. Well, you're welcome. I'm sure they want to say the same. Oscar, what is the minimum amount to open a Regal account? That's where you got to talk to those guys. Chandra, can you identify the difference between Microsoft and Amazon where the max loss potential is different? Yes, with Microsoft, remember that was where your maximum profit was around 400 and something dollars. Your max loss was 500 something. With Amazon, both that and the Tesla, between the two credits of the call and put spreads, those came out to a plus $1,000. So remember that we were using $10 wide spreads. So the maximum risk on any of those spreads is $1,000. You can only lose on one of those spreads. That's why the two credits, they pay the difference of you can only make so much and you can only lose so much. Normally a credit is below 1,000 between the two spreads. In the case of the Amazon and Tesla, because of volatility, you would be able to get off at a higher than $1,000 credit between the two spreads. So that's why Amazon was their maximum loss was no loss. You could only make money on it. It was just, I think, only a couple of $100 was the worst case scenario if the market moved against you. Okay, so for Ravi, let's say, Ted, there might be other stocks that are active for the strategy to minimize risk, tech stocks, trade premium, other options. Yes, there are plenty of other stocks, without a doubt. Tech stocks, because they're big high flyers, this can work for you and against you. Right now, because the market's trending on highs, I wouldn't say that Amazon and Tesla are overdone. They're in incredible bull markets right now, but it doesn't mean that they're not set for a little digestion or a correction. They are already, they're not infant stocks, whereas there's certain stocks that are so young that are breaking out and they're growing to at a rate that is much higher than certain ones. So with that volatility, iron condors become a little bit more difficult. So remember, if you're going to put those on, always look to have at least a credit of around $600 to $700 between your two spreads, between the call and the put spreads. Obviously, getting over $1,000 is not something that happens all the time, but it can happen. Just like I had it in those, I was looking for other ones. Those were the only ones in those two stocks. Everything else would have been below it. But there was a lot of iron condors that you could have gotten off between $650 and $800 at that time also. So, and that's like I said, if you can come close to that, that's almost a free trade. Now, remember, there is no free money in trading. There's sometimes opportunities you can capitalize on, but they're not atypical. They happen every once in a while. Okay, so let's see, Rob, again, I am new to the strategy, but just some observation. I mean, stocks trading under 100 that are active. Yeah, they don't have to be above $100 to put on iron condors, let alone have this type of volatility. It's just that I use these because, once again, when you're learning a new technique, you should use markets that you are familiar with. Trade markets that are liquid. So to use ones that I know everyone is very familiar with, that are out in the news, that I know no matter what are going to be talked about a lot still for the next few months at least. That's why I picked those. Also, because of the fact that there's so much volatility, remember, you're selling volatility, you're selling credit spread, you're bringing in money. So the higher the volatility, the more potential you are to get a bigger credit. Time decay doesn't necessarily work in the sense of like it does with certain strategies where time will help erode. So if you sell high volatility or low volatility, time works in your favor. Time doesn't necessarily work so much in your favor as it will with other spreads, but if you sell high volatility as it drops, it definitely helps you increase your credit, which no matter what, anything that you can, any variable that you can have that helps to give you a higher credit, and the more often you do these trades, one, the more money you'll make, and the less you will lose over time as well, because you won't be taking losers as well either. Remember, I said, don't take trades like that are under $500, because you're not even at a 1-to-1 ratio. You have to make money too often to come out of any shortfall that you would have with that. All right, a couple more questions here before we turn it back to Gina. Two questions. You always close the bear and the call side at the same time. Yeah, you close both positions at the same time, because if you don't, then you're not closing the full position. That would be legging, either just getting out of one leg, and then you go from having an iron condor to having either a call or a put spread on. So yes, when you are done with the iron condor to lock in your money or lock in whatever loss you're at to get out of, you would get out of both spreads simultaneously. All four options would be, you would buy back the ones you sold and sell back the ones that you bought. Okay, so let's see, 2 questions. You always close there. Yeah, we got that. Okay, we got that one for Rosita. All right, keep on going down here to Kent. Do you purchase all 4 contracts at the same trade? Yes, you do. Both credits are done simultaneously. Let's see, Rosie D. If the trade explodes to one side, can you close the side, roll it out, down, and still make money and leave the other side? Okay, once again, yes, you can close one side and leave one side out, but that's not what you're trying to do here. Remember, when you're trading an iron condor, the whole point is to generate a credit, define your risk, define your potential profit, and execute that trade. What you're talking about there, when you're hanging on to one part, remember that time is ticking down. So once you get out of one leg, you no longer have an iron condor. So if, let's say, you did take the side with the most credit on it, then you're margining out. Then you're using part of your account then, because you've already taken a profit that will still go against the potential loss on that other spread, which just makes it then higher because now you've already canceled out one. So yeah, and that's also when you start doing legging around like that, that's why you get opportunities where one side you can get such a huge credit, because people are legging around spreads. That's a topic all in its own for a whole webinar, so I really don't want to get into that one. All right, let's see. And please explain how you get out of the spread. How you get out of the spread? Well, you go to your platform and you just, usually you can do a one tap to get out of most positions. You can do an instant execution to get out of them. So that's one way to do it. Or you could, I guess, depending on your platform and how you put them in, you can just individually pair them up and get out of them. But like I said, I would just get out of them simultaneously and execute, just to go to market. And that's pretty simple to use on any trading platform, whether it's eOption or any other trading platform. All right, how much money in the reserve does such a trade take? Okay, so in the reserve, remember the first one was the Microsoft. Your highest potential profit was $400 and some. That was your credit. So you had to have just over $500 in your account as your risk capital in case the spread went against you. So for that trade, even though you took in $400 and some, you needed to have an extra $500 and some to cover in case the market exploded against you. Okay, now if you got out of it before the market, did explode one way or another, it's still, you have to have that money in. As long as you have that position on, you have to have that maintained in your account. Otherwise, you'd be kicked out of your position. Let's see, for Blake here, option pricing is complicated and had to see in the numbers because they are relative underlying price. What kind of stocks are able to find these no loss situations to help me find them? Remember, the no loss situation, to find this, when they do happen, it happens when you have high volatility and you also have your underlying asset towards an extreme, meaning near its highs or near its lows. So remember that this is something that doesn't happen every day, doesn't happen all the time, but it does happen. So, and you have to be there in the moment. So is it a day trading situation? No, because you're not doing it every day in and out of the market. Is it a day trading situation in the sense that you have to be there around when it happens? Absolutely, yes, you do. So in order to get them on, you have to be aware of the market being volatile at that moment, So in my case, that was, there was volatility, the VIX was screaming, indexes were rallying, and then there was all kinds of other markets that were coming on hinge. So volatility across multiple markets, different asset classes was high, which meant that volatility in these stocks, especially that was right around, I think, when Elon Musk was getting involved with Bitcoin. So just combining Bitcoin and Tesla together, think about that, what it does to volatility. So once that happens, you sell into those spreads. Remember, most options expire worthless. So selling options is where 90% of the money is made. And I'm not saying that means just go out and start selling options. You have to have the right strategy. So yes, just remember, so Blake, don't think that you're just going to find no loss situations. Believe me, if there was that common, and all you could do is just do that every single day, I wouldn't just be doing this webinar, because I certainly wouldn't be talking about it. So, but you can get closer to, like I said, that $700-800 credit range, which definitely puts you in the more profitable opportunistic situation. All right, for Teresa, we're almost done with the questions here. How much more margin do you need to put this trade on? Once again, you don't need any more margin than was the difference between your credit that you take in and your potential loss. So these spreads were $10 wide. Remember, both the call and put spread must be the same distance. They're all the same option expiration month. They must be the same distance, meaning if they're $10 apart in the call spread, they must be $10 apart in the put spread. Then you take a credit from both of them. Remember, you can only lose on one of them potentially. Okay, if the market goes nowhere, you make money on both. If the market goes through or into one of those spreads, that is the spread that you will lose money on. Okay, but you already took a credit in. So you take that credit plus the other credit, which is locked in, because the market can't be in two places at once. And whatever that difference is, you know, if you, like, for instance, like in the Microsoft example, you would have taken in a credit for around, I think it was $450. Your risk would have been around $550. So if you took in $450, and then as long as the market was somewhere in between the strike prices in the call or put spread, then you would not lose a full 1,000 minus the credit. You would be somewhere lower than that. But if the market exploded above or below those credit spreads, then you would be out the full loss on that, which would be the credit minus that difference. So in that case, 550 would have been your maximum potential. You don't need any more money in your account. They don't come looking for more money. They just want the head of money that you need. All right, two last questions, and I'll turn it to Gina, can you determine entering and exiting the strategy in e-option? Yes, you can use their platform to scout around and look for trades on there, and also for the pricing, and just you have to go on the platform and do it. Is there a possibility being assigned? No, there's never a possibility of assigned, because if one, no matter what, you're in between the strikes, so that one cancels out the other. So even if one gets exercised on, the other one covers that one. So no, you never have to worry about it being assigned any stocks. And one last one, is there a possibility stock price moves outside the range of the iron condor that you get extra? Yeah, absolutely, for sure. And yeah, but remember, you're never assigned. Okay, if it goes outside the call or put spread, no matter what, you don't have to worry about being assigned, because one option covers the other. So don't worry about any type of assigned risk. This, once again, was a very neutral. Delta neutral is actually the kind of trade it is. It falls into that. It's not a full delta neutral trade, but it falls into that category. So yes, remember, once again, very important, don't forget this, your risk was defined during these trades. No matter what, it was only that difference between the credit you took in and the spread between the two strike prices. Okay, you cannot be assigned. You cannot lose any more money than that. Okay, so with that, I just want to give you one last reminder about me. I am Teddy Keckstedt from Forex Trading Unlocked. Check out my YouTube channel for other videos, and check out the book I wrote, High Probable Japanese Candlestick Patterns, available on Amazon.com in paperback and Kindle versions. And with that, just remember, you have more options resources at eOption. And now I'll turn it over to Gina.
Okay, great. Well, thank you so much, Teddy. That was very interesting and informative. And thank you to all of our attendees for taking the time out of your busy day. We got an excellent turnout today, and thank you for all of those great questions. If you have more questions and Teddy didn't get a chance to address it, please feel free to give our trade desk a call. The number is 888-793-5333. Again, 888-793-5333. And they're happy to answer any questions that you have. There was one question during the Q&A. Someone asked if there was a minimum to open an account. And I just wanted to let you know there is no minimum to open an account. You can go to eoption.com and just click on the open an account button and fill out the online application to get started. And there's a lot of great benefits to opening an account with eOption. As we've mentioned, it's zero commission for stock and ETF trading, and options are just 10 cents per contract plus $1.99 per option trade. So that's one of the lowest in the industry. You also get free education. We have free tools such as Options Play, as I mentioned in the introduction, where that's a tool that screens thousands of stocks each day and highlights potential option trade opportunities for you. And that's normally $500 annually, and that's free for all of our customers. We also offer free research reports, and something new is we're offering free Zacks research reports, unlimited, on all your favorite stocks, and that's free for all eOption customers. So if you're not currently a customer, we hope you'll give us a try and just go to eoption.com, and there's no minimum to get started. A few people have questions on how they can get a video recording, and that will be available on our website at eoption.com. We have a tab, webinars and videos, and you'll find it there in the next few days. It's also on our YouTube channel, eOptions YouTube channel, and we'll also be sending an email out to all the attendees of this webinar. So if you'd like to watch any part again at your leisure. We also have more education on our website at eoption.com. We do strongly support education. And we do have a great service. It's strategy links. So if there was something on this webinar you'd like to learn more about, such as call spreads or put spreads or even iron condors, you can click on the link and it'll tell you a description, what's the motivation to use it. Some of them have videos. So that's a great way to get started and learn more. Again, as I mentioned, our YouTube channel, we just recently revamped it. So you'll find all kinds of playlists there, whether you want to learn more about spreads or you're a beginner trader and you want to learn about covered calls or learning more about options play, our trading tool. There's all kinds of great playlists on there. So we strongly encourage you to go to our YouTube channel and subscribe. And if you can mark your calendars for our next webinar, it's in just over a month on Wednesday, April 21st at 1 p.m. Central Time. And it's on Leverage Our Trading Platform to Maximize Earnings Season. So Sean Heron, the president of eOption, will walk you through how to use our tools to identify option trading opportunities and how to access our free research reports, news, and create watch lists. He'll also walk you through our trading platform, and you can see how easy it is to place option orders, spreads, stocks, ETFs. So we strongly encourage you to sign up for that at eoption.com/webinars. So again, thank you for attending. We know you have a busy day and we appreciate you taking the time out of your day to join us. Be safe, and we'll see you soon at our next webinar on April 21st. Thank you again, and have a wonderful St. Patrick's Day. Thank you. Bye now. Hello, and welcome to eOptions webinar. We're happy to have you here, and thank you for taking the time out of your day to join us. We're excited to partner again with our speaker, Teddy Keckstadt, a professional trader with over 30 years of experience, to bring you this webinar today on Enter the Options Trading Ring with a Knockout Trading Plan. My name is Gina Bocayas, and I'm with Regal Securities, which is the parent company of eOption and its sister company, InvestTrade. And to provide you some basic logistical information, the session today will last approximately 1 hour. If you have any questions, we're happy to answer them for you. All you need to do is find the Q&A box on your screen and enter those at any time during the presentation. And our speaker, Teddy, will answer all of those at the end of his presentation. Please use the Q&A box and not the chat box, as our speaker won't see your questions if you don't enter them in the Q&A box. You'll be able to access the recording of the webinar in the next few days on our website at eoption.com, and we'll also be emailing you a copy of the recording in the next week. And you can also find it on our YouTube channel if you subscribe to us. And for those of you just joining, we'd like to welcome you to our webinar on Enter the Options Trading Ring with a Knockout Trading Plan. And as eOptions' name implies, we are a firm that specializes in option and stock trading. Our founder was a founding member of the Chicago Board Options Exchange in the 1970s and has been trading stocks and options for nearly 50 years. We charge some of the lowest option rates in the industry. All of our stock and ETF trades are commission-free, are just zero commission for all online trades, and options are just 10 cents per contract plus $1.99 per trade. We also offer a powerful trading platform, mobile app, free trading tools, and live expert support on our trade desk. And that's something we're very proud of, is our excellent customer support, where you can reach out to a licensed broker, a professional with years of experience, and they're happy to answer any question that you have. We also offer a useful options trading tool called Options Play, which scans thousands of stocks each day to highlight potential option trade opportunities for you. Now, this is normally $500 annually, but this is free to all of our customers. We also support option education, and we're glad you can join our webinar today to learn more about using options in your overall trading strategy. And I'd like to now turn your attention to our speaker, Teddy Keckstedt. Teddy has over 30 years of experience in the financial industry and trading. Some of you may recognize his name from past webinars he's done for eOption, and we're excited to welcome him back today. And just to tell you a little bit about him, he has over 30 years of trading and industry experience. He traded at the Chicago Board Options Exchange, the Chicago Mercantile Exchange, and the Chicago Board of Trade for 21 years. And he's been an institutional market analyst for over 25 years. He serves as president of Forex Trading Unlocked, and he is the author of the book, High Probable Japanese Candlestick Patterns. He also has a degree in finance from DePaul University in Chicago. So without further ado, I'll turn it over to Teddy Keckstedt now. Thank you.
Thank you, Gina, for that introduction, and thank you to all of you out there who are coming to participate and watch this webinar. Enter the options trading ring with a knockout trading plan. Okay, we don't have to talk about myself since Gina gave that fabulous introduction. Thank you once again. Real quick, we have to show you our disclaimer from eoption.com to remind you that this webinar is for illustrative and educational purposes only. Remember that everything we view is in a lag and stuff like that, so for the market data. And since I am doing this presentation, I always throw up my company disclaimer as well. All right, get ready to rumble with options. Okay, so what you will learn today, you're going to learn how to trade stock and other market movements without large capital allocations. Expanded portfolio diversification is something else you're going to learn. How to maximize your potential returns with options. Bear and bull directional strategies will be talked about today. And you're also going to learn to see how eOption can help improve your bottom line with your options trading. So why stock option strategies? Well, first of all, you can lower your cost basis. At eOption, it is only 10 cents a contract, much lower than other firms. Options help you diversify your portfolio because you can trade a much broader range of stocks with your allocated capital, which is also something you always want to be mindful of because money management is definitely one of your key variables for success in trading and investing. Options allow smaller to larger investors the ability to capitalize on trending markets that are highly liquid. This is a very important cost control. The nice thing about regulated publicly traded options that you would trade on most equities, they're very, very liquid at all times. Now, what does that mean? That means that the spread between the bid and the ask is usually very, very tight. The tighter it is, the better it is for the customer. The less edge you have to give up. The more edge you give up, the more you will add to your losers and decrease your winning potential. So be very mindful of where you have your liquidity for where you trade and place your options positions is also very important. You know, the tighter your spread, the better your broker, the more it saves you money, increases your bottom line no matter what. Trading in these products is similar to trading in normal equities, but with higher potential ROI and controlled risk. Yes, that's true. Your return on investment definitely has a higher potential with options and option strategies. Okay, today's focus. We're going to talk about credit spreads, which are a type of spread known as a vertical spread. We're also going to talk about debit spreads. They're kind of the same thing. It's just a matter of one you get a credit, one you get a debit. It's pretty much that simple. They are also vertical spreads. We're also going to talk about puts. We're going to talk about calls. We will discuss bullish and bearish strategies, how you would apply which strategy at which time, depending on whether you're bullish or bearish. We're going to show how you can define your risk. We're also going to show you how simple the execution is. And we're also going to evaluate the short-term versus the long-term opportunities with these strategies. Okay, we're going to get to the charts really quickly, but we just want to make sure we have these definitions. Some of you out there are very experienced options traders and have been involved in the market for maybe even longer than myself. Others have probably only been are brand new to it. So we're going to go over these real quick so that you understand the strategies once we get to the charts, what we're talking about. So definitions, buying a call. When you buy a call, that means you have the right, not the obligation, to buy an asset at a specific strike price. That is a long play. If you sell a call, then you give the buyer the right to buy an asset at a specific strike price. Then that is a short play. Okay, I just want to make sure you're very clear on that. The same goes for puts. If you sell a, if you sell a put credit spread, you sell one put option strike price of an asset below the market, and then you will simultaneously buy a lower put option strike price with the same expiration. Now, ideally for vertical credit spreads, 2 to 3 weeks is the best time frame. If you start to go out longer than that, they are not that good. And you will see through our examples and where the market's at today why that is true. We're going to learn a little bit about the Greeks today. You're going to learn about time decay and theta, but instead of having to worry about all kinds of numbers, you're going to learn visually, and by the time we're done, you're going to be like, oh, I have a better grasp of time decay. Okay, so if you sell a call credit spread, that it would be when you sell one call option strike price of an asset above the current market and buy a higher call option strike price with the same expiration. This also ideally is something that you want to execute with no more than a 2 to 3 week time frame before expiration comes. Now, we're going to talk about debit spreads also. If you buy a put debit spread, you will be buying one put option strike price of an asset below the market, and you will simultaneously sell a lower put option strike price with the same expiration. Now, if you're going to sell a call debit spread, then you would buy one call option strike price of an asset above the current market price and sell a higher call option strike price with the same expiration. Okay, we got through the definitions. Now it's time to have some fun. Okay, directional option plays. February 12th expiration. Today is February the 10th. In 2 days is expiration. When I made up the slides for this webinar, I decided, because of the topics, I looked at the pricing for the options, and now we'll see how things would have panned out, whether you were a bull, a bear, and which play you might have chosen. Okay, so for long plays, one way to be long any type of equity or ETF for that matter, or even other markets, would be to buy a call. The nice thing about when you buy a call is your risk is defined. The only amount of money that you can lose is what you pay for the option, also your commission for the option. That is the most that you can possibly lose by a long play when you buy a call option. Another long play is when you sell a put. Okay. Now, the thing about that is you have unlimited risk when you sell a put. So there is a big difference between when you buy an option and when you sell an option. Okay. But now, as far as being a long play, if you sell a put, that is the same thing as being synthetically long is what it is, but it has unlimited risk. Now, if you sell a put credit spread, which is one of the things we just discussed, your risk is defined. So that would mean that you would take a credit in when you simultaneously sell and buy some put options of the same expiration date, but your risk is defined. So no matter what the market does, whether it stays still, rallies to the moon, or crashes to the floor, it doesn't matter. Your risk is defined. You can only lose the difference of what your credit is, and we'll get into that pricing once we get to the examples. The same thing is for if you buy a call debit spread, your risk is defined. That is another long risk-defined play. Now, the other thing you could do is you could buy an asset, high capital outlay. That's the problem with that when it comes to when you actually get into only trading the equity itself or the ETF or whatever market it happens to be. As far as short plays, that is when you would sell a call. Now, this is where the risk is unlimited. Once again, when you sell an option, you have unlimited risk if it goes against you. Now, if you want to do another short play, buying a put, there your risk is defined. The most that you can lose is the purchase price of the option plus your commission that you paid. So should the market rally to the moon, your put expires worthless, that is a defined amount of money that you know that you could possibly lose. Another short play would be to buy a put debit spread. The nice thing, once again, about a debit spread is your risk is defined. However, a debit spread is where you would definitely pay to put on the spread. The next one would be to sell a call credit spread. And this is another nice thing about this is even though you are selling options, your risk is defined. So the nice thing about these vertical spreads, if you are selling them, whether they are debit or credit spreads, unlike a put or a call, if you sell them, your risk is defined. Remember, if you're just in a put or a call, your risk is unlimited. This is big to know. Remember all those hedge fund guys that were out there when GME, when the GameStop blew up in their face, they were all short a stock. They were not hedged. Shorting a stock has unlimited risk. So those geniuses, and the oxymoron is a hedge fund manager, because hedge fund managers never hedge. If they had some options on, even some way out of the money calls, they would have covered and not have lost the amounts of money that they did in that short amount of time. Of course, hindsight is always 20/20. You think they would know how to do that. So anyhow, if you sell an asset, high margin and unlimited risk, that would mean shorting the stock, like the hedge fund guys that got blown up 2 weeks ago. So that I'm sure everyone knows at least something about that that's watching this webinar. Okay, our first example. Now we can get into the visual aspect of this webinar. Now it'll start to make sense what we're talking about and what we're doing. Okay, Amazon.com, everyone's familiar with the stock Amazon. At the time when I produced this slide a couple weeks ago, Amazon was trading at $3,232.58. Now, here, let's figure out what you could do. If you wanted to go short this market, instead of shorting the stock, which we know has unlimited risk, you would buy a put up here. So since the market was at 232, you would buy a put below that at, just above it at 32.35. Now at that point, that option would cost $139.04. Okay, that's what the pricing is here. But actually, you got to remember, anytime you're looking at options, you have to multiply times 100. So that's a very expensive option, but not as expensive as trying to short the stock, right? So we'll get into that pricing. So one thing you could do here is buy that put for $139.04. Or if you wanted to be a bull, you could buy the 3230 call just below the market for $147.90, obviously times 100. So that would be right here. We have your 3230 and 3235 marked here on the chart. You can see how where the close was of this long down day. This was when the webinar was done. We have above here in blue, these are your calls, and we have your puts marked here in red. Okay, so these would be ways that you could go short or long. Now that would also what you could do is you could sell the options. Now remember, when you sell the options, then you start to bring in that unlimited risk factor. So the same prices would be there, and then instead of paying, you would be bringing in that amount of money. So these first two examples where you're buying either a put or a call because you are bullish or bearish and you want to trade Amazon.com, you don't want to put, obviously either put up the money to buy the stock or have the margin to cover the short. And remember, you better have the margin to cover the short because it is a lot. So you're going to tie up a lot of capital with that. Suggesting to go short the market, buy a put instead. That's what I always say. Never go short the stock market. But that's my own personal opinion. So also the flip side here is you could sell these options. There are reasons to sell options. Just because I'm warning you that you have unlimited risk, remember that most options expire worthless. That has to do with the whole flipping of spreads and what have you. Not everyone is having a hedge on or what have you. There's all kinds of reasons for the market mechanics of that. But remember that the ones that do expire and are exercised on or used, somebody had to sell them those. So in this case here, you would be bringing in some nice money. If you sold the put, you bring in $13,904. If you sold the call, you bring in $14,790. Not a bad way to start off a trade, right? But excuse me, remember that you have unlimited risk. Now let's go to the credit spreads. 3235 call for $145 is what you would be selling, and you would be buying the $3245 call above that for $140. If you did that, you would have a credit because you're selling the closer option for more money than you are paying for the other option above the market. So these are these blue ones. The first one you'd be selling, the upper one you would be buying. Now remember, this credit, this is the difference of what this is where the only amount of money that you can make on a credit spread would be the money, the premium that you take in from the simultaneous buying and selling of these options. Remember, they also have the same expiration date. And then obviously your commission also would be, that would be the most that you could lose on the trade. And it would also be, or excuse me, that would be the most that you can make on the trade, which would be minus the commission. Now, what you could lose would be the difference in that spread between your strike prices. So in this case, we have the 32.35 call and the 32.45 call. That's a $10 difference right there, okay? So we'll get into the numbers on the next slide, but this would be a little over $5. This would be a $5.40 credit. So your risk then would be a little less than $4 or a little less than $5. Now on the credit spread to the downside would be the put spread where you're long. Remember, when you sell a credit spread that's a call spread, you're bearish. You want the market to go down. If you sell a put credit spread, you are synthetically long. You want the market to go up. So if you are bullish Amazon.com, you don't want to put up the, well, let's see, $3,282 a share today. Add that times 100, you know, that's a lot of money, you know. The option would be, the spread would be a lot cheaper to go along. Now, remember, when you put on a credit spread, though, you can only make the difference, or you can only make the credit that you received from those, the spread on those options. If the market goes to the moon, it doesn't matter, but it's good for you because the higher it goes, it just locks in your position. You can then sell out of the spread and then you lock in your return. So now we'll look at the debit spread. Remember, a debit spread is where you're actually paying for it. So the pricing is the same. The only difference is that you would be buying the 32.35 call in this case, and then you would be selling the 32.45 call above the market. So in that case, you are paying a little bit more than you're bringing in from your spread, okay? But then your money still, though, is the opposite on what you can make on that spread. So basically, one way you get a credit, you get your money up front. The other one is you put money up front and then you have to wait for your spread to expire, and that's how you collect your money when you roll out of it. So it'll all start to make sense in this next slide here. So your vertical spreads with an expiration of 2/12/2021 that we were looking at there. If you were to put on the call credit spread, that would mean you would be putting on a short position, okay? Instead of selling the stock outright in Amazon.com, which would have a limited risk, or buying a put. Remember, we talked about that as another way to go short. A call credit spread is a great way to go short here. Now, you would be selling that 32.35 call with the February 12th expiration, which you would be bringing in $145.43. Well, actually, it's actually more than that. We'll get into the pricing. But then you have the option you're buying, which would be the $32.45 call, which is above the market, above that, for $140.03. Remember, you have to multiply everything times 100, but it doesn't matter because the credit here still is the same no matter what you put the dollar amount or the option quote price. So your credit would be $5.40 or $540. So that would mean that if you put on this spread, when we put on these slides, if you would have sold the credit spread, you would have brought in instantly for that one option selling it for the 32.35 call and buying one option of the 32.45 call strike prices, you would have a credit in your account for $540. Now the risk, because it's $10 wide, would be $460 because it's $10 wide, it's $1,000. So you're bringing in $540. The most that you could lose is $460 if the spread was to blow up in your face, okay? Because you already took in $540, so $540 minus $1,000 would be the $460. So you know what your defined risk is, it's $460, and you know that right off the bat, you already took your money in. So if you're correct and the market goes down, your money is already in your account. And you can always roll out of the spread and take money early if you want to before expiration. Now, also, you could put on a put credit spread. Remember, that's a way of going long the market. So that's when you want Amazon to go up. So you would be selling the credit spread below the market. So in this case, you would be selling a 32.30 put for $142.46, and you'd be buying the 332.20 put for $138.30. This would give you a net credit of $4.16 or $416. Now on the put spread, this one has a little bit higher risk because it's $10 wide, which is $1,000. You're bringing in $416. So your risk then would be the $584 difference there. So that would be the difference. You have a little bit more risk on this put spread than you would have the call spread. But remember, one is a short position, one is a long position. So depending on what your rationale is for Amazon and if you were to trade this, these would be ways of looking at it. Remember, you could buy the stock. We know how much that's going to cost you, which you have definitely unlimited potential to the upside, and you have a limited downside risk, but no matter what, you have a risk to the downside there. It's not controlled. Now let's look at the debit spreads. If you do the call debit spread, you would be long once again, and that's where you would be buying that $32.35 call and you for $145.43, and you'd be selling the $32.45 call for $140.03. You would have a net debit of $540. This is just a flip side. The debit is just the flip side of a credit. Okay, so that's why these numbers are the same. You just have to remember that it's negative. So in this case, it would cost $416 to put on your debit spread to go short, and it would cost $540 to go long or with a debit spread, just to let you know. Now, to give you an idea of option pricing, today, these numbers here, like we'll start out with this call. This call right here is $145.43. That's selling this $32.35 call or buying it. So whether it's the credit spread or the debit spread, right there, this $145 is now $56.95. So in just 2 weeks, the dollar amount has decreased by 60%. Okay, and there's only 2 days left. So that's a big deal. And the reason that you have this difference, and the irony is the spread is actually still pretty much around this. It's just a little bit different. You could actually put a credit spread on now in these markets for a little bit more than you could back then 2 weeks ago. In fact, you could do it now. This same spread that was $540, you could sell this credit spread in the same options market right here, these same prices, with 2 days left to expiration, where you would have a credit would be of what, $7.50. So $750 with only 2 days left. So this is where, when you only have a couple days left and you are just expecting the market to go down on a stock like this, you put on a credit spread like this, you only have 2 days of risk, and the amount of money you're risking also then would be less than $300. So time is already gone out of the equation, because that's where these prices have gone down, and you can utilize that in the pricing of today's current markets. So now let's see what we would have done here. Let's just say you would have bought 100 shares of Amazon at $3,232. You would have had a debit of, this would be $323,258 in your account. So just to go long 100 shares, if you were a bull, this is how much money of your capital you would have to absorb. If you were to buy the 3230 call, remember we talked about just buying an outright call, it would cost you $14,790. Now, the nice thing about the call is, just like being long, if the market goes up, you're going to make money on that. If you were to look at that call right now, though, because Amazon has only gone up a little bit, the same $32.30 call that is, what is it, $147.90 here, was today, it's trading around $57.25. So this is also like a third of the value. Time decay, because the market hasn't really moved that much, like there's all kinds of variables when it comes to pricing out an option. And we're not going to get into that, because that would be a whole webinar in itself, just option pricing. But this is why we're getting into the different plays and why you would use them. If you were long the stock, all good for you, you're up money. If you were long the call, even though it's going in your favor, the market rallied around $50. When you buy an option, you have time decay, and that works against you, and it moves really fast, especially with short-term expiration. And that's why we're teaching you these different plays. Like, you don't want to use 2 weeks out just being long or an option, because typically you need to have a radical price move in order to realize any true return on that directional play. Reason being is time decay will erode that option, because whenever you buy an option or sell an option, time decay is a value, and the shorter time you have left, the faster it moves against you. So these options here, had you put them on, you would actually be down money had you bought this call. Buying the put, obviously with the market going up, you would be down money in that. So anyway here, the only way of these three situations would you be up is if you bought the stock, but look at what you would have had to put up. Now, if you would have sold 100 shares of Amazon short to be a bear, high margin and unlimited risk, obviously you'd be out $50 a share times 100. So then you could have sold a $32.30 call. Now this is where, remember, how this option went down in price, even though the market went up, you could have sold that option for $14,790, but you would have unlimited risk. The thing about this is, and this is why I said people do sell them, and there's no reason not to, is that had you sold that option right now, you'd be able to buy it back for a third of what you sold it for, and then your risk is off the table. Now, the one thing though is, had Amazon rallied more than $50, what if it pulled a Tesla or a GameStop and all of a sudden it rallied like $400? It's not like that couldn't happen. Well, then that whoever was short that stock would be obviously screwed, and then also the same thing would happen for anyone that sold that call, because they would have to make good on the stock at that price. So now if you own the stock already and you sold the option, worst thing that happens is they take the stock away from you. You made the money on the selling the call, and then that's a good thing. And that's where actually you can make money, when you own the stock already and you sell a call like that to make the 14,000. Think about that. You're already up on the stock. If the worst thing that happens is the stock rallies, you don't see that big realized return for owning the stock anymore, but you did make almost $15,000 up front in a short amount of time, and you're out of both positions, and then you have a bunch of capital to work with. So now if you sold a 235 put, remember that would be for a credit of $13,904. In that case, obviously, that put would be down to, $8.85. So that option would have decayed also. You'd be able to buy that one back actually at a profit as well. And that's obviously because the market is $50 higher. Selling a put, any puts you sold would be going in your favor anyhow. Okay, so hopefully you got that understanding. Now, as far as the call credit spread, remember that would have been short. So $540 is what you would have risked and have under pressure. And right now, with the way the spread is, you would be down to, the spread is very small now. Yeah, it's probably about less than half of that right now. As far as the put credit spread being long, that $416, that would be pretty much money in the bank at this point. With the 2 days left, it would be great just get out of the spread if you were to have had it, because the couple dollars it would cost to get out would be irrelevant, and you would still be up that money right off the bat. The same thing is for a call debit spread going long. You would have cost you $540. Now, because the market has moved $50 and it's above your strike prices, there's no more realized gain that you could have in your debit spread. So that would be the time to get rid of it. And then also your put debit spread where you are short. Well, obviously that's gone to zero. So there's nothing, you could just might as well hang on to it in case Amazon all of a sudden collapses in price between now and the expiration on Friday, in which stranger things have happened, especially in the last year as far as market volatility. All right, now we're going to move a little bit faster. So Tesla, in this case, you would be buying it. When I did this slideshow at first, it was $864.16. As you can see, that's in between this first blue line and this first red line here. Remember, the blues are calls, the reds are our put prices. Okay, so Tesla today is down. It was trading around $814 before around lunchtime. So that means that in this case, had you bought the $865 put for $63.49, meaning you were going short, you would be in the right direction. Right now, that put would be $51.60. Now, there's only a $50 move. The reason that there was a $50 move and you're not up as much money as you would think with this put is because of the time decay. Time decay has eroded the value of this put. Remember that whenever you buy an option and you're only buying, time decay is in your favor when you're selling an option, and it works against you when you're buying an option. Now, the funny thing is when we're talking about our credit and our debit spreads, time decay is neutralized. It doesn't matter at all, period. Nothing. It doesn't mean anything as far as the pricing, because you're net neutral. Where your time decay is hurting you on one option, it's helping you on the other. So they have a cancellation effect. So that's why credit spreads and debit spreads, they take out a lot of risk. They help you define your risk and let you enjoy a lot of things that market movement happens, and you can take an opportunity and you don't have to have all the stress. Okay. So now, if you would have bought the call, you would be losing money on this one. This call is now down to $2.55. So, but look at this. If you would have sold the put, obviously the 865 put, you would be sweating it right now unless you own the stock to cover any exercise that could happen against you. Because remember, in this case, you would be going long and the market went down. But had you sold the 862.50 call, this is where time decay really helps you, because the 862.50 call now is worth $2.55. So this call right here you would see a realized value of basically $64 or 60. That's a lot. That's a lot on this, because when you add, we'll get to the next slide, you'll see how the numbers are. So if you did a credit spread here, now this is where it's nice and interesting, is that if you did the credit spread, you would have been selling the first strike price call above the market at 865 for 63.80 and buying the 875 call for 57.90. This would have given you a net credit and you would then be bearish this market. So in this case, this credit spread is in your favor. Like with 2 days left to go, anything could happen with Tesla. I mean, Elon Musk, this guy just spent what, 1.5 billion on Bitcoin yesterday. Who knows what he's going to do today that can make, we've seen Tesla jump hundreds of dollars alone in just days. So right now, if you had on this spread and you were up on the short position, 2 days left, don't get greedy. There's nothing left in this trade. Get out of it, take your money and run. Now, had you put on the put credit spread, that would be a different story. You're screwed, you were long, you're out. That money, that position is pretty much worthless. In this case, you might as well wait and hope that Elon does something crazy between now and Friday morning to make Tesla's stock, well, it could be up $200 tomorrow for all we know. So in that case, you would just hang on to that one. Now, another way to be long would be to do the call debit spread, right? So in this case, it would just be the flip side of doing a credit spread. And obviously with the put spread where you're short, it's the opposite of doing the put credit spread where you are long. Let's see what this all totals out to. So for your vertical spreads expiring tomorrow Friday on February the 12th, your call credit spread, which is a short play, you would have brought in a $590. Okay, per spread that you execute. Okay, and that would be short. So right now you would be in the money on this spread here, and for $590, and let's see what would be the credit to get back out. Yeah, now you could do it for like $1. So there's like only you would realize over $400, almost $400 on this spread if you were to get out of it right now, if you were to buy it back. Remember, there's 2 days left. There's next to nothing left in it as far as any vig, meaning any price left. Getting out of a short position like this would be, if you had done it at this time, would be a good time to do it. Although time decay, remember, is going so fast that this thing tomorrow, if you look at it, probably is going to be half the price of what it is today. Also the same thing now, it's put credit spread. Had you been long, this one you would have brought in a credit of $691. So yeah, you'd be out the $300 on this one. It's already worked into the price, so it wouldn't change a thing. You might as well just leave it to expiration and pray that Elon Musk says something that makes the stock go up $200, and all of a sudden your put credit spread would become in the money and be a winner. Another reason to get out of your call credit spread. The opposite here is for the debit. Remember, if you're doing a call debit spread, that's the same thing as being long. In this case, you would be down this $590. The market's down at the bottom. There's nothing left. You would leave on the spread. There's no reason to get out of it since you've already lost. It's already down to basically zero. So now you give it 2 days, and once again, hope that Elon comes out of nowhere, and sets it up for a big rally between Friday morning and Monday, over the weekend. Then we have the put debit spread. If you were short here, where 691, you pretty much have your money in the bank, collect what you can. You'd only have cost you probably about $120 to get out of it, and realize your $500 and some gain. All right, so costs for this whole February 2012 expiration. If you bought 100 shares of Tesla, it would have cost you $864.65 a share, or $86,465 of your capital in your account. If you were to buy the call, it would have cost you $6,653. Okay, which right now you would be out that money right now, pretty much. It would be dead between time decay and the fact that where the market value is at, market price is at. This option would be worthless. Remember what I say, the $862.50, yeah, it's worth $2.55. So it's only worth $250. Considering you already lost $6,400 and almost all of it, you would just stay on that for 2 days and see what happens. Even like a $50 rally tomorrow would have you being able to sell it out and maybe get $500 back. So I would definitely wait on that one if you were to be still long that kind of a trade. If you bought the put for, it costs $6,349 at this point, since you could buy it, see, the thing is, it's still expensive because of the premium. It's 51. So you could probably say that this might be a good time to get back at that one. So I don't know. This is kind of iffy. It's right there on a borderline price. So remember, time decay takes a lot of value out of the put pricing. So at this point, you probably would want to just wait for it to expire and just take, or you could get out of it, but you could probably give it another 2 days. It wouldn't matter. If you sold 100 shares of Tesla short right now, you would be up money. However, you would have unlimited risk. And remember, he could say something crazy overnight tonight, and tomorrow the stock's $200 higher, and you would be out a lot of money. Then you're starting with 86,000 right off the bat. You'd be definitely being burned a lot. So, or you could sell the call, think for a credit of $6,653. But remember, you had unlimited risk. But right now, if you did sell that call, you'd be able to buy it back now for $255. Which, had you sold this call at that point, that would have been the thing to do right now, is to buy it back. You'd be making $6,400. Your money is done. Your risk is off the table. If you would have sold the 865 put for a credit of $6,349, well, in that case, you're screwed on this one because you're out all that difference. Hopefully you own the stock at that point. That's why high downside risk. It's unlimited. Remember, we don't like things like that. Or, well, you can do it, but you better know how to cover yourself still with that, or you're going to have some troubles with your margins, that's for sure. The call credit spread, remember, that was a short play. You brought in $590. That's a pretty good play. Getting out of it right now would not be a bad idea. The put credit spread, which would have been a long play, remember, you would be out the $691 on this one. Or actually, you'd be out $1,000 minus the $691. That would be the difference that you would be out on that one. The call debit spread, which is a long play, $590 is what it costs. You'd be making $1,000, so you'd be making $410 on that one. That's a good play. You can get out of it now and maybe only make $350, but still you'd be able to make money on that one. The put debit spread, which means a short of $691. In this case, you take that minus $1,000. That's the money that you would, the put debit spread rather, which we are short here. In this case, you would be up money on this one. And, we just have to see what the pricing here. I would say you might want to let that one go for another day or two if you were to have done that one. So we're going to do one more quick one. We're going to blow through this one and then answer some questions out there. Okay, so for this one, we're looking at Microsoft Corp, which at the time of the making of these slides, it was trading at $232. Today at lunchtime, it was around $241, $242. So really no market movement. This is where you're going to start to see where time decay really makes sense, because the numbers before are so big, it's kind of hard to look at. So let's take a look at this. If you were to buy at a 235 put and go short, it would have cost you which is $800. You could have bought the call of 232.50, which would have been a long play for $752, which is $7.52. Or you could have sold the options, obviously, for the same prices, in which case selling the put makes you long, selling the call would make you short. It's the opposite. For the call credit spread, you would be short. You would be selling the 235 call for $6.20 and buying the $245 call for $269. The credit spread for the put spread would be selling the 232. That's this lower one here and this lower red. This is kind of hard with this chart because it was in such a rally that these call strike prices are up here. Here's your 245 call, your 235 call. So the put spread you can see here where you have the 232.50 put here and the 222.50 put here. That's where you would have a, remember, credit here, and that is also the long play. Conversely, for a debit spread, remember where it costs you money up front. If you were doing the long play, you would be buying the 235 call and selling the higher call above it, the 245 strike price for 269. Conversely, for the put spread, you would be short, meaning you would buy the 232.50 put and you'd be selling the 222.50 put as well. So for these vertical spreads at expiration, your call credit spread, once again, you would be short. You'd be bringing in a credit of $351. The put spread, you would be long. You'd be bringing in a credit of $345. Conversely, for the debit, this is what you would be paying out for it. Now, remember that this pricing, unlike the other two examples, the market's only moved $10. It's not a very big move. So what would mean, in pricing wise, what would be the thing that would have affected these options the most? If you've been paying attention, time value. Remember, time theta decreases at a high rate the closer you get to expiration. So the value and pricing of these options would be the only thing that would be really affected the most, because there's no movement there. It's only $10. It's not that much of a difference in price. I mean, $10 is a decent move, but not when the stock costs $240. So in this case, if you bought the 100 shares at $232.90, now it's at $241.77. So it would have cost you $23,290 to get into this position, and then now it would be obviously up. The call would have cost you $752, and now that would be a debit in your account because you've been purchasing the option, okay? And that would right now be $9.17, so that'd be $917. So considering that you have 2 days left and you are up after a $10 move, about $100 and some dollars, $150, $60, I would say getting out of that call would be the right thing to do because you only have 2 days left. As far as buying the put, which gives you the right to be short, you're out $800. It's pretty much worthless. You would just let this go and hope that Microsoft really falls through the floor over the next 2 days. If you were short 100 shares, your margin would be super high. You would have your unlimited risk, remember, and you would be down you'd be down $10 on that position times 100. If you would have sold the 32.50 call for a credit of $752 and had unlimited risk, obviously you would be down on this one. Hopefully you own the stock. Otherwise you're going to owe, well, it depends if it rallies even more money because someone is going to be buying it from you at that strike price. The strike for the put credit spread, or excuse me, selling a put would be $800. In this case, you still have high downside risk, but this one right here, you would be up money because the market's been rallying. Since there's 2 days left and anything could happen, I would say take your money and run if you would have sold the put. For the call credit spread, being short, $351. In this case, you would be down a little bit of money. But see, here's the thing is that the spreads, the difference sometimes doesn't, the pricing moves, but the credit doesn't move and the debit doesn't move, because since the market didn't move, this really wouldn't change very much. So getting out of it, you might as well just leave it to expiration because the market hasn't moved, whether you're short or long very much. So the short one, you'd be out a little bit of money. You could maybe buy it back if you wanted to get out of it. But your difference of what you would lose or not lose would be slight. So you might as well give yourself that 2 days of time. Remember, time meaning till expiration, not because of the decreasing in price, because of the time value. Your put credit spread would be $345. And then your call debit spread, if you were long this, your debit of $351, you would have some value in this one. So you could buy it back, or excuse me, sell it back and make a little bit of premium because of the $10 move. The put debit spread where you'd be short the $345, you pretty much have exhausted your pricing on this one. So for the 2 days left, I would say you would give that more time. So remember that these strategies, if you want to learn how to maximize your options trading potential, there's ways you can do that. First of all, you use e-option for your stock ETF and ETF option trading. There's also their option strategy tools like Options Play that you can use, and you can use these strategies and try and apply them and see how time and also how certain things would apply and impact these strategies. Remember, we chose the 2 to 3 weeks expiration, showing you how the vertical spreads, even though your return on investment it's very high for the amount of money you take in, but you can have a lot of market movement. It doesn't matter. You're only looking for X amount of money, but the thing is you can make that in a very quick amount of time. The other plays, whether you're outright the stock or ETF, or if you bought the calls or puts, remember you need to have a big move in your favor or else time and other things will go against you. And also you have high capital outlays. You could put on a lot of spreads for the differences here. We're going to get to your questions in one quick second. Remember, there's a free paper trading account also at eOption that you can use to test your strategies. Your ETF and stock trades are free, commission free rather, and your options contracts are only 10 cents per contract. So questions about the webinar option strategies and applications. Remember, you can always learn more at eOption. Let's see. I got your questions. Let's see. Is this trading based on U.S. markets? Yes, these are all from the NYSE and the NASDAQ. Anonymous NT. So when you say you don't want to be long 2 weeks out on a call that expires 2/12. Okay, so here's the reason why you don't want to be long necessarily a call that's when it's only 2 weeks out. Remember, time, it moves fastest, where time decay will erode the pricing. So when you buy an option, just the buying of it means that that price is going to erode. If it doesn't move, if the market doesn't move at all, the time value alone is going to make the price of that option go down very quickly. So let's just say it was 5 when you bought it with 2 weeks left. Within a week, it's going to be at 2 just because if the market doesn't move, just because of time. Okay, so you need the faster time is moving, the bigger market move you have to have in your favor to compensate for the money that you're losing from that premium. Okay, so let's see, what are the cons and pros of credit and debit spreads? Okay, the pros and cons of credit and debit spreads are super easy. The pros, no matter what, for both of them is that you have defined risk. One of the biggest things for I don't care whether you're a bull, a bear, how you figure out when you want to go long or short, whatever market, you always need to define your risk. You always have a trading plan, have a value for your risk allocation. And this is the thing that this kind of trading strategy fits in that model perfectly, because you know 100% when you sell a credit spread, what is the most money you can risk. When you buy a debit spread, you know 100% the only money you can risk and lose is what you already put out. So you can't even lose. No, it's already out of your account. It's already done as far as you're concerned. The best thing that can happen is you make money and you have money that comes back. Now, as far as cons, the con is that if you use a credit or a debit spread to whether you're being short or long in your direction, remember we showed you how you can use a credit spread to be short or a debit spread to be short, and also conversely to be long either one. Depending on that, if you have a major market move, like remember, if you buy a stock and it goes to the moon, you're only going to make on your credit or debit spread, if it's a bullish one, that difference between either your credit or your debit. Okay. Whereas if you own the stock and it kept rallying like $100, you're going to be beyond your strike prices. You would realize all of that gain. So you don't have unlimited upside potential with credit and debit spreads, but the controlled risk factor is one of the most amazing factors and opportunities for any investor or trader to truly take advantage of because of defined risk. And then you know what your ROI is. So instead of putting up hundreds of thousands of dollars to buy Amazon stock, get longs from credit or debit spreads, and you don't have to put up hundreds of thousands of dollars. Now, of course, you're not going to see those big returns to the upside, but they don't pay a dividend. And you know what? If that goes down, you're out a lot of money. So you can control your capital much better. Let's see. I see no mention of risk regarding credit spreads. Wait, that's bouncing around. There's so many questions coming in. Excuse me. I see no mention of risks regarding credit spreads that go south and suddenly get early assignment on expensive shares. Okay, well, here's the thing is, when it comes to a credit spread, your risk is only the difference between the two strike prices. Okay, so when let's say it's $10 wide. So if it's a 220 strike price that you're you're selling and then you're buying the 230 strike price, okay, above the market, that credit that you take in, whatever that pricing is, no matter what, you're only risking $10 of market movement. It's always defined, okay? So absolutely, that is the risk, and it doesn't matter about assignment of anything or whatever, because you can only make so much on a credit spread and you can only lose so much no matter what the market does. Early assignment, you don't have to worry about it. That has nothing to play into that. Now, if you're talking about early assignment when you have other positions on, like when you're naked an option, where you sold an option like a call or a put, that's a totally different story. And that's one why we discussed how, remember, you don't want to be like those hedge fund managers that got, they're everything handed to them on a plate, that's for sure. So remember to always define your risk. That's why you use options. You hedge yourself in market movements by options, and it's a cheap way to do it. It's basically insurance policies that pay off all the time. Now, sometimes they don't. There's also times where you don't want them to pay off because you're making money somewhere else, especially if you own the stock. Do you accept Canadian clients? You have to refer to the options trading desk. They'll help you out with that question. Do dividends have an impact on your liability when option trading? Well, absolutely. The dividends coming out can cause volatility in stocks, especially if they change them, like increase them or decrease them by a big amount. So that's how they would. As far as pricing and stuff, obviously volatility creates option pricing differences, whether up or down, depending on the increasing or decreasing of volatility. So yes, good question. Dividends do have an impact, but it could be slight, it could be huge. It totally depends on the move of whether, like, for instance, if they stop all of a sudden cut dividends or something, like not even just cut them, like completely cut them out, like that would change a stock's price and value for sure. What about leaps with e-option? Those are questions you have to talk to the trade desk about. When would you use a spread of only $5? That's easy. We were looking at stocks that have such volatility. So $10 wide is nothing, it was for pricing. When you're looking at Amazon and Tesla, stocks that are 800 to, multiple thousands of dollars versus a stock that's 55, if you have a stock that's trading like Coca-Cola around $50, then yes, absolutely. You would have spreads that are only $5 wide. In fact, a lot of times you can get some of your best value on credit and debit spreads with the tighter, options. So especially because people don't watch them as much, they're not as sexy, if you will, as some of the high flyers. So let's see, we still have a couple minutes for some more questions here. This is really good. You guys got a lot of good questions today. Is a credit debit spread also known as a straddle? No. Okay. Straddles and strangles are, remember, where you are simultaneously, those are vertical spreads as well. However, straddle and strangle is when you have the same expiration. Okay. A straddle is when you have the same price, same strike price, put and call, and a strangle is when you have, there's a little spread between them. The only difference is that when you're buying those are directional plays. So you just want the market to move when you're buying a straddle or strangle. You don't care which way it goes. You just want it to move away, especially when you're buying them, because time value will decrease that price no matter what, because the time value when you buy a straddle or a strangle, both options will be losing money, time decay, every single day. So the price of that option will be decreasing whether it moves or doesn't move. So price movement is super important. Whereas with credit and debit spreads, the market doesn't even have to move. All it's got to do is expire. So it either has to move or expire, and then what your risk and what your potential reward is, which it's only when it moves against your direction of your credit or debit spread that you're going to end up losing money, but your risk is defined. If it doesn't move or it moves in your favor, then you make money, versus straddles and strangles. Very good question, but that's a nice thing where you learn about time decay too, because remember, if you were selling a straddle or strangle, time decay works in your favor, but then you have unlimited risk. So that's a totally another topic for another webinar. Can you explain the option Greeks? Well, that would be a whole webinar in itself. Time decay is the theta. You should hopefully have gotten a little better understanding of how, when we looked at these options, how within a short amount of time, some decay a lot, like when you do the outright puts or calls, or when you're buying on an option, any type of options, versus when you sell them, time decay works in your favor with short amount of time. Now, let's just say you had an option that's 4 months out. Well, then time decay, you have a lot of time. So the time pricing isn't really moving. So if the market's not moving and just a couple days go down, your option price doesn't really move because of time decay, because you have 4 months out. Now, if you have 4 days out, like now we have only 2 left, or 1.5 going into, or 2 days left, yeah, 2.5 rather, going into option expiration. Time decay is almost all gone, and whatever's left, it's going to erode very, very quickly. So if the market doesn't move, that's going to that premium, part of the premium will be gone. Then there's delta and a bunch of other things that we have to get into as far as how much the market movement goes. All right, so we're going to wrap this up now. I'm going to show you one last thing real quick. Really good questions. I'll try and answer some of these after we turn this over to Gina. But I want to remind you to check out my YouTube channel, Forex Trading Unlocked. If you like this webinar and the information you got there, I do all kinds of other presentations, and also remind you about checking out the book High Probable Japanese Candlestick Patterns, available on Amazon.com in paperback and Kindle versions. You can apply these option strategies with these candlestick patterns and have a way of helping to find you get some good signals. That's which you can find out by reading the book. And so for more resources for you, I want to remind you about eoption.com for more option trading resources. To watch more videos of options tradings, you can subscribe to their YouTube channel as well, eoption at YouTube. And then also get the, or obviously since you watched the webinar, you're going to be emailed a copy of it anyhow. And remember that their next webinar, mark your calendar, is Thursday, March the 4th at 1 p.m. Central Standard Time, bullish and bearish options strategies. Sign up at eoption.com/webinars. And thank you very much.
Okay, great. Thanks so much, Teddy. We really appreciate it. That was very interesting and informative. And on behalf of eOption, we'd like to thank all of our attendees for taking the time out of your busy day and for all of your questions. Those were great. And if you want to trade some of these strategies, don't forget to take advantage of eOption's low rates. We charge just 0 commission for online stock and ETF trades, and options are just 10 cents a trade plus $1.99 a contract. And we know some of you on this call are already account holders, but if you're not and you're interested in opening an account, just feel free to go to eoption.com and you will find buttons there to open an account, and it's pretty easy to get started. We also have a paper trading account, so if you want to try us out, try our trading platform, put your watch lists in there and your news and alerts, you can definitely give us a try with a paper trading account. You'll get $100,000 in virtual currency to get started, and that's free of charge. And a couple people in the chat room asked if they'll be getting a copy of this. And yes, we will be emailing all of the attendees a copy of this so you can watch it at your leisure. And you should receive that in the next few days. And it will also be on eoption.com. We have a resources and education page that has a lot on there. And it will also be on our YouTube channel. So lots of ways you can find a copy there. And we do have, I can't stress enough, I hope you'll go to eoption.com. We have all kinds of education on there for you. You'll find clickable strategy links with videos. So for example, if you want to find out about a certain spread or option strategy, you can just click on the link and it'll tell you all about it, as well as videos on how to use that strategy. We also have all of our past webinars on our website. And then as we mentioned, Options Play is our trading tool. It basically scans thousands of stocks each day and highlights option trade opportunities for you if you're looking for trading ideas. And that's normally $500 annually. And we do offer that free to all of our customers. And also feel free to give our trade desk a call. We're happy to answer any of your questions. And that number is 888-793-5333. Again, 888-793-5333. And that really differentiates us from other firms. I know there's a lot of firms out there where you can just use a trading app and it's really hard to speak to someone, but we pride ourselves that it's easy to get through to speak to a licensed, experienced broker, and we're happy to answer any of your questions. So if you have questions about a particular option strategy that Teddy mentioned today, or just how to use our trading platform or get started with our tools, we're always happy to talk to you. So give us a call. And as mentioned, we hope you'll check out our YouTube channel, and the link is on the page that you're looking at. And we just revamped that. We're pretty excited about it. We have all kinds of new playlists, So if you want to get into covered calls, you can click on that. You'll see all of our past videos on that. If you want to get into more complex strategies, you can also click on that playlist and you'll see all kinds of webinars come up. If you want to use our trading platform, we have all kinds of videos on how to get started and enter complex option strategies. So we hope that you'll check that out. And someone asked a question about the Greeks. If you go to our YouTube channel, we did do a series on the Greeks. We did one on Delta and Gamma and one on Theta, Vega, and Rho. So if you do go, you will see some videos there where you can get started and learn more about it. And as Teddy mentioned, we hope you'll join us for our next webinar that's coming up in early March, and that will be sponsored by the Option Industry Council, and we partner with them a few times a year. So we're very excited about that one. You can go to our website and sign up at eoption.com/webinars, where we will be sending out some email reminders leading up to it. You can also sign up there. So again, thank you so much for attending. We know you have a busy day and we appreciate you taking the time out of your day to join us. And be safe, and we'll see you soon at the next webinar on March 4th. Thank you again. Bye now.
Hello, and welcome to eOptions webinar. And we're excited to have you here, and thank you for taking the time out of your day to join us. We're happy to partner with our speaker, Teddy Keckstadt, a professional trader with over 30 years of experience, to bring you this webinar on kicking off the year with option credit spreads. My name is Gina Bocaius, and I'm with Regal Securities, the parent company of eOption and its sister company, InvestTrade. And to provide you some basic logistical information, the session today will last approximately 1 hour. If you have any questions during the webinar presentation, please feel free to type them into the question box, and our speaker will answer those at the end of his presentation. Please use the Q&A box and not the chat box, as our speaker won't see what's in the chat box, and you should be able to find the Q&A box on your screen. Also, you can reach out to eOptions Trade Desk at any time if you have any additional questions after the webinar. We're always happy to answer your questions, especially about option trades. And you can access the recording of the webinar in the next week on our website at eoption.com. And we'll also be emailing you a copy of the recording in the next week. You'll also find it on eOption's YouTube channel, so make sure you subscribe. And for those of you just joining, we'd like to welcome you to our webinar on Kick Off the Year with Option Credit Spreads. And as eOption's name implies, we are a firm that specializes in option and stock trading. Our founder was a founding member of the Chicago Board Options Exchange in the 70s and has been trading stocks and options for over 50 years. And he created his ideal trading company for those who love and have a passion for trading. At eOption, we charge some of the lowest option rates in the industry, and all stock and ETF trades are commission-free, and options are just 10 cents per contract plus $1.99 per trade. We also offer a powerful trading platform, a mobile app, free trading tools, and live expert support on our trade desk. So we encourage you to go to eoption.com, which also has many resources to assist you in your options trading. We support option education, and we're glad you can join our webinar today to learn more about using options to trade in this volatile, unprecedented market environment. I'd like to turn our attention to our speaker now, Teddy Keckstadt. Teddy has over 30 years of experience in the financial industry and trading. Some of you may recognize his name from our past webinars he's done for eOption over the last year, and we're excited to welcome him back today. And he has over 30 years of trading and industry experience. He traded on the Chicago Board Options Exchange, Chicago Mercantile Exchange, and the Chicago Board of Trade for 21 years, and he's been an institutional market analyst for over 25 years. He serves as president of Forex Trading Unlocked, and he is the author of High Probable Japanese Candlestick Patterns. He has a degree in finance from DePaul University in Chicago. And without further ado, I'll turn it over to Teddy Keckstadt. Thank you.
Thank you, Gina, for that introduction, and thank you, eOption, for hosting this webinar today, and also to all the attendees. So now let's get on with kick off the year with option credit spreads. Okay. And here we go. So you already had a little background about me, so I can skip on that. Real quick, we want to give you the disclaimer from eOption to remind you that this webinar is for illustrative and educational purposes only. And I always put up my disclaimer for my company as well for anything that I do. Okay, so today you're going to learn how to maximize your option trading potential Use e-option for your stock, ETF, and options trading. Free option strategy tools like Options Play are available on their website, which after this webinar you may wish to use. Free option strategy guidebook is also available on their website. There's a paper trading account that you can use to test your strategies like the ones you're going to learn today. And then also remember that ETF and stock trades are commission free at e-option, and all option contract commissions are only 10 cents per contract. All right, what you will learn today. Well, first of all, the thing you're going to learn is how to get paid first. So, but you're going to learn how to trade stock and other market movements without large capital allocations. You're going to also learn how to expand your portfolio diversification by using these strategies today. Also, you're going to learn how to maximize your potential returns with options. Then also, bear and bull directional strategies will be addressed today. So whichever side you like to trade or are prepared to trade, or what kind of system you have, you'll be able to adapt this to either type of strategies. And also you're going to learn how e-option can help improve your bottom line. One is through the cost efficient basis right there to lower your cost. And there's other things too besides the tools that are available. So without further ado, so why stock option strategies? Well, first of all, they lower your cost basis. And e-option is only 10 cents a contract. We covered that. So that's one thing that's going to help you out through these strategies. The spreads that we're going to be covering today are 2 options for each spread. So that would mean that you're going to be, it would only be obviously 20 cents a spread for that because there's 2 options there. So options help you to diversify your portfolio because you can trade a much broader range of stocks with your allocated capital. We're going to look at 3 different examples of stocks today with credit spreads. And when you see the difference in pricing on these stocks, you'll see how if you were trading the stock outright, buying the stock and what have you, what kind of a capital allocation you would take to take advantage of just small to even large movements in the marketplace. And you'll see how that comes clear today. Now, options allow the smaller to large and to larger investors the ability to capitalize on trendy markets that are highly liquid. Remember that all the equity markets that have options markets these days, they're super liquid, which means that when you're super liquid, you have very tight spreads getting in and out. So it's not like years ago where you had to really put in limits and you had to be careful about getting in and out of spreads because the pricing was so wide. Now, because there is so much volume, meaning liquidity, the spread to get in and out is tighter, and that helps the option trader and investor these days, especially because now everyone's off the floor and it's computerized. So this is a very important cost control. So remember, part of trading, to be successful, one thing is to always try and control your costs first, because whether you win or lose, your costs are a variable that are always against you. So that if you can control and minimize and maximize your potential through whatever strategies you use by using that technique, it will always improve your bottom line. That's just a basic accounting fact. So now trading these products is also similar to trading in normal equities, but with a higher potential ROI and controlled risk. So what does that mean? That means your return on investment through these strategies is higher than if you would just be buying the stock outright, or even worse, shorting the stock, which is a very, very high risk, educated trader and capitalized trader thing to do. And also we're going to control risk. Controlling risk is one of the key principles to money management and being not just a successful trader and investor, but once again, controlling and maximizing your bottom line to benefit you in the long run. So today's focus, credit spreads. Credit spreads are spreads where you get paid first. You're going to be buying and selling an options simultaneously, but the net effect is that when you do that transaction, in your account, you will have a credit, meaning your balance will go up. Now, we will go over the risk and what that means when that happens. So now these strategies that we are going to use today are both bullish and bearish strategies. So whether you're looking for the market to rally and go up and be a bull, or to fall apart and break down and be a bear, these strategies can be utilized. So there's always, for credit spreads, whenever you're picking a direction, you'll always have an option, no pun intended. So another thing about credit spreads is that you will have defined risk. So now the defined risk comes into play for money management. You always want to have defined risk, whether you're investing, trading, whatever you're doing in the markets. If you do not have defined risk going into whatever it is you are going to do, not only are you gambling and being foolish, I promise you in the long run, you will only hurt your bottom line, no matter how often you are successful on an investment or a trade or what have you. The other thing about these spreads is they're simple to execute. Simple execution means that whether you are a complex and experienced veteran trader or investor, you can obviously execute this strategy. You probably have done this before. Maybe this is today's webinar will help you learn how to use them more in a better fashion. For those of you that have never used a credit spread, the execution is very, very simple. It's a very basic strategy to implement. Now, today's focus, short-term versus long-term. We're going to go over that on how you implement these strategies. Now, for those of you that have watched webinars in the past that I've done for eOption, for a lot of the strategies that I have done, and for the most part, you use options that are 30 to 45 days or more out as far as before they expire. Today, we're going to have short-term versus long-term expectations on these strategies. For the most part, the options that we will be looking at, they're options that expire in under 30 to 45 days, sometimes even under 30. And we're going to go over the pricing and how you evaluate which ones are the ones you would try and utilize. Now, the reason that we're going to talk about this short-term and use shorter-term options is because we're going to talk about a couple of the Greeks today. So what do the Greeks have to do with it? Now, before you start getting worried and start to have some math anxiety, don't worry. We're not going to have any XY graphs and curves and all kinds of things that you're going to be looking at and be confused about. So we're going to lay it out very straight and simple, with a very simple definition, and you're going to learn how a couple of the Greek variables work in your favor for these spreads. So with that, now let's move on to the next slide. Okay, so what is an option credit spread? Okay, first of all, a credit spread is the opposite of a debit spread. Pretty obvious, right? So it is a vertical spread, okay? And it is always defined, okay? So now when I said it's the opposite of a debit spread, it's like an obvious, he's saying that it's obvious. A debit is where it would you would be paying money to put on a spread, okay? Remember, in a credit spread, you're taking money up front. So your risk is always defined because the money you take from your credit spread, that is the maximum amount of money that you can make on the trade. It is defined right there. But just like that's the maximum amount of money you can make on the trade, your risk is also defined by the difference of the options. And we'll get into the pricing on that. So that is where this vertical spread gives you the option or the ability with these options to define your risk and take your profit right off the bat. So if your trade is correct, you will have your money up front. Now, obviously, not every investment or trade goes the right way. You will have losers, but your risk will be defined with that. So now, why is this a vertical spread? The reason it's a vertical spread is because we will be trading a bullish or bearish direction. Okay, but if the market doesn't move, it's not the end of the world for you either. And you'll understand that as we get into the spread basics. So typically these spreads do well with shorter expirations. Okay, this is because of delta. Okay, now a negative delta will help a bear call credit spread, which is one of the spreads we're going to go over. And a positive delta will help a bullish put credit spread, which is another spread that we are going to go over. Okay, this helps the premium the premium decay faster in both instances. Notice the dollar signs. Remember, this is a credit spread. So you are selling, you are a net seller, you are taking in money right off the bat. So if time decay helps the premium decay faster with these shorter term options, that means that for whatever, when you sold the option, as soon as you sold that, right off the bat, that value
is kicking in right away. So whether it's a day later or 2 days later, it's accelerating your way no matter what in price. So if the market doesn't move at all, the value of that spread, if you were to get out of it, you would be able to make money because of time decay. It would be moving in your favor. Now, it may be very slight if the market doesn't move, and obviously if the market goes the opposite way, that changes the pricing too, but that value will work in your favor. Now, another thing that helps you is that out of the money credit spreads have a large positive betas that will decrease an option premium quickly under a shorter time frame. This is also money. Now, why does it say out of the money credit spreads? Well, the reason is that these spreads, when we go over them, we're going to look at where the stock price is. And then if it's a call spread above the market, we will be using two options that are the strike prices are above the market price. And the opposite will be if they are put spreads, then both the strike prices will be below the stock trading price. So that's why they are out of the money. They're not right, or if they were at the money, they would be pretty much right at the stock price. So we're going to be putting these spreads where they are actually away from the actual current market price. So that's why they are OTM. So now we're going to get into why delta and theta help you. Remember, a negative delta is good for your bear call spreads, and a positive delta is good for your bullish put spreads. Now, theta is something that's very easy to remember, okay? If you can remember time decay, then you can remember theta. Theta and time decay are synonymous. They mean the same thing. So when someone refers to theta, they're trying to talk sophisticated and mathematically in the Greek way. If they say time decay, they're saying it in kindergarten terms, and also so that everybody understands for sure which Greek you're talking about. And time decay, the closer you are to expiration, the more it works in your favor. So think about it like this. When you buy an option that's 3 months out, it's good. Your time decay, since you have so much time, that time value doesn't move very quickly. So no matter where the market's going, that value doesn't move for that option. That's locked in your premium. But when you're selling premium, you want that to disappear because you want to sell something for more than what you're going to buy it back, or you want it to expire worthless. Okay, that's how you make your money. So this is where time helps you right away. So remember, delta is the amount an option price is expected to help you as far as when it moves. Okay, if it moves in your favor, that also helps the premium work in your favor. And with the theta, that's just the time value. So now we're going to get into these examples. So for long term, the time decay is positive, but it's slow. Okay. For the long term, delta moves in the favor of a position, but not as fast. Theta also works in your favor, but not as well as with short-term options, remember? So in the long-term options, that's why you don't use credit spreads. Not that you can't, and we're going to have an example where you might. We're going to show you these things, and then you'll understand these Greeks, and we're almost there. We get to this last slide. We're going to get to the charts, and you're going to be like, oh, now I know what he's talking about. So use these in place of longer-term directional trades. So that's when you would use one of these credit spreads, maybe with the further out dates, okay? And that'll become clearer to you when we get to the charts. For short term, and this is where you make your money, remember, you're getting paid up front. So if you're getting paid, you want to make sure you keep your money. And that's where credit spreads are great, because time decay is almost gone from the premium right away. It disappears. From the time you put it on, it is moving. It just keeps on going in your favor. Once you sell it, the value of the option goes down because time is ticking down. Think about the hourglass. When you first flip it over, it's filled with all kinds of sand and it looks like it's just moving really slow, the whole volume. But once you get down to that bottom and it curves in, it starts just flying, or at least it appears to be. That's how time decay works. So delta helps to reduce the spread premium quickly also. Okay, so when you have these two variables, that's what's going to happen. And now we're going to show you how to take advantage of the short-term movements in the market or lack thereof. So Amazon.com is our first example here. And when I first put this webinar together, it was at the end of the trading year for 2020. So now we are looking at options that are expiring on
the end of this week, which would be the 15th, because today's the 13th. So I picked options that would be within basically 2 to 3, 4 weeks for most of these examples, because that will help you with the Greeks that we're talking about here. Okay, so now Amazon, which you're all familiar with, topped out on a monthly basis about 4 months ago. And they had this little bearish sell signal called a bearish engulfing line. Okay, so just, you don't have to worry about whether it is or isn't going to go up or down. This is for the examples. Plus, we needed to have a reason to go for a direction. So we have an upside risk level that sets us at 35.52, and we have a downside risk level. That's the range for the last high and the low. So we're trying to find a spread directionally, because if we're going to be bearish, since we have a bearish sell signal, then we would be putting on a call spread. So we would be selling the market above the market. Okay, so we would, in this case, the market was trading at 3,256, but because our upside risk level is so high, the only options we could look at would be at 3,550 and 3,560. So in this case, you would be selling the lower call at 35.50 and buying the 35.60 call. Okay, now that would only yield a net credit of $1. It's because it's so far out. Okay. Now, the same thing is to the downside. If you look, or excuse me, even if you go out just one more week, now remember, just the one more week would give you a time premium value. So if the same spread, the same options, they should be, if they're expiring 1 week further out, because of the time decay, they should actually be worth a little bit more. And you can see this from the pricing here, that the first one here, the first spread, is where you're selling the 35.50 call and buying the 35.60 call with an expiration of January 15th. Then we look at the ones from January 22nd, a week later, that are expiring next week. That would be a 35.60 call that you would sell here, and you would buy the 35.60 call to cover the other side. Now, this would give you a credit of $1.82. So what does that mean? Well, you can see that because of the two Greek values, just 1 week alone, the very same strike prices, if you were to put on that trade, this credit spread, you would get more for that 1 week. And that's because your delta would have longer time and have longer time for movement. And then also your theta, which is time decay, there's more value there. So that's where you're looking at the same strike prices, just different expiration dates. And remember, you're going to be selling and buying the same expiration date at just different strike prices. So in this case, it would have been a 35.50 call and a 35.60 call. The only thing is it's too far out. There's no money in it. So the value you would take with these spreads would be $1, which is 100, or for the second spread, $1.82 is $182. The only problem with this is that your risk is between 35.50 and 35.60. So that's $1,000 risk. Now, if you're only taking in $100 or 182, you're laying huge odds. So this is where pricing and the time decay, even though there's a short amount of time, you would be laying extreme odds. So if you were like a betting person, that's when you hear about people laying odds where you bet like $400 to win $100. That's what you would be doing in this kind of situation. So, and I don't like those kinds of odds. So once again, with these credit spreads, real quick, and this will start to get clear. We're using these easy numbers to get you with the Greeks real quick. The January 15th spread, you would have been selling the 35.50 call above the market for $8.80, which is 880, excuse me. And you would be buying the 35.60 call for $7.80, which is 780. That would be a net credit of $1 or $100, okay, for the pricing. The January 22nd options, which would be expiring next week, next Friday, you would be selling the same type of strikes and buying the same strikes, just a different expiration, remember. So selling the 35.50 call would be $15.27 or $1,500. That's a $1,527 that you'd be selling. And then you'd be buying the 35.60 call for $1,345 for a net credit of $1.82, which would be only $182. Now, granted, there's not much time left, so, but there's just, I mean, the market has to go rally a good amount of distance to get up there, but still there's not, you're laying a lot of risk. Okay, so we have a couple of questions. We're going to get to those. They're good ones, but I just want to get through these examples so you'll start to see these spreads. So let's look at the Amazon. This is the same time. I did it on the 31st, or the last trading day of the year. This is the daily chart. Now, there was this bearish engulfing line sell signal 2 days before the market end of the year. So now we have options that we can look at where there's a little bit more pricing and ability and where to make some money. So these are much closer though. So now the market was trading once again at 32.56 when it was settling at the end of the year. So these are the options you could have looked at on a different level for strikes. In this case, for January 15th, if you look at the orange lines here, there's 3,350 and 3,360. So that means that's the 3350 call and the 3360 call. In this case, you would be selling the lower one because that is the more expensive one, and you buy the higher one. That's the cheaper one. That's why you get a credit in these spreads. You're selling the closer one and selling and buying out the one that's further out. So in this case, you get $1.66. Well, that's kind of like the last options, and these are much closer. Not a lot of VIG there. There's nothing. Why would you take on that kind of risk, huh? Interestingly enough, though, you go out one more week to next week, and this is where you find your opportunities with options, folks. Here you have a next Friday expiration. The credit is $7.32. That's $732. In this case, you would still be selling the 3350 call, which is this first one here, which is just above this last high on a daily basis, because this is our risk level. So remember, we looked at the monthly chart. Now we're using this daily. It's much tighter. And then we would be buying the 3360 call. So these prices here would be where you're selling the call at $33.50 for $51.75, which is $5,175. Remember, you always multiply by 100. Then you'd be buying the 3360 call for $4,443, which nets you the $7.32, which is $732. Now, in this case, here's something where you could be shorting Amazon.com with this credit spread synthetically, and you would initially take in $732. Now, the nice thing about it is that your risk here is the difference between that $732 and the $10, which is $1,000, the difference between these two strike prices. So that's only $268. So now you're risking, when you're taking in almost 3 times what you're risking. So these are good. This is where you get your ROI. So in this case, instead of where I showed you those first 2 spreads where you would be laying huge odds, now you're getting odds. You're getting huge odds because right up front, you're getting paid, and your risk is that not only does the market have to rally all the way above 3360 for you to lose, if you do, you only lose that $268, which would equate to the difference of these calls on the spread once you get out of it or once it goes through that price. Now, should it not get above 33.60, it won't go that far and you won't lose as much. As long as it settles somewhere above, below 30, if you look at 3,350 is your first call level right here, since $7.32 is your credit, it has to be $7 above that. So that'd be 3,357.32. So as long as the market stays below that, you would still be up money on this credit spread. Okay, so now this is where the value of looking at these things, and when you have bullish and bearish opportunities, how to find value and how to take opportunity in the market. So in this case with Amazon, we found that first we had a monthly sell signal, but there was no value in credit spreads. There was only risk. You'd be laying odds. Then we switched to the daily. We found a confirming daily sell signal. But with this one, we found within 3 weeks of the date of when we were looking at the market, a credit spread that had a high ROI, which was the January 22nd. That's the second spread here. So the first one, remember, the same strike prices, only 1 week's different. You would have been laying, look at this, you would have brought in a credit of $1.66. That's $166. You would have been risking over $800 on one spread to be short synthetically Amazon. Ironically, how much would it cost to be short 100 shares of stock at Amazon at that price? Now are you starting to see the value of credit spreads and options? Think about that one for a second. So we'll get into that further. But once again, we have January 22nd here. You sell the 33.5 call, you buy the 33.60 call. These are the same strike prices. You're doing the same action. You're selling the closer call and you're buying the further one out. This one, however, you get a credit of $7.32. That's $732. So now, if you were to have done this spread, and today, if you would have wanted to get out of it, see, now here's the beauty of it. If you would have done, you couldn't have done the January 15th spread that expires in 2 days. It wasn't worth it. But you could have done the January 22nd that expires next week and get out of it right now for a debit of $1.10, which is $110. Now, remember, if you were to get out of it as a debit, that's because you would be buying it. So to buy this spread back, it would cost $1.10. So you're going to have a profit of $6.22 or $622 in the past 2 weeks had you initiated this credit spread being short synthetically Amazon.com. Pretty interesting, isn't it? So, and the thing is too, is if you still thought it was going down and you really, now here's the beauty of it is there's only $1.10 left. There's no reason to wait until next week for expiration. You would just get out of it right now. Why wouldn't you? Because now you have all to lose and nothing to gain really anymore on this spread. So now you would have a perfect opportunity to have shorted Amazon stock for 2 weeks and it wouldn't have cost you very much money. And you would have had, guess what? Your account balance would have gone up right off the bat. Now, obviously, there is, because of the difference, you always have the risk you have to cover. So in this case, your account would have had held for margin $2,268, but that's it. That's it, because that's the only, everything else was paid for because you already have the money. So no matter what, this is the case where you get paid up front, you have an opportunity, and you can exercise that opportunity and have a huge return on your investment, meaning a high ROI. If you shorted the stock, you would not be able to take advantage of that market movement. Had you bought the puts also, because the thing is, Amazon, when I did this example, when I first looked at the option pricing for these spreads, Amazon was trading at $3,256. Today it's trading at $3,173. So it's only at basically $75 lower, which is not much at those prices. Okay. So even if you had bought in a put, that would have had to be at the money or above the market to really have seen any value. Okay. And here's the problem is, had you bought a put, because of those two variables that we talked about, remember delta and theta, we didn't forget about those, your value of buying a put would have started to decay because of time and also the market movement that would have also worked against you. So then being outright a put would not have been as good as putting on a credit spread where you get paid first. Pretty interesting, huh? Okay, so here's another thing that really blow your mind. So since you're starting to get the idea of taking money up front, look at this. We had the bearish engulfing line sell signal on the daily. Remember, this is the same chart, and we have the January 15th example with the $1.66 credit, and then we have the January 22nd for a $7.32 credit. Look at this one here. If you would have done this trade and you wanted to actually, and this is where I said you always want to do it within 45 days, 30 to 45 days, you still could have done a January 19th, okay, or February 19th, excuse me. That would have been pushing the barrier. But look at the pricing. The same strike prices, selling a 33.50 call and buying a 33.60 call would have had a net credit of $9.20. Now, here's the beauty of this one, folks. Now, normally I would say you don't go that far out, especially for a credit spread. Well, now here's the thing though, is you're only risking $80 like right off the bat, this is $9.20. Okay, that means you take in $920. The spread is only $1,000 wide. That's $10. So if you take in 920 and it's $1,000, is that's the risk altogether. Your risk is only $80. So if you were really bearish this market, okay, then and wanted to have a little bit longer term, that's when you would stretch it out to something like next month. Okay, so that would be, now if you look at our chart here, you can see these vertical gray lines that shows the first one is January 15th, the second one is the 22nd, and you can see how this chart in the market would possibly wiggle into here no matter what. By time it crosses that. Out here, this other line, that's how far out in time. So the market could scream to high all-time new highs, in which case you would lose this on this position, but guess what? You'd only lose $80. Think about that one, folks. If you wanted to short Amazon.com, you wouldn't be able to stay short through February 19th if it's kept on railing through and made new highs. You'd be losing on margin. If you put on a credit spread, you'd have lost $80. That's it. You know, so this is where you find some huge value. Now, here's another interesting fact for you. Let's say you did put on this 219 credit spread and didn't want to do the $7.32. Today, you would be able to get out of it for $5.08, meaning $508. Okay. Now, the thing is, because of time decay, the delta and theta, there's still more premium in there. So that means that you only were risking, but now you don't make as much money. Now remember, on this first one here, the January 22nd, you would be making $6.22 or $622 on the credit spread if you were to get out of it today. This other one here, you wouldn't make as much, but that's because there's the time decay value. Remember theta, time decay? There's more time, so there's the time premium. So remember we're going to teach Greeks especially the newer people. Time decay, the longer you have, doesn't matter whether the option's going up or down, there's always a time premium. And the further you go out, the more of it there is. The closer you get to expiration, the less there is, and the faster it erodes. All right, so now we're going to start to get through some stuff real quick. So real quick review on that one. You took in a credit of 920 if you want to do that further out option by selling the 33.50 call and buying the 35.60 call. So the total debit on that one and the profit would have been $5.08 or $508. So two different ways to play that same credit spread. So now Walt Disney, remember Disney, they're streaming everything and making a fortune right now. Everyone's buying Disney Plus and signing up because they own Star Wars and God knows what. Well, look at this chart of Disney. There's two big gaps that have been there for the past couple months that need to be filled. Why do I say that? Well, it's not that they have to be, but there is a trader's adage that all gaps get filled. Now, does that mean it's going to happen tomorrow or maybe even ever? No, not really. But it's a reason to look at a type of spread, which would mean we'd be playing the short side. So in this case, we'd be looking at the January 15th and also the January 22nd option expirations. So that's this upcoming Friday and next Friday. In both cases, we're going to look at the 180 call and 190 call strike prices. In both cases, once again, you sell the closer strike price and you buy the further out strike price. In this case, if you wanted the January 15th spread, if you wanted to put it on a couple of weeks ago, it would have been for a credit of $3.54. And the one that goes out another extra week is $3.85. Now, this would be a case where since the pricing is so close to gain an extra week, I would probably say, why not take out the January 22nd one, especially if you were really bearish this market. So just because the pricing is so very, very close. Now, what happens here is that in this one here, remember the January 15th, you are selling it for the 180 call, which is the close one, buying the 190 call, you get a credit of $3.54. Today, if you were to buy it back, you would have had a debit of 53 cents. Now, here's the thing is, you're risking 2 2-to-1 on these trades. So this is where credit spreads are for the person in this situation. When you start to getting these smaller values for the credit, if it's going to be between basically 300 and 500 or $3 and $5, that's when you're looking for the person that really wants to go short. You have a sell signal. Okay. You really need to have a reason why you're bearish the market. Okay, so that's very important because of the value. Remember the spreads that I showed you where we had $7, $6 credit, $8, $9 credit. That's where you have an opportunity because one, you're getting paid up front always, but you actually have something where you have a return on your investment. If you're right, you're getting paid 2 times, 3 times to $1 that you're risking. You know, in this case, you're laying odds. So when you're laying odds, you want to make sure that you really are a bear, you know, so instead of being a short traders, which I never suggest anyone shorting any stock because of the margin that it takes. You have to be a very sophisticated investor. However, that doesn't mean that you can't go short the market. Or here's another thing is, let's say that you're long Disney and you want to stay long Disney outright. Well, then putting on these credit spreads, that's why you would do it, because you've probably heard of doing covered calls. Well, covered calls really don't give you that much value for what you're doing. Not that I don't suggest those strategies. There are times to do it and based on the level of investor or trader. However, you know what's a better idea than covered calls? Credit spreads. So that's a case where, you know, why you're probably been asking yourself, well, if we have these cheap credit spreads, why would we use them? Well, there's all kinds of traders and all kinds of reasons why we use strategies. So remember, once again, when we started out, I was saying we're going to give you reasons where if you're a bull or a bear, how you can execute certain strategies. Right now, I was just showing you because of certain examples why to be long or short. Okay. So in this case here, if you would have done the 1 extra week, remember how the pricing was very similar? If you were to get out of it today, the debit would have been $1.53. Okay. So as far as what you would have made, you wouldn't have made as much on the one that goes out an extra week next week, remember? And that's because of delta and theta. Remember time decay, those values are there. So remember why I said, like, you know, the first one looks like, well, if you wanted to be short longer, then that you would do the January 22nd. But if you were just looking to kind of capitalize on the movement, the 2-week one is the better one because you know that theta, that time decay, that erodes. It's basically like hot potato. It's like you want the spread to go, you want the market to break, but you really just want the time to disappear and just get out of it and take your money and run, you know? So, and that's where these values, I think, might start to becoming clearer to you. So we're going to give you one more example and then we're going to get to our questions real quick. So sometimes it just does not add up. Yeah, that is misspelled, but it is, it's kind of fitting anyhow. So in this case, we have 2 examples. We have this, and these are both January 15th. We have Pfizer. Now, ironically, Pfizer, when we did this example, was trading at 36.81, and today it really didn't move any. It's pretty much right where it was at. Now, Pfizer is in the news every day. We know that. We don't need to talk about why, but we hear about Pfizer more than we've heard about Pfizer in decades. So let's just say you're either bullish or bearish. So remember, if you are bullish, you would put on a put spread. That's these red lines right here. This is the $36 and $35 strike prices, these red ones. If you are bullish, or excuse me, bearish this spread, then you would be selling the call spreads, which is this $37 strike and $38 strike. Remember, and here's the stock trading right in between these 2 credit spreads. So in this case, these blue lines, you would be selling this for a net credit of 93 cents. Or you could do this put spread down here for a net credit of 3 cents. So this is either $30 or $93. There is not a lot here whatsoever. So this would be a case where you're like, well, why would you put these on? You know, and the interesting thing enough is that sometimes it just doesn't add up. There's no value. You would think that even though this market, the stock is at a much lower pricing basis because it's only trading in the 30s versus the 3000s like Amazon that we looked at, that these options might be worth more, especially with all the volatility and news. But sometimes it's just not the case. They're very liquid, but there's not enough VIG here. So there's not much here, but this is a situation where, for instance, like I said, instead of doing a covered call, where let's say you own Pfizer stock and you can see how even in the midst of, there's reasons why most people would think it would be going up right now, that it isn't. So if you think that there's a chance that, you know, it could stay sideways or not get its real big rally, then that would be a situation where you would be selling these calls right here. Okay, because you're not looking for it to really go up. Okay, now if you think it's going to go up now and is pretty much based. Now, remember, we were talking about gaps. There's a gap here and a gap over here. 2 gaps were filled. This market could be ready to explode to the upside over the next week, week and a half. You know, in that case, you would be putting on your put spread. Okay. So once again, real quick with the Pfizer, if you were to put on the January 15th, there would have been only a credit of 93 cents, which is $93. Today, you could have gotten out of it for 14 cents, which is $14. So there's not much there. But once again, even with the put spread, if you were just looking for a short-term little insurance policy versus doing like a covered call or whatever, you would use these examples. And the same thing is with this put spread here, there's not much in it. You would have had a credit of 3 cents and today it would have been a debit of 4. So you actually would have been, you would have been scratching to losing money on that one actually. So there's nothing there, but as far as, unless you're, like I said, using it like a covered call. So you're only using it to try and let it erode a little bit. And if it does go against you, you own the stock. But if you don't own the stock, I wouldn't suggest doing it without having a high premium. So once again, with this, you should through this, you should have gained some ideas on how to maximize your option trading potential. Remember, we showed you ways how you can use credit spreads instead of going short and having all that kind of risk and margin where you can get paid up front and you know what your risk is defined. And you can use this on stocks, ETFs. Remember to also check out Options Play and also this option strategy guidebook at eoption.com to help learn how to use these strategies. You can test it with the trading account that they also have, or the paper trading account. And also remember that the ETF and stock trades are commission free at eoption.com, as well as their option contract pricing is only 10 cents a contract. So with that, let's get into some questions here. Let's see, why set up credit spreads on P&L there. The answer is for okay, what percent of your account should you risk? I've read 5%, i.e. 500 per 10,000 on an account. That is a very, very good question. When it comes to how much you should risk, well, first of all, it depends on, are you talking about overall risk or on an individual trade or investment? For sure, you never want to risk more than 5% of your total account value of more than 5%. The reason for that is you have to think about how much of a return you need to make back losses. Okay, and the reason I'm going to get, there's 2 things I'm going to get at you first here. If you had all of your money 100% in an investment or a trade, and let's say you lose 5%, we'll just use even the 5% as an example, okay? That money that you have to make back now on that 100% of the money you originally had, now you only have 95% left. To recoup the money you lost, you have to make more than 5% to get back that money, okay? Everyone understands that. Now, if you only had 5% of your account at risk in any one investment or trade, when they go south, whether you lose only 5% or 50%, which you should never lose that much, you should have risk defined and not have those kinds of issues. But should you have those issues, that's why you have it spread out in increments like that, because you have more bullets. It's like one of my traders and mentors, when I first started working as a clerk when I was 18 years old, I asked him, like, what is one of the best things of advice that you could give me to know about that I should always remember? And you know what he said to me? He's like, Teddy, he's like, you see this pit, you see these boards. He's like, these markets are ticking 5 days a week unless it's a holiday. He's like, day in and day out, whether you or I come in, whether we're here or sick or not, whatever, this stuff is here. He's like, the whole point of being here is to make money. He's like, you want to be able to keep coming back here. He's like, so don't risk it all in one day. He's like, because if you do, odds are you're not coming back here. But guess what? The opportunities will still be here. you just won't have those anymore. So if you put all your eggs in one basket, and the more you risk, that's why you diversify a portfolio. You have more than one stock investment. It's not that you are missing out by you didn't put it all in this one stock. Well, yeah, you're also not missing out on a loss if you put it all in one stock, or trade or investment. So yes, 5% is definitely the most on any trade or investment that you should, if you are balancing out, and these are money management rules, whether you're option trading, stock trading, ETF, or whatever. Let's see, can you quickly say how to determine your strike price? Yes, the strike price is for your credit spreads. Now remember, if you are having your bear call spread, which means you're buying the closer call above the stock price, the first one, and then you would be buying or selling a higher call price, usually $5 to $10 out above it. So depending on the option, I like to usually do $10 and get a decent premium, but you could also go tighter. Just remember that you take your stock price, and to figure out your strike price, if it is a bear call spread, your first strike price above the stock current price would be the call that you would be selling, and then you would be buying a call above that at a higher strike price. I recommend $10 higher. You could also do $5 higher. You would have less. You would have less risk, but you'd also have less of a bang for your buck as well. The same thing would be to the downside. If you were putting on a bullish put spread, meaning you want the market to go up, then you would look at the stock price where it's currently trading. You would sell the first strike price put below the market, and then you would buy either $5 to $10 below that strike price to counteract the part to get your credit, and that's where you'll be buying that in. So then that would give you your net credit for your spread, and remember your strike price is above or below, whether it's a bullish or a bearish call or put spread. Okay, how do you select strikes? I think that question was just answered with that one. Does the profit come when the option trade is closed, close to expiration? Okay, no, that's fine. Don't worry about your English there. That's great. That's pretty funny. Very good question. Your profit from your trade. Remember, you get paid first. So here's how your profit works. The stock doesn't move at all whatsoever, and you could let the options just expire worthless, in which case you would make the full credit minus your transaction cost. Or the market could, for instance, like in a bear call spread where you want the market to go lower, the stock tanks. It goes down like $30, $50, whatever, who knows, it's so far out of the way. You can let those expire worthless also. Okay, now if they expire worthless, then you realize once again the full credit minus your commission. Now, when we were doing these examples, remember when I showed you about how you had a nice credit, now you could get out of it today, even whether we have 2 more days or next week to expiration. If you've realized the majority of potential profit in your credit spread, whether it's the call spread or a put spread, and you only have 2 days left, like in the one example, the credit was $7 and some cents or $700 and some dollars. Now, if you have 2 days left and you can buy it back for around $100 and lock in your $600 today, and your risk is gone, and now you have that capital is yours. No one can take it away unless you spend it or put it on and lose it in another trade, then that would be the right time to get out of it. You don't need to wait till expiration. Now, if the market goes against you, remember, like if you have a call spread on and all of a sudden the market rallies above it, that's where you can lose the difference of the credit and the spread difference of your strike prices. So if you have strikes that are $10 apart, that means the risk is $1,000 or $10, okay? And you subtract your premium that you take up front from that. And that's why you look at the ones where you have, like, for instance, $400 to $600, $700 or more in premium. That's where you're getting 2 to 3, 4 to 1 odds on your money.
Now, if you're going to be under 300 or around 300, that's where you're laying odds. And that's why I said you want to be careful about that. That's when you really would be trading directionally and you're focused on that. Like you, instead of going short, it's better to put on the credit spread because you're not risking as much as you would if you were doing the outright stock. Next question, do you use Delta? Okay, remember Delta, we got into the fact that Delta works for you in the sense that a negative Delta is good for bear call spreads, meaning you want the market to go down. So a negative Delta, market going down, is good for the call spreads. A positive Delta is good when the market is going up and you're bullish and you have the put spreads. Okay, so depending on which spreads you have, then you want Delta to move in your favor. Now, for instance, here's where Delta works in your favor. If you put on a bear call spread, meaning you're synthetically short, and the market goes down, Delta works for you. So whatever you sold your credit spread at, besides the time decay that's always erasing, Delta moves in your favor. If the stock doesn't move and the spread doesn't move, Delta doesn't really decay very much over time. But the more it moves away from where when you initiated your position, the more it does help you. And that's why it helps these spreads, because these are vertical spreads. You're anticipating movement to happen. And if the movement happens, the Delta helps your premium erode right away, just like the time decay. So in other words, like for instance, you put the spreads on, 5 days later, you still have another week and a half to go. You're up money, and because there's a major move in the stock, Delta would have really helped you with that. You still would have a time variable where that would be keeping that premium a little bit higher, but because if you have a major stock move it, so yes, you can use Delta if you have an explosive move that goes in your favor of your spread. Absolutely. And then you can get out of it quicker, or you could even put on a different spread to look into at that point, which is a whole nother thing, and that would be a more advanced technique. Let's see, real quick, we only got a couple minutes left for questions, but I'll get through these, I think. How do you find stocks you want to apply credit spread strategies for? Right off the bat, I look for the most active and most volatile stocks. And then you look for the pricing. And then it depends on what you want to do. Like for instance, like I said, with the Amazon ones, especially like, think about this. Let's say you own Amazon stock. You had that monthly sell signal and the daily sell signal, and you're just like, oh my gosh, Teddy, I know I should take a little off, but I just don't want to do it. Well, that's where you put on the credit spread. Instead of selling covered calls and being like, oh, I'll just take the heat and now I'm giving up all this profit as the stock goes down. Well, why not make a little bit more money on it? So, and plus a covered call, you could always get exercised on. So I mean, excuse me, not that you would get exercised on it, but you won't have a bang for your buck or return on your investment like you would with a credit spread. So in that case, the long-term Amazon bull, it's like, I'm staying long Amazon the rest of my life. Well, when you get sell signals, you put on a credit spread. What's the worst thing that's going to happen? You just lose a little bit of money, or you absorb part of that quick short trade right off the bat. Amazon comes along, and all of a sudden you have more money in your account and value than you would have before, especially because as far as I know, Amazon's not paying any type of big dividends anytime soon. So putting on credit spreads every time they break, or even if you still don't have the money to buy Amazon, that's when you put on your bullish put spreads. For those of you that can't buy it, look to find some good ones, especially if you can get a good spread rate on it, then you're really getting a bang for your buck. So let's see, as I understood to be successful credit spread, I need to be correct with my assumptive direction. Yes, okay. Yes, this is correct. To be successful in a credit spread, you need to be correct with your assumptive direction, or the market needs to not move at all. Remember, if the market doesn't move at all, time decay will work and expiration will eventually happen. So, which strategy I need to use if the market moves sideways? That's a whole nother question. If you're expecting sideways movement, the good thing is that if the market moves sideways, theta works in your, remember, time decay, that works for you right off the bat. So if the stock never moves and you sell a credit spread, no matter what, come expiration, if the stock doesn't move or it goes sideways and stays within the strike, below the strike price, whether it's a call spread or above the put, first put, if it's a put spread, you're fine. You're good to go. Let's see. I understand the buy and sell the credit spread. Please explain how you get out of the credit spread. Really simple. Just like in a call spread, you're buying the first call and you're selling the above call. You're just going to do the opposite. You're going to sell the first call and you're going to buy back the other call. Now, on your trading platform, you can usually, depending on how you entered it and what you're doing, you can just put that in together. So you don't, it's a very simple execution. So, and usually what you can do when you have a spread on or any type of trade is you can get out instantly. So the platform will get you out. So as far as getting, it's not a complicated thing to execute. You don't have to be like, well, which one do I do first? You know, you can do it simultaneously and then you're in and out. It's very, that's the one nice thing about the computers that made that much more simple. Let's see, do you mainly use a specific strategy, iron condor, credit spreads, etc.? Let's see, I'm going to answer these last three questions real quick. Iron condors, that's much more advanced. That's actually would be a good one for a webinar in the future. Depending on what I'm looking to do. Like, remember I gave you those examples of the Japanese candlestick patterns, the sell signals, the bearish engulfing lines. In that case, credit spreads is definitely what I like to do. I trade predominantly FX and futures markets and also options and binary options. This is when I trade options for the most part. I'm selling them and I like credit spreads. That's what I like. You know, I like to take the money up front. I know what my risk is and I can just forget about them once I put them on for the most part, unless the market goes the opposite way, in which case then sometimes I'll get out of them first. So how long do your trades stay open? Once again, these are short-term ones that we looked at for the most part. So you're only in them for like a week and a half. Okay. Let's see how long this one. How do you close if one leg ends up in the money? Okay, well, I think that was the answer, because you're getting out of both simultaneously. Which is better? Which is a debit spread better than a credit spread? Well, credit spread is better because you get paid up front. Debit spread, you're buying it, and then you know exactly what your risk is because you already threw it out there, so you can't lose more than you already paid out in a debit spread. Let's see. Can you get both a bearish and bullish position so that you can benefit either way? Last answer, absolutely. That Pfizer thing, you could have put on both of those spreads. In any case, at any spreads, you could put on a credit spread, which is a bear call spread above the market, and a bullish put spread below the market. If the market stays within those parameters of the first call and the first put, then and goes sideways, both credit spreads in that case would yield a profit. So yes, if you're looking for a sideways market, which I actually do that every once in a while in the futures and also in equities markets, especially if you could pull off a credit spread, a call spread and a put spread where you can get a premium of $5 or more on both, absolutely do it, because you can't lose. No matter, even if the market explodes, you're going to be making money because you'll bring in over $1,000 on a where you can never lose more than 1,000. So with that being said, I'm going to give you one last plug for me. If you like the presentation, you can check out more stuff I do on my YouTube channel at Forex Trading Unlocked. And if you want to learn about the Japanese candlestick patterns that I use in the example, you can read the book that Gina spoke about that I have written. It's called High Probable Japanese Candlestick Patterns, available on Amazon.com in paperback and Kindle versions. And for the next 5 days, anyone that wants to can check it out on Kindle for free. So with that being said, we have one last slide here. I want to remind you to register for the next webinar at eOption next Wednesday, January 20th at 1 p.m. I'm going to turn the mic over to Gina now.
Okay, great. Well, thank you, Teddy. That was very interesting and informative. And thank you to all of our attendees today for taking the time out of your busy day and schedule to join us. And thank you for your questions. Those were excellent. And if you want to trade some of these strategies, like a credit spread or option strategies, don't forget to take advantage of eOption's low rates. All stocks and ETFs are zero commission, and options are just 10 cents a trade plus, 10 cents a contract plus $1.99 a trade. And also we do offer a powerful trading platform, mobile app, free tools to help you strategize. live expert support, and free education. So strongly encourage you to go to eoption.com and you can check this out and find out more details on each of these items. We'll also have a video recording available later this week of the webinar today, as well as all of our past ones. So again, you can go to eoption.com and just go under resources. You'll see an education tab. And that also will have our upcoming webinars as well as all of our past ones. And as Teddy just said, we hope you can join us for our next webinar. That's next Wednesday, January 20th at 1 p.m. Central or 2 p.m. Eastern. And it's on gaining an edge during earnings season using Options Play. Now, Options Play is our free strategy trading tool. What it does is it scans thousands of stocks each day and comes up with potential option trade opportunities, and it just puts a spotlight on those for you, and it's linked directly to our trading platform. And normally that's $500 annually, but it's free to all of our customers at eOption and InvestTrade. So if you are interested in this webinar, please go to our eoption.com and you can sign up. And we'll also send you an email to that effect so you can sign up. We do normally do 1 to 2 option trading webinars a month, so I would just keep an eye out open for that. And again, as it says on the page, we hope you'll subscribe to eOption's YouTube channel. We have lots of educational videos on there on specific option trading strategies, as well as our trading platform and how to use it and some of the special features such as customizing it so it's exactly the way you want it, customizing your charts, your news. There's lots of great resources on there, so we hope you'll subscribe and check it out. And if you have questions, I mean, one of the great things about our company is that we do have a live expert support team where most of the people on the desk have over 10 years of experience, so they are happy to answer any of your questions about the platform, about trading strategies, option trading strategies. That's an excellent resource. So we encourage you to give us a call, or you can also send us an email. And if you go to eoption.com, you'll see a contact page. There's lots of ways to contact us, but we are available if you'd like to speak to someone over the phone. So again, thank you so much for attending. We know you have a busy day and we appreciate you taking the time out to join us. And we hope, please be safe, and we hope to see you at our next webinar next Wednesday. Thank you and bye now. Hello and welcome to eOption's webinar, and we're excited to have you here, and thank you for taking the time out of your day to join us. We're happy again to partner with Teddy Keckstadt, a professional trader with over 30 years of experience, to bring you this webinar today on year-end holiday option strategies to help keep the Grinch away. My name is Gina Bocayas, and I'm with Regal Securities, the parent company of eOption and InvestTrade. And to provide some basic logistical information, the session today will last approximately 1 hour, and every attendee who's participating is muted. If you have any questions during the webinar presentation, please feel free to type them into the question box, and our speaker will answer those at the end of his presentation. We ask that you use the Q&A box and not the chat box, as our speaker may not see your questions. You can also reach out to our trade desk at any time if you have additional questions after the webinar, and they're happy to answer any questions you have on placing trades, placing option trades or spreads, or any questions you have about strategies. You can also access the recording of the webinar in the next week on our website at eoption.com, and we will also be emailing you a copy of the recording in the next week. And for those of you just joining, we'd like to welcome you to our webinar on year-end holiday option strategies to help keep the Grinch away. And as eOption's name implies, we are a firm that specializes in option and stock trading. We charge some of the lowest option rates in the country. Our option rates are just 10 cents per contract plus $1.99 per trade, and all of our stock and ETF trades are commission free. We can also offer you a powerful trading platform, a mobile app, free trading tools such as Options Play that demystifies options trading, as well as live expert support when you need it. We encourage you to go to eoption.com so you can learn more about us, as well as see all of the resources that we can offer you. We also support option education, and we're glad you can join our webinar today to learn more about using options to trade in this volatile environment and how to secure your gains in 2020. And again, I encourage you to go to eoption.com. You'll find more educational videos, past webinars, as well as option education resources there. And without further ado, I'd like to turn it over to our speaker now, Teddy Keckstadt. Teddy has over 30 years of experience in the financial industry and trading. Some of you may recognize his name from past webinars he's done for eOption this year, and we're excited to welcome him back today. And to tell you a little bit about him, Teddy has over 30 years of trading and industry experience. He traded on the Chicago Board of Options Exchange, Chicago Mercantile Exchange, and Chicago Board of Trade for 21 years. And he's been an institutional market analyst for over 25 years. He currently serves as president of Forex Trading Unlocked, and he's also written a book called High Probable Japanese Candlestick Patterns. He has a degree in finance from DePaul University in Chicago. And without further ado, I'll turn it over to Teddy Keckstadt. Thank you.
Thank you, Gina, for that introduction, and thank you for everyone that's attending today. Real quickly, we just want to put up the eOption disclaimer to remind you that this webinar is for illustrative and educational purposes only. For more information, you can also go to the eoption.com website and check out the disclaimer page there as well. We can skip past my disclaimer. So what are we going to do today? We're going to maximize your option trading potential. That's our goal, is to teach you some strategies that'll help you to deal with not just these holiday markets, but other future markets to come. So use eOption for your stock, ETF, and options trading. Also make sure you take advantage of that option strategy tool book that's on the option for Options Play, as well as also the option strategy guidebook at eOption. So, and we're going to go through some of these different trading scenarios, and then you can try them out also on those through those tools also. So what are you going to learn today? Well, you're going to learn how to trade stock and other market movements without large capital allocations, for one. You're going to expand portfolio diversification. You're going to learn how to maximize your potential returns with options, bear and bull directional strategies, and also how eOption can help improve your bottom line through these strategies. So why stock option strategies? First and foremost, to lower your cost basis. In eOption, it's only 10 cents per contract, much lower than other firms. So one off just using these strategies alone and also using them at eOption will help you with any of your systems that you already have going or that you are thinking about implementing in the future. So trading in these products is very similar to trading in normal equities, but with a higher potential ROI and controlled risk. So by doing these strategies that we're going to talk about today, you're going to find out how you can not just be involved in the equities market, but be involved in a way that gives you much more control of the opportunities that are at hand, as well as control over your risk. And that's one of the biggest things that you want to be controlling. So option strategies to keep the Grinch away. Let's get started. All right, today's focus, end of the year option strategies, bullish and bearish strategies. We're going to define the risk through each of these 4 strategies that we go through. The execution for these strategies is very simple. So whether you're a beginner or an experienced options trader, no matter what your level, you'll be able to execute these very easily. Volatility, direction, and cost, meaning the commission and the spread, are all the key variables. Now, the nice thing about this is that, especially for the options parts, the cost is very minimal. All the markets we're looking at are very liquidable, meaning heavily traded. They have a lot of volume on any given day, even on slow days. That's good. The more volume you have, the tighter the bid and ask spread is, the more easy it is to not only just get in and out of positions, but you get a better pricing model. And the volatility, well, we all know that the market currently is on its highs, and it seems like every day they are. It doesn't matter which index or what you're talking about. For the most part, the markets have been very strong going into the end of this 2020 year, which has been very volatile. And possible exercising of options. We will relieve your angst about that during this as well. So there's always a lot of people that have questions about, well, what happens? Am I going to get exercised on? So we'll cover that as we get through these individual strategies. So the first strategy that we're going to talk about today is the married put. So what is a married put? Oh, let's say a trader buys an asset like 100 shares of stock or an ETF. Now, for each of these examples, whenever we talk about an option contract, one option controls or is controlled by 100 shares of stock. An ETF would be just an individual ETF, and then there's options per ETF that you would be balancing, should that be the equity or investment that you want to use a married put strategy for. So the trader will buy a put option for each of the 100 shares of stock that they own, or for each ETF that they have. Okay, so the trader can sell the stock ETF at the strike price if the market goes lower. So what you're doing is you're putting in a synthetic floor. Okay, so this strategy sets a price floor in case of a sudden bearish break in the market. You can kind of think about it as if you've been long an investment, no matter what company it is, whether it's Tesla, Amazon, Apple, you name it, whether it's one of the high flyers or even this regular, more bargain basement stuff like Johnson & Johnson and things and GE, no matter what the equity is, if you have been in that for a long time collecting dividends and you're positive on your position, you can definitely lock in a price floor, and that's what a married put does for you. So what it does is it locks in your gains that you've already had. You may lose a little bit if there's a market correction, but you don't lose the bulk of your gains. And that's what when we get into the example, you see what that means and what we're talking about. So a trader uses the married puts as a way to protect against a stock in a stock or ETF. You can look at it like an insurance policy. So if it hasn't made sense yet, just think about your insurance policy like you have on your car. Okay, so just like when you buy a new car, your insurance policy is never going to cover it for what you paid for it, but it's going to give you fair value. So that's kind of what you're doing with this, is you lock in a fair value floor. So even if there's a sharp sell-off in the market, like we could have another coronavirus shutdown like we have now that escalates like it did earlier in the year, causing a big sell-off in the market. If you have a married put on, you're totally taken care of. So if the stock or ETF gains in value, okay, then your gains are reduced by the premium paid for the put. So that's what you have to remember, is that you do pay for this insurance policy. But the good thing is that if the market goes up, so does the value of your equity or your ETF, meaning that you'll be seeing gains. They just won't be quite as strong as they would have had you done nothing. However, your risk exposure, if you do nothing, is unlimited, because then if the market collapses, you're stuck with a decreasing asset that has no type of chance of coming back for you as far as on an equity basis. So the trader only loses if the asset does not fall in price or move at all. So is that possible? Sure, markets can drift and go sideways for a long time, but no matter what, you will have that hedge on. So now let's take a look at our visual example so you can see what we're talking about here. So for our married put example, we're going to take a look at Coca-Cola. Everyone's familiar with Coca-Cola. Now, at the time when I started making the presentation for this webinar, the Coca-Cola stock price was trading right around just over $53. So you can see, as we have highlighted this green line here, this is your stock price. The options that we're looking at are the January 15th, 2020 expiration. Okay, so at the time when this was done at the end of November, that would have left just over a month, close to 45 days of expiration. It was right before, around Thanksgiving. Now, typically when you want to do these kinds of strategies that we're talking about, you want to use options that are 30 to 45 days out. So once again, if you look at the upper left-hand corner here, you can see January 15, 2020 expiration is the date used, and all of these will be for that date. There are different strategies where you use multiple expiration months. Those are for much more advanced options traders. We're not going to muddle through any of that today to confuse anybody. So for this one, what do we do here? So the trader buys 100 shares of Coca-Cola at $53.30. So let's say that you weren't even long this market for however long, since you were just started trading 20 years ago or 2 weeks ago. Let's say that you just today decided to get into Coca-Cola. The market's near, at that point, was definitely shaking around its highs, lower than it is now, but definitely near its highs at the time. So what would you do just to protect yourself? Well, in this kind of scenario, you know that you like the stock, right? But you're worried that there's a potential correction in the market. And then here, see what I did here? I highlighted this gap. Now, the reason I highlighted this gap was to give you a reason to have, even in a bullish scenario, an inkling that possibly you would get a correction. Okay, so we're not trying to predict the market here, but we're trying to put what would you do at this moment in time if you bought Coca-Cola and you wanted to be hedged. So you're obviously bullish the stock, you're looking forward to collect dividends, but you're worried about a potential correction. So what do? You take either the 52.50 strike or the 52 even strike price put, and you purchase one of those. So what does that mean? That means that at the 52.50 strike price, if the market starts to fall below that and the stock price goes down, that means that while you're losing money on your initial stock, the price that you purchased Coca-Cola at, or if you'd already had it, you're losing gains that you had already realized. While that's happening, your put would start to go up in value. Okay, so that gives you the right, remember, to sell that stock at that price. Okay, so that locks you in with the floor. Especially think about what happens if Coca-Cola all of a sudden drops down to $49, $40, $48. Okay, a severe $5 a slide in that market, then either whether you had the 52.50 strike price or the 52 even strike price, your stock position would be covered. So while you were at that moment realizing losses in your stock position, but still with the ability to collect a dividend, your puts would be going up in value, whichever one that you would choose to take. Now, why would you want to do this besides just using it as an insurance policy and locking in a floor? There's this gap. Now, if you just wanted to look at it as a technical trader, all gaps typically get filled. That's just a fundamental part of technical analysis, for basic technical analysis. So let's just say that no matter how much of a bull this market is, and this market has been going up, making higher move highs and higher move lows, that's indicative of a bullish trend. It doesn't mean that it wouldn't have a correction. Irony is, look at this. If we were to cover this stock price, stock trade here, when the market was trading at $53, whether you use the 52 or 52 half strike price, that comes right into this gap. It's kind of like a really nice like sell area where, let's say the market comes back to here, it would find support once it fills this gap and then comes back up. So long term, your stock would be in a good place, hopefully. And if not, at least in the short run, your short-term losses would be covered by the value of the price of the put that you would have purchased, whether it was either the 52.50 or the 52 even. So once again, these two purple lines here, either one of these would be the strike price levels. Now, obviously, the closer it is to the stock price, the more expensive that option would be, because there's less room before the market before that option would kick in as far as pricing. Now, when it comes to option pricing, here's the nice thing about this trade. Volatility, if it was to go down, okay, that would be the one thing where you could see a lot of value in your option decreasing. Now, if the market doesn't go anywhere, let's say that come expiration, that the price of Coca-Cola is right around 53 or 53.50. It's above either the 52.50 or 52 even strike price. Well, at that point, your options would become next to worthless and definitely worthless upon expiration if the market goes nowhere. But you would have that insurance policy during that time. Now, the question is, what has happened since then? So real quickly, we're going to show you what had happened. So if you put the market, that trade on, the married put, this is where this black arrow was, the market actually got down to 51.05. Okay, and there's still time before expiration. So now what does that mean? That means that a couple of weeks ago, it came down in here. At that point in time, you would have been down in your stock position, but the options, either one of these, had you purchased them, their value would be higher. So at that point, you'd be able to either sell the option, okay, which would be great because if the market moves down, their volatility would be increasing. So where you would have purchased the option at one point in time at X volatility, a move like that would cause not only the price of the option to go up because of the movement of the stock, of the underlying stock, but also the fact that volatility goes up. So now time decay always works against you. That's always shrinking the price of an option. So the option you purchased, no matter what, is losing time value, no matter what. But if you have market movement and also you have the volatility, that would override the time decay, and you would have a profitable option that you could sell out of. Now, the question is, would you then put on another one? That's what you do, is when you have market movement, you have a set direction. You're not looking for a major extreme move in the market for months, because these options only expire within 30 to 45 days. So you have to have rational expectations. Now, that chart that I just pulled up, you saw that where is Coca-Cola right now? Well, it's actually trading right around where it was when this slide was made. So at this point, if you were to still have these options on, the options prices would be lesser in value, but you still would have the insurance policy going on until January 15th of 2021. So that would still leave you with another over 3 weeks yet of insurance as far as your position is held. Now, the one thing that could happen, remember, with markets on its highs, Coca-Cola actually isn't making new highs. What if Coca-Cola starts to catch up with the rest of the bull market? Well, the nice thing about a trade like this would be your stock price goes up as it starts to make new highs. The only difference in your profit versus not having done the trade would be the premium that you paid. So if you bought the 52.50 put at $1.42, or the 52 even strike price put at 64 cents. Obviously, these numbers are multiplied times 100, so that'd be $142 and also $6.40. So it's not like a matter of, $64. So it's a difference of, either one of those trades minus your 100 shares of stock in the appreciation of the price should it make new highs. So that's the one thing that you have to think about for this trade. So now we're going to take a look at the next one. So the bull call spread. This is where a trader buys a call at a specific strike price. Okay. The trader sells a call at a higher strike price. Okay. So there's two options that are of the same expiration month. So like we're looking at all these options that strategies we're looking at are for the January 15th option expiration. So in this case, the trader would be buying a call at a specific strike price and then selling a call at a higher price above that strike price. Both options, once again, will have the same expiration date and underlying asset as well. The strategy reduces the net premium paid and limits upside potential at the same time. So meaning that whereas in the first example, you had bought the stock or you had already owned the stock and then you bought the put to lock in a floor, in this case, you don't own the stock whatsoever, or the underlying asset, but you're looking to take advantage of potential price movement. This type of strategy is called a vertical spread. Okay, so vertical spread, hence the name, it's exactly what it says. It's a vertical spread, meaning going up. So if the trader is bullish with expectations of a rally to higher prices, this is when you would put on a bull call spread. So instead of just buying Coca-Cola, like in the last one, you wouldn't buy the asset, because let's say you don't have that kind of money to buy a whole 100 shares or more to have big blocks of Coca-Cola and then hedge them with options. Well, in this case, you can take advantage of the movements in Coca-Cola, at least the bullish ones, with the bullish call spread. Okay, so less pricey than buying an outright call, but lacks the upside potential. Remember, if you were to just buy a call, that would be like being long the stock, but at that underlying strike price. And then if the market is above that strike price, that option would be of value. If the stock falls below the strike price, the call's value is negated, except for any time premium that would be involved in that option. However, in this case, if you were to buy the stock or just the one call, if the market rallies, no matter how high it goes, you have all that upside potential locked in. In this case, the market can rally to the moon. All you have is your upside potential between the two strike prices. And this will become clear once we get into the visual example. So this is less pricey than buying an outright call, but lacks the upside potential. Now, if the stock or ETF drops in value or does not move then the trader only loses the net premium paid for the bull call spread. So the nice thing about this is your risk is totally limited to, once again, to the premium paid for this spread. Okay, now let's take a look at what this Teddy talking about here. Okay, we have the bull call spread here for the Coca-Cola chart pulled up here. We have the two strike prices highlighted here. There is the $55 call strike price and the $52.50 call strike. Now, remember, in this case, you do not own the stock, but this is a way of getting long and having a really good bang for your buck as far as your ROI potential. So the trader in this situation, at the time when Coca-Cola was trading around 53.32, you would be buying the 52.50 strike price, and that call at the time was $1.82, which would mean $182 in the actual price. And then there's the $55 strike call that you would sell simultaneously to put this spread on. And that would be for 79 cents, which equates to $79. So basically, you have not quite 50% of the total pricing there. So it's around, $80 would be to put on this spread versus buying the whole 100 shares of Coca-Cola for $53 plus $100. Now, so remember, the only difference, though, here is that in this case, should Coca-Cola go even up to $150 in a couple of days, you only make the value between the $52.50 call strike price and the $55 call strike price. Okay. Now, the nice thing about it is you already take that premium, or excuse me, you already know what your risk premium is on this spread. The only thing that you can lose is that difference of is what you paid for the debit, meaning that the price of the call is more than the price of the $52.50 strike price call is more than the price of the $55 call that you sell. So, but that difference, that debit, is the only amount of money that you would lose should the price of Coca-Cola go down to, say, $25. So in this case, instead of having the stock where you would be losing equity, you know your risk is defined. Now your upside potential is also defined too, because should the stock go above $55, that's what you're hoping it would do for this position, if the stock goes to, say, $56, $57, $58, even $70, anything beyond $55, you will not realize any gain on that. So once the stock pierces the $55 line, that's when you would be exiting the bull call spread, because you've already hit your target, your expected target area, and anything beyond that, you reach a point of diminishing returns, meaning that up to expiration, you'll lose time value. Every other part of the equation will be locked in, but it won't change. So, and once again, also, you only risk the pricing of the spread. So in this case, it would be around 80 some dollars, minus the 10-cent commission, or 20 cents for the two options that you would put on. Now, once again, also, if you remember that as far as the cost basis for this, think about if you were to exercise, if you were really like Coca-Cola, if you were looking for a long-term investment, this would not be the position for you. However, for the speculator, especially since the market's on its highs right now, if you believe that the indexes are going to remain bullish, and Coca-Cola right now, which has been in somewhat of a rally over the past month, but hasn't been keeping up with the broad market. Maybe this is getting ready to catch up. We'll see how things go. That's irrelevant as far as the longer term, but at least for our option play here, we had an expiration of January 15th. This would be a good way to try and realize some year-end gains on a rally that, let's say you're shaky, you're bullish the stock market, you're bullish Coca-Cola, but you know that it's been a big run, you're coming into fourth quarter end, year end, and what have you. So there's a potential for, there's always a potential for a sell-off, but maybe putting a stake in the stock is something you don't want to do, but you want to still participate. So bull call spread would be a very good option for you in that. And just to show you how that is panning out, we have the chart actually right now showing you where the Coca-Cola is trading. So it's trading basically right where it was when we started out with this chart here when we made the webinar a month ago.
So as far as this bull call spread, it still has potential. And as you can see, the trend line holding up the market right now over the past 2 months, it's riding right on that right now. So it had just come off a higher move high. It made a higher move low yesterday, and it's strong today. So this position, at least in the short run, for that 1 month still left to go, you have a chance with this position. So now let's go on to the next one. We have the bear put spread. Now this is the opposite of the last spread that we looked at. The bear call or the bull call spread is a bullish strategy. Once again, trying to maximize a little bit of potential upside in the marketplace. The bear put spread is the opposite. In this case, the trader buys a put at a select strike price. The trader then sells a put at a lower strike price of the same asset and expiration. Remember, all the trades that we're talking about today, they're all of the same expiration date, and the options all are on the same asset when it comes to whatever spread we're talking about. Now, this strategy offers limited gains and limited losses, just like the previous example. Okay, so now think of it like this: a bear put spread is the same thing as going short the stock. But if you short the stock, you have to have the margin money to cover any potential unlimited losses that you could have when it comes to shorting stock. Remember, shorting stock is not like buying stock. Buying stock, you have limited losses because you can only lose what you paid, just like when you're buying options, you can only lose what you paid for. However, when you're short, which is the opposite, then you have unlimited liability. But this is a way of being synthetically short without having the liability. This is how, remember when we started the webinar, the whole purpose of this is to teach you ways of reducing your risk, controlling your risk, defining your risk, and also increasing your potential return on your investment. And this is a strategy that will help you to do that. The upside, once again, is limited, but the risk is reduced as well with the spread. So the bearish trader will use this strategy when they're looking for a short-term correction. So remember how the market, when we first put that on that slide, we showed you how there was that gap, okay? And we'll show you with the chart how this trade would have been a very good short-term play for that. This is a synthetic way of going short the market without the risk. Okay, once again, and the bear put spread is also a type of vertical spread, just like the call spread. The only difference is this time the vertical, you want it to go down. At least that's the intention. So the only downside is if the stock or ETF goes higher, and then the trader only loses the premium that was paid for this spread. So now let's make it a little clearer by looking at the chart. So once again, Coca-Cola stock price was at 53.31, January 15th, 2020 expiration options for the bear put option strategy. Now, remember when we talked about that gap in the first slide, when we talked about the married puts, this is a way of trading that gap. So let's say in this situation, you notice the indexes are very bullish. The stock market keeps making higher move highs and higher move lows. That's indicative of an uptrend no matter what. That's a defined bullish market. Coca-Cola right now is in a defined medium-term bull market with higher move highs, higher move lows. Well, maybe now you're on shaky grounds here a little bit. You like Coca-Cola, but you don't want to put the money into the stock, okay? So, and also you think that the upside coming into the year end is most likely there's a chance for a correction. Corrections can happen at any time. We're not talking about how and when to time one, but we're just looking at a situation where here's a play that's a low risk play to take advantage of a potential move like that. Now, this gap, remember when we first talked about the first slide, on a fundamental technical basic principle, gaps typically get filled. So let's just say you want to, instead of shorting the stock, once again, if you were to short the stock, you would get that $5,300, but you'd have to have the margin to cover that any type of swing to the upside going against you. And remember, your risk, if you were to short the stock, would be unlimited, versus in a play like this, you could put on a spread, a debit spread, where you would be buying the 52.50 strike price, and then you'd be selling the $50 strike put. Now, in this example, it says 52 here. That's actually a $50 here. It's a little error there, but this is $50 strike price put that we're talking about here. Now, notice that that 52.50 strike and then that $50 strike, that fills that gap. So let's say you are the bearish trader and you didn't want to short the market, because that only is for very experienced people with deep pockets. And I also always say I never recommend shorting stock. That's for sure. Short other derivatives, but never stock. This is what you do. You put on a bear put spread, or you buy puts or something like that if you want to do that. So anyhow, expiration date in this time period, what happens if it goes down into this area? Well, if it breaks down into this area, this spread would be a way of taking advantage of that bearish move. Now, once again, let's see what happened with this market. So when this trade, when we made this chart, this is where this arrow, this is where it was. It took a dip down all the way to 51.05. Okay, so that means your bear put spread at that point was in the money for sure, because you were below the 52, the original put that you had purchased. Remember that you are purchasing the closer put to the market and you are selling the lower put. In this case, the 52.50 strike would have been $1.42, which is $142. That's what you would be paying for that option. And then you would simultaneously be selling the $50 strike price for 64 cents, which is $64. So you basically, it's going to cost you around $70 to purchase this spread. Now, that is to go short synthetically 100 shares of stock with a limited potential of return. However, if you look at the return, look at this. You have 52.50 to 52 even. This is your range that you would be capitalizing on. The market got down to 51. So that means that the 52.50 put at one point at that low, that was $1.50 in the money, and it was only $1 out of the money for the other put that you had, and that's the one that you sold. So obviously they both would go up in value at that time, and if you would have taken off the spread at that point, because see, once it came down to 51, it pretty much filled the gap. Okay, because if you look at how this gap goes, you have the trading beforehand, you have the trading afterhand. The real gap is from this high to this low. So that comes right into this 51 area. So when the market came down there, this would be a great way to lay off that spread, or for sure if it would fall below $50. So that's one thing you have to remember, is being synthetically short the market, your only potential for profit is in this range. Once it falls below the higher strike price, heads towards the lower one, or falls below it. And once it falls below $50, that for sure would be a time to exit this put spread no matter what, because you would have no potential gain left in this potential chart. So once again, remember that this is a debit. And your return on, now think about this also, for your return on investment, let's say that you were short this stock. Obviously, yes, you would, if you went down to $51, that would be just over a $2 gain if you were short. Okay, so that's $200 that you would make, but you would be risking thousands and thousands of dollars to do so. And this is where the ROI of options and option spreads really becomes something that investors and traders can not only take advantage of, but where you are really coming out ahead. You have to put thousands and thousands of dollars of risk to potentially make $200. What is your ROI on that? It is next to zero. So if that doesn't give you a little light bulb going on, it should, because if you're risking $70, in which case you could double to triple your investment off of that, why wouldn't you? So that's a 100 to 200% return should the market dip down definitely below $51 down to $50 even, and especially if it goes below that, because the debit that you would have paid to put on the spread, when you would sell out of that spread, your return would be every bit of at least twice on that one. So that's where you have to think about options and option strategies as not just being a less complicated way of participating in the market environment. It's a much more, it is a little more refined way of being involved in the marketplace. However, it's definitely a much more financially astute way of dealing with the marketplace. Remember that whether you're a trader or an investor, it's a business just like anything else. Like we're looking at Coca-Cola. If you were just to buy the stock, you are an owner of that company. You may have absolutely nothing to do with it, like most shareholders do. However, once you are a shareholder, once you are an equity holder, you definitely retain rights of ownership. You get dividends, what have you, and it's an asset. So now, once you hold that, buying and holding is one thing. You cannot take advantage of any other opportunities with that stock except for what you are given, which would be potential appreciation with the risk of potential loss and a potential dividend, depending on whether it does or does not pay one. Now, in this scenario with the bear put spread or even any of the other strategies, you can take advantage of the movement in Coca-Cola without bearing all of the risk that you put up by just being an outright stock investor. And definitely being, just like I said, once again, like I would never, ever suggest even to the most experienced traders of shorting any stock to begin with. It's just not I think it's un-American, but that's a personal thing. But definitely on a financial basis, unless you have deep pockets and really know what you're doing, you should never short it. The fact that options exist, that's the better place to go. All traders that have been trading for a long time would say, before you want to short the market, put on a spread, And here's another thing to look at too. Once again, the cost basis for this. If you are, let's say, right or wrong on any of these investments, if you were, say, buying the stock or even shorting the stock, you have to be right almost all the time, or else your capital will erode at a very, very rampant pace. And think about this. Let's say that you were in a normal stock position and you lose 10% of the value. You need to have a gain of more than 10% to recoup and get back to zero. With options and option spreads, you don't need to risk remotely the amount of capital to gain the amount of money that you would had you been right on a return, and your risk is defined and limited, meaning that, for instance, like whether it's this bear put spread or a vertical call spread, if your ROI is so much higher with the options, you don't have to be as right as often, one, to realize a profit, and two, to keep yourself from eroding your capital. Whereas when you're more capital intensive for the position, the more damage it will do. So, that's a whole webinar money management lesson for another day. But that's one of the beautiful things about the bear put spread and the other spreads that we're talking about. So now let's get on to an even better one here. We have the protective collar. So this is where a trader does own the stock or ETF. Okay, remember in the very first example, it was one where you may have owned the stock for a long time, or you may have just gotten into it. And the last two other examples, they were debit spreads, which you were trading the direction. Now, this is one that's it's kind of a marriage and similar to them, but you definitely had to have already owned the stock or ETF. So in this situation, the trader buys a put at a strike price below the underlying stock or ETF price. So very similar to the married put. And then the trader sells a call above the underlying stock or ETF price. That is just like doing a covered call, but since you're doing a put at the same time, it's called a protective collar. Now, we didn't talk about covered calls, and we're not going to confuse things. So just think of it, just know that this is what you have to do. You have to sell a call above the underlying stock price. So now the options must have the same expiration date. Remember, once again, just reinforcing that these are basic fundamentals. You're like, he said this 5 times already. Well, that's because people do make the mistake when they place orders. I've seen it happen many times over the years. Professionals do it all the time. People who do it for a living do it all the time. So always make sure when you're placing these things, you have the proper dates. This is used when a trader has been long and seen substantial gains. So once again, this is where you had the position on for a while. You're happy with it. And we're using Coca-Cola once again. So this is for the long-term bull, someone who's always going to be long the stock, but wants to manage their risk with it, especially when you've had gains. Why wouldn't you do so? It's like I always tell people, if you're outright long the stock, you should always have a protective stop in the market so you can avoid big swings. If you don't, then you should have protective option spreads on, especially if you have seen substantial gains and there's a substantial positions. So once again, the strategy gives the trader downside protection of the underlying asset. The put locks in the potential sale price. So remember how we had the married put? That was a locked in a floor. That's what this does. The protective collar has a floor locked into it. The trade-off is that the trader may have to sell off the asset at a higher price, thus reducing the potential upside profits. So now this is where you have to remember that, let's say you've had the asset, Coca-Cola, you love it. But for this amount of that asset, whatever you, for this 100 shares or multiple blocks of 100 shares, you realize that, you know what, I made money and I'm willing to forego all of the potential upside benefits, but that's a potential. You don't know. You could still have, and remember, the stock market's on its highs. You could have a correction. We saw a violent correction this year and it came back and made new highs. Coca-Cola didn't. That's called divergence. This would make someone who's a Coca-Cola investor a little shaky right now. So if the trader has to sell the stock or ETF, though, they will be happy to do so because of the prior gains. That's the beautiful thing about this position. So let's take a look at this. Let's dissect this one. So once again, we have the $55 out of the money strike price option, and we have the $52.50 out of the money strike price option. Now, in this case, we are using a $52.50 put. Okay, remember, this is a put. A put is the right to sell a stock, okay, or ETF. This $55 OTM option is a call, which means that you have the right to buy the stock or underlying asset. Now, in this case, also, we will be selling the call, but it's not a naked call. Now, remember we said that all of these strategies will have no margin risk, and they're very basic strategies that anyone can implement no matter what level of trader you are. Reason being is there's zero margin risk. If you attach margin to a position, then it changes everything, and that would be another webinar for more advanced option traders. So, but in this case, because it is a spread, there's no margin. So even though you're selling the option, the call, it's offset. So you remember our other examples, they are either both puts or both calls. Well, now this is a put and a call where you are buying the put, which is below the market, okay, and you are going to sell the call, which is above the market, okay? Now, what does this mean? So if the stock goes nowhere at expiration, you will have made the money on the call, which is 79 cents or $79, okay? And then you would lose the money on the put. That's if the market goes absolutely nowhere, okay? So the only risk that you have on this position would be that the stock price goes nowhere, the options expire worthless, and you lose the debit that you would have put on, which would have been basically half the spread. So it would have been around 70 some dollars, $80, okay? So that would be your risk per spread, okay? Now, what else happens here? Should the market rally and go above 55, at that point, then you would have made money on the call. However, you could possibly get exercise. Now, if this is what happens. Now people get, I don't want to get exercised on, or do I have to fear expiration? Well, you don't have to really ever fear expiration or being exercised on if you put on a position with the right outlook. Remember that for this trade, the outlook is that, first of all, you've already made money. So you're up money in the stock. So think of it like this. You're up money, the stock's at 53.30. If it goes above 55, you realize another $1.70 in appreciation on the stock. So you make money there. Anything above 55, you don't make any more, because that's because either you're going to be exercised on and get rid of the stock, and then the option is gone. The put will expire worthless because it's below the market. Or you just sell out of the spread. So that's the thing, is that it's not that the second that the market taps or goes through a strike price do you get exercised on. Okay, so usually, like I said, like we had with the other examples, if the market goes outside of your range of your spread, that's when you get out of it. Remember how whether we were in the bullish call spread or the bearish put spread, once you superseded your range, there's no more potential. So you liquidate the spread. So in this case, should the market rally, one of two things will happen. You'll either sell out of your spread, okay, in which case you would make, then you would make the money on the call, okay, or excuse me, on the stock, and then your options that's where you would lose your money as far as that difference there. Okay, because you don't make the money from the debit that you had taken out already. So when you would be credited back that money, and that's the only thing that you can risk, remember, is that initial debit. Okay, but the only gain that you would have would be the premium on the stock between the 53.30 and the 55 even. So that premium, that difference gets offset by the options. And then remember that the stock, you can't make anything after $55. Now, if the market doesn't rally, okay, and like I said, if it stays where it's at, the options expire worthless. You only risk, your only premium that you lose is the premium you paid. If the stock goes below 52.50, however, that changes everything. Okay, and that's where, remember, we have this gap to fill. Let's pull up this chart. So for the protective collar, when we put this thing on, remember it dipped down to $51. So what does that mean? That means that at that point, you would be down in your stock position. However, both of your options would have been working for you at this point. At this point, your call is basically worthless, and your put would have been up, depending on whether you use the 52 even or the 52 half. In this example, we used the 52 half. You would be up $1.50 on that. So where you would be down in the stock, your only loss on this position would be the stock was at 53, so 52.50. So basically $1 in stock value would be all that you would have lost at that time. So when the market was down here at $51, your put would be offsetting half of the price of because it's the difference here between this 52.50 strike price and the stock price when you get in. That's your only potential loss. So that's how you set your floor. Remember how we said that this is a way of, like it has the married put and a covered call combined. That's the protective collar. So when the market came down to 51 to close this gap, at that point, you would only lost on this position would be right here between 53 and 52.50. So once again, also there's the debit that you paid on the option spread. So your risk is defined, but this would also mean that you locked in your return. You already had realized gains in this stock, and you're willing to forego the upside where if the market rallies, if the stock rallies and you have to get out of the spread and get rid of the stock, what you've already made money, you're going to make an extra buck. And so you make an extra $1.70 if it goes and rallies. You don't get to see any gains beyond $55. But once again, if it falls below 52.50, your only loss is less than $1 plus the debit for the option spread. And then you would have the option, you would have the ability to stay in Coca-Cola, and you would still realize some of the gains that you had initially had earlier. And then once again, if it's now we show the chart where it's at right now, it's trading right around 53.30. So at this point, this spread would still have potential. So, because remember, it's the January 15th expiration. So if you look at where it's at now for this married put, you still have great protection, because let's say that there is a year-end sell-off, okay? And Coca-Cola comes back down to its lows and comes back to $51. In this case, owning the stock, you'd be down in the stock, but your put would still be up money, and you'd be able to sell that back and have a nice little padding to your account and realize some gains that you had foregone because you held the stock and did not sell the stock. Plus, you would also be up money on the call. Now, also remember our other spreads that we put on. every position that we looked at today would have been in a fairly decent spot going into today. We had our married put, which is still a great protection. Remember that this market isn't a bull market, but it's interesting that while the stock indexes, the S&Ps, the Dow, the NASDAQ, and everything, they're making new highs every day. Coca-Cola has been up, but it has failed to make new highs. And right now it's going sideways. So that's called divergence. So for the stockholder in Coca-Cola, not someone who's bullish the market, you may still be bullish the overall market. This married put is great protection, whether you have the 52.50 or the $50 puts. Obviously the cost is different. So the $50 much, $52 cheaper than the 52.50. So those are good, those have good value. Now, this was done back on November 24th when we started this webinar. Today we have, it's December 16th. So you want to have this with 1 month left. If you were to put any of these trades on now, you would go for the February expiration. But this was, we're dealing with the January. So had you done this back in January, the married put is still a great protection. The bull call spread, it has the potential to break out to the upside. It's holding this trend line, and as long as the indexes are on their highs, the broad market is lifting most stocks, even stocks like Coca-Cola. Now, the bear put spread still has strong potential. We did have a slide a couple of weeks ago. Maybe we do have a year-end sell-off, you know. Anything could happen yet, you know. So, and then there's the protective collar, which in that case, especially going into the end of the year, this is probably one of the best positions of all, because should the market go absolutely nowhere, or if we have a correction, or even if we have a major bull run, you have a lot of potential with the protective collar. So, I mean, the only thing where you wouldn't get anything is if we go completely sideways into January 15th. But once again, protective collar would be for the person that already had the underlying stock value. So once again, when you get a chance, check out Forex Trading Unlocked on YouTube. You can catch me in some other webinars and even past webinars for e-option. And also, if you get a chance, check out my book, High Probable Japanese Candlestick Patterns, available on Amazon.com in paperback and Kindle versions. And with e-option also, before we get to our questions, I just want to remind you to maximize your option trading potential with e-option. Remember, stock, ETF, and ETF option trading is available. Free option strategy tools like Option Play are available on their website. Also, I suggest the Option Strategy Guidebook, as well as the paper trading account to test your strategies or the strategies we talked about in this webinar. When you get a copy of this webinar, you can review it and then also try to enter them into the strategy tester. Then there's ETF and stock trades are always commission free. And remember, the option contract commissions are only 10 cents at e-option. So now let's answer some of our questions out here. First one, at any point, would it be good to buy back the call you sold? Okay, so this was a question that was asked early in the presentation when I was going through the bull call spread. You would buy back the call spread when you would offset the spread rather when you reach your potential. So because remember, you're looking for, it's a vertical spread, so you're riding it out to expiration. You're looking for it to make a move sometime between the date it was entered and expiration. So you would get out of that spread once it would have rallied above the since it was the bull call spread, if I remember right when the question was answered. Once it got above that $55 level, that would be when you would exit the spread, because there would be no longer any potential for gain in that spread. Let's see. Next question. I noticed for the spread, the trade is only going out 30 days. I understand taking advantage of the decay, theta decay for the option being sold, but what about the options being bought? Okay, not to get too much into the theta decay, there's the various Greeks in time decay and theta, how they move. With these positions, you'd get out of these positions at the same time, because that's how they're designed. As far as the decay, it's pretty much neutral, because it's a debit spread. nuances of the Greeks for that, you could get really minute, but that's more for advanced strategies. Strategies such as the 4 that we talked about, or especially when it comes to either the bull or call spread, you wouldn't be trading those legs. You trade them simultaneously as a spread. So plus it's also how you get the better pricing for one. So that kind of doesn't really it's a good question, but we didn't talk about the Greeks because for these strategies, we're not making them that complicated. I mean, when you try and if you're trying to trade the numbers like that, that's a whole different way of approaching option spreads and your outlook. These were more about the underlying instrument, like Coca-Cola or whatever stock you would choose. So it's more about having a view of that market opportunity versus options pricing and the Greeks. And that's a whole more advanced webinar that I don't want to confuse people with. But once again, good question. The next one is if the stock price 50, how can the $55 and 52 even, how can they be out of the money? Well, they're both out of the money because they're different options. And I think that's why the person who answered the question, that's what you're getting at. That would be the excuse me, the last one that we went over, the collar. The out of the money means it's out of the money because the one is a call above the market, not a put. Okay, if it's in the money and it's okay, if you had the stock is trading at 53. If the $55 was a put, that would be in the money. Since it's a call, that's out of the money. The $52 option in that example, or $52.50, that is below the market, and that is a put, so that is out of the money. If it was a call, that would be in the money. Okay, so that's why they're both out of the money. So I think that maybe in that example, when I was going over it, you didn't catch the part that the stock price was for Coke was around $53. The above the out of the money strike price above the market, since it's above, that's a call. That's where you would be selling that call and you'd be buying that put that's below the market. So I think that answers that question. Then we had, let's see, Stephanie and Desiree. Here's another one. Okay, here's a couple more. The one has to do about getting out of the spreads to what's the right time. Once again, for the married put, that would be one where once you realize a profit, and especially like the one with the gap, like you're only going to see so much. You know, remember that you're using these positions either as a hedge or as a protective hedge. Okay, so when you use the married put, you're either entering that stock or ETF, or you've already been long that for a while, realizing gains, and you want to protect it. So you're either getting in and you want to limit your risk, your downside risk right off the bat, or you want to protect your gains. Okay, so that's where you would have a target. Like for instance, when the stock does make a $2, $3 move, you would adjust that. Okay, that would mean you're either taking off, using it for what it did, like in that case, a protective put, you would take out your gains there to pad your current losses on your stock, and then you would reevaluate whether you would want to either stay in that option, give it more time, or roll that option because you want more time. That's a whole nother thing. But right now, when we put these on, these were for a short-term 30 to 45 day outlook. So when you're looking to trade that in a different way, like I think you're looking at with that one, that's a totally different story. But for these, everything was with an initial plan. You always stick with your plan, and then you can reevaluate it. Like for instance, when in that Coca-Cola example where the stock dipped down to $51, that would be where the married put, you would probably get out of that one. You'd be up $1.50. You have a month left till expiration. You would take some of those, you would take that profit, and that would be something that pads your current losses of equity, either in a position you had been in, or if it was a new stock position, the current losses that you had incurred. So it pads that. Let's see. And then here's another, there was the other one from Steph. Oh yeah. Once again, when you get out of the spreads, you get out of it once you've realize your maximum return. So with the vertical spreads, once again, you know for sure when to get out of them. That's a no-brainer. When they exceed
the upside or downside projection. So for remember, for the bull call spread, you're buying the closer option, you're selling the further out option for a debit. That further out call price, whatever strike price that is, in this case, it was the $55 strike price for all the examples that we use. That's why I love using just the one stock. I think we're going to do this for more webinars. It's easier to go back to. That's where you would get out. So because there's nothing left in that vertical spread above that $55 strike price. Conversely, for the put spread, there will be the same thing as well for the bear spread. If once the market got below either that 52.50 or that $50 even strike price, that would be where you would get out of the spread, because there's nothing left of value left in that spread. Remember, that's where you get your return on your investment is high with these spreads, but it's also capped and limited. So you don't get to take full advantage of a runaway bull market that happens when you have a bull call spread on. You don't get to take full advantage of a market correction like we saw earlier in 2020 from the coronavirus pandemic that rocked the market and sent most stocks down 30 to 40%. You would only realize that minimal spread between whatever options those are. So, but that's what your intention is. Remember that you're not bearing all of the risk. Remember that if you were outright long the stock and never did anything this year in Coca-Cola, you would have had to have ridden a big wave down, a good 30, 40% correction, and then you still haven't come all the way back. So, and you would have gotten your dividends, but you would have been taking heat along the whole time, and your capital your capital equity curve would have looked like a roller coaster. Well, definitely like a V, that's for sure. So, but with options, had you had on, I mean, think about this. If just like now, when we're coming into the end of the year, the market's on its highs, we're looking at a potential extended shutdown going into the new year. The market may have another crack. You know, this is a good time to have on a married put. This is a good time to have on your collar. This may be a good time to put on a put spread where you're not risking very much, and you're either locking in gains or you're taking advantage of potential market swings, you know, and not even just like the bull call spread. The market's on its highs, it's overheated in going into an environment that's very shaky. The bull call spread is a great way to be long instead of owning the stock. So I think we've answered all those questions. And with that, I'm going to pass the mic over to Gina.
Great. Thank you, Teddy. That was very interesting and informative, and we appreciate all your efforts with webinars this year. And on behalf of Regal Securities and our divisions, eOption, InvestTrade, and Regal Discount Securities, we'd like to thank all of you for attending today. If you want to learn more about option strategies mentioned today, we encourage you to go to eoption.com, as it says on the screen. We have tremendous educational resources there. You'll find all of our past webinars and as well as trading videos on there that you can listen to at your leisure. And all you have to do is go to eoption.com, and on the very top, you'll see resources, and then go to education, and you'll see everything there. I know the question was asked, are these strategies good for any level of investor? Any investor can learn how to do these, and we encourage you to learn about options. And again, if you go to our education section, we do have an option strategy page with clickable links on it. So for example, some of the option strategies that Teddy mentioned, a married put, a bull call, or a vertical spread, a bear put spread, or a protective collar, all you have to do is go to that strategy page and click on the link, and it'll go through with you a description of the strategy, an outlook, if you use it, whether you're bullish or bearish, your profit, as well as the expiration and assignment risk. And also some of the strategies also have a short video you can watch. So that's a very good resource if you want to learn more about the strategies that Teddy talked about today. And if you want to trade options, eOption is the place to do it. As our name implies, we are the option trading specialists. We were created by George Bocaius, who's a founding member of the Chicago Board Options Exchange, and he's been trading stocks and options for over 50 years. He created his ideal trading company for options and stock trading for people who have a passion for trading. And again, to reiterate, we offer some of the lowest option rates in the country. It's just 10 cents per option contract plus $1.99 per trade. So you can trade 10 contracts for just $2.99. And the more you do, the more you save, as well as all stock and ETF trades are zero commission. So they're all commission free and there's no hidden charges or volume requirements or anything like that. Our pricing is very straightforward. And we also offer a free tool called Options Play, and that's a tool that scans thousands of stocks each day to help you set up the right option trade to fit your needs. Normally it's $500 annually, but it's free for all of our customers. So we encourage you, if you are an eOption, InvestTrade, or Regal Discount customer, all you have to do is log into your trading account and you will see an Options Play tab. And if you aren't a customer, we encourage you to go to eoption.com and sign up, and that will be free to you, and you can start using that right away. And that's a popular tool that our investors use, whether they're a beginning option trader or they're an advanced. We find people of all levels really enjoy that. And next, I would say mark your calendar for our next webinar. That's on Wednesday, January 20th at 1 p.m. Central Time, and it's using Options Play to trade earnings. So the tool I just spoke about, we're going to have the president of eOption talk about how to use the tool, and he'll walk you through how to trade earnings this January. And again, I'd just like to reiterate, a video recording will be available later this week on our website. And it will also be emailed to you so you can watch it again at your leisure. And as it says on the screen, make sure to like us on Facebook. You'll get advance notice of any webinars, and we also give you investing tips as well as market updates. And on behalf of Regal Securities, again, eOption, InvestTrade, and Regal Discount Securities, we'd like to thank you for attending, and happy holidays and happy trading. Thank you again for your time, and have a wonderful day. Bye now.
Hello, and welcome to eOptions webinar. And we're happy to have you here with us. And thank you for taking the time out of your day to join us. We're excited to partner again with Teddy Keckstadt, a professional trader with over 30 years of trading experience, to bring you this timely webinar on trading the 2020 election using ETFs and options. My name is Gina Bocaius, and I'm with eOption. And to provide some basic logistical information for today, the session will last approximately 1 hour, and if you have any questions during the webinar presentation, please feel free to type them into the question box, and our speaker will answer those at the end of his presentation. We encourage any and all questions, and please use the Q&A box at the bottom of your screen and not the chat box. If you put it in the chat box, our speaker may not see it, so please make sure you use the Q&A box. Also, you can reach out to eOption's experienced trade desk at any time if you have any additional questions after the webinar on trading strategies or any questions about options or using our platform. You can access the recording of the webinar in the next week on our website at eoption.com, and we will also be emailing each of you a copy of the recording who attend today. And for those of you just joining, we'd like to welcome you to our webinar on trading the 2020 election using ETFs and options. And as eOption's name implies, we are a brokerage firm that specializes in option and stock trading. We charge some of the lowest option rates in the industry. Options are just 10 cents a contract plus $1.99 per trade, and all stock and ETF trades are commission free. We also offer many tools to help you in your trading strategies, especially with options. We also support option education, and we're glad that you can join our webinar today to learn more about using options to trade in this volatile market environment. You'll also find more educational videos and past webinars on our website at eoption.com under resources. So I'd like to turn our attention to our speaker now, Teddy Keckstadt. Teddy has over 30 years of experience in the financial industry and trading. Some of you may recognize his name from past webinars he's done for eOption this year, and we're happy to welcome him back again. And just to tell you a little bit about him, He traded on the Chicago Board Options Exchange, Chicago Mercantile Exchange, and Chicago Board of Trade for 21 years, and he's been an institutional market analyst for over 25 years. He currently serves as president of Forex Trading Unlocked, and he is the author of a book called High Probable Japanese Candlestick Patterns. He has a degree in finance from DePaul University in Chicago. And without further ado, I'll turn it over to Teddy Keckstedt. Thank you.
Thank you, Gina, for that introduction, and eOption for presenting this webinar today. And we're going to start right off by getting into a couple quick little things we have to take care of. So Gina already gave you a little background about me. So now we're going to put up the eOption disclaimer just as to take care of some things that we have to do for compliance, and just to let you know that this webinar is for educational purposes and informational purposes only. And if you need any more information about the disclaimers, you can check out the eoption.com website. And also for my company, since I'm doing this, I always put mine up as well, which I can spin through because this is a video. All right, so what we're going to talk about today is how to maximize your option trading potential. You can use options for stocks, ETFs, and other types of option trading strategies. You can use an eOption, which Gina had already given you a brief little introduction to, so we can skip over this. She talked about their ways of stock-free trading as well as cheap options pricing. So what you're going to learn today. So we're going to learn how to trade stock and other market movements without large capital allocations, for one, how to expand your portfolio diversification, how to maximize your potential returns with options, bear and bull directional strategies, as well as neutral strategies, and how eOption can help you improve your bottom line. Now, so we're going to use the 2020 election event, which is a spectacular thing to use when it comes for examples, especially for what we're going to talk about today. So for many of you, so there's many of you that are traders, some of you are just investors, and I'm sure that there are times when you've traded events before. The election obviously is always a big event in U.S. When it comes to U.S. markets every 4 years. This year has been one crazy year for God knows everything else. So volatility, it definitely is something I think everyone knows and agrees will be here. So why stock option strategies? Well, the first thing is you can lower your cost basis. At eOption, it's only 10 cents a contract for options, which was explained to you. That helps to keep your cost basis at a minimum. Options can help you diversify your portfolio because you can trade a much broader range of stocks with your allocated capital as well as ETFs. Options allow you smaller to large investors the ability to capitalize on trending markets that are highly liquid, such as the ones that we're going to talk about today. And this is a very important cost control. The less your commission costs are, the more you will earn when you are profitable, and the less you lose when you are not profitable. So trading in these products is similar to trading in normal equities, but with a higher potential for ROI and controlled risk, which is a wonderful thing. Anytime you can control your risk as well as amplify your return on investment, you are doing the most you can do, as whether you're a trader or an investor. So today's focus, we're going to be talking about the 2020 U.S. elections with ETFs and options, which ones will be most likely going to be in play. We're going to show you bullish and bearish strategies. So just to remind you, this is not a political webinar. This is about what is going on currently in the market, what has happened, and what is most likely the consensus based off of whether or not you have a win on one side or the other. The good thing is that because of the strategies we're going to talk about, we're going to have our defined risk, which is huge. Having defined risk for any trader or investor is always important. It's one of the key rules to success. Anyone that does not have that as a component in their trading or investing strategy, you are definitely bleeding somewhere. Now, simple execution is also something that is important, and we're going to discuss that too. And there's nothing that we are going to talk about today. There are many very advanced option strategies and equity plays that we are not going to get into any type of discussion about. These are very simple, easy spreads and outright positions that anyone can execute. So volatility, direction, and cost are the key variables that we will be covering today. Okay, expected impact on the markets. So the incumbent Trump, if he wins,
Stronger equities, reduction in safe haven investments, meaning like, for instance, because it's an election year and with the COVID-19, there's always safe haven, flight to quality type of investments. Sometimes it's the US dollar, a lot of times it's gold, a lot of times it's the 30-year bonds, and all these things influence equities and moves in equity sectors. So a Trump win would be bearish gold most likely, stable interest rates. We know that because of Fed policy. It's stated that no matter what for the next year, they're going to keep rates at where they're at. They have no intention of raising them. So that's a variable that usually you don't have that much foresight from the Fed, but due to, and this is not political, these are economic conditions with what's going on in the world. That's probably why that variable will stay that way. Stronger trade policies, you know, what's happened over the past 3 years. So to think that anything would be different if Trump remains the president for another term, and stronger U.S. dollar. So the dollar has been relatively stronger versus most currencies over the past 3.5 years, except for, you know, obviously there's periods where it's a bear and it's a bull, but overall it's been stronger. A Biden win, what does that mean? Well, just like we can't predict who will be the president or necessarily what's going to happen with the markets, we know that a Biden win, odds are, is going to reverse a lot of economic things that were set over the past 3 years. Does that mean that all equities are going to go down? No, there's going to be lots of stocks that are going to be winners under a Biden win, and there's going to be lots of stocks that are losers under a Biden win. The same would happen if it was Trump that gets reelected. There's always bulls and there's always bears. It's not all going to go well for any sector. So we're going to get into these ones that are most likely to have volatility. So the good thing is you don't have to be right on who's going to be the president. You don't even have to be right on which sector, where it's going to go. Our strategies are going to help you to profit no matter which way they go. Now, also with Biden wins, equities are expected to stagnate or fail. Why would they do that? Well, because of projected lockdowns and more restricted regulations and other things like that. Will that happen? We don't know. That just seems to be the leaning consensus. Skyrocketing national debt, that's happening under no matter who wins. However, with the other social policies that are expected to be put in place, that would be on top of everything that's already going on with Corona and what have you. Higher taxes, that's been stated multiple times that, you know, that's the first thing he's going to do is raise taxes. So these are the things, the variables that we're going to look at, how this impacts certain sectors and how you can profit with options and ETFs. So let's get into which sectors that should do well. A Trump win: energy, defense, materials, financials, US dollar. These are the ones that have done well over the past 3 years. Obviously, defense, building up the military, there's most likely no chance he's going to fade on that if he still has another term. Materials, obviously building, infrastructure, these are things that are going to continue to grow. Financials, not that financials are safe, because we have a lot of issues with the credit markets and other things that can drag the economy. Banks are definitely not necessarily on stable ground, but they're more likely to have support under a Trump administration. US dollar, if the trend is your friend and it stays consistent with what has happened over the last 3 years, except for when there are bearish fundamentals involved, the US dollar should most likely remain strong. And now with Biden, utilities just stand to win. Consumer staples stand to win. Alternative energy, solar companies, wind companies, you name it, all stand to have very good projections moving on into the future should Biden get the next term. Gold also, well, because of higher taxes, a relatively unstable forecast for the equity markets and other things, and increased COVID-19 response and how they seem to be looking at how they want to deal with things. Gold is obviously going to most likely be something that's going to continue to remain a bull. So how do we trade this and prepare our portfolios for this? The sectors that should do poorly are the ones you really want to pay attention to and protect yourself. So when our first option strategies are going to actually cover that. So if Trump wins, consumer staples are likely to get hit, and also alternative energy stocks, because just as if Biden wins, that those should do well. The opposite is for Trump. Now with Biden wins, pharmaceuticals probably are going to be under pressure for a little bit. Consumer discretionary are going to be under issues. Energy companies like ExxonMobil, oil companies, we know that his stance on oil, what that is, and that stands to with oil as it is going into COVID-19 being under pressure, and then with the consensus that Biden wants to literally limit the oil industry over the next 10 years. These are issues that will weigh on those stocks. But the alternative energy stocks on the flip side are going to do very well. So, and then there's the US dollar, which is projected to go the opposite way as well. So strategies, November option expiration. Everything we talk about today are for options that expire into November, or you can even now, if you're going closer into, or if you put them on into next week, then you'll be looking into the December options. So we're right on the cusp because you want to have options that expire somewhere between 30 and 45 days. So for equities, covered calls is a strategy that you want to look into. Collar trades is a strategy you want to look into. Outright long call and put trades are trades you want to look into. And then there's credit spreads. For ETFs, trade the sectors outright. You can do that. Straddles and strangles, option spreads are very good, which you could also do for stocks. Outright long call or puts on ETFs instead of trading the ETFs. And you can also use the ETFs and the ETF options as a hedge for your broad portfolio. Like for instance, let's say you have a lot of money vested in, say, mutual funds, where some are heavy in financials. You could hedge your mutual funds with an ETF trade or an ETF option trade. The same as if you're in a mutual fund that's heavy in pharmaceuticals or metals or what have you. And we're going to get into how you put these trades in. Now, real quick, for those of you that are not familiar with the strategy, a covered call is where you own the stock and you sell an out of the money call above the market, the strike price above the market of where the stock is trading at. A collar is where you would sell a covered call and you'd also buy a put. The covered call would be out of the money above the market from the stock price, and the put would be out of the money below the market from the stock price. Obviously, outright long call or put would be just buying the call or put either right at around at the money or near a strike price to trade the direction for the equity. Now, credit spreads are the same. They're a way of getting long or short, and that's where, for instance, let's say you're long whatever XYZ stock, and instead of doing just a covered call, and you'd want to make a little bit more money, and you actually are more bearish, that's where you would sell the out of the money call, like a covered call, right off the bat, and then you would buy the next higher strike price or two strike prices higher back, which would mean you would have a credit for that transaction. So you would be selling the nearer out of the money call and then buying the further out of the money call, which would give you a credit for the transaction. And then your only risk would be the difference between those two strike prices minus the credit you take if the market was to go against you. Now, for straddles and strangles, they're very similar. Straddles is where you buy the call and the put at the same strike price. And the strangle is where you buy the call just a little bit above or at the strike price of the stock. And then you have a put on the other side, which is just the next one lower. So there's a little bit of a gap for strangles. The straddles is the same strike price. Strangles is where you use two different ones. And then we have the outright, once again, position, which you can do for the ETFs. So now let's get into our first example. We have the XLP. Okay, now this is the consumer staples ETF. So now remember, this is not political. We just picked sides here on which one is most likely going to gain or lose by who would possibly become the next president. So when we did this webinar, this XLP was trading at 66.17. Okay, so now if you wanted to do an outright ETF strategy, you would be long this if you were bullish the consumer staples, and which, for instance, if you were bullish Biden, you'd be looking to continue to stay long XLP, or if you were long XLP, then you would already be looking just to have an option strategy on for the election, and vice versa for Trump. So what would you do here? So the nice thing about it is, it doesn't matter who you want for president, you can put on a neutral strategy, because the odds are going into this election, wherever we are trending, when we have things that are working for us is for many of these strategies. Volatility is rising and is going to most likely continue to rise into November 3rd. So you can see I have November 3rd and it'll be marked on all these sides. This is where we're heading to. Now, when I did this slide over a week ago, this is where the market was at. It was at 66.17. Now today the market's actually lower. It's at 62.71. So that puts it all the way down here below by this box right here. That's a big drop. So now what would have happened, regardless of whether you were bullish on Biden or Trump, you could have put a straddle or a strangle play on. So the market was trading at 66.17. So the closest strike price would be $66 even. So you could have put on a straddle at $66 for the call, or excuse me, a $66 strike price call and a $66 strike price put for the straddle, or you could have done a strangle. Now remember, the strangle is where you use two different strike prices. In this one, you could have had a 66 half call and a 66 even put. Now, when you look at this, the price of the strangle would have been a little bit less than the price of the straddle because you're getting one option. It's further away from the strike price. Okay. And now as far as direction, you would want to have for election win bet, you would do something different. So for the straddle and the strangle, you don't care who wins or who loses. So right now, just if you would have put on this strategy when I made the slides for this webinar, the market's trading now at 62.71 down here. So no matter what, your straddle or strangle trade would both be winners in this case. Now, as far as your outright election win bet, if you were buying the put, you would have been doing well on that because you would already have over $3 in the money on the put. And then if you bought the call, well, that one would be the only loser on this. So that's the nice thing is, like I said, this is not a political thing. We're not taking an outright position on who's going to win the election. I definitely am not. And even when it comes to trading the election, I wouldn't do the same either. You have the ability to, and even if you say that it's going to go one way or another because of one win or another, the market's going to most likely do what it's going to do. So these neutral strategies are very good. Once again, because of the fact that we have rising volatility, which most likely will continue into the election, and then it should start to drop a little bit. So the positions you put on when it comes to especially like credit spreads or any type of selling of options, you'll be selling into high volatility, and most likely that'll work for you going into the election. And also for buying spreads, because of the volatility and the odds of the market not staying exactly where it's at as we head into the election and then post-election, you are really looking at a good situation for movement. And that's why you trade events. You know, a lot of people say, when's a good time to get in and out of the market? Well, there's times not to get in, like right before a Fed announcement when you have no idea what's going on unless you're trading volatility. But directionally, and even when it comes to getting in and out for pricing, those are times when usually it's a good thing for most people to stay away because you can't fight the machines. But when it comes to something like this, it's a totally different story because you're trading an event with an outlook of something that's going to go on, you know, afterwards for a little bit of a trend. And when it comes to these sectors, remember, these things have been moving because of coronavirus and other reasons, whatever, trending either up or down. But once the election is over, this trade is over. So when you look at these sectors, how they've been moving and how they're reacting, odds are you're going to get a lot of really good movement coming into the next 2 weeks. So situations like this straddle, you're already, over $3 in the money, where the straddle and strangle would have been moving. So like I said, this would have the market down here around $62. And then the only loser would be the put. And remember, it doesn't matter whether it says Trump or Biden. It's just a matter of whether it's a call or a put that's making or losing money on that trade. So the spreads do really well for volatility in that situation. The outrights, well, remember, you're making a bet no matter what, always with an outright position. Okay, no questions on the chat. So let's move on to the XLU. This is the utility sector. Now, at the time of this slide, it was trading at 64.09, and now it's trading just slightly lower at 63.24. Now, utilities, I think, going into the election are going to be very, very neutral. And I think it's going to be most likely once we get through next Tuesday or Wednesday and have the results, you're going to really start to see a breakout. So right now, utilities are usually very conservative as well. And you can argue for both sides on this one, but it looks like for the most part that Biden has the edge when it comes to the utility companies. So now let's take a look at this. So for this trade, the market was trading at 64.09. So the straddle and strangle trades would be to buy the $64 call and buy the $64 put, or you would buy the $64.50 call or and the $64 put. Now, you could also do outrights if you want to really take a stake on direction for these sectors, you know, especially if you think that these are really the ones to gain or lose. Remember, these are only from consensus, you know, anything can happen when it comes to the markets for sure. But your outright trades would be buying a put for Trump and buying a call for Biden when it comes to the utility sectors. Right now, they're very neutral going into the election, and I think you're probably going to see that, but I would bet dollars to donuts that come after November 3rd, we're going to see some sort of either correction to the downside or rally to the upside for this ETF sector. Okay, now let's move on to the next one. We have the XLE. We have the energy sector here. Now, this one was trading at $30.19 when I did this slide. Now it's trading down at $28.14. So it's actually trading way down over here. So this has had a nice little move over the past couple of weeks. Let's see, are these trades that we would make before the election, or would you use the strategy after the election? Absolutely. For this question for Denise, these are trades that I would put on going into the election, especially like if you are an ETF trader or you like to trade sectors. Now is a great time because this is an event trade. Usually after an event like this, you're not going to see a flatline market. You know, usually when you have something like that, it's an event when you had something that happened, such as like a hurricane or something like that, where you might have some sideways. But there is so much publicity going on about this election. I mean, we're not going to get into the political parts of it, but economically, and then when it comes to the market with certain sectors, there's a very big tug of war. So yes, right now would be a really good time to put on these volatility plays like straddles and strangles. As far as doing the outright directional plays, I would always say, unless you have a valid buy or sell signal, never take any trades such as that. I would never go just on trying to make a bet on the election, on who wins the election, you know. So, but these sectors usually, on a consensus basis, you can see where you can trade these. So yes, I would definitely say the straddles and strangles. Now, as far as the election win bets, if you want to go outright long or short on a position, or even do a credit spread in that fashion, I would wait until November 4th. Or November 5th. Once you know who has won the election and things start to stabilize, all the noise is out of the market, and then most likely some sort of trend, whether it's a corrective trend or a continuation of a major trend, is most likely to occur at that point, because we'll be through the election. Okay, so now that question is answered, XLE, once again, this was at $30.19 when we did the webinar, and now it's down at $28.14. So the straddle and strangle plays, both of these would be moving in the money right now. So this, for instance, the straddle, which is the $30 call and $30 put that you would have put on at the time of this slide when it was made, would right now be up about, well, a little over almost $2 as far as where the movement was away from it. So with the increase in volatility, you would start to see an edge on that play. Needs a little bit more movement to really become a big profitable trade, but it's definitely moving in the right direction. And the same as with the strangle, where you would have bought the $30.50 call and the $30 put. And remember, as far as the election win bets, this would be one where odds are that if Trump wins, the $30 call would be a good buy, and then also a buy in the $30 put should Biden win. So as far as the ETF sector, so if you wanted to trade just the ETF sector and you didn't want to do the outright ETF, remember the options are a great way to go for a short run, especially when you're trying to trade an event or post-event. Okay, now let's look at the PBW. What is PBW? Well, PBW is the clean energy ETF. So this is the one that goes along with the Biden trade. So for this one, when we did the slide, market was trading at 69.25, and now it's trading at 63 double, which is quite the slide. So actually, if you would have put on any of these options, straddles or strangles, they would have a nice little move right now. You're looking at over $6 move right now, which would have you trading down in this area right here, right above where it says straddle and strangle on this box right here. So at the point of the slide, the $70 call and the $70 put would have been one volatility play to put on, or the $70 call and the $69 put also would be another one. And then post-election, or even if you were looking to get ahead of the election, like I said, I personally wouldn't do it. If I was going to do anything as far as going outright on these trades, I would wait until the election's over, because trying to pick the president, let alone to be right on the market as well, it's a double-edged sword. You're trying to hit both plays, which I wouldn't suggest. That's why I like the volatility strangle and straddle plays. Or you could do credit spreads. Like for instance, let's say for this one here for PBW, the market was trading at right around 69.28. So let's just say that you were really looking for Trump to win. So instead of selling the ETF or even buying the put, a less risky trade would be to do the credit spread above the market, where you would sell, for instance, the $71 call. Like, see how I've been putting these three lines here, because there's different ones you could use for your straddles. But let's say you want to put on a credit spread. Instead of selling the ETF, or even buying the put, what you would do is you would sell the $70 call, and then you would buy the $71 call. And then that way you would have a credit between those two options, and your only risk would be if the market rallied above those strike prices, in which case your loss would be the difference between those two strike prices, which would be $1 minus the credit you received on that. So it wouldn't be that, depending on the pricing, and since you would be selling into high volatility and buying into high volatility, it would pretty much be neutral. So you don't have to worry about volatility when you do a credit spread at all. That's completely neutral when it comes to that. So that would be another way that you could trade this ETF as well. Now let's go and take a look at, we have the IHE. Now the IHE was trading at 169.85 when I did the slide. Now it's at 161.10. So that's all the way below this box. So this thing, the pharmaceuticals, is definitely in play. And we know that healthcare this is a great thing about why event trading is fun. And you can use volatility plays. So let's say you're long the pharmaceutical ETF, and you really like the pharmaceutical ETF long term. I mean, who doesn't? We have an aging population, what have you, coronavirus, et cetera, et cetera. Why wouldn't you think the pharmaceuticals would do well, right? So it doesn't matter what your take is on who wins the election. Let's say you're a bull. But short term with the election, you don't want to deal with the volatility. You know that between the new court justice that was just approved, and now they have a big vote on the Affordable Care Act and a whole bunch of other things, not to mention, we're moving it through this election. The pharmaceutical industry is up for grabs because nobody knows how the whole insurance industry, what kind of look and face it will have, not even just a month from now, let alone 3 months from now or 6 months from now. So even though you want to buy this, you're bullish to pharmaceuticals, you want to put on a straddle or a strangle. So that's where you would look right now, around the at the time you would have been looking at the 170 call and the 170 put, and you would also been looking right around the 170 call and 169 put for the strangle. So these volatility plays would already be, 161, you're looking at below this box right here. Both of these volatility plays would be huge. In fact, at this point, with only a week before the election, odds are you would be rolling these spreads. You would already be getting out, either just taking profit on them, or you would be getting out of these and putting on new ones just because of where we're at in that kind of market movement. And then obviously we have the outright $170 call for the Trump win, which obviously would be a loser right now. And then the buying the 170 put, which would be a winner right now. If you would have done it back then, like I said, if you're going to trade the election win bet, wait until the election win is decided and then try and jump on those trends. Because especially, like, for instance, here's a trade for you. Let's say a lot of you have owned like a company like ExxonMobil or Northrop Grumman that's been in a bear market for the past few weeks. They're pricing in a Biden win. If Trump wins the election, there's a good chance that even if oil stays low, ExxonMobil will be in a very neutral to potential bullish posture over the next 6 months to a year. It's been beaten up really hard. ExxonMobil is the same thing. So these are post-election trades that you can take these sectors, and we're going to get into it with the other ones as we get into the oil thing. So you can either, if you trade the equity, you can look for those plays, or with this, the ETFs is even better because you can trade the sector. You don't have to hit the individual wins with the companies or losses, and you can still trade the options as well on this. So now let's go into our discretionary sector. So XLY. At the time of the slide, the market was trading at 152.85. Today, right before the webinar, was trading around 145.96. Now, obviously, the S&Ps and the broad stock market is down over the past week or so, which is definitely laying credence to why these markets are getting some kind of nice move to the downside. And for the most part, most markets are dragging right now. So it's not a Trump-Biden thing. It's not necessarily an election thing. It's just the market is selling off because of the coronavirus. That's why these sectors are what we're looking at, because even in the midst of a breaking stock market, some of these sectors are rallying. You know, just remember, whenever the market's going up or down, there's always a contrast somewhere else. There's always a bull market somewhere. There's always a bear market somewhere. So now the Select Spider Trust here, ETF. The 153 call and the 153 put would have been the one of the credit option strategies you would want to put on for volatility, and also the strangle, the 153 call and the 152.50 put as well. Now, the one nice thing about the consumer discretionary is that this ETF and this sector typically trends a lot. It's like you can usually count on currencies to trend. Consumer discretionary, it's rare when it holds a neutral sideways market. So going into the election right now, it's very, very likely that since it's already trading down here, it's already had a big move. It's had over a 10% move in the past week and a half. We're heading into the election. Odds are pretty good that we're not going to stay in a straight line going flat line across for the next week or two going after the election. So your straddles and strangles, if you had put it on then, you'd probably be looking to roll them just because of the fact that, let's just say you get a bounce back. Well, then your straddles and strangles are going to be pretty much worthless. You would have missed the trade. So, like I said, since you have the movement already going into this one, I would look to roll out of these and then do, what did I say? The XLY is trading at 145 now. So you'd be looking right around the 144 to 146 options and trying to put on a new straddle or strangle if you wanted to do a volatility play in front of the election. And then obviously post-election you'd be more bullish for Trump and bearish for Biden for this sector. In theory, as far as, like I said, the consensus is. But right now, because of the movement you've already had, it would be a situation where this straddle and strangle, now you would be rolling out of this. And think about this too. This was done back on the, what was it? It was back just a week and a half ago. If you have a 10 to 15% move in, say, a ETF such as this or an equity, and you have a volatility play where you're already in the money, where you've had an $8 move or so, something like that, that's a big deal. That's a time to always readjust and think about taking your profits. Okay, let's see. I believe you mentioned buying options 30 to 45 days out for the strategy. Why not buy them for a sooner date, just like a little after the election at a lower price? Okay, so we have a question from John here, two questions actually. Like I said at the beginning of this webinar, the 30 to 45 day out options are the ones we were looking at. These were the November elections when I first did the slides. Yes. Now, what you're talking about, a lot of people will do that when they have earnings and short-term short-term until option expiration. This is something that I would be very cautious with for most of you that are listening. You have to be very good with your timing and know your pricing if you're doing such a thing. Yes, you're right. That is a way that you can profit and have a very huge return on your investment if you were to trade the nearest option expirations. Here's the problem with that. I look at that situation. It's the same as buying out of the money options and doing the, like, for instance, let's say you're very bullish on a stock and it's trading at $50 and you're like, oh, I'm very bullish and they're going to come out with earnings and it's going to soar. And instead of buying the at the money calls, you're like, oh, I can see it going $25, $30 higher. So I'm going to buy the out of the money $20 calls, and buy like 100 of them. And then all I need is a $5 move above that to make, 10 times what you normally would make. Those situations just don't happen that often. The theory is there, but the ability to capitalize on them typically is not very strong. And you have to be right most of the time, because the few times that you're not, you're just feeding the fire. Like you need too many wins to recoup your losses to become a positive. So I hope that answers that question. The second half of the question is, how long after the election would you wait before taking positions on in the money options, taking profits on in the money options? Okay, so after the election, if let's say you put like the straddle, like one of these straddles or strangles on right now in the consumer discretionary. Once you have, obviously the election is on the 3rd. Let's just assume that we know who's going to be the actual next president the next day and the votes are tallied properly. Like I said, we're not getting political here. Then I would say that your straddle and strangle plays, for instance, I would say you're going to have most likely a period of 1 to 3 weeks to really capitalize on it. Here's the main reason is that we're going into the election, obviously, post-election. Let's, like I said, say that hopefully on November 4th, we know the answer. Well, then people are going to start to reevaluate and start to reposition. Funds are going to reposition. All kinds of investors are going to be repositioning. Investors are going to be all lined up and chomping at the bit. So I would say you have 2 to 3 weeks. And that's why I like these further out options, because you have time for them to get the movement. Okay. So like, for instance, the mid-November to the December options, because now we're talking about if you were to put them on now or right after the election, that will give you the best bang for your buck as far as pricing, because here's the thing is that as you get like the shorter term options, like the first part of the question was, why wouldn't you use something that's expiring very quickly? You just need it to be around for the election. And then after that, and you can cash out. That does work when you're trading, especially earnings and certain events. With this one, there's too much noise, and especially because there is the possibility that we may not know on 4th what is the outcome. So those situations would not pan out. Now, however, once an actual decision is laid out, I think you're going to have every bit of 2 to 3 weeks to jump on it. Like, for instance, think about this. Let's just say that Trump wins. Let's just do it this way. Landslide victory for Trump or Biden. Okay. We're not getting political here, but just to make this as an easy, what would most likely happen? If Trump wins, you're going to assume that there's going to be more of the same policies that have been going on for the past 3 years. So even though it's the stock market is bearish because of coronavirus, it's less likely to fall as harshly because of it. Now, let's just say Biden wins by a landslide. Okay. Well, coronavirus or not, the stock market's going to be very, very unhappy about the fact that they're going to like, okay, taxes are going up, which means that the stock market's going to be suppressed. There's going to be all kinds of selling because you're going to have only this year and then next year to take your capital gains at the lower tax rate. Because once Biden gets elected a year later, when everything's overturned, there's going to be, think about this. You'd rather sell your stocks now or sometime next year than a year later at a higher tax rate and possibly even at a lower market rate, So it's not going to be, so you're looking at volatility one way or another. And that's why I like these neutral trading strategies. Okay. And then also, like I said, for those of you that are invested with like mutual funds, like consumer discretionary, there's a lot of you that have mutual funds that are heavily weighted with consumer discretionary stocks. You're not going to do anything with your mutual fund, and your fund manager is in control of that. But what you can do is you can have a position on in an ETF, either long or short, or you can put on the options and also have some kind of a spread or a hedge against your mutual funds. So then And the beautiful thing about the straddles and strangles is if your mutual funds go up, you make money, and your straddles and strangles will make you money. And if your mutual funds go down in the short run, your straddles and strangles will make you some money, and you'll have a little bit of a return while part of your investment is slumping, but you're still long that investment. So you still have time working with that one. So for when you have an equity position or a long ETF position, you can cover yourself with that and hedge yourself with that. Okay, now let's move on to something called the XLB. XLB is the material stock. So we're going to look at let's see, this will be elected when taking into consideration foreign policy. Okay, we'll get to a couple of questions in just a second. I just got to breeze through a couple of these slides real quick, and then I promise I'll get to these questions. Thanks, you guys are asking a lot of questions today. That's great. So the XLB, which is the material stock, straddles and strangles. At the time of this webinar, 66.27 was the price. Now it's trading at 62.13. It's all the way down here. So once again, these sectors are in play going into the election. That's the beautiful thing about this is just because it's, let's say, for instance, you were trading this XLB before, or now you want to take a look at it. It's corrected from 66 down to 62 in just a matter of a week and a half. Let's say it continues to trade lower into the November 3rd election. It's either in the middle of a new bear trend, or it's ready for a corrective move higher again. So the odds are once it comes into this area where it's at, if you were to roll, like right now would be a very good time to roll out of a straddle and strangle that we would have put on before. So let's say that when this slide was going on, somebody put on a straddle or a strangle, which would be the 66 half call, the 66 half put, or the 66 half call and the 66 even put. Those right now would be winners. Now would be a time to roll out of those into another option, trading somewhere around the 62. So I would say probably the 62 even call and 62 even put, and then maybe the 62 half call and 66 even put for a strangle. If you were going to roll right now in front of the election, I would wait until after the election. Right now, it's Wednesday afternoon. You have a weekend in front of us, and you only have Monday and Tuesday's trade. It's going to be ridiculous. So there's going to be a lot of noise, and I'm telling you, I would just wait until then if you're not already in, or price yourself in now and then get ready for the ride, because odds are pretty good that we're not going to have a sideways market a month from now. XLF. This is the financials. This is another one of the sectors that we had talked about. Now, as far as the financials here, this one was trading at around $25. So the $25 call and put would have been the straddle. The $25.50, which is this one here, and 25 even put would have been the strangle straddle options spread that you would have put on. And then obviously since then we've had what kind of a move? So XLF was trading at 24.94 and now it's trading at 23.66. So this one, the financials are very stable. And this is another reason why I think, it doesn't matter who wins. We know most likely financials are favorable under one versus the other. This is looking like a sideways trade right now. So this is pretty much where it was when I did the slide. It's just moved over a couple days. And this is another one too, where I don't think that the financials are going to sit quiet once you got to remember, if you have a Biden win, financials are going to swing regardless. They're going to swing because they're faced with higher taxation, lockdowns on businesses, and all kinds of other restrictions. And then on the other side, you still have the coronavirus issues and whatever, but you're going to have a less restrictive environment. So definitely a post-election straddle and strangle play is probably a good idea with the financial sector ETF. Especially if you already are long it, why not have a hedge on it? So then we have the XAR, the aerospace and defense. So aerospace and defense definitely looking to boom under a Trump election, and under Biden probably going to slump because you're looking at defense cuts right off the bat. That's something that was already on his table, is defense cuts. So that's the first place he's going to look for to find money, as far as cutting spending. So for this ETF right now, it was trading at, what was it, 92.50, 92.56. Now it's at 85. Yeah, it's down here. So this market here, this ETF is pricing in already a Biden win. And this is a good one too. Like, let's say that Biden doesn't win the election. this would be an ETF to either look to get out like long to buy the ETF, or to definitely put on a new straddle or strangle. I mean, if you would have put on the straddle back then, it would have been a $93 call, $93 put with a strangle of $93 call and a $92 put. Both of those now trading down at, what is it? Like I said, it's at the 90, 85.57 area right here. So now would be a good time to put on a new straddle and strangle right around the $85 strike price. We've got a couple of questions I'm going to get to in just one more minute. I just want to go over two more ETFs real quick. We have the gold ETF. Remember, we talked about gold as a sector. This would be another one to look at. This one is pretty neutral. So where the slide is at right now, it's pretty much where the market is trading right now. Gold was at 178.30 for this ETF when I did the slide. Now it's at 176.5. So it's pretty much these same strike prices. I would look around this 179.5 to 179 area for your spreads. Gold is one that, like I said, wait until after the election, because it's been trending lower, pricing in a Biden win. If it's been trending over the past month, rather, trending higher, going against its longer term trend because it's pricing in a Biden win. A Trump win would most likely have gold selling off again, because gold has had such a good run. So anyone that is no longer looking for such a flight to quality and thinks that their stocks and other investments are going to stay relatively stable, then gold will probably not suffer, but just no longer be quite the bull that it was. Now, one thing you can also trade is the US dollar. Most people, I'm a currency trader. Most people are not, or futures traders. So one way you can definitely trade the dollar is with the UUP or the UDN. So I didn't put the options on this one because it's hard enough for people to know what which direction it is. So basically it's like this. The UU up is when you are bullish the dollar. Okay, so if you're bullish the dollar, you would buy this ETF or the some sort of option play being bullish. If you were bearish, you would sell this ETF or put on an option strategy the same. Now, the one thing that you could also do is that you can do conversely, because just like there's an up, there's a UDN, which is a US dollar down. So if you're this is the thing is where if you think it's going down, you buy it, and if you think it's going up, you sell it. So it's inverse. So these are, if you want to trade the dollar on this, I just wanted to brush on it so you know that it's there. It's a little bit of a confusing thing for most people because of the inverse relationships. So I would not go outright on this one unless you're an educated, experienced investor and you understand the fundamentals with this one. But you could do neutral straddles and strangles on both of these, and they're basically the same. It doesn't matter which one you take if you're doing neutral strategies. All right, so I'm going to do one little quick plug and then answer a couple of questions. When you get a chance, if you like this presentation, you can check out my channel, Forex Trading Unlocked, on YouTube with all kinds of video content with different lessons. You also have the e-option webinars as well, just like they have on theirs. And you can check out highlights of the book, High Probable Japanese Candlestick Patterns, which I wrote, which is available on Amazon and Kindle in different versions. So you can check that out. And now let's get to our last couple of questions let's see, we have taken into consideration the foreign policy of the U.S. presidents, diversification of emerging markets. Okay, foreign policy has nothing to do with any of the trades that we just were talking about here. Foreign policy does have an issue with certain things, but that has more to do when you're trying to figure out trade balances and things like that. So then you can go with a protectionist for America for Trump. That's where you would go with that if you want to get on that political end of foreign policy. And then also foreign policy being where things work in our neighbors or our allies and enemies' favor, then you would lean towards that sort of a slant. So let's see, that will be elected in one. Hope I am clear. Thank you kindly. How to trade the tech sector. Okay, the tech sector obviously is booming because of the coronavirus thing and everything else. That's a tough one, but here's what I do like. cloud technology, data centers, things like that, because no matter what technology you go with, those things are going to be used. They're the core. So I would definitely lean towards those. The nice thing about data centers is, let's say you like to play the real estate markets. There's a lot of REITs out there. Most data center stocks are actually REITs. So you're actually trading the real estate market in a way that you're kind of covered because you have a guaranteed cash flow renting structure. That's a whole webinar another day. So, but you can look into a couple of them, like QTS is one of them. There's a couple other ones. Let's see. Are you allowing your losing straddle position to expire worthless, or can you cancel it by exiting the position? Yeah, straddle and strangle positions. If, for instance, the market, the only way it's losing is if the market goes sideways and it doesn't go anywhere. If that's the case, considering that you are buying into high volatility and there's no real consensus that volatility is going to drop anytime soon, as long as there's enough time in the spread, yeah, then I would say you could still get out of it as a loser if you think the market's going to continue to go sideways to recoup whatever you can from the trade. But especially if there's not much time left in the trade and volatility is still on the rise, then I would hang on to the position, because at that point, you got not very little to lose, and your risk reward on any type of move becomes huge, to where if the market explodes all of a sudden right before expiration and you get out of the trade, then you're looking at having, well, then you lost on the trade when you were right. And that's not a situation that you have to weigh. Depends on how much is left in it. And I mean, if you're only going to get a couple dollars back for your, I mean, the good thing is it only costs you 10 cents to get in and out of an options contract. It used to cost you more. So, I mean, it costs you next to nothing to get in and out. So that's something you have to weigh. I would say that if you had still a month or a month and a half, and it was only 10 days into the trade, yeah, get out of it if you think it's not going to go anywhere and the volatility is dropping. But if you only have like 4 days left after you've had it on for 30 to 40 days, well, at that point, let it expire worthless and take the shot. At least that's what I would do at that point. And let's see, what scenarios make the strangle better or worse than the straddle? Here's where you make where a straddle or a strangle would be better versus the other. A straddle is a little bit more expensive, but is typically the one that you will, you'll be right more often because it's at the same strike price. When a strangle comes out into play where it's really good, this will be one of our last questions, is let's say that the market's trading at $50, okay? And you buy the $50 put and you buy the $50 call. Well, the $50 put, since it's at the money, that's going to be the more expensive option. And the $55 call, that's going to be less expensive. Now, had you bought the straddle, which is buying this $50 call and the $50 put, because they're right at the money, that's going to be a more expensive position. So it's going to cost you more to put it on. Okay. And then the movement, as far as how far you got to go, is more on the straddle than it is on the strangle. So if you're right and the market goes down, okay, let's say you're bearish, okay, and you put it on. So this would be a situation where you're not necessarily just looking for a volatility play, you're bearish. Let's say you had a sell signal. So you would do that. You would put on the strangle instead of the straddle, okay, because you know that the call that you're buying, which is above the market, is going to be cheaper. And that's the one, you're not looking for the market to go up. You're looking for the market to go down. So because of that, you're gaining a little bit of an edge, because you can, the position costs you a little bit less. But then you also need a different type of movement, for that to be profitable if it goes the other way, because then you need more of an upside. So your risk is that you better be bearish to neutral and not bullish, because if you're bullish, that kind of trade would screw you in that sense. So that's where you have to layer your straddle differently than your strangle versus your straddle. So if you're bearish, you would have the call be the further away option from the strike price. And if you were bullish, conversely, you would have the put as the further level. So now we are at our 1 hour mark. I think I've answered all the questions. Just want to remind you guys once again, you can maximize your option trading potential at eOption for your stock, ETF, and ETF options trading. Free option strategy tools like Options Play are available on the eoption.com website. The free option strategy guidebook is also available on the website, and free paper trading account to test test your strategies is available. ETF and stock trades are commission free always. And remember, option contract commissions are only 10 cents. And I want to thank you very much once again for your time. And remember to like the eoption.com on Facebook to get advance notice of future webinars, latest market views, and investing tips. And also check out forex-trading-unlock.com if you want to see me again sometime. Also, thanks a lot.
Great. Thank you so much, Teddy. That was very interesting and informative. And thank you to our audience for attending and for the excellent questions and feedback that we got on the Q&A section. It should be an interesting week for the markets and also the significant volatility in the next week. I'm sure all of you saw the significant volatility today and downward pressure on the markets. And we hope that our speaker gave you strategies no matter what the outcome is for the election and how to play volatility. And eOption hopes that we can be your partner in option education and trading. And just to reiterate, we have much more education on our website for options trading. If you go to eoption.com and go under resources, you'll find so much information on there. You'll find our past webinars, trading videos, and we also have something we're very excited about. There's clickable links provided by the Option Industry Council. So if you have a question about a strategy, let's say you want to trade an iron condor, you can click on it and it'll tell you all about the strategy, when to use it. A lot of them have short videos, so it's an excellent resource. I can't stress it enough. And we also have free option trading tools like Options Play, as Teddy mentioned, where it scans thousands of stocks every day and helps you set up an options trade to fit your needs. So that's also a tremendous resource. And that's normally $500 a year, but that is free for all eOption customers. And if we're all over social media as well. If you like us on Facebook, you will get advance notice of future webinars. We do try to do 1 to 2 a month. You also get the latest market news and investing tips, and we carefully curate that to make sure the tips are relevant and interesting to our audience. And as mentioned at the beginning of the presentation, we will have this a video recording available later this week, and you can find it as well at eoption.com under resources, under webinars and videos. And as a courtesy to everyone attending, you will also get a copy of the webinar, and we will email that to you directly. And again, don't forget to take advantage of our low rates. All stocks and ETFs are zero commission, and options are just 10 cents a contract plus $1.99 a trade. So if you want to try any of Teddy's strategies, the savings, you can get a tremendous savings on your commissions compared to many other players out there. And so again, just to reiterate in closing, we hope that this webinar gave you some good ideas on how to play volatility in the current election. And thank you so much for attending, and be safe. Thank you.
Okay, hello everyone. Welcome to our webinar today. We're excited to have you here, and thank you for taking time out of your day to join us. We're excited to partner with Teddy Keckstat, a professional trader with over 30 years of experience, to bring you this webinar on Get a directional view on the markets. Consider options. My name is Sean Herron. I'm with eOption. To provide some basic logistical information, the session today will last approximately 1 hour. If you have any questions during the webinar presentation, please feel free to type them into the question box, and our speaker will answer those at the end of his presentation. Please use the Q&A box and not the chat box. Also, you can reach out to eOption's trade desk at any time if you have additional questions after the webinar. You can access the recording of the webinar in the next week on our website, and we will also be emailing you a copy of the recording. For those of you just joining us, we'd like to welcome you to Get a Directional View on the Markets, Consider Options. As eOption name implies, we're a firm that specializes in option and stock trading. We charge some of the lowest rates in the industry, options 10 cents a contract with a $1.99 minimum. And all stock and ETF trades are commission free. We also support option education, and we're glad you can join us our webinar today to learn more about using options to trade in this volatile environment. I'd like to now turn our attention to our speaker, Teddy Keckstat. Teddy has over 30 years of experience in the financial industry and trading, Some of you may recognize his name from past webinars he's done for eOption, and we're excited to welcome him back today. Without further ado, well, a couple other notes here. Teddy, his background, he's got over 30 years of trading. He traded at the Chicago Board Options Exchange, Chicago Mercantile Exchange, and Chicago Board of Trade for 21 years. He's been an institutional market analyst for over 25 years, and he serves as president of Forex Trading Unlocked Incorporated. He's the author of High Probability Japanese Candlestick Patterns, and he has a degree in finance from DePaul University. And without further ado, I'll turn it over to Teddy. Thank you for joining us.
Thanks for the introduction, and thanks eOption again for hosting this webinar today. Got a directional view of the market, bullish or bearish? Consider the options. So first, foremost, you already got the introduction from already for the start, so you don't need to go through that anymore. And one of the things, though, we have to cover real quick is our eOption disclaimer for compliance purposes, to remind you that this webinar is for illustrative and educational purposes only. So take a look at that real quick, and there's information on their website at eoption.com also that you can see the disclaimer as well. And also real quick, I should always put up my company disclaimer as well. I can just breeze through that. Just wanted to have that popped up. So real quick, a plug for eOption: maximize your option trading potential through the use of eOption for your stock, ETF, and options tradings. You can get free option strategy tools like Options Play available on their website. You have free option strategy guidebook also available on the eOption.com website, and you can also start your own free paper trading account to test your strategies out before you actually start to actuate those trades. ETF and stock trades are commission free, and option contract commissions are only 10 cents. So it's very good for your bottom line when it comes to trading options and stocks as well. So what are you going to learn today in today's webinar? Well, first of all, you're going to learn how to trade stock movements without large capital allocations. Then you are also going to learn how you can expand your portfolio diversification, how to maximize your potential returns with options, and we're going to be looking at very simple bear and bull directional strategies and how they would pan out and what you need to look for market movement to realize a profit, and for how those would compare versus doing other common strategies such as just buying a stock or trading in an ETF. And we also show you how eOption can improve your bottom line through these strategies. Okay, so why stock option strategies? Well, the first thing is you want to lower your cost basis. At eOption, it is only 10 cents a contract, much lower than other firms. So that right off the bat is how you can help your bottom line, whether you're in profitable or losing positions. No matter what, you do have a cost of transactions, which is very slight and small with eOption. Options help you to diversify your portfolio because you can trade a much broader range of stocks with your allocated capital, especially with the technology stocks right now that are just on a crazy run when you look at markets like Tesla and stuff like that. And we're going to get into these examples, and you'll see how options can actually benefit you as a trader and also as an investor, using derivatives such as options to give yourself more of an opportunity to take advantage of market movements. Options allows the smaller to larger investors the ability to capitalize on these trendy markets that are highly liquid, okay, which also helps out in whenever it comes to trading. You always want to trade a highly liquid market. This is a very important cost control because if a market is illiquid, you typically have high spreads getting in and out with typical options. In the major markets, the spreads are very, very tight, so you don't have to worry about any real slippage from the getting in and out. You're not giving up much of an edge from the entering and exiting of your transactions. So trading in these products is similar to trading in normal equities, but with higher potential ROI and controlled risk, so that you have a higher return on your investment potential, and you also have much more controlled risk. So now with that, let's jump into what we're going to focus on today. So long puts and long calls, very simple. You will be buying, the puts or the calls. The one thing that's nice about this kind of strategy Besides, it's a very beginner strategy. It's also used by advanced traders as well. The nice thing is there's no margin. So right off the bat, you don't have to worry about that. Your risk is defined. Your risk can only be what it costs for the price of the option and also your commission. So it would be that price plus 10 cents if you were using e-option per option. Then there's also simple execution, getting long and puts and calls. Very liquid in all your major stocks. So it's not a hard thing to execute. So right off the bat, those things give you an edge in the right direction, especially when because it helps to keep your losses from being exacerbated, and it also keeps your winners from being less than what you deserve. So the volatility, direction, and cost, the commission spread, are the key variables, and that's once again helps is why the simple execution, since we have such high liquidity, we don't have to worry about that. Now, obviously, if you're trading a number like when earnings come out or some major economic number, at that time when the market starts to go haywire, you're probably going to have a little bit more of a liquid spread than you would have during the normal trading day, even if the market's in play. So that is something you do need to take into account. Nothing is steady 100% of the time. Those would be the only times you probably really have to worry about it the most. So that would be right around the opening and closing of the markets during the trading day, and then also, like I said, major economic numbers. So with that, let's get to our first example. Why we would get into our first stock example. So long stock and short stock. If you are long, you are a buyer of stock. Okay. If you're short stock, you would be a seller. Okay. So this would be the equity way of trading a call or a put. Okay. So the difference though here is that if you're long the stock, meaning a buyer of stock, versus buying an option, your capital outlay can be very high. And through our examples, you're going to see the difference between some stocks versus some very expensive stocks or high volatile stocks. Then here's the thing is, if you are long the stock, you do have the potential for dividends. That's a plus. That's the only one thing that if you buy the stock versus any of these other things we talk about, you would have the potential for that. The one thing though is it ties up capital and limits diversification. Your risk is capped by your capital outlay and also your potential for margin. Now, here's the thing is for short, if you were to sell short the market, the equities, you have your margin capital is very high and must be maintained. You will not have dividends like as if you purchased the stock. It ties up capital and limits your diversification as well, and your risk is unlimited. Not so good for anybody. So now options, long puts or long calls. This is the reason why we picked this strategy. It has a high potential ROI, which is a good thing. It has limited risk, which is a good thing. Flexible medium, meaning liquidity, which is a good thing. And potential rise in volatility, which is good. Because when you are buying options, the one thing that does always go against you is time decay. But if volatility goes down, that also hurts you as far as the price of the option. But then if you have the volatility goes up, it helps you as far as the value. So when you purchase it, if volatility goes up, it helps to maintain the price of that option. And we'll talk about that as we get into it. The negatives of these scenarios, though, is the time decay, the potential drop in volatility, and the fact that there's no dividends on this one either. So, like once again, only if you were to buy the stocks would you get dividends. Now, the negative is that the potential drop in volatility would, just like time decay, would erode the pricing of the option that you had purchased. Because remember, you're purchasing these trades. So our first example is going to be old big blue, IBM. So we looked when we started to figure out what we would do this, the topic for this webinar would be. We picked the date, and then I figured, all right, well, let's start with that, and we'll look at the options that go out. So this is from a couple of weeks ago. IBM had settled at $123.31. So at that time, before the market closed or the next following day, the trade would be, if you were bullish, you would be buying the 125 strike call, or you would be buying the 125 strike put, conversely, if you were bearish. So that's that green line there that represents the strike price that we're talking about. So remember, if you are bullish, you would be buying the call. If you be bearish, you would be buying the put. Now, interestingly enough, when I pulled up this chart, the 2008 high, I went back to look and see how IBM has fared. You know, obviously it hasn't been doing well during the pandemic, let alone over the past couple of years. It's been trending lower. It's been kind of basing, I guess, for the last 2 years with some extreme volatility, obviously over the past few months. Now, the one thing that we look at here for the strike price for the 125 is how much does it cost for these options. So if you can see right where I have the expiration, it's the October 16th, 2020 option expiration. The 125 call is was priced at 395, and the 125 put was priced at 545. Now, if you notice these blue lines here, 128.95 is your upper break-even price for where the market needs to get above or be above at expiration for you to be in a profit should you buy the call, okay, the 125 strike price call. Conversely, if you were a bear and you bought the 125 put at that time, you would need to have the market down at 119.55 for the option value to be at break even or plus. So let's go to the next slide and give you an idea of what this all means. So if you were to have bought the stock at the time of that when we did the slide, the 100 shares at $123.31 would cost you $12,331. So that's just for one block of shares. Now, the nice thing about IBM is that it's not quite the glamorous stock that you hear of in the news every day, but believe it or not, it still has value and it's a big company and it's still out there. The nice thing is that because of that, the volatility typically is not running at the levels like the stocks, say, such as Tesla or Facebook or, you know, Google and things like that, or Apple. So let's say you look at the buy the call 125 strike. Okay, that was $395. So that cost equals $395. Now look at that. To control 100 shares of IBM for the 30 to 45 days that you would have on that option from the time that that was set, for less than you know, a third of a cost of the stock position, you could put on the option. You could buy the call, the 125 strike price. That's if you were bullish. Now the break-even price would be $128.95, and at that point, the call would still be worth at least what you paid for it or more, depending on how much time was left and the volatility at the time. Especially if volatility was rising and IBM, let's say, for instance, shot up to 140. Obviously, if that happened, you would be up all the money from the 125 strike price all the way up to, say, 140 minus the cost of the option, which would be that first $395. On the opposite end of this trade would be the put, which would be the 125 strike price put that was valued at $545. So that would mean that the cost would be $545. Remember that the multiples for option pricing for equities is times 100. So if it was $1, it was actually being $100. So now your break even on this trade would be if IBM was to break down to 119.55 or lower. So if you were bearish, you would be buying that put, and if you were bullish, you would be buying that call. Now think about the ROI on that. Now if you bought the stock, and well, then you have to be right for sure on the long side, because otherwise you're going to be at a loss as the market goes down. Now, granted, you can hold the stock for a long time, but then who knows how long, you know, how much further it may break. You know, if you were bearish this stock, you know, but not overly bearish, it might just hang, you know, for a little bit, if, you know, so then you get a little trade there. And if you were bullish and it only broke a little bit, it could just hang for a little bit, and you may have time, maybe collect some dividends, but you may not, but your capital will still be lower than when you got into the trade. If you were wrong and you bought the call, all you're going to lose is $395. Now, I don't know about you, granted that you only have a month and a half for the option, but you could do that multiple times over the course of the year. And for 10% of the cost of buying the stock, you could always be long at the money call. Eventually, you're going to probably see some movement, I would think, over a 12-month period. So would it work every time you try to put an option on? No. I mean, usually if you're going to be long or short the market, you should have a reason to have a buy signal or a sell signal. So this webinar is not going to be concerned with why you would buy or sell it. It's just a matter of what would happen. And now the same thing is also on the opposite side. Like if you didn't want to buy the stock, well, shorting the stock definitely has a big cost to itself. And then your risk is unlimited there as well. Now with buying the put, you would be able to play the bearish role on that trade right there at $1.20 to 125 and see what happens over the course of the 30 to 45 days. And if you get your market movement, then it would be, you obviously are right on the sell side, which would be a good thing. And it would also be much cheaper than doing the short. So just to let you know how things worked out, IBM as of yesterday, the 125 call was priced at 139, so that's obviously a loser. The 125 put was priced at 633. Remember, it was priced at 545 back when when the first slide was made a couple of weeks ago. So that being said, the market yesterday when it closed was at $1.2051. So it was just about $1 above the break-even price for the put. So even though now see there's time left in this trade, this is the new pricing is 9/22. It still has almost a full month left. So you have, besides the volatility pricing in, you have the timing pricing in. So that's why this option is it's already worth more than what you paid for it, and hasn't broken below there. But the thing though is, if the market stays where it's at right now, the time value will start to erode, and because it's above the break-even point, this put will eventually become worth less than when you first purchased it. So that's something you have to be mindful of. That you still have to get the directional move. That's what the whole point of putting on this trade is. It's a way of being short without the risk of shorting the stock. So now let's move over to our next example. We have Coca-Cola. So in this example, we use the $50 strike price. The blue lines indicate once again the pricing for the upside and downside. So the 51.22 up here above the 50, that would be for your call, which is $1.22. So that's where your pricing is. For your put, it's $2.06. So that would put us down to $47.94. So these are levels that you have to breach to for the long and the short side for the option at expiration to be worth a profit. So now let's look at Coca-Cola. If you were to buy the stock, the 100 shares at $49.53, it would have cost you just under $5,000. Now, if you buy the call for a $50 strike price, the price was only $1.22. That's very, very cheap. So that's for $122. You get to control 100 shares of Coca-Cola for up to 45 days. Now, the break-even point on that, like I said, was 51.22. Granted, this stock doesn't move like Tesla and all these other ones. However, it does move. It does move up. It moves down. So let's say you did have a reason to buy Coca-Cola, whether it's in front of earnings, you're positive you've got a really good hunch they're going to beat expectations, or just you have a buy signal for whatever indicators you use. Like for instance, let's say you had a high probable Japanese candlestick pattern, like one from my book, that was a buy signal for Coca-Cola. Then you would put on a call, and let's say that was the $50 strike price. So all you had to do was have the market go from the 49.53 where you started to above 51.22, and you are in the money. Now, if you were bullish the stock, think about that. $122 was the cost to put on a position that would be just under 5,000. Like your return on investment, which is your return, how much capital it takes versus your investment to give you your yield. This is where you make your money. Not only is your risk reduced, one, what your risk is always because you're purchasing the option, remember, but it's much more reduced. Now, granted, risk brings on more reward. However, you're still controlling. The thing is, you got to remember, you're always only controlling 100 shares per option. So you got to figure out what's the value you know, in those options, you know. And the same thing is with the puts. So let's say you had a sell signal for Coca-Cola. You're looking for a $2, $1.50 move. You're not looking for big moves here. But the thing is, you don't need a big move for you to make a profit. And that's the whole thing, is when it comes to trading and it comes to using options in a way of like this, where you're trading directionally, the whole point is to make money, you know. So now if you were to buy the put and the call, that's a straddle. That's a totally different strategy. That's a totally different way. We did a webinar that actually discussed that a little bit. Look at the past webinars on eoption.com and you can find that out. But that's not what we're talking about today. Today, we're talking about whether you are a bull or a bear. So we're not giving you a reason to buy it right now, no signals, but if you are watching this webinar, we're showing you the difference on what you would do and how much you would cost. So your ROI, once again, with something that's a steady company like Coca-Cola, has really good potential here for the investor and the trader. Now let's look at the U-All. We all know that besides all the other airlines, United Airlines is no different than any other ones. It's gotten beat up really hard this year. A lot of volatility, and who knows what's going to happen over the next 6 months. Maybe the holidays start to bring people traveling, and then who knows, maybe we don't. But so we don't need to know whether it does or not. We don't have a crystal ball, and it doesn't matter. But look at this. It's kind of funny. The low for United Airlines in 2008 was $2.80. So it's kind of, we dipped down below $20 earlier this year, and now this market settled right around $36 when I did this example. So I picked the $35 strike. At that point, for the October 16th option expiration, the $35 call was $4.75. The $35 put was $3.65. Someone here was saying how to calculate the break-even formula. Is there a formula? Yeah, you can. I'm going to explain that to you right now in this example. So your break-even is always going to be the price of your option away from your strike. Like, what do you have to make? So, for instance, in this situation with the call, if you bought the $35 call, the price would have to be $4.75 away. So that would put it at $39.75. So at expiration, if the option was at that price or higher, that's the price, the value that you would have for that call. So that's how you figure your break even. It's very easy to do. Now, granted, since if let's say the market right now is trading at $40 and it was above the $39.75 threshold, it would be worth more than what you paid for it, obviously, because you have time still left. There's volatility priced into the option as well, because there's time left. So then it wouldn't have more value than it does, obviously, when it started off. But at the end, to make sure that you break even at expiration, the market needs to be at least that distance away. And conversely for the put, so this is $3.65. The $35 put, you subtract that puts it at $31.35. If the market is below that, the put value will exceed the price you paid for it, and you would be profitable in that trade. Remember that right now, we're not saying you should be bullish or you should be bearish. We're just showing if you were bullish, what you could expect, where are your thresholds for break even, and how much market movement you need. Now, the funny thing is, on any given year, you might be like, well, I may not be expecting that much movement in United Airlines, maybe a couple bucks a month on average or whatever, maybe $5 range, $10 range for the whole month, especially if there was a lot of news. But look at what we've had this year. I mean, it was up just shy of $100. It fell off its high in at the end of 2019, just below $100, and fell below 20 just a few months ago. So the odds of it moving more than a couple bucks right now are pretty decent. So giving that, these trades like right here, this is where you get a big bang for your buck. So think about this. I think we answered that question. So let's move on to why the U-All example is a good example of why you trade options. So in this example, the price of 100 shares is only $36. Remember, it was at almost $100 less than a year ago. So the cost to buy 100 shares of U-All is actually not that expensive anymore. It's $3,600. Of course, remember 12 years ago, the low in 2008, and that wasn't a pandemic low. The price of the stock was at $2.80. I don't know, maybe UL is expensive, maybe it's cheap. But if you were to buy the 100 shares, $3,600 would be your risk that you would have. Now, if you bought the call, if you were bullish, United Airlines thinking that, hey, you know what, pandemic aside, traveling is going to start to come back a little bit. People are going to start to move for the holidays and get things moving. And, so who knows, whatever or you maybe have a buy signal. So the $35 strike would cost $475, which means that total cost would be $475 for one option that controls 100 shares of stock. And the break-even price would be that $39.75. So you don't need a big move considering the volatility that there's been in the UL market this year. It's very likely that at least if you were to stay rolling a strike price for a few months, that you would see a movement of more than $3, I would think, especially when you have an over $80 range so far this year. Now, if you were bearish this stock, thinking that, hey, the airlines are in trouble, they're just not making any money, they're going to have to keep on laying off people, and even if they do that, it's not going to be enough to keep their books afloat. We could have a lot of bankruptcy possibilities propping up. So puts right now, and especially when you look at the pricing, because the call is more expensive than the put, if you use that rationale, this is pretty cheap, $365 with a break-even price of $31.35. So for the market to get below that, that's not that hard to do. So let's see, we have a question. Are the VIX and the VIXN volatility levels artificially kept lower by algorithms or formulas? Oh, wow, there's a webinar into itself. Are they artificially kept lower by the algorithms or the formulas? No, I think that what you get is a lag more than an artificial lowering. And that's a whole concept and topic for a whole nother webinar. So I don't want to drift too far off of the topic with right now of just directional trading. What I can tell you though is that the VIX, and even the VXN, the rising and lowering of them and the levels where they're at, definitely helps you when gauging your volatility for trades. So we can kind of incorporate the VIX, since you brought this in, and show you how this would be even come in with this trade. So here, let's look at Microsoft. Microsoft is one of those stocks like we mentioned earlier in the webinar, I said we would get to, and talk about volatility, right? I mean, just this year alone, it had its little swing in February and March, but boy, did it bounce. And of course, everyone's using technology. Everyone's working from home. The kids are at school is at home, blah, blah, blah. I don't have to tell you what you don't know. So the 2008 high for Microsoft was 37.50. That was right before the market tanked. And then now it has come not only back above it, it's accelerated to $200 above it. Now, the funny thing is back then, Microsoft just bobbled around $35 for years. It didn't go anywhere. I mean, they made their money off their operating system and blah, blah, blah. But as a whole, they don't have the footprint like they have now. They've definitely bought into a lot of things that have helped to accelerate their growth. How long can that be maintained? I don't know. So, but just to get into the VIX, because of this accelerated slope of this rally, the volatility index from if the volatility index is really high, that would coincide with this slope of this rally. As volatility drops in the VIX, you would be able to tell that, or assume that it's very likely that the volatility component of the option pricing will drop. Now, when you look at an option like Microsoft at these levels, unlike Coca-Cola or even IBM that was trading at $100 and something, it doesn't have the volatility pricing in. And volatility pricing, remember, these options that we're looking at right now are the same expiration date as the ones we looked at before. Now look at the price of the call and the put here. The 225 call and put, so this green line here is our strike price. The market closed at 225.53, so it's perfect. It's right in the middle. The pricing for these is very similar. So obviously the pricing, the call is very bullish with the slopes. The call is a little more expensive than the put, but they're $12.55 and $12. That's $1,200 per option plus just for 100 shares. Now, obviously, because of the $225 share price tag. It's $22,553 just to buy 100 shares. So the cost of that call, if you look at it on a relative basis, is still very similar to the pricing of what we saw in those other stocks. However, it's starting to get more expensive. So now if you want to get long Microsoft, and you think it's going to catch a ride, and now here's the thing is, you got to remember, you're buying the 225 strike price. Now you need to have a break even of 237.55 to the upside. So that's what kind of a rally you need. Now, the good thing is if the VIX is in a situation where it looks like it's rising, okay, that helps to keep the stock price, or your option price higher. So that's a good thing, especially as it approaches the break-even price point, or even if it doesn't go anywhere, if it's just staying sideways. So that's a thing that the VIX, if it's rising, can help you. Now, if it starts to go down, that's where it can hurt you, the pricing of your option, which means if the market really needs to get closer to your break-even price or get above it for you to get your money back and become profitable in your trade. The same is for the put, because this market was settling right at the same price as the strike price. Your put costs $12, so it's $1,200. Your break even would be a break below $213 for the stock price. Once again, now the thing is, think about this. If you were right on the put, thank God you didn't buy the stock, right? Because at those levels, that's a big deal. And now as far as the pricing with the call and the put, because they're basically the same, the cost there's no difference in whether you which one there is as far as how much of your return on your investment would be. But you can still see that you're looking at only a 5% of your initial outlay if you were to buy the stock. So 5% to put on a call position, buy the long call, or 5% to buy the long put. All right, so now let's get to Tesla, our big explosive stock of the decade. So when I put this slide presentation together, remember we're using the October 16th, 2020 option expirations for all these examples. So here you have the 490 call or the 490 put. Now, remember we started talking about the options. Initially, they were like $1, $2, $3. We mentioned they were like 100 and something to 300 something dollars. Here we're talking about Tesla. A 490 call costs $77.20. A 490 put costs $68.35. Now, remember, that is not $77 or $68. You have a multiple of 100. So to put on that Tesla stock, now this is great. Tesla just split in half, and still to buy 100 shares, it costs you almost $50,000. Look at that, $49,832. That's how much it costs to buy 100 shares. Wouldn't it be nice if you bought 100 shares a few years ago? Well, now you'd have 200 of them at that. So, which means you'd have almost $100,000. Anyhow, you can't do that. Can't go back to the past. But what you can do is see how much putting an option position would be. So if you're still bullish Tesla, and they just had the big battery announcement yesterday and whatever, you could have put on at this time when this slide was made, a cost of $77.20 would equal $7,720. Leaving you a break-even price of $567.20 to the upside. So now it's kind of funny. You would think that looking for a $60, almost $70 move within a period of 45 days in the stock, that's usually a lot to ask for or to even remotely think you could get. But when it comes to Tesla and the way it's been moving to the upside or the downside, if you had a buy signal and buying the call at that moment, that would be the call, your trade of the day, then that's what would cost. Now your risk, think about this, to the upside is only $7,720. Obviously, if the market goes down and continues to break, you would lose money, especially if you waited towards closer to expiration. So that's the risk you would have. But if the market goes down, I mean, obviously, if you're looking for a $60 move to the upside, it could easily have a $60 move to the downside. $60 move to the downside, well, that's the same. That's why you want to have a put on versus a call, obviously. But that's a big deal because of how much you would lose if you would just own the stock. So buying the call, definitely better than buying the stock, especially at those volatile levels. Obviously, you have you only have the time available for until expiration, but definitely for bang for your buck, for 5% of the position to catch that ride to the upside, I'd like the options even at those prices. Now remember, when the question about the VIX, if you have volatility rising, and especially this already would be a volatile stock, that's why the pricing of these options is very expensive. So you got to really know what you're doing, because even though you may think you're going to get the movement, you're going to need a lot. You're going to have to get it or more because of the pricing of your options. So that's why those other ones like Coca-Cola and IBM may not be sexy or in vogue, but you know what? If you can get your ROI and be consistent, that's what really matters. That's something to think about. But if you want to trade these high flying stocks, buy the put or the call, it's $6,000, $7,000 a position. That's all good too. Just to let you know where it went to, look at this on the day of the slide when we started it. Remember, it was $77.20 for the call. The new pricing as of yesterday was $28.89. So think about that. You lost, over $4,000 on the call if you were bullish Tesla at the time of when those options were priced out at. Now, if you were bearish and you had bought the 490 put, it was $68.35 when it started, and it's all the way up at $93.20 as of yesterday. So in that situation, you would be making over $2,000 off of the put position just in the past couple of weeks. So now when you think about it, the position cost around $7,000, you make $2,000, and you're looking at a good 25 to 30% return on your investment within just 2 weeks, without having to put up the whole $50,000 of buying the stock. So just something to think about. Once again, we have Dow. Now, unlike Tesla, it doesn't cost the same amount. It's not 35 times greater. So here we have an example again. We take the $45 call and the $45 put. Look at this pricing: $2.70, $2.35. Once again, the stock may not be as in vogue as others, but it is a very good price point. Dow, $4,500 to buy the 100 shares. Not a bad investment. It's a good company. Chemical companies, they're never going anywhere, that's for sure. The $45 strike price call, though, if you were to buy it, think about it, it's $270. That's it. I mean, that is amazing. For 5% of your investment to lay up to buy the stock, you could buy the call and trade and look for that break-even price of only $2.70, which would put you at $47.70 for this price for the break-even for the call. Or if you're bearish to the market because you think that there's going to be another second wave and the whole stock market as a whole is going to take a dip, the $45 strike price put at that point would have been $235 with a break-even of $42.65. All right, now we have Budweiser. Everyone's familiar with Budweiser. Kind of funny. You'd think that if anything, this would be really bouncing and rallying, but I guess it's not. It is going up and has been for the past couple of months. It has bounced since the big correction back in the beginning of the year from the coronavirus trade. So this market was at 58.15. When I pulled up the slide, we have the dotted line here once again as our option expiration. The $55 strike call and put. The call was $4.80. The put was $1.54. Main reason being is that the closing of the market was very close to the price of the put. So anyhow, that is, look at this, $480 or $154 for a stock that costs $5,800. Once again, this is where you make your money trading options. Your ROI, you're not having, you have defined risk. I mean, think about it. If you're thinking about trading Tesla or even Microsoft, not that I'm saying to discourage you from trading those options, but you can expand your portfolio and trade a basket of options companies that are very liquid, which gets back to our price point issue. And $5,800, good investment, good dividend paying stock, obviously beaten up right now. So the $55 call would have been $4.80, which is $480 with a break even of $59.80. And which was very close to where the market was at. And so if you were bullish, you would pop above that very quickly and give you a good chance to make a profit on that. The put, though, interesting enough, because the market's so far away from it, you really got a good value on it. So if you even do hit your price point, let alone get a significant slide below that, you would have a big value in the put. So that's sometimes like if you have a big sell signal and the market's rallying into it, this is where you can pick a strike where you can really gain your ROI. And this is something that you're not going to catch so much in some of your bigger high flying options. So in this case, if you were bearish, I'm not saying one way or the other that was the situation. We're looking at both sides and what you would get at, what you would realize for it. But your return on investment would be much better on the put in that situation. Now let's look at Allstate Corp. Insurance companies, do you think they've been getting hit? Let's see, what happens on expiration date if you don't sell beforehand? They expire worthless, or they're in the money, so it's a cash settlement. So, but usually you're going to get out beforehand, because if you've already made your money and you only have a little bit of time left towards expiration, why run the risk of all of a sudden losing on your position? So I would always say that you should try and look to liquidate a day or two in advance, maybe even a week sometimes, if you've already realized your profit and your target. Always have an objective too on your positions. That's a whole nother, obviously, thing when we maybe have a webinar where we actually define, like, certain buying and selling situations and how to define your risk with that and stuff like that. So anyhow, with the Allstate, we're going to do the 92.50 strike price call and put. The call is $2.55 and the put is $2. So for that, the break even, and for this would be $95.05 for the call, when the cost of that option would be $255. Now look at this, Allstate, $9,300 to buy 100 shares, but you can control 100, and this is the call or the put, because we're the 92.50 is right by the $93 closing price of the stock. For $255, which is really, really, really nothing. You're looking at, like, for 3% of your cost of controlling the stock to buy it, you can buy the options. I mean, at that pricing, you could roll it in every 45 days buying the calls, and that would be more effective, most likely, than buying the stock. You wouldn't get the dividends, though. That's the one thing you wouldn't get. And for the put price also, look at that. I mean, $200 versus, for where the stock value is at. This is a lot of bang for your buck for ROI. So you don't need to have a big move. Just think if you have a 10% move in Allstate, you don't need to have a major move, but a 10% move with trades where you're using literally 5 to 30% of your capital that you would use for buying the stock. So whether you're being long or short by buying the call or buying the put, your ability to capitalize and build your capital base is just, it multiplies exponentially. Now let's look at Apple once again. Here we go. Here, the 130 call was $8.80, and the 130 put was $9.80. Now, that's actually not too bad considering the high flyers that these stocks really are. So 129, $12,900 to control 100 shares of stock, only 880. This is, for 8%, you could control 100 shares, and this stock definitely moves, not quite as much as the other ones. But if you're going to look at the high flyers, this is still somewhat of a reasonable trade for their options. The same is for the put price too. Now this one would have a break even where the market had to go from, it was 129.04. It would need to rally to 138.80, or it would need to break down to 120.2. So this one, a little more expensive, not as good as some of those more or less in vogue stocks. So one last one before we get to the last couple of questions. Abbott Labs, The 110 call and put is what we found for this one. We made the slides. The break even is $114.45 or $1.520 to the downside. Once again, this is a position that would have cost $10,000 to put on, only $445 or $480 to put on for your call or your put spread if you were bullish or bearish. Once again, the break even, you're looking for just a $5 move basically in either direction. Not hard to get in this environment, especially when Abbott Labs is up for all the coronavirus testing. So real quick, do a couple plugs and then we'll answer a couple more questions. Yes, I wrote a book called High Probable Japanese Candlestick Patterns. And for all of you viewing today, for the next 5 days, you can get this book for free in Kindle version on Amazon.com. So if you're already a Kindle Prime or Amazon Kindle user, you just go on there and you can get the book. I think you get it for a week or 30 days for free, somewhere around that time frame. So for the next 5 days from today through the 27th, you can download that book. I'm in the Kindle version only. Paperback is purchase only. So remember to maximize your option trading potential and use e-option for your stock, ETF, and ETF option trading. Remember, they have the free option strategy tools like Options Play. They have the strategy guidebook also available on their website. You can set up a paper trading account. And then remember, ETF and stock trades are always free and option contract commissions are only 10 cents. So let's see, we got some more questions here. I do not understand why he is doing a straddle for all options. Okay, I'm not doing a straddle for all options. We were showing the difference of whether you put a call or a put on. It was not giving any, those were examples of the market was where it's at and then what would happen if you put on a call or a put. And we also showed whether you would have a stock position on too. So that's why you could see that if you wanted to be long, one way would be by buying the stock. Okay, so if you bought the stock, there was the price of what your capital outlay would be. And then if you bought a call instead of buying the stock, which would give you the same ability to control 100 shares, but only for 30 to 45 days, because there's obviously an expiration date. So if you wanted to buy instead of buying the equity, you would buy the option, and that was showing the pricing and how the return on investment and how you could also trade multiple stocks versus only investing in one. I mean, think about it. If you had just enough money to buy 100 shares of Tesla stock, okay, that's $50,000. You're done. Unless the market goes up, you're going to be losing money and waiting for it to come back or waiting to figure out when you're going to get out of the trade a loser. If you were to buy the option, the call, then you would have to much less of a capital outlay, and you would also lose less. And like, for instance, at the time of the slide, if you would have bought the call, you would have been a loser, just like if you would have bought the stock. However, if you would have been a bear and you bought the put, well, then you would be up money, So this webinar is not about directional trading. Yes, if you were to buy the put and the call at the same time, that would be a straddle. However, right now we were just looking at the ROI on using those directional trades. Whether you were long or short is up to you. We were just showing what would happen to you in those scenarios at that moment, one versus the other, and also showing the ROI. That's the main thing, is to show you how with options, unlike with equities, see, if you were to short the stock instead of buying the stock, then you'd have to put up all the margin money as well, and you'd have to maintain that margin money. So that's why a put is better than shorting stock, and it's definitely much less riskier than obviously than shorting the stock. Let's see, do you have the full cost of 100 shares of stock in your account before you make the trade? Well, no. If you have the ability to, depending on your account, most people have the ability to buy on margin already. So now I would always say that you have to be careful about buying on margin, because then that's being just like when you short stock, you have to maintain that margin. So yes, if you were to buy on margin, let's say Coca-Cola, let's say instead of buying just 100 shares, you could buy 200 shares if you would be able to buy at 50% margin. But the thing is, if the stock starts to go down, then you better have extra money in your account to cover it. Otherwise, they're going to liquidate your position because they have to satisfy the margin. So yes, you do in the examples that we use, because that was the whole point, was to eliminate margin. If you bring margin into the picture for the stocks, then for sure that would be a totally different comparison for the options trades. But then also that would make your long stock position much riskier than it would be normally, which would also make your long call position so much better of position. So yeah, so actually it's a good question you asked. So I hope that that's clear about whether you do or don't need to have the full cost for the 100 shares. So if you have a small account, odds are you probably have to have the full amount. You're not allowed very much margin room. So I don't know if there's any other questions. The reason I asked you to go buy a call, that's, we already answered that question. Expiration date, I think that's it for the question. So if there's, oh wait, let's see, one more coming up, I think. Just waiting for this to come up. Nope, I guess not. So I want to thank you guys once again for having me for the webinar today. And also remember that you can get the copy of High Probable Japanese Candlestick Patterns on Amazon.com for free on Kindle for the next few days. So with that being said, I want to thank you very much. You have a great day.
All right, great. Thanks, Teddy. Very much appreciated for you taking time and putting the webinar on today. It was a great educational hour here. So we just want to say, everybody, thanks for attending. We have more educational content on our website. Go to eoption.com under resources, and you'll find past webinars, trading videos, links to option strategies, and free option tools like our options play tool that's very useful. Also, like us on Facebook to get advance notice of other webinars, latest market news, and investing tips. We'll also have a video recording later this week of the webinar today, as well as our past ones. And don't forget to take advantage of our low rates, zero commission for stocks, ETFs, and 10 cents a contract for options. On behalf of eOption, thank you again for attending. Take care.
Hello, and welcome to joining eOption's webinar. We're excited to have you here, and thank you for taking the time out of your day to join us. We're excited to partner with Teddy Keckstead again, a professional trader with over 30 years of experience, to bring you this webinar today on Do You Think You're Priced Out of the Market? Think About Options. My name is Gina Bocayas, and I'm with eOption. And just to provide some basic logistical information on how this webinar will work today, the session today will last approximately 1 hour. Teddy's presentation is about 40 to 45 minutes, and then we'll take your questions at the end. You will see on your screen there's a Q&A box, so feel free at any time during the presentation to enter your questions in there, and Teddy will do his best to address all of them at the end of the presentation. You'll also see a chat box, but we ask that you put your questions in the Q&A box and not the chat box, as our speaker will not be able to see those in the chat box. And also, after today's session today, if you have any questions at all about the content or specific strategies, please feel free to call eOption's trade desk at any time, and our experienced professionals can assist you. And a popular question that's often asked is if there's a recording that will be available of this. And yes, we always put them on our website within a week after the session, and you can just go to eoption.com, and we do have a tab called Webinars and Videos that it will be directly there. So for those of you just joining, we'd like to welcome you to our webinar today on Do You Think You're Priced Out of the Market? Think About Options. And as eOption's name implies, we are a firm that specializes in option and stock trading. And we do charge some of the lowest option rates in the industry. Our options are just 10 cents a contract plus $1.99 per trade. And all stock and ETF trades are commission free. We also offer other products such as mutual funds, fixed income as well. So we also support option education, and we're glad you can join our webinar today to learn about using options to trade in this volatile environment that we're in. So now I'd like to turn our attention to our speaker, Teddy Keckstead. Teddy has over 30 years of experience in the financial industry, and has also worked as a professional trader. Some of you may recognize his name from past webinars he's done for eOption, and we're very excited to welcome him back today. And to tell you briefly about Teddy, he has over 30 years of trading and industry experience. He traded on the Chicago Board Options Exchange, the Chicago Mercantile Exchange, and the Chicago Board of Trade for 21 years. He's been an institutional market analyst for over 25 years, and he's currently president of Forex Trading Unlocked. He's also an author, and he's written a book called High Probable Japanese Candlestick Patterns. And he also has a degree in finance from DePaul University. So without further ado, I'll turn it over to Teddy Keckstad, and we'll get started. Thank you.
Thank you very much for that introduction, Gina, and thank you, eOption, for sponsoring this webinar today. And let me just get this slide going. Here we go. So do you think you are priced out of the market? Think about options. So we're going to skip past my little documentary since Gina already did it. So we're going to first show up our disclaimer to remind you that this webinar is for illustrative and educational purposes only. So please take a moment to just read this real quickly and just look it over. And there's information if you have any other further questions on it as well. And then I always have mine from Forex Trading Unlocked as well, but I can just briefly skim over that because we already had the other one. So maximize your option trading potential. Use eOption for your stock, ETF, and options trading. You have the ability to get a free option strategy tools from their website, like their Options Play. You also have their free option strategy guidebook, which is also available at eoption.com. And you also can start your own paper trading account also to test your option strategy off of eoption.com's website as well. So one thing you want to remember is the ETF and stock trades are commission free, and options, which we are going to talk about today, their contract commissions are only 10 cents per contract. So we are going to talk about what you will learn today. So we're going to talk about how to trade the big stocks without large capital allocations. I'm sure a lot of the names that we're going to mention today are very familiar to all of you. Even if you're not familiar with options trading, I'm sure that you are very familiar with these names, these equities that these options are going to be based off of. So one thing you can do with options is you expand your portfolio diversification, which is something everyone wants to do as they begin to grow their portfolios, no matter at what level you are at, whether you're beginning or even advanced. So then we have, we also are going to talk about how to maximize your potential returns with options. So you can have, with options, they are a mechanism for the markets in which you can maximize your return on your investment. And we're going to discuss that as we go through the examples today. And then we have this simple option strategy, trading strategies that can increase your odds of success and protect your trades. And so that's what we're going to talk about as we get into these strategies. They can be used for both bearish and bullish, and also there are ways you can apply these when you are in a neutral outlook also, and before you put them on. So how eOption can help improve your bottom line also is obviously something we're going to show you, because since they have such very low commissions for your options trading, that right off the bat is one way to help you with that. So why stock option strategies? Well, the first thing is you lower your cost basis. At eOption, it is only 10 cents a contract, much lower than other firms. Option spreads help you diversify your portfolio because you can trade a much broader range of stocks with your allocated capital. As we get into some of these names and you see how much these stocks cost, it'll become very clear to you how options all of a sudden make these stocks something that you can participate in a different fashion. So option spreads allow smaller to larger investors the ability to capitalize on trending markets that are highly liquid. In both the stock and option pricing, the spread is typically very tight, and this is a very important cost control. Why is it an important cost control? It gets back to how do we increase your bottom line. The more liquid the market, the higher the spreads. That means that as you're getting in and out of your options contracts, that your pricing is going to be better for you. When your pricing is better, that means that your profitability is better. It also means that in the event that you lose, which losing is something that does happen, you don't lose as much. So that's something that you want to always take into consideration as, like, when we go over these strategies, the reasons we're looking at these particular examples isn't to promote these particular equities. They just happen to be highly liquid stocks, and they also have very highly liquid option markets. And once again, this is a way of controlling a cost. And when you can control a cost, that's something that's very important in trading, especially with options, because it's one of the few things that you have the ability to control, where you have the ability of whether it's going to be a good outcome or a bad outcome. So we're going to discuss that more with our examples. So trading in these products is similar to trading in normal equities, but with a higher potential ROI. So you will definitely see that in very simple math as we get into this. Today's focus, straddles and strangles. These are very, very simplistic option strategies, and we are going to give you a breakdown on how they first work, and then we're going to show you through some examples very simply how you can apply them and how you can expand your portfolio by using these strategies. So first of all, one of the main things is there's no margin. That is a big deal. So when it comes to option strategies and option spreads, there are some that will require margin. Margin means that you have to have more capital. The more capital you use, obviously, the less you can do, depending on what markets you're trading and how volatile things are. And especially right now, we have a very, very high volatile market. The VIX is something that is an indicator of market volatility. It's been very high for months for multiple reasons, especially we know from the geopolitical global impacts of the COVID-19 pandemic and things like that, how it's had the ripple effects. So defined risk, that's another reason why we're talking about straddles and strangles today. So besides the no margin, defined risk, this is something that's very, very big. Remember what I was mentioning in the last slide about controls? This is something else where you have the control. So outside of that, things start to get a little more sketchy because none of us can control the market. But if you can control your costs, if you can control how you get in and out of your trades, which is also part of controlling your costs, and then if you can define your risk, locking in what your potential loss is, or your capital that you're allocating for a potential risk reward, that is something that is huge. So these are variables that are all in your control. And they're also simple execution. That's the next stage. That's another reason why we like straddles and strangles. Very simply executed. And then also it's a volatility play. And this is where right now we're in a volatile market. And this is something where you can take advantage of it because volatility plays can go for you and they can go against you. And we're going to show you how these can work for you and actually how you use the current volatility with these strategies because it actually fits the current market environment. So with that, we're going to start to look at something visual that you're going to have more something where your eyes will be like, okay, what are we looking at here? So Boeing Company, BA. Boeing is a company that is, if it's not on the radio, it's on the news, it's in the TV or somewhere every single day, it seems like, from the MAX Jet 737, right? And as you can see, besides the fact of the volatility that every market has seen over the current past 4 or 5 months, Boeing has not been any different. Now, when we started this, the idea for this webinar, now we're at the end of July, I picked the Friday, the July 10th, just to be our marker for the options. So all the examples we're going to use today are based off of August options, which usually when you want to put on a spread like this, you want to have 30 to 45 days out minimal. And pretty much that's a good range for most straddle and strangle plays. If you want to go out for much longer months, that would be a more advanced lesson. So, but for when you're considering the volatility, when we started this marker here on July 10th, it was a perfect time because we'd seen such extremes, but the market had started to consolidate. And ironically, as you can see this gray line here that separates this whole middle of the chart, there's an arrow. It says piercing line buy signal. This is actually a Japanese candlestick pattern that is a reversal signal. So let's just say that whether you're bullish or not, because of the high volatility and expecting higher volatility at this point, this would be why we would put on a straddle or a strangle. So now the definition of a straddle is when you are buying and both a put and a call at the same strike price. Okay, so in our example here, you see we have our straddle. It equals buy the 180 call and buy the 180 put. So when our example here with this little black arrow here on July 10th, the market was trading right around $179.96, so just below $180. So 180 is a strike price for the options, okay, just like 175 is also. So there's the options are priced out in strikes of $5 increments, okay? So now when you do a straddle, what you're doing is you're trading both of the same strike price. You're buying both the call and the put once again. It's the same strike. Now, at the moment of this slide, when we first came up with this webinar, the market was trading just below 180. So the straddle would be the 180 call and the 180 future. Now, if you were to buy the stock, you would be paying just below $180 a share. Okay, so for 100 shares, and we'll get into the example, that would be our baseline for what we're looking at. Now, for a strangle is very, very similar. However, the strangle uses two option strike prices. So in this example, we would be using the 180 call, which is the same as we used in the straddle. So 180, in the straddle, we only use the 180 strike price. In the strangle, we use the 180 and the 175. And then so for when we buy the put, that's where we use the lower strike price. So your upper strike price is your call, and your lower strike price is your put when it comes to your strangle, okay? So just remember, a straddle is the same option, and a strangle is where you use two options, okay? So now at this point, for this example, the market's at basically 180. So what does that mean for this option spread? So when you buy a straddle or a strangle, you're looking for the market to move. Now you may be bullish, you may be bearish, or you may not have a clue about which way it's going to go, but you just expect volatility for one to increase and also for market movement to continue to increase. So now in this example, we have a potential buy signal with this one pattern. Now there could be other reasons why you would be bullish here, or maybe you would be bearish, because for either example, whether you're bullish or bearish, so let's say this buy signal is incorrect and it fails, well then it still works out for this trade. So for those of you that are following or didn't quite get that, yes. So in this example, let's say you had a buy signal, okay, and it fails. For both the straddle and the strangle, you would be able to profit off of that move no matter what, okay? So now if the market goes nowhere, that's where you would not make any money. And the reason you wouldn't be making money is there's multiple factors in option pricing. One is your time decay. So no matter what, over time, you would be losing money. Now, over a couple days, it's not very nominal. Over the course of a month, especially for options like these that are 30 to 45 days out, then you're using up a big part of your time premium. So you need market movement to absorb time premium no matter what. Otherwise, that part will start to decay. And especially since you're purchasing these options, you want to sell them for more than you purchased them. So in order to sell them for a profit, you need to have market movement that will erase your time decay. And then also you have your market volatility. So in this example, the reason we pick for this webinar is we're in a market where we have high volatility with expectations of even increasing uncertain volatility. And that's a reason why you would use straddles and strangles as an option play for this market environment. So not only is it strategically aligned for the conditions of the market, it also is a way of, if you remember from the beginning of the webinar when we explained how the strategy works, there's no margin. So you only have the cost of the spread to put up, and we're going to get into that right now. So now that we've covered Boeing, the stock, okay, so remember we said for 100 shares at 178.44 was the cost. So that would mean that if you wanted to buy 100 shares, so that would mean that you would have to be bullish. So whether you would like that buy signal from that piercing line, or if you had some other reason that you wanted to buy Boeing, maybe you think that their MAX jet that is going to finally work and I pass all the regulations and new tests and what have you, or for whatever reason. And so if you wanted to, it would cost you $17,844 just to buy 100 shares. That's one block. Now, that could be a lot of money to some. It may not be a lot to others, but no matter what, it's not a cheap stock. It definitely is $17,000, almost $18,000 to put the position on. Now, if you buy the straddle, remember that is where you buy both the call and the put. In this example, if you were to buy at that same time period on June 10th, the 180 call, it would have cost you $15.70. Now remember, when it comes to options pricing, it's a multiple of 100. So we'll break this down as we get to, through this straddle. So the 180 put equals 17.92 cents basically. So the cost to buy the straddle would be 33.625, which basically equates to $3,362.50. So that's how much it would cost to buy that one strike price at both the call and the put. Now remember, in this example, if you buy the stock, you have to be bullish, or why would you be doing it? Because if the stock doesn't move, then you're just sitting on $17,800, and hopefully they are paying a dividend, which I think actually their dividend may be, if it's not reduced, it may actually be suspended right now. So I don't think buying the stock, unless it does go up, that's the only way you can make money right now, especially in the current volatility and the market, the way the market is trading right now. Now, if you buy the straddle and the market goes up, well, then you would make money just like you would on the stock, except you didn't have to put out $17,000 to do it. So now as the market does go up, obviously you would be making money on your 180 call and you would be losing money on your 180 put. So that's where you need your market movement to continue to move enough to cover the cost of your option straddle, for what you paid for it at the time versus what the value is as the market moves. So now in this example also, we have the strangle. Now the strangle is just like the straddle, but remember you use two strike prices. You use a call and a put from different strikes. In this example, we would use the 180 call because that's just above the stock price. And that's the thing, is that when you do a straddle, you might be right at the stock price, or you might be just above or just below the stock price, because you're using only one strike. They're both going to be relative in that perspective. Now with a strangle, you can wrap around, and that's a way where you can remember strangles versus straddles. Okay, so a straddle, you can remember it's all the same strike price, and it can be either above, right at the stock price, or below it. Now with a strangle, typically your call is above your stock price and your put is below your strike price. So in this example, the market was trading at 178.44. So that is right in between the 180 strike price and the 175 strike price. Perfect for this example. Isn't that nice? So now in this case, the 180 call would be 15.7, $15.70. Or basically $157. And then we have also your 175 put at 15.175. So when you add those together, you have a cost of 30.875. So it's a little bit lower than the cost of a straddle. And now that the price for that one at this time would be $3,087.50. Now, obviously, there's the price of your option commission, but that's only 10 cents. So there would be 20 cents right there, or $1.90 minimum if it's for, I think, one spread. So anyhow, in this example with the strangle, it does cost a little bit less. And then the market movements, you still need to have the market movement, but not quite as extreme as you do with the straddle. Okay, but then also the thing is with the strangle, for instance, let's say in this example, you were bullish. So instead of buying the stock, now the 170, the 175 put that you're buying is further away from the stock price than the 180 call is. So in that regards, you can see that the put is a little bit less than what you're paying on the call. So in that regards, where the 180 call appreciates, let's say, in your straddle example, let's say the market rallies $10, just to make it easy for you to think about. If the market rallies $10 in the straddle, well, you still lose more money on the put in the straddle than you would on the strangle, because the strangle put costs less. This one costs 15.175 versus the 17.95. So let's go into another example to make this start to look more easy. We'll go through keep each stock, and you'll see. In this case, Bank of America, once again, we have on the date of this July 10th, which all these examples are, we have a bullish engulfing line buy signal. Does that mean that we're bullish? No, we're not saying that Bank of America is a buy here by any means. But for this example, you could either say that, yes, this is a bullish time for to get long Bank of America stock, or it would be time to put on a straddle or a strangle. One, because in this example, in all these examples that we're getting to, there's been so much volatility that even if volatility was to drop off a little bit, implied volatility most likely isn't going to work against you too badly. And because markets typically don't just stop and flatline, odds are that you would still have, even if volatility starts to drop, market movement would continue, meaning you'd either have either an extension of a trend or a corrective move going the opposite way of whichever market had been trending. In this case, the market had been trending lower radically for a month. And that's the thing, is you got to look at the bell curve of the ranges. These stocks typically only trade, like this one, in $1-2 moves and ranges typically on any given weekly period or even multi-week period. In this example, you can see that from the middle of May, the market went from $20 a share for Bank of America, or just above that, to $29 a share, to, in this example, where it had bottomed back to almost $22.50, and then here it's at 24. So this is all over the place. So there's definitely market movement, and that's what you want for straddles and strangles. You don't care which way the market goes. So this buy signal here, let's say you were bullish here and it fails. Who cares if it fails, as long as it continues to move and the trend continues? So the only thing here is we have different strike prices. This example is going to be a little bit easier for you to see, I think, than the last one. So this one, we have the market was at just around 24.14. We have the 24 strike price, and we have the 23 strike price. So for the straddle, once again, straddles are the same strike price for both the call and the put. You would be buying the 24 call and the 24 put, and then you would be buying the 23 strike and for the strangle trade. Okay, so for this one, you would be using the 23 and the 24 for the strangle, and only the 24 strike price for the straddle. So in this example here, 100 shares cost you $24. This is not such a big trade. This is not a big investment to buy 100 shares, $2,400. To buy the straddle, it's only 310. See, look at how this is. Where before we were talking about 17, this is only 1.515 for the call, 1.59 for a put for the straddle. That equals 3.105. You multiply times 100 for your pricing, and that equals $310. So for you to control the straddle on this stock, that's not very much at all. Think about that. So for your lesser, smaller capitalized traders and options traders, you may not be priced in for the first example, but now all of a sudden for this example, you have the ability to, where maybe you could invest the stock if you were bullish, but you're like, hey, I don't know if in this market environment, if I really want to wait, maybe there's going to be another big dip in the economy, another shutdown, who knows? And that's where these straddle and strangles come on. We've been living in 2020 where you can't figure vacation 2 months from now, let alone try and figure out market direction in many cases. So this is something where we know the markets are moving, so we can take advantage of that, because that's what these spreads do. So in this case, the strangle here would only be $263. So that would be a cost, you think about this, you're looking at 10% of that cost of what it would cost to buy the stock. You can control the movement going in either direction, okay? So now, here's United Airlines. I don't know about you, but I had one of my vacations canceled this year and been trying to plan another one, and it hasn't been that easy, although I have to say some of the deals to fly around the country are good. Of course, mine were to go out of the country, and those dreams are kiboshed. So for this one, though, United Airlines, you can capitalize on this. So the straddle at this time of this webinar was at 33, was our strike price for the straddle, and we used the 33 and 32 strike prices for our strangle. And why is that? Because the market was trading at the time of this example in between these two strike prices. Now, here's something I want you to look at too. All these examples I've been showing you, there's the middle gray line going through them. if you notice how just in a couple of days, the market moved significantly. And so the question is, how long do you hold these on for? So let's say United Airlines, let's say you were bullish this stock. You're going to put up your $3,200, okay, because remember, stock price is $32.67, so times 100. Or you could put on your straddle and strangle trade here. So remember, with the United Airlines, you're thinking, like, if you just think about what I just said, a lot of people are driving this year. Maybe not everyone's going to be flying across the country, you know, so, and we don't know when these bans are going to be lifted. So it's really hard to be a bull with the United Airlines. If anything, is you're looking to probably buy the dips, you know, maybe it's already in the already factored in, and maybe the low, the best low for you all is already in place for a long time. You know, hopefully it is, as far as for the market's concerned, but we don't know, and we don't care when it comes to these straddles and strangles strategies. So once again, look at this. For $3,200, you can control a stock to be long, most likely not get a dividend, or it's a decreasing dividend, and have the risk of downside risk for quite a bit. Or you could put on the straddle and strangle for a relatively cost-effective pricing and expect the market movement. So now we have Microsoft, another high flyer. At the time of this slide, the market had just made a recent higher move high and was just floating right below it. So the 215 strike price is our single strike price for our straddle, where you buy both the call and the put for the 215 strike. And the straddle, or strangle, excuse me, is the 210 strangle, where the market is trading in between that. And you can see that from the day of when these pricing would have gone off on, just a day after, 2 days later, the market traded, I mean, it was trading between 215 and 210, and then it had gotten just above $200. So it had a 5% move within just a couple days. So this is the thing where these trades, you may have them on for a few days, or you may have the ability to have them on for a few weeks to a month and a half. And that's just something you have to think about. Like, as we get into some of these stocks where they're trading on their highs and have been railing and railing and railing, well, no market goes in one direction. These are great ways to catch corrective moves where you wouldn't be able to do with if you were just long the stock. In this example, Microsoft, $213.67 for the per share. So that's $21,367 for 100 shares. The straddle you could buy for just over $2,000, and the strangle you could buy for just over $1,800. So you can see that you have the ability to participate in market movement in Microsoft, where if you only bought the stock or you didn't use the options, that's pretty much the only thing you could do is buy the stock, and either if you're buying in 100 lot increments or whatever you could afford. Versus with the options, you can utilize the market movement and the current market situations and capitalize on that. And the good thing with this is you don't even have to pick the direction. So all it has to do is move. Not that the markets can't ever flatline. They do, and sometimes they do get settled into range bound patterns. However, right now with the extreme volatility, you're not seeing so much of that. So now we're looking at Tesla. So everyone knows Tesla because they see the cars driving on the road. So this was a great stock to use for this webinar, because at the time of it, Tesla had been just screaming higher. I mean, it went from $1,000 to over almost $1,800 in the period of just over a week and a half. That's insane. It's just absolutely insane, the volatility of this stock. The option pricing on this is where things get expensive. Now think about this. The straddle for this, when I made this slide, would be, the straddle would be 1550. So you'd be buying the 1515 call and buying the 1550 put. The strangle would be the 1550 call and the 1540 put. So to put this into perspective, and think about this for all of you that you missed out buying Tesla for only $1,000 5 years ago, where you would have been able to buy a lot of shares. To buy 100 shares of Tesla at the time of this slide, it would cost you $154,465. I don't know about you, but to a lot of people, that's probably a lot of money. The straddles and the strangles is something that can help you participate in this market, but then even still, that's where you have some costs too, because volatility is so high in this market, and this is something that you have to think about. You don't want to buy straddles and strangles when markets are so overdone and over-exacerbated. The examples we showed you before, you had the potential with market movement to make money and you had time on your favor. But when you have volatility that is so extreme, and I mentioned, in the last slide, I said that Tesla had rallied from 1,000 to almost 1,800 in a week and a half. That's ridiculous. That is absolutely extreme for any stock, especially a major industrialized stock. So to put this into more perspective, think about this. Your return on these options, this slide was done on a Friday. When this was done, the stock was trading at 1544. The following day, the following Monday, the stock opened up over $100 higher. To give you an idea of the type of market movement straddles and strangles can make, especially when they kick, the 1550 call, if you can look at in the center here, I'm circling at the 1550. It was 213.25 for the puts, and it was 92. It was 205.65 for the calls. Now the difference of 1550, all you got to do is look at the negative and the positive. For the calls and the puts here, this was a minus 58.4. This was plus 92.8. This was an increase of over 25% on your option spread in the course of a weekend. That is an amazing return, basically overnight. Now, obviously for Tesla, you would have to have had a lot of capital up. So let's come back down to earth a little bit to something that, oh wait, this is another expensive stock. Not completely back down to earth. Amazon too, look at the volatility on this example. This example, the market was trading between 3,200 and 3,190. The market, Amazon traded to above 3,300 the following day and then settled lower, and then 2 days later was below 3,000. This is where it straddles and strangles, is where it can make you money. But when you're playing these big stocks, even these straddles, these spreads are expensive. So for here, the straddle would be, once again, the single strike price of 3,200, which would be the call and the put. And then we have for the strangle would be the 3,200 call and the 3,190 put. Now in this example, Amazon, and for 100 shares, it would cost $3,200. $3,200 a share, and that's $320,000 for just 100 shares. Very, very, very expensive. So this is even more expensive than Tesla, but Tesla's getting there. The straddles and strangles on this one, even though these numbers are big, $43,580 is nothing compared to laying out $320,000, right? So the funny thing is, think about this. If you put on the straddle that Friday when this slide was made, 43,580 gained over 25% within the course of, this would be on the close of Friday to the opening of Monday. That was just insane. And that's where, you know, you lose 2 days of time decay, but wow, when market volatility increases and you have that kind of market movement, that's when you see those kinds of return very quickly. And that's also when you would get out of those options. This is something you need to think about. These options, they cost a lot of money, whether they're this one or we have the examples where they're much, much cheaper. It doesn't matter what the cost is. Your profit is always relative. If you make a 20 to 25% return in a time period such as like these spreads have moved in the course of a few days, you get out of those spreads. If anything, you rotate into other ones, or you take your money and you run and you wait for another moment to put on new spreads. Reason being is there are variables that work against you. And when you have a high return in a short amount of time, that's the one time you can throw in a control on variables that you usually don't have the ability to. It's basically like if you're up at the tables in Vegas and you had a big run and you just got there, you stop right away. Most people won't do that. So that's the discipline you need to have, and it's rational expectations. If you made 25% on your money, whether it was $43,580 for the straddle or $42,000 for the strangle in this example, or if it was $400, why wouldn't you take your money and run? It just makes sense. So here we have Roku. Here's another example of a straddle and a strangle for you. This market had a nice run up since June. and is definitely one of those high-flying tech stocks that is in play right now. At the time of this example, the market was trading around $153 a share, and the strike prices that we're going to use for this example would be the 155 strike for the straddle, which is above that market price, and then also the 150.55 strikes for the strangle. So once again, you would buy and sell, or buy the put and the call at the 155 strike price for the straddle, and for the strangle you buy the 155 put call, and you'd buy the 150 put, and that's surrounding the strike price of the market. Remember, usually excuse me, you will have your stock price right in between those different options prices. Excuse me. So now let's look at the pricing on this. So coming back to earth here, $153 a share. Wow, it's much different than $3,000, right? It only cost you $15,300 to buy the stock, but the stock had a nice run up, and we have all kinds of uncertainty in the market environment. Unless you're looking for a super long-term investment, maybe buying the stock is not the way to go. Maybe buying the straddle or the strangle is the way to go. In this case, buying the 155 call and buying the 155 put, it would have cost you just over $3,500. To buy the strangle, it would have cost you just over $3,200. Now, the thing about this is to have a nice little movement, the stock, for it to move 5-10% when it's been moving 10% in swings over the course of just a few months, this is a situation where you're getting fine value. So even though these spreads are still expensive, it allows someone to participate in Roku and not having to worry about things that, remember, we're in a dividend cutting environment. Even if earnings are up, to maintain stock pricing up, it doesn't mean that dividends are going to be going up. And even if earnings are holding strong in many companies, they're not increasing their dividends. In fact, many of them are cutting them or putting them on hold. So dividends is something, buying stock is a different type of thing right now. You're not where you would be normally buying dividend stocks because of they pay dividends, and you want to do that in a harsh environment or an uncertain economic environment. All bets are off for this environment because we don't know how dividends are going to play into this, let alone if they're going to hold. So then buying is the only way to look at it. If you're just going to be long, that's one directional. If the market goes down, you're going to take heat, you're going to be down money, and you're going to have money sitting there that is not making you money. So the straddle and the strangle, once again, it gives you that opportunity in these more expensive stocks to be a participant in that market. So now then we have Facebook. So now this one here is, everyone is familiar with Facebook. For this one, we're going to use the 250 and the 245. Now for this one, we're using the 245 call and put for the straddle, and for the strangle, we're using the 250 and 245 strike price. In this example, to buy Facebook, 100 shares would cost you $24,500, a little over that. And for the straddle, you'd be able to get into it for $2,900, and for the strangle, $2,700. Once again, you look at the math on this one. Facebook, you hear everything from how their advertising revenue has been getting strangled because of certain regulations and things like that. You don't know if this is going to continue to be a high-flying tech stock, or is it going to get crushed because its earnings are going to fall apart. Then you have the whole thing with the election, which you can and can't run for ads, which goes into another thing. And when it comes to Facebook, everything they give away is for free for people to connect it, but they use it for marketing and for those ads, and that revenue is where they generate all of their money. And for that to be strangled, that doesn't make good for, even if the NASDAQ is going up, that doesn't mean that Facebook's going to continue to go up. So for this one, Facebook, exactly, straddle and strangle, talk about a great way to trade Facebook. Because if you're going to invest in it right now, being a bull, that's more of a long-term strategy that you're going to have to stick with, because, well, maybe it goes straight up from here. I don't know. But right now, there's variables that none of us can have any control over, and they're definitely going to be impacting the price of Facebook over the next 3 to 6 months. Knowing that even if market volatility drops, and Facebook volatility most likely is going to be up, straddles and strangles, once again, is another good way to go with this market and look at the cost. You're looking at less than or just over 10% of the cost of buying the shares And in this case, you don't care if if Facebook goes to the moon or if it pulls back 25%. You're just looking for some market movement. Same thing as with Apple here. Once again, with these other stocks where they have been very volatile, this market had been a bull, just trending higher, just like Tesla. Markets don't go in a straight line forever, and they don't keep going up forever. They definitely have corrections. So in this example, we would use the 380 call and put for our straddle, and we'd use the 385 call and the 380 put strike price for your strangle. For this example, you would be buying the stock at $383 a share. That's $38,368 per 100 shares. However, for the straddle and the strangle, your costs are much, much different. Once again, with this one, your cost would be $3,600, just under $3,700 for a straddle and $3,400 for a strangle. And for this market movement, think about this. Apple trading on its highs at the time of this thing. It could be going, obviously, continuing to go higher. Apple is another market, too, that has had some issues with some pricing, and they have some lawsuits they're dealing with. But as a most part, their company is doing well. But who knows how things are going to go with the China trade deal and how things hold up with that. So, I mean, is Apple overdone? I think it's always looking for a dip to buy. And Apple right now, you know, like I said, you don't want to be picking market direction. And with the high volatility, and if you see how the NASDAQ, you know, has given reasons for a corrective move back, what happens if profit taking comes in, you know, especially since we've gotten through quarterly numbers. Now it's time to, you know, take profits and then see where things go, which causes corrections. Now, not necessarily turning this market to a bear, but it means that straddles and strangles of volatility play is something that's ripe for action, and buying this versus buying the stock, which unless the stock goes up, you're going to take heat. So now let's look at Netflix. This is one of our last examples here. In this example here, you would be buying the and buying the 545 call and the 545 put, and for the strangle you'd be doing the 550 call and the 545 put. On this example, you can see that the market was trading in between those strikes, and then the following day it shot up over almost $30, and then came back to settle lower on the day. 2 days later, it's trading below $500. Netflix, in the period of just 2 days, you would have been able to capitalize on both these straddles and strangles. Now, the reality is you can see how much volatility is going on in the market when the cost of these options. Look at this. $54,873 would be the cost for 100 shares. Now, the straddle and the strangle, both here, the straddle is at $7,900, the strangle is at $7,600. That's very expensive. That's not quite 20%, but remember before, most of our spreads were around 10% of the cost of buying the stock. This is much higher. So that shows you how much volatility is in this and how much movement is expected. So no matter what, the price of these options may be expensive, but movement, when you have pricing like this, it's usually a time when markets do not flatline. So Netflix at the time of this was at 548, and just to give you an idea, today it was trading at 488 this morning when I looked at it. So that is a $60 move in the course of just a few weeks that you would have been able to capitalize on this Netflix. And had you bought this stock, which everyone's bullish Netflix, you would be down right now $60 a share, $6,000, which would have been almost as much as what it would have cost to put on a straddle or a strangle that right now you could get out of at a profit. Isn't that something? Is this starting to make sense? We're ending on a note where I hope that you see how straddles and strangles are something, how you can participate in high-flying markets, make a high return, and capitalize within both a short and a longer-term target. And you have the ability to trade multiple directions with no margin, knowing your defined risk, knowing your defined cost, and knowing that you don't have to be right on direction whatsoever. Because if you buy the stock and you're happy with Netflix right now, over the past 3 weeks, you would be saying, oh, I guess I should have waited 3 weeks, or I guess you can buy more and spend like, only 50 grand a share, or 40 some thousand, or $48,000 for a block of that. So with that, I hope you've enjoyed this webinar. We're going to answer some questions now. And if you have a chance to check out the book, High Probable Japanese Candlestick Patterns, that's the book that I'd written that Gina had spoken about. You can check it out on Amazon.com in paperback and Kindle version, and then you can see how those signals I talked about in a couple of those examples, how you would trade them. And also, before we get to the questions, remember you can maximize your option trading potential. Use eOption for your stock, ETF, and ETF option trading. Free option strategy tools like Options Play are available to you. Free option strategy guidebook available at eoption.com. Free paper trading account to test your strategies. ETF and stock trades are commission free, and option contract commissions are only 10 cents a contract at eOption. So, questions about the webinar, option strategies and applications, anybody? And remember to like eOption on Facebook to get advance notice of future webinars, latest marketing news, and investing tips. So let's see, on the Zoom thing right here, I don't see any. Let me see if there's any. Oh, here we go. Sorry, I had this out the wrong way. Oh, now all of a sudden I got the questions. Okay, here we go. Real quickly, we have from Ken. Ken, does the call have to be in the money? Remember, when it comes to the straddles and strangles, you need them to be, well, for the straddles, it's going to be same option price, and for the strangle, you're going to have one is going to be above the market and one is going to be below the market. Now, as far as in the money, remember, you're going to be trading 30 to 45 days out. So in the money, yes, you're going to have one that will be typically in the money. So that would be when you have your straddle, where you have the same option, it's the same strike price, one of the market, unless it is at the market, like for instance, for Tesla, or for example, let's say at $15.50 a share, if it's $15.50 and you're doing the $15.50 straddle, then you're buying the call and the put the same, so they're right there, they're at the money. But for when you're using certain straddles, then if the stock price is above, then obviously you're going to be in the money for your call, or vice versa for your put. So I hope that answers that question. Then we have for Godfrey, normal option, the closer you get to strike date, time kills value movement. Does this happen in straddles? Let's see, normal option, the closer you get to strike date, time kills your value movement. Does this happen in straddles and strangles? Yes, it does. But that is why, for all these examples, I said that you always trade for this exact kind of strategy 30 to 45 days out. So in that case, you do have time on your side. And think about that. This is a very good question that Godfrey asked. You know how I said, like, some of these, because the extreme market movers like Tesla and like Roku, or even the last one we did with Netflix, when you have a market that has been up and just appreciating, not just on a monthly basis, but on a daily basis, just so exuberantly, markets go out like they come in. You know, they don't just go in one way forever, you know. So, and that's where when you put these volatility plays on the straddle or strangle, for instance, where 3 days later the market moves so far that you can make 25 to 40% on your option. Think about this. In a 3 to 4 day time frame, if your options, if they were shorter term options, like Godfrey would be saying, like if you had only a week or two left, you would be losing money on time decay. But when they're 30 to 45 days out and you've only used up 2 or 3 days, your time variable is next to nothing. So especially if you have extreme market movement, your time decay is nominal. So that's nothing. So that's something where, yes, you do have an impact with that. And that's why you want to use the further out ones, because unless you have to wait for 4 to 5 weeks for that market movement to be achieved, in which case, if it does, then you'd still absorb that time decay from the market movement. So very good question by Godfrey. That's really good. And that also gets back to why I said earlier, if you make 25, especially at 40% in 2-3 days or over the weekend, get out, take your money, call it a day, and look for something another day. Not to be rhyming there. All right, and that's for Mr. Anonymous. Can you share an example of profit potential in a straddle or strangle? I think I did in the last couple examples, especially as I got to the Netflix example where the market had moved $60 in the course of, from time when I did the slide to today, which was the course of the 2.5 weeks. So I think that should have been covered there, because that way you could see how the only way, if you had bought the stock versus putting on the options, you would not have made any money whatsoever. And versus with the option strategies, with the straddle or strangle, you would have capitalized significantly on that trade. We got two last questions to go through and then we're done. In the first slide, there was a buy point. Is it arbitrary? No. Remember, for the straddles, they're the same strike price. You typically want to have it. Now, if you're in a bullish market and the market has been rallying and rallying and rallying, then you might want to have it if it's slightly above the stock price and you're heading up into it. That would be a good way to do it. Or you could even go to the lower strike price, thinking that if you're ready for a turn, like if you had a sell signal, or like in this example, I had two or three of them with buy signals. In that case, you would want to use the lower strike price for your straddle, because you're looking for a rally, so you'd want to see the biggest return on your call and you want to pay the least for your put. So that's why you'd want to use the lower one in a buy, and the conversely for the selling side. Let's see, Majo, please walk us through why our strangles are not even at price of stock and more directional. Let me see, please why your strangles are not even at price or stock and more directional. Why are they directional? Because they are directional spreads. You're not when you for the buy spread, that's why I use those. They weren't arbitrary when you were for the buying ones. Those were put because you want to have the stock price in between your strangles. And usually when I have that sets my my zone for what I would want to use for a straddle. So for a strangle, if I'm putting on a strangle and it's a buying situation, then where my call is at, that would be my strike price that I would use for straddles, and then strangles obviously surround the stock price. And conversely, for a sale, if I had a sell signal, I would use the lower strike price for my straddles, and then I would use a strangle in the opposite fashion. So with that, I think I can turn it over to Gina and Scott if he's there, because I think we're out of questions unless they have another one. Actually, sorry, I guess there is one. What is option website address? eoption.com. That would be your website address for to get this webinar and see the past ones and other information. And let's see, do you have a videos to learn how to use option software? That is also on the eoption.com website. And let's see, what's the web address? There you go. Okay, cool. I think everyone got those questions answered.
Okay, great. Well, thank you so much, Teddy, and thank you to everyone for attending the webinar and for all of your questions. And if you have additional questions, you can feel free to call eOptions Trade Desk at any time, and they'll be happy to answer your questions as well. Also, a recording of this webinar will be available on our website in the next week at eoption.com. And to all attendees of this webinar, we will send you an email with the recording as well, so you can view it at your convenience. And if everyone can mark their calendars for our next webinar, we are having, it's called Understanding the Greeks, Delta and Gamma, sponsored by the Option Industry Council. And we did have part 1 earlier this month. And so this will be part 2, getting into a few other Greeks, Delta and Gamma. So again, that's August 25th on a Tuesday at 1 p.m. Central Time. If you go to eoption.com, we do have a webinar and video tab, and you can sign up there. And if you missed part 1, it's not a prerequisite to attend part 2, but if you missed it, you can also go to our website and under eoption.com, and you will see a recording of part 1 there if you'd like to view that before the next webinar. And as Teddy mentioned, eoption.com is a plethora of information. We have lots of education on there. We have strategy links, so you can click on a straddle or a strangle, and it'll go into a chart, when to use it, the benefits, the market outlook. So that's a tremendous resource, and that's provided by the Option Industry Council. And we just recently updated all of that with them. Also on eoption.com, there are lots of instructional videos on various option strategies if you want to use covered calls or various spreads, or how to trade in a bearish market. And so there's lots of great information on there as well. Also, how to use our platform if you're new to eOption and you want to find out a little bit more about how to use it. We also do have free tools on there to help you set up your trade. As Teddy mentioned, we do have a wonderful tool called Options Play that scans through thousands of stocks every day and helps you set up the right option trade to meet your goals. And there is normally a fee for that, but that is free for all eOption accounts. And we get a lot of great feedback, and a lot of our customers do use that service. And we hope that you found this session informational, instructional today, and that you'll give us a try. And as Teddy mentioned, if you want to give straddles and strangles a try, our option trades are some of the lowest in the industry. It's just 10 cents a contract plus $1.99 per trade, where if you traded 10 contracts at eOption, that would just be $2.99 your commission, where a lot of the big competitors, that would be more than double for 10 contracts. And all stock and ETF trades are commission free. And as it says on the screen, remember to like eOption on Facebook. And if you want to get advance notice of more webinars like this, market news, investing tips, and we get a lot of great feedback. So we hope you'll connect with us on Facebook and stay in touch with us. So again, thank you again for attending. We greatly appreciate it. And thank you to our speaker, Teddy. And we hope to see you in a few weeks. Thank you. Bye now. Hello and welcome to eOptions webinar. And we're excited to have you here, and thank you for taking the time out of your day to join us. We're happy to partner with Teddy Keckstad, again, a professional trader with over 30 years of experience, to bring you this webinar on 10 ETFs every options trader should know. Some of you may be familiar with Teddy. He gave our last webinar about a month ago, and so we're excited to have him back. My name is Gina Bocayas, and I'm with eOption. And just to provide you with some logistical information on how this is going to work today, the webinar session will last approximately 1 hour. And if you have any questions during the webinar presentation, please feel free to type them into the question box at the bottom of your screen, and our speaker will answer those at the end of his presentation. You should see a little box at the bottom that says Q&A, and you can enter your questions, just type them in there. Also, you can reach eOptions Trade Desk at any time if you have any additional questions after the webinar. And if you go to eoption.com, you'll also find information on option strategies, where you can type in the strategy or click on it and it'll show you basic information, as well as you can see our other educational videos and other webinars we've done in the past. And so for those of you just joining, we'd like to welcome you to our webinar on 10 ETFs every option trader should know. And I'd like to turn our attention to our speaker now, Teddy Keckstad. Teddy has over 30 years of experience in the financial industry, and he has years of trading and industry experience. He traded on the Chicago Board Options Exchange, the Chicago Mercantile Exchange, and the Chicago Board of Trade for 21 years. And he's been an institutional market analyst for over 25 years. He currently serves as president of Forex Trading Unlocked Incorporated, and he also has a YouTube channel at Forex Trading Unlocked that you can also check out. He's the author of a book called High Probable Japanese Candlestick Patterns, and he has a degree in finance from DePaul University in Chicago. So without further ado, I'll turn it over to Teddy Keckstad, and we'll get started. Thank you.
Thank you, Gina, and thank you to the viewers for showing up for our webinar today, 10 ETFs every option trader should know. And I want to thank you very much for that great introduction. So since she gave the background for you guys, we can just skip past this slide right now. And real quickly, want to give you the eOptions disclaimer to remind you that this webinar is for educational and informational purposes only. And since every time I do something, I also have my disclaimer for my company as well, Forex Trading Unlocked. So let's get to what you guys are all here for today. First of all, you're going to learn how to maximize your option trading potential with ETFs and ETF options. So now how do you do that? Well, you use eOption for your ETF and ETF option trading right off the bat. There's a good start. One of the reasons why is you get free option strategy trading tools like Options Play that are available on their website. You have a free option strategy guidebook, which is available at eoption.com as well. So the strategy that we go over today and the ETFs that we go and the examples that go over today, you can actually run your own kind of examples and strategies through these things as well. You can sign up for a free paper trading account to test test your strategies like the ones that we're going to go over today, and you can see how these might work in the future on different ETFs that you may particularly desire on trading. And also there's another reason to go with e-option, because ETF and stock trades are commission free, and also their option contract commissions are only 10 cents per contract. So they are right there with all of the majors, and unlike some of the newer ones that you might think, oh, it's a cheaper and better deal, well, you get what you pay for, and you don't want to, you want to maybe have someone you can talk to, and you don't want a brokerage house that's going to go down either. So let's go into what you're going to learn on how to use these tools from e-option. Well, you're going to learn how to expand your opportunities in broader market sectors. For one, we're going to cover 10 ETFs today. And I think that you're going to really like how a couple of them we really bring in how you can really see how you can integrate ETFs and ETF options in a way that will give you a chance to participate in broad markets without having the risk of where you would if you use other different derivatives and things. So your expanded portfolio diversification is something also that you gain by using ETFs and ETF options. So you, instead of just having outright stocks or bonds or funds, you can actually, like I said, participate in different ETF sectors, and we'll cover them as we go along. So now here's another thing we're going to talk about is how to maximize your potential returns with options on ETFs. Okay, and then we're going to also use simple option trading strategies that can increase your odds of success and protect your trades. So this is what we're going to get into. I think it's something that you're going to find that's valuable, whether you're a new trader or new to options, or if you're an experienced veteran trader like myself. So bear, bull, or neutral outlook strategies. Well, there's all kinds of strategies, and we're going to show how the strategy that we're going to use is kind of like a little bit of all three put together. So how e-option can help improve your bottom line. Well, like we said through the last slide, as far as being commission free and very cost effective on option trading, now we're going to show you how to use their products and their platform to implement these trades. Okay, here we go. So why ETFs and ETF options? Well, first of all, you lower your cost basis. ETFs are commission free, and at e-option, it is only 10 cents per contract, much lower than other firms. Now, here's the thing you got to think about. Let's say that you want to participate in broad market sectors, and you want to, we're going to get into some some examples of where there's metals markets, interest rate markets, equity markets. If you want to trade derivatives like the S&P 500 index and the futures and futures options, you have to be, one, a very skilled trader, have a very good amount of capital behind you, and understand the risks. But with this, using ETFs and ETF options, you can do the same thing without taking on all the risk, let alone having all the margin issues as well. So ETFs help you diversify your portfolio because you can trade broad market sectors through one product and without the high risk of leveraged derivatives, like I was saying. So ETFs allow smaller to larger investors the ability to capitalize on trending markets that are highly liquid. So for instance, like the S&P has been all over the place because of the coronavirus fundamental trade that was on for a few months. And then also we've had recently because of other geopolitical things, especially political things within the United States that have caused a lot of instability and volatility. How do you capitalize on these things? Well, let me tell you, as an ex-S&P guy from the floor, you don't want to be trading the S&P futures or futures options unless you really know what you're doing. I like it, but I would suggest most people stay away and look at the spiders, which are in the QQQs, which we're going to get into. So in both the ETF and option pricing, the spread is typically very tight. This is another thing where you gain an edge. If you're trading the futures or those leveraged products, typically the spreads are not always as good as you would get in the ETF market. ETFs are very, very liquid. They're just like your heavily traded blue chip and other heavily traded NASDAQ stocks and Russell stocks and things like that. They fall into a classification where even on a slow day, you have liquidity, which means your bid offer spread is very, very tight. And a lot of times you're basically getting in at the market, like at the actual price point. There's not much of anything. You're right at the actual cash price, which is very significant when it comes to your cost basis for trading. When you think about the spread getting in and out of your trade, the wider that is, that means that you're giving up, and the more edge you give up getting in and out of your trade, that goes against your bottom line. So your winners are less and your losses are greater. So using ETFs and ETF options helps to control one variable that is something that definitely will be indicative of whether or not your bottom line is higher or lower. Not necessarily that your trading is going to be higher or lower, but at least that one variable will be. trading in these products is the same as trading in any normal equities. So for any of you that are used to just trading like IBM or Apple or, you know, Tesla or whatever stock you're talking about, and even starting to trade those options, ETFs are no different. It's kind of funny, like when you're new to trading, you start to hear about this market and that market, and like, oh, what does it mean? What does it matter? Like someone like me who's been trading for 30 years, I buy and sell numbers, so it doesn't matter if it's a futures contract and a stock price, stock market product, or an ETF or an option or whatever you want to call it. I just buy and sell numbers. But for now, you need to focus on what we're talking about, which is the ETF options markets. So trading these products is the same as trading in normal equities. Okay, so now 2 for the price of 1, the collar. This is the strategy that we're going to be using for this webinar. You own the ETF, okay? So we're going to go over 10 of the that are the top 20 ETFs that are traded. So these are all, like I said, highly liquid ETFs where you're going to have really, really good actionable trading results because of liquidity. So in this trade, you're going to buy a put at a strike price A, which is below the ETF price. And then you're going to also simultaneously sell a call at a strike price B above the ETF price. Now, this is because you are bullish to ETF, but you're starting to get a little bit nervous about the trend, especially over anyone that hasn't been in a coma for the last 4 months knows that 2020 is something where everyone's been nervous about every trend, no matter what market you're trading. But this is good for traders because we want opportunity. The only way you can have opportunity is if you have market movement and market volatility, which those are 2 things that we are not lacking right now. Time decay is neutral for the most part. The reason for this is, and we're not going to get too heavily into the Greeks because which are the different valuations on how you price out an option. But this strategy kind of is nice. Remember how when we started out, what are we going to learn today? How is this going to be a bullish, a bearish, and a neutral strategy? Well, the neutral part is that time is neutral for the most part. You're going to be buying one option and then you're selling one option. So where it fails, where time starts to decay on the option you bought and you're losing value, it's helping you in the option that you sold because it's losing value because of time decay as well. And then that also means you're being a plus side on that. Now, implied volatility is also fairly neutral because it does the same thing. So if implied volatility drops, meaning that whatever the ETF price was and options pricing was when you got into the trade, if the volatility goes down, the value of both those options are going to go down, but that neutralizes itself because the one you sold, you want that to happen. Obviously, the one you buy, not so, but they cancel each other out. So those are 2 things that you don't even have to worry about. Now, that's a very nice thing when you're putting on a trade. Now, the one thing we are going to have to look at for this trade is the options will be traded anywhere from 30 to 45 days out. This gives you pretty much the best pricing mechanism besides the fact that, remember, I mentioned about the spread. So getting into the spread for not just the ETFs, but the options, you'll get the best pricing, the best liquidity. And also, like, since time and implied volatility don't matter, the beginning part of the curve or the later part of the curve, these are all things that you would talk about if you're studying the Greeks on how to price out a trade. We don't have to worry about that. So we're making it very simple. So for all those of you who are wondering, is this a complicated trade? Absolutely not. Now, the funny thing is, it's actually 2 trades. When you sell a call, that's like you're doing a covered call position when you have a stock, okay? And if you're buying the put, well, that's the same thing as when you're covering a stock, as if you wanted to see if it's going to go down, and you want to hold the stock indefinitely or for a long period of time, but you're nervous about its short-term potential trend position, as far as whether you're going to continue to go higher or whether it's going to start to reverse gears and all of a sudden become a bear, and you don't want to give up your potential gains that you've already seen on your position. So now that we've explained everything, let's get into the first trade. So here we have the SPY. So what is the SPY? Well, this SPY Spider is the S&P 500 ETF Trust. So this is basically, when you talk about the S&P 500, this is what it is, except this is the ETF that goes on it. Now remember, there's the S&P 500 index, there's the that's the cash, okay? Then you have the futures and the futures options. Now this is the Spider is the for the SPY. is the ETF equivalent of the S&P 500. So when you hear the S&P 500 number on the radio or the news, and when they talk about the financial shows and the markets, the spider would be something that is basically the same thing as the S&P 500. Okay, so with this trade, here we are on June 8th when I made this video for this webinar. I looked at the pricing. And I figured, okay, we're going to take these 10 ETFs and how are we going to place these trades? So what are we going to look at? So here we have the market has been railing up into June 8th. As we know that while there's been all kinds of crazy volatility between the coronavirus fundamental and everything else, the stock market somehow bounced at the end of March and has continued to leg up higher, even though it has not made all new highs yet. So with this trade here, the market was trading at 321.19. So this is where the top is right here. And as you can see, this yellow line, this is the upward sloping support line that is maintaining the trend. Okay. So we have the SPY 325 call that costs $498. Okay, and then we have the SPY 315 put that costs $781. So our collar trade is we sell the 325 call at $498 and we buy the 315 put at $781. And the reason is because we are long this spider. We like the fact that we want to be long this, but we're getting kind of a little bit nervous about whether or not it's going to maintain this rally and stay bullish. Is it time for a correction? Well, corrections can happen at any time for one, but we have a lot of instability and reasons why, for instance, especially with the second potential wave for coronavirus and things like that are going on, at least if this, this was made a week ago. So this spread, if you put it on, would cost you $2.83. So it's basically, it's $283 because remember, it's a $100 multiple, just like with a regular option trade, whether it was for Apple or Tesla, it's a multiple of 100. So this would cost you $283 to protect this ETF position if you were long the ETF. Now, what does this mean? Why would you do this? Well, this, like I said, you are bullish, but you're wondering that you're looking for a correction. Now, what happens if the market does keep on rallying? Well, if the market rallies and because you sold the call, it gets exercised, well, you're making money on the ETF. So the only thing you lose technically would be your debit of 283. So we just have to look at it. If the market, as long as it gets above $325, which is your strike price of the call, plus your debit of 283, then you've locked in your return, and you already know that the only thing that you did was it did not make $283 out of the max of the move if the market should rally higher. Now, should the market go lower, here's what happens, okay? So our maximum potential profit equals the call strike price minus the ETF price minus the net debit. So that was, like I said, the 325. You got to add 283 to that because that's what you paid. That's what you forego. Okay, so that's where you get your loss in would be just that, or excuse me, you would restrict your potential gains by that 283, but you lock in where you're at. Okay, so you wouldn't be losing money on this. You're just capping your gains. Now, if your maximum potential win, it's totally different, okay? Because remember, you're selling the call and you're buying the put. So if the market was to fall below the 315 price here, that would mean that the call that you sold would be obviously a winner. Then the put that you bought would all of a sudden become a winner as well. Now you would be simultaneously losing money in the ETF. Now remember that this is a strategy where you want to stay long the ETF. What you're trying to do is lock in either a potential return or limit your potential losses in the short run while the market is correcting, not necessarily completely reversing trend. You never know whether the market's going to, which way it's really going. But for instance, in this situation, you're looking to cover yourself. Remember, this is two strategies in one. It's a covered call, just like you have a protective put going on. That's why it's called a collar. You got basically both sides covered on this trade. So our break-even price equals the current ETF price minus the debit paid, meaning that if the market stays where it's at by expiration and doesn't move at all, then whatever gains you're up in the ETF would be minus this debit here. That would be what you would be down in that instance. However, you would have been protected. Obviously, this market would have to go sideways for that to happen. However, you would have been still protected for the 45 days. Now, since I've given you this example, you're like, oh, this is all fine and dandy. Well, what does that really mean today? How does this translate? So we're going to give you the answer to that question right now. So the same example here, we have the spider, but we had this updated to today before this webinar came on this morning. I wanted to see what would be the pricing and how this trade would have evolved for you. And you can see why you put these trades on because of the scenarios like we said. Remember, you are long these ETFs because you like these markets, okay? So being long them, if you didn't hit a target that you want to execute your target price and get out, since you want to maintain your long position, you need to hedge yourself, at least when you know that there's most likely an increasing chance of a market move, whether it's either going to accelerate your trend, which will be in your favor, which is good for you. You can't lose that way. But if it does reverse gears, you want to at least keep some of the profits that you have realized and then for either reevaluate and get out later, or you can put on another option strategy and readjust then. So this particular example here, remember we had the spider 325 call was at $4, meaning 400. And then we have the, the spider 325 call is now at $4, meaning 400. And the spider 315 put is now at 1129. So that's 1,129. Big difference in price, okay? So remember, our original collar trade here was we sold the 325 call at $498. So that's basically just under $500. Then you buy the $315 strike price put for $7.81 or $781. The net debit, remember, was $2.93. Okay, well, here's what happens. Today's open, the collar trade, the 325 call was priced at $4, okay? Remember how I said that? And at $11.29 was the put price. So that means the value, if you were to execute this, would be $7.29. Well, if you sold it out and all of a sudden you have a realized profit of $7.29, that's because then you take out your debit of $293. That means you're basically have a $4.36 profit on this position. So your original ETF price was at $320.79 when I made this video or the slides for this video. And this morning, the market was at $313.45. So as you can see, this gray line here, this is June 9th, June 8th. This was when the first example was first made. The market has traded for the past week. And as you can see, remember that upward sloping support line? The market came through it. Now the market made a higher move low. So the market has been making higher move highs, higher move lows, and continuously, which is indicative of a bull market. However, we did take out this upward sloping support line from the main trend. This is the first bearish indication right here, meaning that you're set up not necessarily for a bearish slide, but for a neutral trade more likely than positive trade. Okay. And now here's the other thing that's interesting. We rallied over the past few sessions, and now here we're back just above this upward sloping line, but we're below our put price. So now we'll have to see, we still have, because it's only June 6th, 17th, these options expire on July 17th. They're still a whole month away. So if you liked this hedge before, you probably still like it now, because even though you're down on your ETF price, you're up on your options hedge. So you're doing exactly what you want, and you're still long the S&P 500, which ultimately is your goal. Now, should you decide to get out of the ETF and not put down a different options play or whatever, this is all stuff that it would obviously be your decisions for your reasonings and for whatever your goals and trading objectives are. But for this example, we're taking the assumption that you want to be long the S&P 500 indefinitely through the ETF, and you're trying to figure out how to weather the corrections without getting out, instead of trying to time the market. You know how a lot of people you hear on the major news financial shows, they say average person should not try to time the market. It's going to burn you every time. Well, this is a way of not timing the market by staying long the stock market, but then capitalizing off of short-term corrections. In this case, you would be making, you know, 400 over the course of the past week by holding the ETF and having put on this position, which would have cost you under $300, you would now be up over $400 on this hedge. So for the correction, you would be up that. Obviously, you would be down the difference on the ETF price, but that's you don't care about that because you want to stay long. You're just trying to limit your losses. And then remember, if the market is going to go back and makes new highs, then your ETF price goes higher, and then you also will be sorry about that, will also be up on that position as well. So whether you put another one on later at the end of the month, if at the end of July 17th is a whole nother topic of a conversation, and we can answer that question later if anybody wants to know that, because now it's time to move on to the next ETF. So now we're going to the QQQs. This is the NASDAQ, guys. This is one which is the high flyer with the tech stocks. If you want to participate in this market, like I said, instead of dealing with the futures, I would definitely look at these ETFs. So now this example, we have the QQQ 245 call, which costs $4.43. And the QQQ 235 put, which costs $6.52. Remember, for a collar trade, we are selling the call. So we would sell the 245 call for the price at $4.43 in this example, and buy the 325 put at $6.52 for a net debit of $2.209. So it'd be just over $200. Now, in this example, the market is trending higher, making higher move highs and higher move lows. Remember, your potential loss, once again, is your debit paid. It's your ETF price minus your debit paid. So if the market goes nowhere, the only loss you have is on the spread. You wouldn't have it on the ETF. If the ETF goes lower, obviously you would be making money on the spread. So in this case, you have the 245 strike price and the 235 strike price for your options, and the market is right in between these two. And remember, the maximum potential profit is if the ETF rallies above the call price, because then eventually you'd be exercised on your call, and you would lose your the difference you would lose would be the debit minus the ETF price once you're exercised out. So you still would be making money. You'd just be making a little bit less money than if you had not put on the collar trade and there is a big rally. However, if there's a break, then it's a totally different story. And remember, your break-even price would be if your current ETF price minus your debit paid. So that's where you're at with that. So you know your maximum risk on your hedge is $209, but you have a potential, remember, if the correction does come, to realize a nice little gain. So let's go to our next ETF, which is the GDX VanEck Vectors Gold Miners ETF. Now, this is a pretty interesting trade to look at here. When we made this slide, we looked at the calls and the puts, and I'm thinking, okay, well, you know that the call has to be above the market, the put has to be below the market. So ironically, the low from the prior session was right above this $31 put. So I used that as the base. So the put was $1.65 in price, and the GDX call was $1.35. Now, this is pretty interesting because the collar trade here, you sell the $34 call at $1.35, you buy the $31 put at $1.65, for a net debit of 30 cents. So we have a 30 cents debit. Can I put on mobile with a single click? I'll look at that question in a minute. So anyhow, this would be a net debit. It's next to nothing. It costs $30 to put on this hedge, which is kind of crazy when you think about it. But think about this. Gold is something that fluctuates in a big way. Now, when I was looking at it, I noticed, oh my gosh, while I'm looking at putting on a collar for the GDX ETF, look at what else is going on here. We have a head and shoulders pattern here. So for any one of you that is familiar with technical analysis, you can see how we have this initial bullish trend here with this upward sloping support line, this big yellow line, okay? And that's where the shoulder came up here, and we fell through this, which showed that the market wanted to go kind of neutral, and that's neutral to higher, neutral, and that's what a head and shoulders is. It's where the market starts to lose the velocity that it originally had, and even though it still is pressing through resistance and going a little higher, it's having trouble. So it looks like it's trying to consolidate and base, but it's still bullish. But then you're looking for the turn. So as you can see, here we have this head, and then we had this little break, break, and then we had this little shoulder. And I noticed here's this little neckline. So here's the day I'm looking at the trade, and I'm like, we already have a head and shoulders that's already formed. So this is the perfect time for a trade like this. So just in case you want to know, as far as where the market goes, this actually had gone flat. So basically, the market right now, the gold market, is basically trading sideways over the past week. So not much has happened. So this spread cost almost nothing to put on. You still have a month to go, and the market is basically right there. So in a position like this, you're still long your ETF. You have a month to go, where if there is an upside breakout, and think about this, the reason I'm explaining this to you is that this is a head and shoulders pattern. So this line that's coming across here, right around $32.59, this long blue line, which is right where the market was trading at when this example was made. Anything below here, below this put, that's all profit. So you'd be losing on your ETF, but you're definitely getting a short-term correction, but you're prepared for it because you have a head and shoulders pattern. And usually when you have a head and shoulders pattern, it results in pressuring support to some degree. Now, will it get the total maximum target? We're not even going to get into that. That's a whole nother lesson in itself, but this does have you in a bearish way. So remember, you like the ETF. Here's a situation where you have a head and shoulders pattern on. What a great time to put on a collar. So if you didn't like to put a collar on before for those other two examples, here's a reason where you're like, oh, you know what? Now I remember when Teddy showed an example of how the market was rallying, all of a sudden there's a head and shoulders pattern. What kind of a trade do I put on? Well, with this one, you don't have to get too complicated. You're pretty much looking for a bearish correction. You put on the collar, you're covered on both sides, and then if you get the break, you actually still get all the bang for your buck. You're still long your ETF, you make money on the hedge, and then you wait for the bounce, and then you're still long your ETF, and you figure out what you want to put on another options play or a different options play at that point. So that's why you use the collar. Remember, once again, the maximum potential loss and the maximum potential profit are the same. So now we're going to go to the EFA. So the EFA is the Russell 2000 ETF. So we've covered the QQQs, which is the NASDAQ. We've covered the spiders, which is the S&P 500. And now we're at the Russell, your middle of the road stock index, which covers a very broad base of stocks. So now for the EFA, we have the $66 call and the $62 put. So that means for the collar trade, you sell the $66 call and you buy the $62 put. This would be another instance where the market is slowly grinding higher. You're right in the middle of these two option spreads or these two option strike prices right here. And if the market does start to run out of gas, you know that you are protected and you know that you have the potential to still be long in this upward trending bull market. I mean, look at how we have this upward sloping yellow line right here. Here's the day that we put on the trade on June 8th. It goes all the way to July 17th. So we're still another month going on yet. Anytime that it falls below $62 and then starts to come north, if it does come down towards this upward sloping trend line like it did over here, if it holds and goes back up, well, that's an ideal scenario for you on your ETF, because that means you've gotten a little correction, a little digestion, and a chance at another bullish move higher. At the same token, if you have this trade on, if you put it on this date, as the market comes down to this point, you have the ability to capitalize on that hedge and take a profit on those options and then stay long your ETF. So how you manage it and stuff like that, and the timing, that all is indicative of other factors in your goals and whether you have target objectives and what your strategy is for being long the ETFs. But in this scenario, this is what you would do. Okay, now we're going to go to the HYG. Okay, HYG iShares Box High Yield Corporate Bond. Now this is something where now we're going to talk about the interest rate market. I started out trading sugar and the 30-year bond when I was a lot younger. It was the first two markets that I traded in the futures markets. And the interest rate markets I love because they're very tight. Typically, well, they used to be, especially some of your shorter term rates. Now, when you look at this, you're talking about corporate bonds. Now, we hear a lot about the Federal Reserve all the time once, they have the FOMC meetings periodically, and you're always hanging on the decision on whether they're going to touch interest rates. Now, recently, we know with what's going on in the current market conditions with the coronavirus fundamentals that have been going on and stuff like that, you can see that this corporate bond ETF has been rallying since the middle of March. Now, one of the reasons this has probably been is because interest rates were cut and the Fed has started to do its open market buying operations, propping up the federal bond market. Now, then there's the corporate bond market. So the Fed came out last week and said, hey, we're going to prop up. The irony of it all is I made this slide, and a couple of days later, the Fed comes out and says that they're going to start buying the corporate bond market. So that's good for those that are holding this ETF. If you were insecure about holding the ETF and you didn't know what option strategy to put on, you got some good news there. That's on so many levels, I think it's actually more of a problem than good news. In the short run, I think it's good news, but it does tell you when it comes to this kind of a hedge, what can you do? You know, so here we have the $83 put strike price and the $86 call strike price. So we have this upward sloping trend line. Remember here, you are bullish interest rates, you're bullish the interest rate pricing. Remember, when bond prices are going up, that means that interest rates are going down. So you're bearish on interest rates, meaning they're going lower, and you're bullish on the bond pricing. But since we're basically capped out at zero, how much more is there to go? Another reason why you want to have potentially a collar trade on or some other option spread to help you weather the storm as you are buffering up against a ceiling. I mean, no matter what, we could go, I guess you could go into negative territory. I mean, we have had synthetic negative interest rates, but I really highly doubt that the Fed is going to start to pay people to actually borrow money. It's not banks to borrow money, because then that's a whole nother issue on itself. But this is a good reason why we put on these collar trades. Okay, so this gives you another way to participate in the corporate bond market without the risk. When it comes to the corporate bonds, they're like evaluating stocks. You know, when you're looking at the indexes and the broad base market like this, you have the ability to absorb the sector. And the sector is always a good way of dealing with this instead of dealing with individual like bonds, I would say, especially now since interest rates are so low. Let me look at the questions we have. Why would you not exit at the bottom 4 days ago? Let's see, that was, why would you not exit at the bottom 4 days ago? Well, how do you know that was the bottom 4 days ago? That's the first thing. Never trying to pick a bottom or a top. The main thing is, when do you exit? You have to have your target parameters involved. So for instance, like when you have corrections, what are you looking for? And I'm actually going to get to an example really quickly, and that will probably answer as we move on that question. Let's see, another question. Should you be worried about the sell call being assigned if it goes above the call sell strike price? No, absolutely not. And remember that the reason that you're putting on this trade is you like the ETF. However, if the market rallies above the call strike price and you get exercised, that means that you're making money off of the rally. The only thing you're losing is the debit that you paid for your option. So you can always buy the ETF again. So it's like this. I always tell people, you don't want to let a winner turn into a loser. That's one of the reasons why you do strategies like this. Now, if you have an upside target price, which in this case you do, if a market rallies above your call price, you're making money. So you don't lose money by taking a profit, especially when you blow through your target. So in that case, it's, you could say, well, I am out of the market, but you can always get back in. And the thing is that if you've gotten out of the market and you made money on your trade, there's nothing to be disappointed in. It's like when you're when you're on the tee box of a par 3 and you hit the green and you still have a 25-yard or 25-foot putt. Well, how many people hit a hole in one on a par 3 consecutively? You know what I'm saying? So that's basically the same thing. It's like if you hit the green on the par 3, you're already there in par potential. Take your get it close, tap it in, and take your par. And be happy with being up a winner. Remember, pigs get fat and hogs get slaughtered. So you don't want to be a hog. You'd rather be a pig and eat nice and stay plump. So we'll get into the next example. I think it'll be a little bit more clear on this. So HYG, the high corporate bond ETF that we were just talking about. Look at what has happened since then. Since then, ironically, with the Fed not only buying the institutional debt market from the federal side and now saying it's going to back the corporate side, look at what's happened so far. This market, the day that we put on this first slide, was trading up near its highs. Now it has fallen below this upward sloping support line. So that's the first indication that we have a potential for a neutral to lower trade developing. It hasn't yet, because remember the high that we're coming off of and this low that was made a few sessions back here, this was a higher move low. Remember, when you have higher move highs and higher move lows, that's indicative of an uptrend. However, in the short term, this low, this higher move low, could potentially be the beginning of the new slide lower. Why? Because it took out this low back here. So we made a higher move low in the longer grand scheme of things, but we went lower than the last higher move low. And we are now no longer in this upward sloping support line here. So these are two neutral to bearish indications that there's a good chance that this market could go lower. Now remember, when you put this on, that you put this $86 call on, this $83 put, you sold the put, you bought the call for a net debit. Well, guess what? Right now, time has eroded. Remember, time doesn't really mean very much. Volatility doesn't move very much, but the market has traded lower. Now you're trading just above the strike price. So this is a situation where, and especially since we've just made this low the way we did it, if yesterday's trading, if this is the cap, if we don't get above 85.14 where the high was the day before this slide was first made, then what's going to happen here? We have the potential to take out these lows, and if we take out this 81.84 level here, you're looking for a nice corrective move lower, which means your collar trade would be good. So in this case, you're still long the high corporate bond ETF situation. You're very prepared with this collar trade right now, and you still have a month to go. And if the market does rally and all of a sudden finds a big gush of strength, well, then you get exercised on your call, you make money, and you just lose the difference of the debit. So you're still going to be positive on that scenario. Remember that when you blow through your call, you're making money no matter what. It's the downside that you're using this for, is to limit your downside exposure and limit your downside losses. So remember, if you get exercised once again on the call, it's a good thing. It's a good thing. Let's see. I did not see anywhere to select option strategy for trading. That's something you have to do on the eoption.com website, and I believe they have a support tab for that as well. So that would be in their strategy book line. So anyhow, that's the corporate bond ETF, the HYG. Now let's look at the XLF. This is the financial selector index. So this is a way of trading the financials, the bank stocks and the brokerage houses and stuff like that, in a way that instead of dealing with the individual ones, you deal with this one. And for this trade here, back in this, we did all these ETFs on the same date, on June 8th. This is one where you would have sold the XLF $28 call for 59 cents and bought the XLF $25 put for 63 cents for a net debit of 0.04. So you're looking at next to nothing to put this spread on. Now remember, when we were talking about maximizing your profits, and definitely by doing that by cutting your bottom line, because if you cut your bottom line, no matter what, you're either making your profits stronger or you're reducing your losses. So if you can put on a spread like this was on June 8th, it expires on July, and this one goes out to July 24th. You're looking at almost 2 months for this market to move away from the point where it was at on June 8th. Now, in this situation, obviously the market had been going higher. They're making higher move highs and higher move lows over the past couple of months. But remember, you're kind of shaky, the stock market and things like that, especially financials with what's going on. That's why you put on a trade like this. And think about that. For next to no cost, remember, it costs you only 10 cents an option. So you're talking about 20 cents for the option plus the 4 cents. I mean, you're looking at nothing to put on an options hedge where you have basically a covered call or a protective put, which equals a collar trade, all for next to zero, and you have almost 2 months in which you have the ability for the market, if it just moves $3, I mean, think about the day that I did this, the market was trading at $26.54. The day before that, it was at $25. So it was $1.50 move right there. And you're looking for this market just to move. It's in the middle of a $3 range. It's not that it couldn't stay sideways for the whole time. However, with the way the volatility is going here and the way the market's trending, I think you can see where I'm getting that. this was a layup trade. I mean, this is crazy. It costs nothing, just literally dollars to put on a trade that within any time the market moves $3, $4, it's great for you, either to the upside or to the downside. Now, silver, this is another great one example we're going to run through real quickly about how you can participate in broader markets and not take the risk. Remember, I told you futures and futures options are for experienced traders, people who are capitalized, and you definitely have to have a trading plan. You have technology. There's a whole, I could spend a whole day talking about what you need to have before you're ready to do that. But if you want to participate, for instance, in the silver market, here's a great way to do it. You have the SLV, Silver Trust iShares. Now, when I put this trade on, once again, all these were done at the same time. I've looked at these prices and I'm like, okay, well, we had the day of the trade, we had looked like we were coming off a new higher move low. So I marked the last low here at 1570 because there was a 1550 put. So I'm like, oh, this is great. We'll use that as our base because if we're looking for a protection, we wanted to capitalize off of the put as much as we can. So this was a 1550 put, and the SLV 1750 call was above our most recent higher move high. So when we did this trade, SLV, so we sold the SLV 1715 call, bought the SLV 1550 put for a net debit. Now here is what's interesting on what was going on. Why would we do that? Well, the silver had a good run up. They do it for the same reason as all the other ETFs. You're bullish the silver market or whatever the other ETF market it is, but you don't want to get out of it, so you have to put on a position. So when I did this, interesting enough, if you look at this gray line here, this is the date that I put on the silver position. If you go back to here, see how it is June 8th, this is the date. See how it's above that upward sloping yellow line, that support line? Well, on June 8th in the futures market, it was there the same. Now the futures market the chart looks a little bit more full. You would wonder why, but that's because there's a difference in volumes and also pricing a little bit. Remember, the cash market is one, the futures is always at a positive, it's either at a credit or a debit above that. So one thing that I noticed on this date was that we had just made this high here, made a higher move low, higher move high. But then this date here, I'm like, this is a higher move low. I'm like, okay, so this will be our baseline, $17.39. This is good. You know, this is what was going on in the silver chart back then. Well, now this is today, or actually as of yesterday, because out of rulings, you can't have live futures data. Everything has to be in delayed. So this was as of yesterday. So over the past couple days, it took out the neckline here, which is a head and shoulders here, which is a sell signal. So you got a shoulder here, a head, and a shoulder here. Then you have a bearish engulfing line sell signal. That's this big down day right here, which also ironically was the same time that it topped out here in the ETF. So on the day when I looked at the ETF thing, I'm like, okay, I looked at the silver. I'm like, okay, well, here's this, but there wasn't a head and shoulders yet. It was just a bearish engulfing line. Then I looked at it today and I'm like, oh my gosh, I haven't looked at silver since then. And it turned out to be a full-blown head and shoulders pattern, with this being the shoulder, and the past couple of days coming right down to this upward sloping support line holding up the silver market. So great time that if you're getting shaky being long the silver market, well, you have a head and shoulders sell pattern, plus you have the bearish engulfing line sell pattern. Not that these things mean that the market's going to go lower. However, if these things work, you have the market most likely heading down towards the 16 to 1550 area. You know, not necessarily bearish, but a bearish correction. And that's why you put on a trade like this. So ironically, we looked at the silver and look at where it is. Here it is, the day that we put on the trade initially. That day, the silver ended up railing for the next couple of days, set the shoulder, and then see, this is a head and shoulders as well. Came down, did the same thing, took out these upward took out the neckline from the head and shoulders sell signal, and then it took out this long-term upward sloping support line, and today still was below it. Remember, there's a discrepancy. Remember I said between the futures and the cash? The futures was still on that, above that line, but the cash, which is indicative of the ETF, was already below it and trading below it. So that means that the collar trade is a plus, and you have, for the same rationale, once again, being like, you want to be long silver, but you're looking for a short-term correction. There's a gap to be filled here on the ETF. It wouldn't, like I said, get down to, like, say 1550, even down to 1450, get a nice little bounce, stabilize, and then there you go. So that's how you can trade another big broad market sector without using expensive derivatives and risky derivatives. Now we have the Russell 2000 IWM ETF as well. Here's another example where at the same time period, we had the 160 call and the 150 put, which means a collar trade. You sell the IWM 160 call, you buy the IWM 150 put. You can see how this was in the same type of scenario. We marked a little last low, higher move low here as a support base and a target area. And this will be another market that has high liquidity, and it's a broad-based index that can help you participate and at a very low cost in these markets. Like I said, remember, if you trade the futures, you have to pay the commissions in and out on those things, but not on just the futures, but on the options. So you don't have to do that with ETFs. And also pricing. If you think that you're going to get as tight a spread in the futures market or even the Forex market or the futures options market, you will not get that like you will in the ETF and ETF options market. So where you may not get the full leverage capability, and you will not have the highest risk exposure, and your cost basis is also less. Remember, trading, you want to make money. Trading is a business. It is not gambling. Your whole point of investing in trading is to make money. So one thing you can always control is your costs. If you choose to pay high commissions, if you choose to pay high costs, you choose to raise your bottom line. That is a financial decision. However, if you choose to try and keep your costs down, which is a smart business decision, I think, and has been proven the test of time, then you want to cut your costs, which you can by trading ETFs for free, cut your costs by trading options for only 10 cents, and also cut your costs by having a tight spread getting in and out of these options. So here we have the S&P oil and gas market here. Now this is going to be one really good example as we wind down this webinar. So we have the $75 call and the $65 put. Look at how this market, remember how oil all of a sudden it came back off from March, exploding into June. All of a sudden we're paying higher prices. I mean, I paid $1.69 at the pump for a month and a half for unleaded, and now it's back up to $2.25. So this is where it was when I started this slide. Here's where the XOP was today. Look at this. The market tanked. So think about this. You would have sold your money. You would have made money on your $75 call, and also you bought the puts. So you're up money on that. So you're still in the ETF had you exercised this trade and put this on, and you would be already up a really nice amount of money, and you still have. Look at this, July 24th. See how we made this higher move high, and we recently made this low 2 sessions back. Now we're kind of bobbling around. If this is a lower move high from yesterday, and we take out this bottom right here, that we made a couple sessions ago, that would mean that we do what? We made a high, we made a low, we made a lower move high, and then a lower move low. Very bearish, which would help to accelerate this the pricing on your collar. So remember, you got over a month to go. So time's not an issue, but pricing is. The lower it goes, the more you'll make on that hedge before it eventually bounces again. So, and now we're gonna look at the EEM, which is also a July 24th expiration heading out there. Now this is the EEM is the iShares MCI emerging markets. So if you want to participate in your emerging markets, this would be the ETF to do it in. Now here, when we did this example, we found the 42.50 and 39.50. The market was right in the middle of this $3 range. So that's why we took this one, because the pricing came off of this last little low here, and it gave us the ability that if we come through this put price, we could come down this upward sloping support line, which would still would keep us in a bullish trend, meaning that we still want to be long the EEM ETF, but we would be profiting off of the collar trade, especially setting this up. So why switch from July 17th to July 24th? That was because of, for that particular ETF, because of the liquidity, because you could go out that far, and the pricing, it was worth it. That's why I looked at the July 17th. And there's some where you got to realize that they don't have all the same expiration dates. That's another thing that you need to take into account. The main thing is you want to be 30 to 45 days out. That was a way of stretching the longer out option for that example. Now, I want to say thank you very much. We're going to get into some more questions real quick, but I just want to give you one little plug for me. If you want to see more videos that I do, you can check us out on YouTube at Forex Trading Unlocked. Or if you want to learn how to exercise these high probable Japanese candlestick patterns, check out the book, High Probable Japanese Candlestick Patterns, available on Amazon.com in paperback and Kindle versions. And oh, I see the edited probable didn't get caught there. That was corrected and then not saved properly. Oh well, so once again for E-option, maximize your option trading potential. Use E-options for your ETF and ETF options trading. Free option trading, free option strategy trading tools like Options Play are available on eoption.com website. The free option strategy guidebook is also available at eoption.com. ETF and stock trades are commission free, just like all the major other competition out there. And E-option also has option contract commissions that are only 10 cents a contract, which is bargain below. You're not going to find a better deal out there, folks. And remember, you also get what you pay for. You want to be with someone with a history. They've been around for a long time. They've been in all kinds of markets up and down and through all kinds of geopolitical things. And as we move forward in technology, you want to be with somebody who hasn't been around for only 3 years or 3 months or whatever, because you will find that you're not going to do well when the markets really start to decay. One more thing is, apologies if it is already explained. Why do you do collar trade? You sell call at a price. What happens if the stock goes up to the stock price? Once again, if the market goes through that call price, you are making money on your ETF, and where you will get exercised on your call, and you'll just lose your debit, which will be that minus where you get out of your ETF when you sell it out there. That'll be the only difference. So you'll give up a little bit of your potential profit if it goes through your call price. But the thing is, you are making money and you don't have to worry about when it goes to the downside. And the thing is that's the main thing, is that you want to stay long, and you're kind of shaky in terms of whether in the short run, whether you're going to see any real expected higher move highs. You're expecting the market to go sideways to lower, and that's why you put that on, because then when you do have a break, especially when we have right now where volatility is high, so where volatility doesn't affect your pricing for your trade, that's why I used the collar example. When volatility is high, like the VIX is high, this is a great reason to put those trades on, because odds are the market's going to move. And if you notice, most of those were only $3 wide, and those markets were trending in $5 moves. So the potential for you in that time frame to move $1.50 to $3 in either direction is high. So if it goes to the upside, you're making money, you're just not making as much. And if it goes to the downside, you're still long your ETF, and you can still make, and you're going to make a nice little bit of money on the side as well. So with that, we have questions about the ETFs and options. I think we're right at the time limit, and we don't have any more questions. So
Eddie, there were a few questions in the chat room I just wanted to throw out to you. Someone asked, is the data you use real time? Is there a delay, such as 20 minutes for bets?
Okay, for the data that I use for the webinar, obviously this is everything. This webinar is obviously in delay. Everything was already, made up before. But the data that I used, the pricing from the options, that was all live pricing from the SIBO. And then I also used the futures, obviously was delayed for the silver example, but for the ETFs, that was just a 15-minute delay on that. So, but I used the opening prices for today's numbers to see the differences because I started on June 8th was the original slides, and for those examples to see how the pricing and the markets moved to show how they would have reacted. That's why I use those.
Okay, great. No, thank you for the explanation. And we just got one more question. Sure. That someone had just missed part of the webinar. And yes, this is recorded, and we will post it to our website in a couple of days. So if you go to eoption.com, under resources, we have a webinars and videos tab. So you can click there. It will be there in a couple of days. We will also email it out to each person who attended this webinar in a couple of days, so you can review it at your leisure. And just to wrap it up, Teddy, thank you so much for an interesting and informative webinar. And hopefully
you're welcome.
Everyone who attended, we got a few more questions in, so
okay.
Maybe we'll just try to address those.
You want me to? I saw one here. Would the concept still work for stocks versus ETFs, or is it more favorable for? No, absolutely, it works for stocks, especially right now with the volatility. I mean, you look at a stock like, for instance, Tesla. You're long Tesla stock. You put on one of these positions. Now, I would suggest probably straddles or strangles more for a stock like Tesla, because I mean, every time Elon Musk says something on a video chat somewhere or something, the stock moves $10, right? You know, so that would probably be more of what I would suggest. But also with Tesla, especially with the market, if we get a big sell-off in the NASDAQ and things like that, Tesla is still going to probably take a hit for a little bit. So a collar would be a good example for a market like that, for a stock as well. But it depends. You know, for other stocks, I would say more of your bank stocks right now, your brokerage stocks, or you're probably even like your more tried and true stocks like Walgreens, Johnson & Johnson, the ones that will maybe have an initial sell-off should we have another second wave from the coronavirus and the market gets hit, because those will bounce back quick. So those are ones you probably want to hold. So the collar example would be good on that, because if it breaks, you're going to be hedged. You're going to have a little bit of juice while you're getting dividends too, you know, and then you are obviously either readjust different option strategies once you've had a correction, you know, so that's a totally different story, you know, and it's also about what your objectives are. You know, like I mentioned, you know, when I did these examples, it's under the premise that you're looking to hold these ETFs. Okay. You want to stay long these markets, but you are at least short-term neutral to bearish. But if the market rallies, you're willing to forego a little bit of profit because you don't want to lose what you've already gained for the most part, you know? So, I mean, if you're only giving up a couple % of what you've already gained and also have the potential to even increase your potential reward, then why wouldn't you do it, you know? So that's why you put these strategies on. So they do work in the stocks, to answer that question.
Okay, great. And then there was one more question. When you say long, do you mean owning the ETF?
Yes, that means you own the ETF for sure. So if you were shorting ETFs, it's a totally different topic. So, but this is what all these were under the premise that you want to participate in these broad-based market sectors. And while you've been long them, you've already been in a position, instead of just having a corrective stop in the market, which is one thing you would do. If you didn't have, for instance, if you didn't have a collar on or anything like this is something I have to say to all you viewers out there who catch this webinar. If you don't have a stop in your positions, you should. You definitely should. So, but that's why you use option strategies, so that you can take off the stop, don't worry about getting stopped out in the market, and take advantage of market swings. So it's a way of using the mechanism. Remember, there's all kinds of market mechanisms out there. Most people just choose not to use them. That's their choice.
Okay, great. Well, thank you so much, Teddy. We're going to wrap
You're
it up
welcome.
now. And thank you to everyone for attending this webinar and for taking the time out of your busy day. We really appreciate it. There were a few questions about entering option trades on our mobile app, as well as our trading platform, how you can easily enter spread trades. And so I would encourage you to give our trade desk a call and they can walk you through it. And you can either email them, or the phone number is 888-793-5333. Again, 888-793-5333. And that will give you an experienced trading professional who would be happy to walk you through it, how to do it. And so again, thank you. And we'll be having more webinars on option strategies in the future. And we'll send you details. You're on our list now. So we'll let you know, give you advance notice of that. And you can also go to our website at eoption.com under resources, and you'll see the webinar tab there. Like I said, you'll get the video recording later this week of this webinar, and you can also see our past webinars, and we also have other instructional videos on there. And we also have a lot on option strategies. So if you go to our website and you click on strategies, you can hit the collar button. It'll walk you through exactly how a collar works, how to enter it, the advantages, and so forth. So we do have a lot of great education on our website. So please feel free to check it out at eoption.com. So again, thank you everyone for attending. We greatly appreciate it. And we hope to see you at our next webinar in the near future. Thank you.